Let's figure out what is happening. Let's get into this market open, this Friday session, and show you what the numbers actually look like. I think at an index level, maybe not much in terms of the news flow story here. You're going to get a FTSE that is a little bit negative, but not by much. You're going to get a DAX, which maybe is SAP influence more than Volkswagen influence. We'll have to wait for the Germans to bring that market open to us. Now, elsewhere, I think you're going to see a fairly flat story developing. There's not an obvious kind of new narrative that I think European equity markets have got to price in after yesterday's session, which saw a lot of turbulence. The bond market is getting really interesting. We'll get the gilt open in just a moment, so we'll bring you that as well. But the IBEX is absolutely flat. The CAC's not really doing much. The FTSE, as expected, is down by 0.75%. We'll wait for the German market to open and see what happens with some of those big heavyweights in that market, Anna, in just a couple of minutes' time.
Yes, absolutely. So we don't have an opening price on the DAX, but we do have some companies over in Germany that are open. We'll get to that in a moment. Looking at the sector picture then, travel and leisure is up by 0.6%. So this is fairly mechanical these days, isn't it? The oil price drops a bit from that lofty level above $100 a barrel. We're at a 98 handle right now. And so we see a little bit of upside for some of those airlines that have been beaten up by a higher oil price. So Ryanair is moving higher, Lufthansa moving higher, and the like. Insurance also okay this morning. That is another sector that moves a little higher, not by a huge amount, but there is some resilience in there, along with real estate. We've seen M&A in that sector this week, which has sort of been offsetting perhaps some of the concerns around higher interest rates, because you would have thought that maybe the higher interest rate story has been weighing on the real estate sector. To the downside then, on the sectoral picture, we've got telecoms, actually the worst performing sector this morning, and that is to do with Nokia. So we had numbers out of Nokia yesterday, so we'll dig into that one a little bit, but that's been seen as something related to the AI story of late. Energy stocks also on the back foot. Again, that's fairly mechanical given the drop in oil prices that we're seeing this morning. We're down by 1.8% on Brent, and so we see some weakness coming through in some of those energy names. But the technology sector is really interesting, Guy, because it's not in itself moving very far as a whole, if you like. Yeah. But it is, where we have SAP to the upside, that is a substantial area of movement to the upside. And as you were mentioning, I was wondering, Bloomberg Intelligence was talking about how ASML might open at the start of trade on the back of the Intel numbers. Yeah. But that is an area of negativity, but only down by 0.7%. You know, it's a big weight.
The biggest points drop, though, yeah, in terms of Europe. That's adding the biggest downside on Europe at the moment. SAP is adding the biggest upside. So that points us in a positive story towards what is happening in Germany this morning. So SAP is having a good morning. It's actually up by nearly 4.25% now. But ASML is down by 0.8%. Oil stocks are lower. Nokia is down. It's quite a big kind of mix in terms of the stock stories that we're watching. But I think it's coming up now in terms of opening up as well. We'll get to that stock in just a moment. But we are seeing some fairly big moves.
Yeah, Volkswagen down by 2.5%.
That's better than we thought it could be. So when I first looked at the numbers this morning, when they started coming through after the numbers dropped, there was talk of kind of 3.5%, 4% on the downside. So that looks like it could be worse in terms of what we're seeing in Wolfsburg this morning. Let's just see if I can get kind of how it's trading on a tick by tick basis.
Because some of the line that stood out, and it was the red headline earlier on this morning, 6:30 UK time, was around their full year revenue guidance, and it does look quite bleak, doesn't it? When you take it down from you previously were at 0 to 3% growth on full year revenue guidance, and you take it down to a range of -3 to 0. 0. That's quite, if you take the extremes of that, that's quite a hefty downgrade. So maybe down 1.9% in that context is, as you say, not that bad.
Yeah, I think it probably is. It's going to be interesting to see what they do there. What do they need to do now for the rest of the year to try and even stay within that range? I think is going to be an interesting point.
And how much comes down to China? Because that does seem to be the area of weakness coming out in their report. Local manufacturers taking up so much of the demand story there. How much are the German car manufacturers struggling up against those domestic Chinese manufacturers right now? We talk about that a lot in the European context, about how much they compete here in Europe. We don't talk about it so much in China, but that is clearly an area of big competition for these German car manufacturers.
At what point do the Germans just go, we've had enough? We're going to protect this market now, and you are not coming in. Are they willing to sacrifice access to the Chinese market to maintain kind of some degree of protection in the European market as we can increasingly kind of look for localized markets? I think it's going to be a really interesting question.
And just another of the challenges that this company faces after software delays, cost issues, plenty of other challenges that the company has.
So Oliver Crook has been speaking to the Volkswagen CEO, started by asking him a question about the fact they've cut the full-year revenue target, but not the margin target. So how are they going to maintain that margin target? Let's find out.
In the second quarter, the trend from the first quarter continued. Yeah, we make progress on various fields. We brought new cars to the customer, specifically an exciting new electric urban car family. We make also progress on cost and productivity, and this is also reflected in our cash flow. But you're right, the situation in the industry is weighing on our margin, and in the long term, 3.8% or 4% after adjustment is clearly not enough. If you talk about the year 2026, we kept our guidance outlook because we have some tailwind in the second quarter, specifically product momentum at Audi. Audi expects some very exciting new models in the second half of the year, and we also expect some tailwind on the continuous cost work we implemented 2 years ago. We started 2 years ago, and based on these factors, we keep our outlook.
Yeah, and so we've talked about cost for a very long time, Arno, over the last couple of years. And here in your earnings statement, in the quote that they have of yours, the currently planned initiatives, you say, are not sufficient. One of the big initiatives that there is a lot of discussion about at Volkswagen are the question of job cuts, are the question of potentially factory closures. Will you be able to reach the targets on costs? Will you be able to do what's necessary on costs without cutting jobs, without closing factories?
Well, let me elaborate a little bit on the situation where we are. There are a lot of figures out there. Look, we decided on a first restructuring package, I would say, 2024, late 2024, which incurs about a job reduction of 50,000 in Germany, which includes like taking out capacity of about 1 million and a contribution on the wage side. But since then, the situation has completely changed. Tariffs were introduced, which burdens us by 4 to 5 billion. We see much more intense competition in China, and Chinese competitors are exporting not only cars, but also competitive pressure to Europe. In this situation, we need to step up our efforts and do more fundamental restructuring, and this is what we are talking about in the transformation program. We have some elements on the cost side and on the customer side, and this package should enable us to move into the future with strengths and with confidence.
But I want to get a little bit more into that question of job cuts. I know that there are currently very sensitive and very complicated conversations happening with the unions, but are we reaching a point now where there's a more serious conversation that Volkswagen needs to have, one that sounds something like the future of this company, the existence of the company, is dependent on being able to get those cuts through? Is that the message to the unions?
We have great products, but the costs are too high, as I just mentioned. And we have various elements of these costs. First and foremost, we still have an overhead cost gap to competition in the magnitude of about 30%. And closing this overhead cost until 2030 closing this overhead cost gap until 2030 would mean lowering the overhead cost by 10 to 11 billion. This is one element. And another element is productivity and competitiveness of our plants. We have to increase efficiency in the plants, but we still have overcapacity, and it's very hard to face competition with underutilized plants. So this is the second element of the program. There's a broad understanding in the company that we have to address these topics in order to move successfully into the future.
CFO of Volkswagen, Ola Antlitz, speaking there to our Chief Europe correspondent, Oliver Crook, who joins us now. Ollie, you kind of posed the question, how existential is the threat at the moment? The Chinese car market is brutal, and cost competition is rigorous. And he's talking about a 30% overhead gap that exists at the moment. This is a company that has to make some radical changes. How existential is the crisis?
I mean, I think we're getting to a point where you can't really talk around it anymore, and I think that is increasingly the feeling over at Volkswagen. I mean, I remember talking to them, I don't remember what it was, maybe a year, maybe 2 years ago, when they had their first sort of cost drive. They talked about the cost cuts that they had to do, and I asked them then, I'm like, listen, does this go far enough? Because it does not feel like it does. The problem is in Germany that there's so much power within the unions. There is a stake of the company that is also held by the state of Lower Saxony, so they have a huge influence on the board. Obviously, the government does not have any incentive of allowing sort of jobs to be cut. So this is just one of the many ways in which Volkswagen's hands are really fundamentally tied. But Guy, if you just do a quick analysis of the three main regions for Volkswagen, there is a very negative story to tell in basically every single one. On the United States, there's obviously the tariff issue that adds all these kinds of costs. They need to rethink their whole strategy. That has been the big story for the year and a half. In Europe, it's all about the Chinese competition within the European market. And you saw it in the car sales figures represented that we had yesterday, and we had a story out in the month of June that effectively of the plug-in hybrids that were sold in Europe in June, a third of them were dominated by the Chinese automakers. And that's bearing in mind that these Chinese automakers are still paying tariffs to bring their car into the European tariff zone. In the next few months, in the next few years, there will no longer be any tariffs on these Chinese vehicles because they will produce them locally, and that, of course, will bring the price down even more radically. Then you look at the Chinese markets. I mean, the deliveries in the second quarter in China for Volkswagen down 37%. If you lose a third of your market, consistently, there's a big question about what the future is going to look there. Obviously, the competition is very intense in the Chinese market. They're buying very largely EVs, but overall, it's a very tough market in every single one of the main markets for Volkswagen.
And so you wonder then, closer to home, Ollie, when it is going to be the case that Europe, that Germany decides that it needs to do more to protect this industry from Chinese competition. What's the broader narrative around that? Because the German perspective had actually been quite nuanced because they operate in China and they don't want to kind of shoot themselves in the foot in terms of their ability to sell into the Chinese market.
Yeah, absolutely. And I mean, this is a theme that you guys have been talking about a lot over the last couple of weeks, and I think it's dead on. I mean, if you lose a third of your market share, or say a third of your sales in China year after year after year, China becomes much less important to you as a market for these Chinese automakers. And of course, they are one of the great lobbyists against trade barriers, against keeping open markets, because historically, basically, Volkswagen had something close to a monopoly in China for ICEs back in the 1970s when it went in there. The dynamic has completely changed. Of course, the Chinese have basically adopted the German model, and in fact, until 2010, Germany was the largest exporting nation on the planet. It is now, of course, China. And so you're getting to a point now where some of the leverage that these companies had on the government and trying to put pressure on the government, on Friedrich Merz, not to basically get on board with some of the initiatives you get from, for example, Emmanuel Macron, who is much more conscious of trying to defend the European market. The reasons to not get on board begin to diminish, they begin to diminish, and we have reporting over the last couple of months that for Friedrich Merz, the Chancellor of Germany, this is now a more active debate. Historically, the Germans have been very resistant to this, but we understand that he is now potentially turning the corner, and this is a very active conversation here in Brussels and is going to be for the next couple of months and years.
Ollie, great stuff. Great interview. Thank you very much indeed for bringing it to us. Our Chief Europe correspondent, Oliver Cook. let's take a quick look at what is happening with the Core 6 and show you some of the numbers that we are seeing this morning. Quite a mixed picture, quite an interesting picture, actually, I think, developing this morning. Tech is definitely under pressure, which I think is something that it was difficult to call first thing this morning because there's a kind of single stock narrative, which I think is kind of playing out here. And tech is not uniform either. So ASML is down, but SAP is up, as Chloe's about to tell us.
Yes, indeed. Good morning, Guy. We are seeing SAP up quite strongly this morning, almost 5% after cloud revenue came in ahead of expectations. That is because the migration of customers onto the cloud is accelerating. And so this is quite a positive update from SAP, and that reassured investors after just so much weakness in that stock recently. So we're up quite strongly there. We are down, however, for Volkswagen, perhaps not as much as we had expected. We are in the red for the car maker this morning after it cuts its guidance because of this weakness in the Chinese market. And so we are down about 2%, perhaps because of all of the negative sentiment over the last few weeks, all of the bad news coming from Volkswagen. Some of that weakness was already priced in, and that explains why the shares are down, maybe not as strongly as we might have expected. Moving on to Wise, and there the shares are down very strongly this morning for the fintech. We're down almost 9% after the US banking regulator rejected its application to be a national trust bank. So that's a huge setback for that company as it tries to expand into the US market. We are also in the red for Carrefour. The French supermarket has missed analyst expectations on earnings and revenue. We're down about 5% this morning on the back of this, with analysts saying that the company really needs to work on improving profitability in the French market. The other markets are actually doing pretty well, but the French market is very weak, so it really needs to work on that. And finally, Arcadis, the Dutch engineering firm, is up quite strongly this morning, about 6%, after receiving a second unsolicited offer from its Canadian peer WSP, and now the company is reviewing this latest proposal, and we are up quite strongly on the back of this M&A offer.
Chloe, thank you very much indeed. Chloe Melly with all the single stocks.
I was too excited about French PMIs. I nearly jumped in, which I wouldn't do. But we've got the composite PMI number looking at higher than had been expected. So 49.6 is where it's come in. So it's still below 50, still in contraction territory, but it is above that estimate. And it's the services side that seems to have come in better than expected. That doesn't seem to have moved the euro, because the euro actually spiked ahead of those numbers, which is interesting.
Always interesting. What is interesting also about this is that the service number is still negative, i.e. it's a diffusion index.
Below 50, yeah.
So it's still below 50, so you're still seeing contraction. And what you've got is a manufacturing number that has moved closer to 50 from 51. So on aggregate, yes, I would say maybe the number's a little better than anticipated, and the private number was sort of 47, but we're still contracting. We're just contracting it at a lower rate, a slower rate. Anyway, we'll park that and come back to it maybe in a few minutes' time. Let's talk about one of the other single stocks that we're watching this morning. Vontobel, the Swiss investment management firm Vontobel, reporting first half earnings. Let's go to Zurich. Let's speak to the company's co-CEO, Christelle Rendu de Linde, who joins us in just a moment. We'll get to that in just a second. We'll do that conversation and talk a little bit about what is happening in terms of demand. That's coming up. This is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield around the world, right here on Bloomberg. Context changes everything.
20 past the hour, welcome back. Bontobel stock is up by, let's call it circa 1% this morning. This is the Swiss investment management firm reported a record profit for the first half. Clients basically are adding new money. They've got a cost-saving plan. That's beginning to reduce the cost base. These two things basically working hand in hand to produce the numbers that we're talking about. Bontobel's co-CEO is Christel Rendu de Lint, and she joins us now. Good morning. Is the plan working, I guess, is the simple question.
The plan is definitely working. You see it with a record set of numbers in terms of profitability, assets under management, but most importantly, what you're seeing from clients. So clients choosing us across segments, geographies, for our leading capabilities. And that is really not only the plan, which is working, and what's working is this operational leverage that you mentioned. So we're disciplined on the cost, and that gives us the opportunity to invest into growth, into our ambitions for our clients. But the client choice, this is what's fundamental and structural, and is around our differentiated positioning. And that will only compound over time, given the type of markets that we're seeing. That's a strong conviction.
Good morning to you, Christel. Can I ask you about the sort of dominant trend within Swiss wealth management right now? Some people are talking about getting a boost from maybe some in the Middle East, moving some of their money into Switzerland. Others are talking about competition being tough from the likes of Hong Kong for offshore wealth management. What's the dominant theme for you driving the highs and lows for Swiss wealth management?
So I will speak very specifically for us. Actually, the driving theme is really that differentiated positioning that I've been mentioning, and I'll link back to your question in a second. But, you know, that differentiated positioning is that clients do not come to us because we're aggressive in lending. That is not who we are. In fact, we pledge to be exactly the opposite. They come to us because what we bring is the asset management skills, discipline, traceability, repeatability, to all our clients, including private clients, and we bring the ability to customize around an outcome that you traditionally see in wealth into the institutional clients. And that is what will resonate going forward. Now, what is important for Switzerland, it's this stability that I mentioned. It is also part of us. That is still a trend that is very strong for Switzerland and continuing to play favorably for Swiss wealth and asset managers alike.
Given you've got this plan and that it's working and it sounds like it's giving you confidence, are you starting to kind of raise your eyes a little bit and think about what you could do next, how you could sort of step change the growth that you're seeing? That takes me to the M&A story. Are you starting to think about that? Is that a way that you could utilize maybe to grow faster?
Yes, by all means. I mean, this is something in a sense that we always have in our minds, and that was the whole idea about the program, the efficiency program that we decided, was to have that strategic flexibility to invest, whether it's organically or inorganically. And indeed, this is one of, again, it's something quite differentiated when you think about the landscape in Switzerland and how we have grown over time. We've grown both organically and inorganically. Many choose to do one or the other. And inorganically, what we do is either scale in our private client focus markets or additional skills. So in Ankala, for instance, which is still in the pipe for us, but we have our eyes very much open for this type of inorganic growth, yes.
Okay, so eyes open for M&A. Can I ask about AI? The changes anticipated within the wealth management industry, they could be large in scale. Christel, what are you expecting around the AI theme?
So I personally, I'm super excited because I think AI has these two components, right? The one aspect is automating tasks, which is not necessarily the most exciting. It's a nice feature, but the way we think about it is the augmenting skills part, because this is the part that really accelerates you. Is how do you build on your own edge? A little bit like on sport, you know, you should not only work on your weakness, you should actually predominantly work on your strength. And as an active manager, active advisor, you can definitely augment your skills with AI. And that is totally the frame of mind that we have. And it's going to up the ceiling of the industry for sure.
Christel, you said earlier in this conversation, the first answer, you talked about these kinds of markets. What are these kinds of markets? What are your clients doing right now? How do they feel about private markets? We seem to have a story every quarter about massive redemptions. Are they steering clear of private markets? What do they think about the AI trade? Are they worried about bubbles? Talk to me about the narrative that you're hearing from your clients right now.
Yeah, so these kinds of markets, what I meant was that it's actually quite schizophrenic, or it does feel at times, right? Because we're cruising along, and that is because the economy is strong, AI is a powerful theme, but we've got this massive turbulent phases, these air pockets, and that is, I think, what's here to say. So that's these kind of markets. That's what I meant. And what we are talking about with the clients is about building resilience in the portfolio. The clients, both actually institutional and private clients, do not want to miss out on the up market. So just going to the side is not, that's easy to discuss, but that's not the way you make money and you grow capital. But at the same time, no one wants to be caught sort of wrong-footed still in a theme that could look extended, or where for sure, in hindsight, people would say, how could you?
Yep.
So resilience can be, how do you diversify away that theme?
Okay, how could you? I'll remember that one. Thank you very much indeed. Christel, we really appreciate your time. Vontobel's co-CEO, Christel Rendu-de-Lind. What we got coming up?
Coming up, we'll focus in on the oil price again, hovering above $100 a barrel, where it has been. It's at 98.65 right now. That's renewing inflation fears. We will get an equities perspective on that, though. We will speak to Sebastian Redler, Bank of America. This is Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is open interest.
Only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Ruffini.
We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
This is the opening trade, 30 minutes into Friday's session, and it's a positive one actually now. Took a while to get there, but the further we see the oil price drop away from that $100 a barrel mark, the more room there is perhaps for a little bit of strength coming through in European equities, and that seems to be what we're seeing now. So the DAX is getting the best of those gains, up by 0.6%. The CAC 40 lags a little behind, but still, generally we are seeing these markets move a little bit higher, perhaps with a bit of relief on the back of that slightly lower oil price. Let's talk about what we're seeing in the indicators around growth or otherwise in the European economy. We've got the German July composite PMI joining the French PMI this morning. It's rising, so that's the similarity. It's rising to 51.2 against a forecast of 49.7. So a guide that's back into expansion territory by a little bit, not by a huge amount, but by a little bit, and better than anticipated. The euro had been moving higher in the run-up to that French PMI data, and now seems to have taken just another leg higher on the back of that French PMI data into this German print. So we'll keep that in mind as we look at some of the more detail around this session.
Can you just ignore the data, though, this PMI data? Because what we're seeing effectively here is a reaction to a lower oil price. Germany's clearly highly dependent on the oil price, particularly dependent, even more so you could argue, on the gas price, which came down pretty sharply as well. All of that's reversed since we took this data. So I don't know, pay your money, take your choice on that one. 2-1 on the upside, certainly is the narrative at the moment. Oil price is rolling over. We're just back sub 100. Volume's ticking up a little bit, but definitely we're on the front foot when it comes to the stock story here in Europe and gaining a little bit of traction. Leaders look like this. SAP on the back of its numbers, which have outperformed, are doing very nicely. Arcadis is up as well. I think that's an M&A story. I think the Renshaw's a numbers story. Both of those two stocks are reacting as well. Hope I've got that the right way around. Let's talk a little bit about what we're seeing on the downside. Here you've certainly got some weakness coming out of Germany as well. You've got, actually, I don't have Volkswagen on there. Wise is down as well. That's a banking license story. Carrefour is down 6%, and Neste in the oil space is down by 8%. So some fairly significant losers. But we are basically 2-1 on the upside in terms of the narrative, and that is pushing European stocks higher this morning, Anna.
Let's get an update on some of the other news flow this morning then, Guy. Let's start with the tariff story. The US will collect duties of at least 10% on imports from most major major trading partners as President Trump moves to reconstruct his global tariff regime. The new levies follow an investigation into the alleged failure of around 60 economies to prevent forced labor in their supply chains, to the detriment, according to the US, of American workers. Trading partners have criticized the tariffs as baseless and unjustified. The Spanish government has declared a national state of emergency due to wildfires on the outskirts of the capital, Madrid. Madrid's regional president has requested the central government take control of fire extinguishing tasks after blazes forced the evacuation of thousands of people across the region. And Volkswagen shares are lower this morning after the German automaker cut its sales outlook. Europe's largest car maker now sees revenue declining as much as 3% this year. The results underscore the scale of the challenge for the CEO, Oliver Blume, who is trying to make Volkswagen faster and leaner after years of software delays, bloated costs and declining profitability. Guy.
Okay, let's just come back to the market story this morning. Equity futures are certainly picking up stateside. That is the narrative we're getting from the other side of the Atlantic. One of the reasons for that is that oil prices are coming down relatively sharply this morning. We're definitely below 100, and that is the narrative that I think is turning things around a little bit. Quick look at the bond market as well, which I think is a kind of an interesting trade around all of this. You've certainly seen a big turnaround in the US 10-year. Had a 4.7 handle, now has a 4.6 handle, and you're certainly getting a decent bid coming back into the European bond market as well this morning, so yields are lower. That's the kind of the background of narrative that we're looking at. Does it all hinge around the oil price? What else is a fact? What other factors do we need to fold in? How bullish should we be about this equity picture right now? Let's try and answer some of those questions. Sebastian Redler is the head of European Equity Strategy, Bank of America Global Research, joins us around the table this morning. Bullish or bearish?
I'm bearish.
Shocker.
Talk
to me about the narrative. I got some PMI data out of Germany that looks better. I've got an ECB that's only going to raise one more time. The oil price is up, but it's not streaking kind of above 100 this morning. Why is that all negative?
So first of all, fully agreed. The data is looking better than expected. Once more, like last year, you had a big shock with the Iran war. Global macro surprises hardly turned negative, and they're now back at a 3-year high. But we have to see it. What is the picture in terms of the risks and the opportunity, and what is priced? And if I say to you what is priced, margin expectations at an all-time high, you've got expected 5-year forward earnings growth at an all-time high, you've got market cap to GDP globally at an all-time high, and you've got risk premium at a 20-year low. What the market is pricing is a scenario where everything goes right and there are no risks. And then we look at what happens in reality. There are a lot of risks. And specifically, you have a once-in-a-generation CapEx boom that has basically generated this kind of picture, but there are a lot of cracks in that CapEx boom. And we know historically how that story ends. And we're seeing problems coming up in terms of customers' willingness to pay, borrowing costs for the hyperscalers and so on. There are risks that are not priced. And then you look at the Middle East, clearly you've got challenges there, especially with the crack spreads exploding as they have. So I'd say the market is pricing no risks, but there are risks. You're not being compensated for those risks. That is not a bullish picture.
That's not a bullish picture. No, it isn't. I'm stunned. We were talking to Vontobel earlier on, and they were saying that turbulence is here to stay. And so these are some of the risks, I suppose, that you think the market is underpricing. Sebastian, how do you protect yourself from an expectation that turbulence is here to stay? Because on the one hand, that can create opportunities for alpha, can't it? So what's the mindset when it comes to being in a world of higher turbulence?
Yeah, so the interesting thing is that you have what I would call a K-shaped, very bifurcated equity market where everything that offers safety and defensiveness has been thrown to the dogs because it has been so far from the winning theme, which is the AI theme. Everything that's close to the AI theme, at least until the recent momentum unwind, was flying high and priced for something extremely bullish. So I would say the best way to protect is to pick up these very beaten up things like quality stocks, things like staples and pharma. They basically are trading on extremely undemanding valuations. If anything goes wrong in the world, they will look a lot more attractive, and you're picking them up at very cheap valuations.
So that sounds like you should be quite bullish on Europe then.
No, because Europe is still a very cyclical market. It's a value market. And on a relative basis, maybe if tech goes wrong, maybe if the AI story goes wrong, Europe will do well, but in absolute terms, it has been pulled up as well and is trading on very tight risk premia that really require everything to go right from here.
Quality stocks are a relative trade or an absolute trade?
It's a relative trade.
Okay.
So I think generally, if you're looking for hiding places, you're thinking about things that do better in a more challenged market.
How big, if you do get a drawdown, how big could it be?
So in our base case, we see around 7-8% downside, partly because we are very respectful of the point that you made. The macro data is still doing well. But then we have to see if at some point the AI CapEx wave crests, then growth will be weaker, earnings will be weaker. And there's a very interesting point from the Bank for International Settlements. They say a lot of this AI investment is now debt financed. There are a lot of financial interconnections between these players. And what they say, once the music stops and once the spending disappoints, there's a lot of debt that will be hard to be financed. And then, of course, if you get financial stress, as they expect, once that starts to roll over, then, of course, you're not talking about 5-6% downside. You're talking about something more.
Okay, so you could argue, do you argue that then a cresting of the AI capex wave will become systemic on the other side?
History strongly suggests, and they've got a very nice chart. Normally, I would never recommend to you reading the annual reports from the Bank for International Settlements. I think this is an exception.
We've got a weekend coming up, Sebastian. So, you know.
I'm sure you're going to do more fun things on the weekend. But maybe in a lazy moment, they've got a great chart that compares the current AI capex surge to the big boom-bust cycles of the past. They go all the way back to the canal mania of the 18th century, which I'm sure you'll remember. And of course, once that rolls over,
that was harsh.
Yeah, I know.
No.
Not personally. I mean,
well, I wanted to.
I'm aging really well.
What I want to say, Anna's exceptional knowledge of financial history, of course, that's what I was referring to.
And the tulips. Remember all of it.
Exactly. And the way that has typically played out, of course, once that rolls over, especially because at that point, typically margins are very inflated, valuations are very inflated, growth is very inflated. Of course, the deflationary impact when it rolls over historically has been brutal. And so therefore, as one client said to me, we have to survive twice here, on the way up and then again on the way down. So for now, we only have mild downside. We just think expectations are too high. But of course, we are watching to see whether history is a guide. And if it is, then once the regime switches, it potentially will be quite a ride.
But I get. But at the moment, we're on the way up. We're not on the way down. I don't know how much further the way up has to go. So the danger is rotating into those quality stocks early, isn't it?
Absolutely. But there's danger in both directions.
Yeah.
And what I'm saying is, in one case, you already have all the good news priced in. And look at how quickly the Kospi, for instance, which is the poster child of this whole thing, is down 25%, with very little happening by way of fundamentals. The more expectations are stretched on the upside, the more risky it becomes. And I'm saying is, sure, you could be early in the quality stocks, but nothing is priced in. So therefore, that scope for disappointment is a lot less pronounced than it is in the stretched AI trades.
Just briefly, Sebastian, are you nervous about all of the tech earnings next week, including SK Hynix and Samsung and everything we might learn from that?
I am nervous. And it's clearly a very high-stakes game. But what we're seeing, for instance, in the Google and the Alphabet results, you get a very good results. But if expectations are so stretched, you might still get pummeled.
Thank you very much. Thanks for joining us. Sebastian Redler, Bank of America Global Research European Equity Strategy Head. Coming up on the program, sweeping new U.S. tariffs come into effect as President Trump rebuilds his tariff wall. But what impact does it actually have? We'll have the details next. This is Bloomberg.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns,
particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We've already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Thursday. The Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts Thursday at 12:30 p.m. only on Bloomberg.
Welcome back. 44 minutes into the equity market session, and the big thing that you need to know right now is that the oil price is lower. Brent is back below $100 a barrel. We're at 98.84. We're down by circa 2% right now, and that is rippling across equity markets globally and equity market futures globally. European stocks are on the front foot as a result of that. I think it's just been given an extra boost by that. Plus also the German PMI data actually looked fairly favourable this morning.
This in the context of more tariff headlines. We're back to getting tariff headlines from the Trump administration. The US will collect duties of between 10 and 12.5% on imports from most of its major trading partners. That's the top line, but let's get into some detail. It is the biggest move yet to reconstruct President Trump's tariff wall that was struck down by the Supreme Court. Joining us now with those details, Brendan Murray, who leads our global trade coverage. And Brendan, of course, you see these headlines and then you immediately want to get a sense of how much they really matter, because we have had 10% tariffs and now we're going to continue to have these 10% tariffs in the context of these other tariff deals which seem to override these tariffs, and then lots of sectors that are excluded. So whose life is changed by these tariffs today?
Well, some of the countries that woke up today saw their tariff threat go down from the 12% bucket to the 10% bucket. We saw that with India, with Cambodia. And so some countries were relatively surprised on the upside to say, okay, it could have been worse for us. But then you have, this is about $1.1 trillion worth of imports into the U.S. that are getting hit with these rates, the 10 and the 12.5%. So that's about a third of all American imports annually. And so it's not a gigantic change in the economic picture, but each country is going to look at this and say, what can we do to improve our forced labor situation, so to appease the Americans? And of course, you have companies that are going to have to pay these tariffs, calling their lawyers this morning and saying, can we? Is there anything we can do to chip away at this from a legal perspective?
Forced labor, is that really the reason behind all of this, or is it?
Well, I mean, a lot of what's driving the Trump administration right now is the revenue that they need to generate to close, a huge.
So this isn't driven by false concerns. Does the UK have a big problem? Does Europe have a big problem with this?
Well, according to the USTR, all of these countries do. This is the 98-page report that they released 6 weeks ago. A lot of people would say this is a pretext to put tariffs on, that the president, lost that authority back in February, and so, but countries. for the most part, the reactions today range from mildly upset to, kind of taking their medicine and trying to move on.
Yeah, and to your point, some pushback from some of those countries that are affected, certainly in Asia. There did seem to, further down our stories on this, Brendan, there did seem to be a little more nervousness around some of the other 301 investigations that are going on, something called investigations into excess capacity, and some in the trade industry suggesting that actually this could be an area where we see another step change in the tariff regime. Is that something we need to look ahead to?
Absolutely. This is a case that the Jameson Greer, the U.S. Trade Representative, has said is coming. It's taking longer. We understand that it could be maybe August or September before those results come back, but that would be another tariff, whether it be 10% or 25%, that the administration could stack on a smaller group of countries, but still, the European Union is in there, China is in there, and so this is not the end of the new tariff regime. It's, in a lot of ways, it's the start of a new beginning of it.
Brendan, great to catch up. Thanks for updating us. More tariff news. Brendan Murray updating us on that. He leads our global trade coverage. Let's talk about some of the single stock stories. Let's talk about tech, actually. SAP shares climbing after the software company reported second quarter cloud revenue that grew faster than analysts expected. Now, earlier in the show, we had the great opportunity to catch up with the company's CEO, Christian Klein. He was talking about actually some really interesting issues around AI and how his company is using frontier models, open source models, and how they're trying to control token costs in terms of integrating AI into their story and how they're managing costs around that.
In the R&D costs, you see, a higher token consumption as we are using AI to code additional features, but especially now additional agents. But vice versa, you also see a huge productivity increase of 30%. Obviously, we are also managing tokens as part of our cost budget. Yeah, you have a headcount budget, you have third-party budget, and you have tokens. So our managers in R&D, in the go-to-market space, they have one budget, and they have to manage that also according to the productivity assumptions we reflected in the budget.
Okay, let's talk about that. Let's talk about all the other tech news we've had out overnight and this morning. Bloomberg Intelligence senior analyst Matt Bloxham joining us now. The market likes SAP this morning. Why does the market like SAP this morning?
I think because you're seeing perhaps a slightly better than expected shift from the old kind of on-premise based software licenses sold to cloud. Okay. There's a hard deadline coming up for customers. If they don't switch, they're going to face higher maintenance fees. And I think perhaps the amount of revenue transitions are a little bit better than expected. And I think you have to put into context, SAP share price has been on a one-way street for a long time. So the market is not kind of really particularly optimistic about this company. So you get a little bit of, slightly better than expected good news, and then the shares react a bit. But, the numbers were only fractionally better than expected. There's no change to the full-year guidance, but the full-year guidance for revenue and profit is a little bit above where the market is, so maybe there's going to be a small upward revision to estimates.
Yeah, we'll watch this, and we'll watch how they deal with these sort of SaaSpocalypse threats. In the wider tech landscape, we also had these numbers out of Intel. Yeah. I know some in BI were joining the dots between the Intel numbers and what ASML could make from that. And what is the takeaway from that Intel story?
That Intel is back. I think, and it's been coming back for a little while, really was on its knees. And I think two things going on there. One, as AI shifts from training models to actually deploying them in real-world situations, the demand is going back towards general-purpose computing, CPUs, which is what Intel's always been famous for. So seeing huge demand growth for that, and they're expanding capacity to deliver against that demand. And secondly, although it's still kind of bubbling away in the background, their foundry business, so them building chips for other people, is definitely gaining traction in the background. So the likes of SpaceX, for example, looking to work with Intel to kind of build their terafab capabilities. So whilst that's yet to come through in the numbers significantly, I think there's growing optimism that actually that business is going to grow because people are looking to diversify away from the traditional chip providers.
And that's to make them in the States as well,
exactly,
which is geopolitically of some significance.
Yeah.
Anna's reading complex reports this weekend.
Absolutely, from the BIS.
From the BIS about AI.
It's on my reading list.
That's what she's... What am I going to be doing in terms of getting ready for tech next week? What are you watching out for?
Well, obviously, we've got Meta, Amazon, Microsoft, Apple. I think if we look at Meta, Amazon, Microsoft, I think the big focus is going to be what they say about CapEx, because we had the kind of the prelude from Google raising this year's CapEx numbers. They've already signaled CapEx is going to go up a lot next year. People will be seeing if they follow suit, and are we then stretching the relationship between investment and return?
Yeah, absolutely. And what's the sweet spot for CapEx? You know, the Goldilocks sort of story.
I think we're probably beyond that, to be honest.
Beyond that. Okay, well, there we are. That in itself is revealing. Matt, thank you very much. Bloomberg Intelligence Senior Analyst Matt Bloxham with a bit of a look ahead there to what to expect next week from the tech stories. Joining us now for more on tech is Kit Rees, editor of our Markets Today blog. Kit, nice to see you. Let's talk about the tech earnings then, because we're looking ahead to next week, expecting perhaps quite a lot of volatility. We talked to the Markets Live team earlier on. Adam Linton was reminding us of the volatility we get on an average day around SK Hynix and Samsung, and that's even without the earnings stories. So what are we looking ahead to next week?
Well, the tech earnings are going to be super duper key for market sentiment more in general, really. But one thing that I wanted to take heart from was that despite the disappointment around Alphabet's earnings and, you know, the worries over capex and spending, that the markets have actually held up pretty well. The Nasdaq 100 is only down about 1.6% this week. Same also for the S&P 500. And volatility remains relatively contained. So we've got the VIX below 20, and that's considering everything that's going on in the world in terms of geopolitics and oil and all those concerns. So there's going to be a lot of focus on the capex numbers, of course, and spending intentions, and also the wider existential questions of whether these companies are becoming more industrial. Maybe they're becoming more utility-like, given they have such big fixed assets now. So it's going to be really key for market sentiment. But overall, it does seem that markets are holding up relatively well.
Fed next week, Bank of England next. Should we be excited? Of course we're going to be excited. What is going to be exciting that comes out of this? Is the Fed going to raise rates? What's the Bank of England going to tell us?
Yeah, it is very exciting, and I'm always very excited for a Bank of England meeting. But, I mean, markets have moved so quickly this week alone, and we've had oil hit $100 a barrel. So, you know, central bankers are going to be paying very close attention to this. So we had the ECB yesterday saying that, you know, hinting at perhaps a September rate hike, and we might even have the Fed also think about moving in the future. So we're going to be looking a lot at the forward guidance, a lot of the rhetoric that comes out from central bankers. But one thing that has struck me is that they're very focused on second-round effects. This is when higher oil prices cause things like wage growth in the economy, and we just haven't seen those signs yet. So it might just be that the central banks are happy to stay on hold for now, see what happens, and whether the conflict in the Middle East, all those tensions get worse.
Yes, I mean, we're joining the dots between what's going on in the Middle East and what that means for central bank policy. You said we're looking for forward guidance, but I wonder what on earth we'll get from the Fed, because they're not such fans of that anymore. What about the oil story and how much you see that cutting through then, Kit, when it comes to the markets next week? The weekend always proves to be a huge unknown, doesn't it? I mean, all this week we've gone higher on oil. We're up 38% in July, but then we're tracked down today by 2%, and we just wait to see what happens, what's delivered over the weekend.
Yeah, I mean, there could be a bit of volatility, especially coming back from the weekend next week. We'll just see what happens in terms of those tensions and also the questions over supply and whether, you know, we've had the Houthis open up another front in the Red Sea, which is obviously a bit worrying. And, I mean, the question now is, oil at $100, can it go higher, and where will it ultimately settle, and how long does that land? And this will inform everything for markets, for investors, for central bankers. But, of course, it's just so unknown, and there's just so much uncertainty that it's really hard to say, you know, what's going to happen and how it could all shape out.
Kit, nice to see you. Thank you very much indeed. And we're all excited about the Bank of England. Kit Rees, editor of our Markets Today blog. Thank you very much indeed. We're almost there. The weekend is almost upon us.
Yes, we've already established that I'm busy reading an AI BIS report. What are you watching?
There's going to be a lot of sport this weekend. Not as much sport as there has been recently.
Is this the first weekend we are without the World Cup in a very long time?
So which has
crowded out everything.
It has almost. Like, there's been some tennis, there's been some rugby, there's been all kinds of other things. But yes, I think you're right. The World Cup has pretty much crowded out everything. But we've got the Hungarian Grand Prix coming up this weekend. The Tour de France finished, I think it's Sunday. They go down the Champs-Elysees. There's obviously some quite big hills to climb between now and then. Commonwealth Games in Glasgow. I'm sure Anna's going to Bruno Mars.
Well, one of our producers snuck that last one in, didn't they? We think we might know who it is. The Pulse is up next. Have a good weekend. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
President Trump rebuilds his tariff wall that was struck down by the U.S. Supreme Court with new levies on 60 economies, including most major trading partners. Well, traders fear the AI rally may have gone too far, with the Magnificent Seven shedding nearly $800 billion in market value in one session. And Brent touches $100 a barrel, with President Trump saying he's considering a, quote, massive attack on Iran to encourage negotiations. Also, don't miss our interview this hour with Meredith Whitaker, president of the Signal Foundation. We discuss AI safety and privacy back in the spotlight after Hugging Face was hacked by OpenAI. Now, very quickly, it's been a big week, especially for earnings, but it's also been a big week when it comes to, of course, everything that we see in the Middle East, especially the price of oil. Stocks, I see, are drifting a little bit. U.S. stocks on track for their first back-to-back weekly loss since the early stages of the war. And then it does seem that traders are, for the moment, holding off on some of the big bets after a week in which stocks and bonds were rattled by not only the intensifying war in Iran, but these fresh concerns over AI investments and when they will pay off. If you look at the data points, Eurozone July composite PMI rising to 51.9%. Anything above 50 is expansionary territory. And then that one-year CPI expectations also falling to 3%, a little bit below or a touchdown from what we were expecting. A couple of other housekeeping things that we need to do. Intel shattered Wall Street estimates. Its revenue forecast lifted by booming levels of spending on data centers, and so Intel pre-market gaining 4%. So for the conversations that matter and the insights you need, let's get started.
makers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Traders are avoiding risk headed into the weekend. Brent touching $100 a barrel. Some big tech, big U.S. tech stocks actually tumbled yesterday. Now, to cap the week, we have new tariffs from the White House. So I'm now joined by Kamaksha Trivedi, Chief FX and Emerging Market Strategist at Goldman Sachs, Brendan Murray, who leads our global trade coverage, and Shona Ghosh, Bloomberg's tech editor. So there's a lot going on, and I'm glad that we can bring you all together to try and figure some of them out. Kamaksha, overall, I mean, do you worry more about AI, trade, or the Middle East?
I'd say different horizons. So I think on the trade side, this is a replacement of tariffs that were about to expire. There's a similar range, so I don't think it's going to be a first-order market mover. I think in the short term, I think the Middle East, the energy price moves, I think they are important. The headlines there are getting worse. I think markets have been reluctant to price it, but I think are coming along to the side that I think you need to start taking this a bit more seriously now. But I think the bigger picture, the main risk here that I think is really going to affect market views one way or the other in the long term is what is going on the tech sector and kind of the AI, because I think that AI investment spend has been a big driver of a lot of global market themes.
Yeah, and Shona, overall, I mean, what did we learn this week? There's a lot of spend out there. There's a lot of bonds that will be issued or debt that will be issued to make up for it. There's nothing concerning, but again, it's one of those weird weeks where markets are also taking pause.
For sure. So we obviously learned that Tesla, Google this week, their capital expenditure is just going up and up and up. That's causing some concerns. For Google, you would expect it, but kind of an alarming sign was this is the first quarter, possibly since its IPO, that we've seen a negative cash flow for the company. Tesla, similarly, first negative cash flow in a couple of years because the AI expenditure is so big. Not seeing necessarily a ton of returns on that expenditure just yet, and sort of no signs in the foreseeable that might come. We had some early signals that maybe sort of AI earnings are kind of catching up to that expenditure, but really the sheer volume needed to be spent means we're not going to see a return for a while, and that's causing some jitters.
Sure. I mean, we also spent a lot of time actually, thinking about this. I mean, it's not hacking, but basically the fact that some of these models are dangerous because they can also go into other models without knowing. Do we know any more about how we can fix it, and actually what exactly happened with Hugging Face?
A little bit. So, as ever, there's a degree of human error here, which is simply not understanding the guardrails that need to be around such models. In this case, this was OpenAI testing a couple of its advanced models, putting it in a sandbox, which is a protected environment. But the model was quite clever. It was given a test, and it said, I will solve this test in any way I can. And so there clearly wasn't enough of an instruction there, perhaps intentionally, to sort of stop the model from trying to do anything to break out of the sandbox. And it just goes to show that sometimes these models can be extremely determined if you don't sort of cleverly think around how they might try and break out of a sandbox or protected environment. So it's a little scary. I think it's not the end of the world. I think it just goes to show these models need really careful thought before they are released into the wild.
And Brendan, I mean, we thought tariffs was like a risk of the past, didn't we? I mean, we kind of started the week with a bit of skirmishes between the U.S. and Canada, but President Trump is rebuilding these tariffs.
Yeah, exactly. As the U.S. Trade Representative Jamieson Greer said to Congress this week, the authorities are changing, but the overall strategy isn't. And at the core of the strategy are tariffs. And they're basically going down two tracks now. One of them is this slower procedural path with the 301 investigations like the one we saw take effect today into forced labor. There's another one coming on excess capacity, could be August or September, with additional tariffs on a lot of major U.S. trading partners. And there's this other path that we saw emerge this week, as you mentioned, with Canada, this new authority that hasn't been used in almost a century, this 338 authority that the president threatened against Canada with 50% tariffs that'll take effect in 30 days. So we have this sort of predictable path with the 301s, and then we have this new untested authority that the president may be using against Canada and perhaps other countries to sort of shake things up, to live negotiations. So a lot of the uncertainty is in the past, but we have some new questions about how much authority the president has to sort of wield tariffs on trading partners as he sees fits.
So, Kamaksha, where does that sit? I mean, is that kind of, I imagine it's inflation in the short term, right? When we're inflation, we may be worried about it a little bit less than a couple of months ago. Or do you put it in the kind of geopolitics?
No, I think there is an inflation impact, but again, I go back to the fact that at least the level of tariffs is replacing the tariff level that was already there, that was due to expire at the end of this month. So I think from an additional inflationary impulse, it's probably not going to be the game changer unless you go down these kind of 50% tariffs, the Section 338 authority, which of course will be questioned and challenged. So I'm less worried about the inflationary impulse from tariffs per se. I'm much more worried about the inflationary impulse that is coming out of the energy complex right now, and that's the one that I think we need to watch.
But that's oil, or is it also actually the CapEx spending that we're seeing in AI?
Both. I mean, I think the energy and oil is the kind of short-term swing factor that kind of drives this up and down, but I feel like you've heard from the FOMC that there's kind of limited tolerance for overshoots no matter what the source is. But again, the longer-term, bigger factor here is the AI CapEx spend, and shifting views there, I think, are going to be a key driver of the cross-market response.
Brendan, I mean, do we know whether we've heard from, I think, the Singapore foreign minister who's pushing back, but do we know the biggest danger is if some of these countries then retaliate? Right?
Yeah, exactly. We've heard from a number of countries. They're not happy with it, but most of them are sort of taking it on the chin. The European Union said it falls within the deal that was struck between Brussels and Washington, but it almost went unnoticed yesterday that the U.S. Trade Representative went after the European Union for the fine that they levied against Google and for this European Investment Bank loan to Airbus. So these long-running issues, the overregulation, according to the U.S. Of American big tech companies, and the long-running Airbus-Boeing dispute over subsidies have kind of come to the fore there to perhaps shake up the transatlantic relationship.
And Shona, on AI, I mean, it is pretty incredible when you look at these figures. You know, Alphabet's future spending commitments are basically $111 billion. I mean, just the sheer size, and you wonder what kind of impact this has on inflation, because I don't know if anything happens with interest rates, they'll stop that. But there's also a couple of other stories like Microsoft replacing, OpenAI images. Like, are we just also going to see, is our interface with AI going to change quite quickly?
I think it will, and I think a big story this week has obviously been the rise of the Chinese models. Yeah. This is periodically a story every few months because a new model will come out and everyone gets very alarmed. And I think what we're seeing is that China is certainly willing to fund the development and the powering of these models and then issue them out into the world and issue them at very low cost. And increasingly, businesses are beginning to notice. We're hearing perhaps not so much of the big players, but certainly smaller startups who, have limited runway are saying, I can't afford to spend all my tokens on Claude, which is expensive from Anthropic. I'll switch to DeepSeek or one of the other cheap open-weight Chinese models. So that's the other factor that is, going to have an impact on the spend, which is, some of these companies are relying on making their returns from being able to charge customers for their models, but the Chinese competition may undercut them.
Yeah, something that we actually really need to keep a very close eye on. Shona Ghosh and Brendan Murray, thank you both for joining us. Kamaksha is staying with us because oil is holding around $100 a barrel after President Trump threatened to escalate strikes on Iran and hold the country responsible for any attacks in the Red Sea by Houthi militant in Yemen. Now, for more, let's bring Honor Arndt. Bloomberg's managing editor for the Middle East and North Africa. Honor, so is there any prospect of de-escalation at this point?
Well, there are certainly efforts underway to de-escalate. According to the New York Times, there was a truce proposal, a new one, that was relayed to Iranians by the Iraqi Prime Minister on Thursday, but that was flatly rejected. We are also seeing, according to headlines that are just moving on the terminal now, Iran's foreign minister, Arakchi, is meeting with his counterparts from China and Russia later today. That's also ostensibly about the efforts underway. But the differences between the two sides, especially over the issue of Hormuz and who controls it and how, remains really wide for there to be an imminent breakthrough, just judging by the narrative coming out of D.C. and Tehran so far, Francine.
Honor, thanks so much. Honor Anther, Bloomberg's managing editor for the Middle East and North Africa. Let's get back to Kamakshi Trivedi, Chief FX and Emerging Market Strategist at Goldman Sachs. Kamakshi, I mean, when you look at, and we talked a little bit about the inflation forecast and the fact that actually this war seems to be going nowhere, and we don't really see de-escalation points. So does it change your outlook for both dollar, oil, and inflation?
Yeah, I mean, I think what is interesting is that in this particular re-escalation, the dollar impact was actually somewhat more muted, at the start of the re-escalation, right? And even though the headlines in some sense seem to be worse, you have now 2 straits blocked instead of 1. You're starting from a point of much lower inventories in the global energy market than you did before. But I think part of the reason why the response has been more muted is I think, people are expecting some sort of de-escalation, the question you were just asking, and also partly the impact from the terms of trade of the first part of the war hasn't completely dissipated. So I think that there has been a reluctance to really commit to this energy price increase in a way in dollar, in cross currencies, in inflation markets. But I think it is changing. I think, you're beginning to see now the levels of increases in gas prices in Europe, in oil prices, that I think the dollar is beginning to, acquire some degree of a front-footed nature. It's beginning to appreciate a bit. You're beginning to see those terms of trade distinctions start to play out versus the oil exporters and oil importers.
And Kamakshi, of course, yesterday we had the ECB and here's President Lagarde on the price of oil.
The energy shock continues to feed into higher prices. It is becoming more expensive for firms to source inputs, and they therefore expect to put up their selling prices. While developments in underlying inflation have remained contained, the full effect of the energy shock have yet to play out.
Kamakshi, I wanted to ask you about emerging markets, but also about the UK. This is a small open economy that's extremely impacted by the price of oil, with energy impact, with a new prime minister.
Yeah, absolutely. And I think the surprising thing for a lot of people and for us as well is at the start of this month, the pound was one of the best performing currencies. And actually, that's in the short term. But actually, if you look at the medium term, there's been a lot of downbeat sentiment around UK assets. That's not been true of the currency. The currency is one of the most overvalued currencies on our metrics across the G10. So we expect some degree of, pound bearishness or some depreciation creeping in as you unwind some of that optimism, partly on the back of some of these energy price increases as well.
But why are pound traders so optimistic? What are you expecting from the Prime Minister?
I mean, I think that what has happened here is, you had some unwind of negative positioning. You had quite a lot of M&A inflow. I think carry has been a big theme, both in emerging markets, but also in G10. And, UK and the pound in particular offers one of the highest carry in G10. And so I think that you had a number of factors come together. And ultimately, it's a pro-cyclical currency. It does well when equity markets are rallying. I think all of that has helped the pound. But we think it's gone a little bit too far. And, so far, it's early days with the new Prime Minister. We'll see. But I think that, if you are bullish on the prospects of the UK with the new Prime Minister, there are other better assets to express that, we think, whether it's mid-cap stocks or, bonds rather than the currency itself right here, right now.
I mean, the million-dollar question, of course, what happens with fiscal discipline? And again, we're day 5, so it's a little bit unfair to put him and the Chancellor on the spot. But are you hearing the right noise? I mean, can they basically please the bond markets, but also make this a fairer society where citizens feel like they are not left out?
It's a really tough question. I don't envy the shoes that he's in and those trade-offs that they have to make. But I think, again, it goes back to the discussion we were just having, Francine, which is that I think they can try and do a little bit to help people, but ultimately what bond markets will care about is if you're going to be a kind of cost of living prime minister, what happens if the energy price shock is a much bigger one? Like, how do you deal with that? And I think that's what bond markets are going to care about. Like, can you maintain fiscal discipline if you really get that? If we're lucky and the global supply shocks abate and the inflation picture is much more quiescent, I think bond markets will be okay. But I think, we haven't been very lucky with global supply shocks in the last few years.
And that is very true, especially for emerging markets. Now, they've overall had a pretty good run, but actually the last 3 months have been extremely difficult for some of them. So what do you see, for example, in Japan, but also some of Southeast Asia?
Yeah, I think that, again, a lot of these are big energy importers, and I think, again, that energy shock is not going to help. But I think the other theme, like I said, is playing out across a lot of these countries, both G10, EM, is carry and the ex-ante real yield. Places that have got a decent real yield cushion, they're holding on okay, even in the face of these supply shocks, even in the face of some of the volatility in equity markets. Japan does not have a big, yield buffer. It's one of the low-yielding currencies, which is why I think, we are more cautious there, and that's true of a lot of the Southeast Asian low-yielding economies as well, like Thailand and the Thai baht is a good example. We think it should be on the short side, on the funding side of global carry trades.
Mike Chapman, I feel like we've spent 15 minutes looking at the forces at play, some of the risks out there. At the end of the day, what does it mean? What do you think is the best value play in the markets right now?
Look, I think that in the near term, a lot depends on what's going to happen with the energy side of things, right? I think if the energy side of things comes off, as we've seen a few episodes of this, I think some of the hikes that are now priced into the curve are going to be tough to sustain. That's probably the clearest, value play, if you like. I think more medium term, I go back to, I think, shifting views around AI and that spend, the value proposition there, I think is going to be key to driving sort of markets for the second half of the year.
Kamaksha, thank you so much. Come up, Goldman Sachs. Now, coming up, global trade trouble. We'll discuss the impact of President Trump's new tariffs. That's coming up next, and this is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI. That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Thursday. The Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts Thursday at 12:30 p.m., only on Bloomberg.
The conversations that matter and the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, President Trump is rebuilding his tariff wall with new levies on 60 economies. Just after 5 a.m. London time this morning, U.S. tariffs on between 10 to 12% kicked in on most of America's major trading partners. Now, it does follow an investigation into the alleged failure of those economies to prevent forced labor in their supply chains. Now, for more, let's bring in Rebecca Harding, Chief Executive at the Center for Economic security. Rebecca, thank you so much for joining us. I mean, if you look at exactly what happens, like, what is the reason for this to be back on the agenda? We knew that President Trump was never going to let it go. Did you expect it to come back so soon?
So it was inevitably going to happen today because the previous sort of stay of execution, if you like, on the 10% tariffs expired today. So it was something that was definitely going to happen today. That was obvious. The real concern here is that this is using parts of the law. It's been investigations that have been going on for a long time, but it's using parts of US trade and tariff laws that are very technical. So the real challenge here for everybody is that this could get worse. It's certainly not gone away. America is still using tariff policy as its major instrument to coerce and influence the global economy. And so everybody has to start getting used to managing through this type of uncertainty, because there will be disputes, there will be arguments, there will be conflict, and this is something that the Americans are preparing for.
But are these new tariffs purely a replacement of the earlier duties that were struck down?
So they actually cover a large amount of international trade. So they cover around 99% of US imports. So it's covering a huge amount, but they're doing something different. So they're asking for every single trading bloc, every single nation to look at their supply chain rules and their regulations and their enforcement regulations. So it's very, very technical, asking every single nation to have a look and see where they could actually tighten their law in order to accommodate this rule that in no supply chain must there be exposure to enforced labour. Now, there's already corporate law and corporate regulations and reporting standards around all of this. So the UK, for example, relies on all of those sorts of things. So it's almost voluntarism and doesn't have trade law as such that says you know, we can't import stuff that's exposed to enforced labour. So the European Union does. So this is where the grey areas are going to be, because the UK government will quite rightly say, well, this is all catered for by corporate law.
I mean, a lot of countries, of course, India to Norway, have pushed back against the allegations. This also has huge implications for the cost of living, as inflation could go up. I find it quite risky 4 months to the midterm. I mean, when you look at, you know, the focus, which is for the Democrats in the U.S., the cost of living crisis, would this not automatically make it worse?
I think that, I mean, the jury is out on the effect that this is having on the American economy at the moment, but the price influences over and the pressures on inflation at the moment for the US economy are very significant. US policy is not, you know, the US trade policy, the administration's trade policy at the moment is not loved by the American public. And so the problem as we get closer to the midterms is always going to be the fact that President Trump is not seen to have reduced prices in the way that he said he was going to. Now, he's saying this is all a price worth paying, and he doesn't worry necessarily about the impact on the economy. He believes that the whole point around making America great again and America first in everything that he is doing at the moment is actually going to be sufficient to carry him through those midterm elections.
Is there, I mean, and again, also complicating things is that currently we understand there are refunds at the U.S. Customs and Border Protection from the previous, of course, trade agreements that were then struck down. Rebecca, what is your feeling? Will other countries be fed up with this and retaliate? Because if there's one thing that I remember from 2025 is that we're all quite surprised that actually the rest of the world took it on their chin and moved on.
I think this is slightly different because it is accusing countries of, so the 301 tariffs are, and the 301 reviews are accusing other countries of being unfair. And the European Union will kick back and say, well, we're not being unfair, and we've stood by the terms of the agreement. Now, the European Union, for example, does have a huge anti-coercion instrument that it can introduce in return for these types of tariffs, and it's never actually triggered that button, but it could. So there are mechanisms by which this would happen. So, for example, the pharmaceutical tariffs, which have come in as well on generic tariffs. Now, on generic pharmaceuticals, that's going to hit in 2 years' time. But it's going to affect the way in which countries think about investing in the United States. And it will particularly severely hit India, because India produces so much of American generic pharmaceuticals. So there are going to be points where I think the rest of the world turns around and goes, actually, this isn't fair anymore on us. And there is a risk that other countries will retaliate. And the one country that could, of course, is China.
Yeah, Rebecca, thank you so much for all of your insight. Rebecca Harding, the Chief Executive of the Center for Economic Security. Coming up, how much of a threat does AI pose to our private communication? We'll discuss all of this with Meredith Whitaker from the Signal Foundation. That's coming up next, and this is Bloomberg.
We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this field forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. President Trump rebuilds his tariff wall that was struck down by the U.S. Supreme Court with new levies on 60 economies, including most major trading partners. Traders also fear that the AI rally may have gone too far, with the Magnificent Seven shedding nearly $800 billion in market value in one session. And Brent touches $100 a barrel, with President Trump saying he's considering a, quote, massive attack on Iran to encourage negotiations. Now, AI security has come back into, of course, global focus this week after Bloomberg learned that OpenAI's advanced models attacked the startup Hugging Face in just a matter of hours. Well, my next guest is warning that the rise of AI, alongside further tech legislation, risks, of course, undermining the principles of private communication. Well, Meredith Whitaker is the president of the Signal Foundation. That's a nonprofit organization which also owns Signal Messenger. The organization says its app has been downloaded or installed hundreds of millions of times, including in countries like Ukraine, following the Russian invasion. Meredith, great to speak to you today. I mean, there's a number of questions, of course, about, what we should worry about most, but can you break down the potential security risks posed by AI agents?
Well, for Signal, there's a very concrete security risk, which is that we're seeing these agents integrated into our core infrastructures, like our operating systems, iOS, Android. We see these updates, agentic capabilities. Great, it can live my life for me. It can book my travel. But of course, in order to live my life, it needs to know about me. It needs to have access to data. So what we're seeing is agents that, under the guise of being our magic genie butler helpers, are actually demanding huge amounts of access and huge permissions to do whatever they want with that data. My credit card information, my calendar information, my contact list, to book a dinner for my friends, all of that then being sent to external servers, processed in ways that may not be secure. And Signal really sees this as a threat on our ability and every software developer's ability to really ensure privacy within these environments. So we see potential in these technologies, of course, as does everyone, but we're also seeing them architected and pushed into the markets in ways that we consider extremely reckless.
Meredith, I mean, just to be clear, this would be because you could have someone hacking into the system and getting information, but it could also be a government, tapping in and saying, actually, I want that information because I need to surveil, a certain type of person or a group of individuals.
Absolutely, all of the above. So there are 3 large commercial operating systems. We all know them: iOS, Android, Windows. And we all use one or another one of those. And so an ability to tap into one of those circumvents Signal's encryption and provides a kind of honeypot, a master switch to be able to get that kind of information. And again, what we are calling for is much more constrained deployments of these systems, the ability for developers like Signal to say, no, you can't touch Signal data. Signal data is mission critical. These are communications between Ukraine's military commanders. These are human rights defenders in places where they could be harmed if their communications were leaked. These are journalists who are protecting their sources, and giving access there is something that is extremely perilous to these people and undermines Signal's mission and our ability to continue with our mission with integrity.
Why do a lot of people not think about it? If you look at the big developers, is it just commercial, or is it because they think they can think about it afterwards?
Well, I think there is a commercial imperative. We saw, the CapEx versus revenue is a big topic on your show and everywhere in AI, and there's a real need to find a consumer market fit and prove that revenue can turn to profit and actually reap the gains of these technologies. So I think the incentive for cutting corners, for reckless deployments, for saying, we'll solve that later, is pretty significant. But I also think there's a tension here that's more fundamental. In order for an AI agent to be able to do everything for us on our behalf, it needs to have data. And so the question then is, how much data, where does it get access to this data, and what kind of guardrails can we put on that so we maintain the core security of our infrastructures, which power our governments, our financial institutions, our militaries, and our intimate and personal lives.
Honestly, it's quite difficult actually to speak up on that, because the European Commission and certain MPs have tried, and then there's an idea in the investment community that Europe over-regulates, and that's bad for business.
Yeah, well, I think that is a long-held trope. Europe is behind in tech because it over-regulates and it just needs to cast off these guardrails and innovate. I don't think that is at all entirely true. I think that's a very convenient story that sort of plays into stereotypes. But look, the U.S. regulates as well. everywhere, these businesses are given industrial policy incentives that may not be a bill or a regulation in the U.S., but nonetheless are sort of the government taking a stand on the side of these businesses or in other ways to direct what they're doing. In the U.S., I think the restrictions on models that have been floated and deployed and then revoked around Fable and Mythos are a form of regulation as well. So I think, one, we need to define what regulation is really, and then we need to get real. This is not a conversation about sort of, regulation versus innovation. What do we mean by regulation? How do we ensure that these technologies protect our core values, protect our economies, protect our ability for sovereign governments to act on behalf of their citizens? Those are the adult questions that need to be asked and answered instead of sort of high-blown rhetoric based on sort of stereotypes that break down under closer examination.
So who are the adults asking those questions? And is it a country like the UK that should take, it's a kind of, I guess, framework, if we don't want to call it regulation, to put guardrails?
Well, I think any country should be putting guardrails in service of ensuring that these technologies serve and don't undermine, like full stop. Those are what guardrails are for. I think, that a lot of people are asking these questions, but that you see a kind of admixture of hype around AI that is making it hard to come to consensus on, real solid answers. And again, I think the economic imperatives and the wobbly markets around, sort of, again, CapEx versus revenue versus profit are incentivizing a kind of looking away from some of these necessary conversations.
So this week, I feel like we had, big news. Certainly, we had recent news with OpenAI hacking Hugging Face. How seriously do you take this?
Well, look, I think one of the things that was concerning to me about that, yes, there was a breach. Yes, there was, a number of issues around Hugging Face's access to defensive models. We have a whole nexus of issues there. But I think we need to back up. This wasn't OpenAI hacking Hugging Face. This was an offensive exercise in which a human being told a model created by OpenAI, a system of software and hardware and statistical models that included an OpenAI model, to exploit vulnerabilities in software. That model then went ahead and did that. It did that in some unexpected or unpredictable ways. It looks like they didn't have an air gap network, which means it was able to sort of breach into Hugging Face's production code, which was sort of the shocking element there in a lot of the headlines, and that it did what it was told to do by the human beings who were running that exercise. Now, we saw a lot of hype coming out of that. We saw a lot of hyperbole. We have seen no incident report. We have not seen a log of what the prompts that were given to that model were to, compel it to do that or to, sort of prompt it to do that. And so I think we need to really tamp down the hype and really back away from this anthropomorphic language that paints these models as somehow conscious. And every time they do something that we might not have intended, we're like, oh, are they breathing, right? These are complex software, hardware systems that humans are behind. And I think, anchoring it in that technical reality will help us have much smarter conversations that aren't, again, kind of inflected with this pre-IPO hype and hyperbole.
Should OpenAI have done something differently?
I don't have enough details to understand the answer to that question, but I would say it appears that they did a fairly shoddy job of sandboxing and of kind of containing this offensive exercises. In the security community, we'd say it's a kind of red team exercise where we want to know the vulnerabilities in our systems, and so we prod and poke at them and try to find those before somebody else finds them.
How do you look at the Chinese models?
I mean, the Chinese models are impressive. I think the U.S. versus China, we're seeing a very interesting game of market arbitrage with the Chinese models. I don't have any secret insight into whether, Kimi 3 was a distillation of an Anthropic model, but it's clear that there are two economic models at work here. There is a sort of proprietary model that is licensed through cloud infrastructures and, owned by a given company. And then there are open source models where the model itself may be free to download, but then what you're paying for is infrastructural capacity and the construction of a system that will use that model in a way that is, useful to your business. And I think, I don't have a crystal ball here. Things are moving very fast, but I think it's very interesting and to see what happened there and to watch the market's response.
I mean, I like speaking to you because actually you're quite balanced, right? Because you either have a lot of concerns about some of these models, as you say, running away and kind of being the end of humanity, or you see only the benefits. I see a lot of chief executives, but also maybe heads of state, not knowing the questions they have to ask.
Yeah.
Is this the biggest concern, like how people go around thinking about this because it's moving so fast and all at once?
I think this is a huge concern, and I actually think there's a lot of uncertainty and almost embarrassment on the part of people who are in positions of power, who over the past few years have been hit with questions around tech and are like, shoot, I don't know the answer to that, but I feel like I have to fake it, or all the men in the room seem to know about tech, so I'm just going to nod along. And I will see the same people who will tear up a balance sheet in a board meeting, just asking incisive questions. I don't understand how that accounting works. What's that group doing? Really, really confident in their ability to, ask the questions that matter for them, their business, their institution. Say nothing when they're given a presentation that is, kind of an admixture of AI hype and reality. And so I do think we need to be asking much better questions, and those questions can be dumb questions, but they should be selfish questions. How does this actually work for our citizens, our government, the future we want to create? I may not understand the linear algebra to build a large model. That's not my discipline. But hey, I run a large hospital. I understand how that works, and I need to know whether a software system built with that model integrates with our legacy infrastructure, or whether I'm signing a contract that will ultimately not serve our patient population. Those kind of questions need to be much more front and center, and I think, hopefully integrating those into the public debate will give us a much more grounded understanding of how to govern and build these technologies.
And what you said is also, at the end of the day, AI is also worry about the concentration of power, because there are so few actors.
Yeah.
And it seems that, when you look at the spending, this power is growing.
Yeah, this power is growing. So is the cash flow is shrinking. Power is growing. Look, there is a long history to this. This is not, we snapped our fingers in 2023, ChatGPT grew an entire new scientific paradigm on which a large industry was built, and only the smartest won. We saw in the 1990s the U.S. government turning over network communication, so these communication networks, the internet, to the private sector. And the incentives built by the U.S. state over a number of decades to grow that sector into monopoly communication networks. And so what we had is the growth of a surveillance business model where social media platforms came out of that moment, spread globally with the U.S. state behind them, creating a monopoly infrastructure that is not the result of Europe or any other jurisdiction not innovating. It's the result of the fact that network effects, economies of scale, and that type of entrenchment across the stack in a vertically integrated way, allotted those winnings to a handful of actors in the U.S. that AI is now built on top of. It's the social media business model with the huge amounts of data, with the giant economies of scale in compute that actually catalyzed the AI boom in the early 2010s, when it was recognized that, hey, deep learning, this thing we hadn't thought was very interesting for very long because, it didn't really work for us, it actually does new interesting things when we have huge amounts of social media data and huge amounts of compute. And in particular, it is useful for calibrating engagement-driven algorithms. So the concerns over the 2010s around, what is the algorithm feeding the young people that we continue to talk about are actually deeply linked to this AI revival. And that's the kind of view I think we have to have of the market if we're then going to turn to the conversation on guardrails, on what Europe should do, on how we govern these. And the answer is not snap your fingers, try to build an alternative hyperscaler, because we understand these are monopoly forms you can't simply replicate. It's how do we leapfrog? How do we build better, more secure tech?
And so, like, how do you do that? Because if you're Europe, then you're also seeing, the conversations between the Department of Justice and, of course, and you kind of think, well, there could be the U.S. government calling some of these big companies and saying, stop giving your technology to Europe. And if we're too far behind in Europe to build it, how do I think about it now?
Well, I think we think about the problems we're trying to solve, right? And you can build a large model, you can build server capacity, but what are the problems that are not being solved by these large models? There are real security and privacy issues that have a market. Military, defense, really, the financial institutions need very robust systems. They can't be just sort of hand-waving at hallucinations. That's a market to serve. I think the energy expenditure and the compute required to train and to run inference on these models is another opportunity for a market. We're seeing massive pushback against data centers, largely, or in many cases, because we're seeing rising energy costs. We're seeing kind of energy depletion on the grid in the U.S. Well, there is an opportunity there to try to leapfrog in terms of efficiency. These large models themselves, these LLMs, which have sort of become the end-all, be-all to the AI conversation now, they do some things very well, good at coding tasks as long as you carefully review the code they produce. But there's a lot of things they don't do well. So can we invest in smaller or alternative approaches that don't require hyperscaler infrastructures? So there are many things that a leapfrog and sort of innovative approach could actually focus on, but you'll always be behind if you're focusing on trying to replicate a monopoly that has a many decades start.
But so you also said the Chinese, the Chinese models were impressive. So what would it stop? I mean, should a company actually in Europe and the U.S. look at those models, or there are even more concerns?
Oh, I think they are looking at those models. I think the concerns would track to what do you actually want to do with those models? What are you? What would you be concerned with with a data poisoning attack in one of those models? Would you be concerned with that in a U.S. model, right? So these questions need to be asked across the board and can't be filtered through a sort of geopolitical arms race, Cold War era narrative. It would be my answer. Any sober business leader needs to be asking these across the board, particularly in this environment.
Meredith, thank you so much for joining us today. That was Meredith Whittaker, the president of the Signal Foundation. Now, coming up, Bloomberg's exclusive interviews with the daughters of Africa's richest person, Aliko Dangote. We speak about their roles in family business empire, but also the upcoming plans to go public. Those interviews coming up next, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance.
flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, the daughters of Aliko Dangote, Africa's richest person, are taking on greater responsibilities in the family business in a bid to build a conglomerate into a $100 billion industrial group within 4 years. Well, Bloomberg spoke exclusively with them in their first interviews in their new roles. Well, Fatima Dangote, who leads commercial operations for the petroleum refinery, spoke about its upcoming IPO.
Yes, it's good that there's one of the biggest IPOs about to happen within the continent. But for me is the participation of both Africans and people outside of Africa into this story that the Dangote Group is trying to sell. When you look at it, Nigeria in particular has been exporting crude oil and importing refined petroleum products. But this refinery has changed that narrative or equation, whereby we're now having to add value to our natural resource here within the continent. And we're having to now be a net exporter of jet. When you look at it, when you look at the second quarter of products, jet in particular, that went into Europe, you see that 25% of that volume came from the Dangote refinery. So we're selling a story that Africa is able to industrialize at scale, not just at scale, but at a global scale. It's telling a story that Africa is able to conceive an idea, finance it, and manage a mega project at a global level. So it's not just IPO selling shares. It's showing the world that Africa has entered into the new phase of industrialization.
Fatima Dangote there. Now, her sister Maria sits on the board of the family's cement business, and she told Bloomberg that the unit is hoping to complete a secondary listing in London this year, saying the city is more compatible than other venues.
It will happen maybe by end of this year, the secondary listing, and we are planning to list in London because I think we compared many, like stock exchanges, London is the one very, like it's compatible with the, our business.
Really?
More easily because if we say, because Halima is running the family office in Dubai, so before we thought of the secondary listing in Dubai, but the rules, it will make it hard, for us, to list, to do the primary listing in Dubai, because there are many regulatories, compliance that we have to do, and it will take us more years, and we have been talking about this listing, for almost like, I think, 6 or 5 years, more than that.
But you're confident this is the year?
Yeah, I'm confident. Because why I'm confident? Because we did all our, background checks and everything, as I'm talking now, we have our lawyers, our financiers, and every other person, and even, the team, yes, are working, day and night to see if there is anything that will stop the listing. And as I'm talking now, nothing, no any constraint for now.
Well, that was, of course, Maria Dangote. Now, Pakistan is enjoying a moment in the diplomatic sun, having emerged as a key mediator between the U.S. and Iran. Bloomberg Regionals has been looking at how Pakistan's leaders may have opened a path to more economic opportunity by cultivating ties with President Donald Trump.
The Roosevelt Hotel, with its Italian Renaissance-style facade, used to be a happening spot, a choice location when Hollywood visited New York.
But ladies and gentlemen, we're not here to indulge in fantasy.
The reality is, last year it was a migrant center. Today, it's shuttered. And yet, its owners say it's worth $1 billion, and they've called in help from this guy. Oh, and who are the owners? That would be the Pakistan government.
It is one of Pakistan's most valuable foreign assets.
In February 2026, Steve Witkoff, one of Trump's closest advisors, helped broker a deal for the U.S. government and Pakistan to jointly redevelop the hotel.
But recent deals between the Trump administration and Pakistan have extended beyond the hospitality scene.
Markets are waiting for Islamabad as delegations from Iran and the United States prepare for talks in Pakistan. The ceasefire remains fragile.
Pakistan has done something impossible. Pakistan brought the U.S. and Iran together on one table after 50 years.
This was a deliberate attempt by Pakistan to make itself a global player.
That peace hasn't lasted. The ceasefire between the US and Iran has collapsed. But Pakistan hopes its role as mediator has more longevity.
So this has really been Pakistan's shining moment.
So how did Pakistan become one of Trump's favorite diplomatic partners, and can it capitalize on it?
Well, subscribers can watch that documentary in full right now on the terminal and on Bloomberg.com. Now, Intel shattered Wall Street estimates with its revenue forecast lifted by booming levels of spending on data centers. You can see pre-market Intel gaining some 4.2%. We'll have plenty more, of course, on the markets. U.S. futures, if you look at what markets are doing, they're getting a little bit of relief. Brent slipping below $100, but still concerned about AI. Up next, Bloomberg Brief, and this is Bloomberg.
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting.
What magazines were you reading as a kid?
I don't think I was reading magazines until I was in them.
You are on the cover of all of these. Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting, rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Futures wavering after the Mag 7 suffered their biggest one-day drop since the tariff-driven sell-off back in April 2025. Fresh U.S. levies take effect on goods from 60 economies as President Trump rebuilds his tariff wall. And Brent crude below $100 a barrel now, having topped 100 as President Trump says he's mulling a massive attack on Iran. Let's check in on markets around the world. Asia closing out an eventful week. Winnie Su is in Hong Kong with the latest. Winnie.
Yeah, good morning, Bonnie. Well, it is a risk-off day in Asia as we head into the weekend amid these geopolitical tensions, and still oil remain at elevated levels. Now we have the MSCI Asia here down more than 2% after 3 days of gains. It is the tech really leading the declines today, as concerns are still really around how these massive spendings of U.S. hyperscalers are going to weigh on sentiment. We have South Korea's Kospi Index today leading declines in Asia. Now, flip aboard, we'll take a look across asset when it comes to Japanese markets, because it still is those inflationary risks and also the higher U.S. dollar weighing on the Japanese yen as it weakened overnight to inch closer to that 164 level against the dollar. Now, it is also on track for its worst week in more than 2 months. Now, when it comes to the bond yield space, we are looking at similar impact because we have the 40-year bond yield leading gains across maturities up about 10 basis points, while the 5-year is also hitting a record since its debut in 2000. The concern really is that the Bank of Japan might be too slow in tightening the policies to tame inflation. But for now, the expectation for the policy meeting next week is still for a hold.
Yeah, and that yen very close to up one more big figure, Winnie, very close to 164. Winnie Su there in Hong Kong. Now to London, where beyond all of that, markets have also been digesting that ECB meeting and new leadership in Britain. Here's Louise Moon.
Good morning. As we're saying, roughly broadly higher across the European space. We can see the stocks Europe 600 just slightly into the green, potentially ending that week there into the green, boosted largely by tech and by financial services. So tech on the back of SAP earnings, coming in stronger on the back of their cloud, easing some concerns there to do with AI, and that is boosting tech across the board. And then we've got financials, you can see up just over 1% there on the back of this higher for longer rate story boosting banks across Europe. And then a quick look at the German bond yields. This is a story we've been seeing playing out across Europe this week. It's been a tumultuous week as, you know, on the back of this higher oil prices, easing slightly today that we can see, just easing there. So we'll be keeping an eye on that one throughout the day.
Yeah, those yields in Europe have really been shooting higher, as they have around the world, including in the United States. Louise Moon, thank you so much. Interesting to hear Louise talk about the positive tech story, because, of course, we had a sell-off on the NASDAQ yesterday, a pretty dire one, in fact, down 1.9% as things go. I mean, if 2% is dire. Today, we might get a little bit of relief because we are seeing Brent and New York crude trade a little bit lower. Brent having topped $100 a barrel, now is just above $97 a barrel, even though we got word from Iran that New York Times report that suggested Iraq had sent some kind of mediator or mediation request, that wasn't actually true. Either way, headlines keep coming and the market keeps digesting them. No relief really, though, for European gas futures, still above 62 euros per megawatt hour. Let's take a look at futures, because obviously we've had an up-down week. Intel with great earnings, SAP, as Louise mentioned, with great earnings, and we are starting to see the NASDAQ creep into positive territory. Futures really were wavering between losses and gains earlier on. It looks like, very tentatively, we might be having a positive day off the back of some of those tech earnings. Nevertheless, the broader tech sell-off does still seem to be a little bit intact. And yields-wise, well, we're seeing a phenomenal picture in yields. The 30-year yield is at 5.17, basically. We had another, not failed, but weak demand auction yesterday for 20-year tips, and that was just yet another sign that the appetite isn't there for longer-dated yields. Look at the 2-year, 4.32. We have shot up in just a few sessions to 4.32.85, and we're just down 2 basis points, so we were even higher than that. The 10-year yield as well topped 4.70 in yesterday's session. Really a phenomenal move in yields, but central banks obviously digesting the potential inflationary impact of oil, whether it's right above 100 or just below 100, it doesn't really matter. The VIX also yesterday topped 20. We're a little bit off that now. Okay, let's get to some individual market movers, and for that we'll go back over to London and Chloe Melly.
Good morning, Bonnie. We are seeing Intel shares up this morning about 4% after their revenue forecast came in way ahead of expectations. This indicates sustainable, strong AI demand and really reassures investors on both this AI demand, but also this turnaround from Intel, which seems to be paying off. Moving on, but staying within tech, and we've got Max Linear this morning down after the results actually came in ahead, but only modestly ahead of expectations. So that was not just quite enough to really sustain the impressive rally that we saw in those shares over the start of this year. And finally, Amcor is also down this morning. Up this morning, up 10% after signing a multi-year partnership, $1.5 billion partnership with NVIDIA, and that is to develop some new technologies around AI platforms. And so we're up quite strongly there as well for Amcor.
Chloe, thank you so much. Chloe Melee will be back later in the hour. And also coming up this hour, we're going to speak about the tech sell-off and risk-on sentiment with Wei Li of BlackRock, the resurgence in energy prices and its impact on global yields as well, to the forefront of that conversation. But first, President Trump rebuilding his tariff wall with new levies on 60 economies to prevent alleged forced labor in their supply chains. U.S. Trade Representative Jemison Greer writing in a statement, quote, "The United States has had a forced labor import ban for nearly a century and rigorously enforces it. It's well past time for our trading partners to do the same." Joining us now is Bloomberg's Brendan Murray. Brendan, are there no countries on this list that don't enforce a forced labor ban?
Well, that's what the U.S. administration says, is that all of these countries, some 60 plus the European Union, have some sort of lax enforcement or no regulations to prevent forced labor to appear in their supply chains and in the imports into their own countries. And so this measure has been in the works for a couple of months now, and what we're seeing now is the implementation, and it's really the first step of the administration's efforts to rebuild this tariff wall that the Supreme Court struck down back in February. The Supreme Court took away President Trump's favorite tool, but he has these other authorities that we're going to see come out throughout the months ahead. He's also used one recently this week against Canada that no one has ever used before, threatening a 50% tariff on Canada. So a lot of the uncertainty still will linger around this area of global trade because we don't really know exactly when or what level these tariffs are going to come in.
Yes, and there are exclusions from these particular tariffs, so imports of fuel, foods, fertilizers, also some, other products like automobiles and anything that's covered by NAFTA, so a lot of exclusions. What about individual countries? Will they start asking for exemptions, and what will they have to offer for that?
Well, the line is already starting to form from countries. We've got reactions from a number of them today, from Europe, across Asia, and this will feed into the administration's efforts to try to bring countries to the negotiating table. It will add leverage on the U.S. side to encourage these countries to open their markets, to lower their barriers to American exports, and to negotiate the kind of trade deals that the president has struck so far. The U.S. Trade Representative Jemison Greer appeared before Congress this week. He says there are 19 of these so far, so there's a lot of work yet to be done, but what we're seeing is the administration sort of brick by brick trying to rebuild this barrier around the U.S. economy to accomplish their goals, reshoring U.S. production, a revival in manufacturing employment, and ultimately to raise revenue for the Treasury.
Brendan, thank you so much. That is Brendan Murray, our trade czar in London. President Trump also sending a stern warning to Iran, telling Axios in an interview, quote, "I am considering a massive attack, bigger than ever before. I am close to making a decision. We are all set for it." Bloomberg's Onur Ant joins us now for more. Onur, if the president is serious, and he has carried out attacks, obviously, 13 consecutive days of them, would he need a new catalyst, or does he have enough already to make that military strike?
He probably doesn't need a new catalyst, but if he needs one, he clearly singled out what it would be. He said, well, he has been saying that Iran should stop attacking maritime shipping through Hormuz. But what happened earlier this week was that not Iran, but a group backed by Iran attacked ships not in Hormuz, but about 2,000 kilometers away in the Red Sea before those ships were supposed to exit the area through another choke point called Bab al-Mandeb. So that had created some confusion as to whether that would qualify as a trigger for further U.S. retaliation. And President Trump yesterday clarified that very openly. He said any shipping attack in the area, be it by Iran or any other groups that it supports, will be considered a fault or a mistake by Iran, and it could result in further escalation and retaliation by the U.S. So yes, in essence, he doesn't need a catalyst, but if he needs one, he clearly made it very clear what that catalyst would look like, and that's any attack on shipping in the Middle East, be it in Hormuz or Bab al-Mandeb Strait.
You know, Oner, when the Strait of Hormuz was being blockaded by Iran, after a while, President Trump turned around and decided that the U.S. could also do that, could also blockade on the other side, right? Can it do anything like that on the Red Sea side of Saudi Arabia?
Well, that would be quite a stretch. Well, first of all, there is not much to blockade on the other side, because in the case of Hormuz, he pledged to blockade Iran, whereas in Iran, Bab al-Mandeb, he would only be blockading Yemen, which doesn't have the kind of oil exports that Iran has or relies on. So there isn't really that same cost or benefit dynamic that could go into that kind of blockade. And probably equally importantly, the U.S. military is already stretched in the area, in the region. So it's hard to imagine a scenario where it can successfully blockade, for whatever reason, another country that's about 2,000 kilometers away from the Strait of Hormuz.
Oner, thank you so much. That's Oner Ant, our managing editor for the Middle East and North Africa. Now to other top stories trending on the terminal this morning. Bloomberg sources say SpaceX has started turning away satellite operators seeking rides on its Falcon 9 rocket beyond 2028. SpaceX has said it plans to transition Falcon 9 for Starship. Starship is central to Elon Musk's ambitions to put data centers in space. The company declined to comment. Volkswagen cut its revenue outlook for this year, saying it could decline as much as 3%. The automaker is expanding in Europe to counter slumping sales in China. Volkswagen still expects earnings to improve in the second half of 2026. The CFO spoke to Bloomberg.
We introduced about 20 new models this year and another 20 new models next year in various joint ventures. And with this setup, we want to achieve in the long term 10 to 11% market share in China.
Euro area business activity jumped to a 5-month high. The S&P Global Composite PMI rose to 51.9, moving back into growth for the first time since March. Germany also returned to growth while France's downturn eased. S&P Global warned renewed tensions around Iran could still weigh on the outlook. Coming up, Intel shares higher in pre-market trading on a blowout revenue forecast. We'll examine next. This is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ula, Saudi Arabia, and this is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Bloomberg Brief. I'm Bonnie Quinn in New York. Shares of Intel higher in pre-market trading after its revenue forecast shattered the street's estimates. The chip maker looking to keep capitalizing on the AI boom. CFO David Zinsner told Bloomberg, quote, "We'll be increasing our capex from about $18 billion to $20 billion for this year, which will then mean it's up year over year. When we came into the year, we thought it would be down." Bloomberg's Neil Campling joins us now. Neil, incredible. How did Lip Bhutan and his team position Intel so quickly to benefit so much from the AI revolution?
Yeah, it's a great question, Bonnie, because we know from historically the company has struggled with execution. So firstly, they have turned this around in terms of executing to plan, which is a great relief. The second aspect, and the reason why Intel are benefiting from this, is what's happening in terms of the AI workloads. Because we're now moving away from training models, if you like, and now moving into really the key growing workloads, they need a lot more CPUs, the core processing unit power, which of course is the bread and butter of Intel's business. So we're seeing a massive renaissance really of the CPU demands, and that's coming through in terms of Intel's growth and Intel's revenues and the ability to have the confidence to raise that CapEx guidance, as you mentioned. So that's really positive and playing out for them. And the other thing to think here in terms of the geopolitical dynamics that are at play, then, you know, the only US-based leading edge maker of the actual chips is Intel. So that clearly plays into another key positive for the company, despite the fact that we've got, you know, other concerns in other areas of the AI trade with the Mag 7, etc. And, you know, I saw somebody called out the Mag 7 as a malignant 7 this morning. Oh. Well, this is a way of benefiting from that, that's for sure.
It does feel like a group of the past at this point. Neil, I do have a question though. Why do none of these companies disclose who their clients and what their contracts are? Lip Bhutan himself just talking about multiple engagements. He wouldn't say who, what, where, when.
It's either a question of the competitive arrangements in terms of not wanting to let secrets out as to what kind of form factors the deals might be, whether it's based around the NVIDIA ecosystem or an AMD system or the Google TPUs, those kind of things perhaps. Or is it perhaps because of some of these circular deals that are concerning some investors that are taking place where NVIDIA's been funding some of its neo-cloud partners, etc. So it's certainly something that we'll be looking to get more disclosure on going forward. But for now, yeah, it is one concern to be aware of for sure.
SAP's cloud growth also extremely impressive and really helping Europe massively today. What has SAP done?
I think if we came into the print, then there was real concern that they might do should we say, an IBM. What IBM said in terms of the stalling of spending from clients, that could come through in SAP. They didn't see that. Their bookings growth is very strong. So that's a relief rally for sure for SAP for the time being. So I think that's very, very good news for European investors for worried about the kind of maybe the Anthropics of the world where clients may be spending on their tools. The core business for SAP is still in high demand. So there's definitely a relief there. And I think for investors, they're going to be looking to see what Microsoft say next week. That's the real, I think, key bellwether for the next move in the software complex.
Well, several stocks higher this morning. It remains to be seen if the broader tech sector will be up or if some parts of it will be dragging the tech sector down. Neil, thank you so much. Neil Campling there in London for us. Coming up, Meta facing higher than expected borrowing costs for a new data center. More on that and what else is making headlines in your front page news. This is Bloomberg.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC. Africa CDC is the leader in terms of public health in Africa.
Asia is at the forefront of some of the world's biggest stories. And we're here, where the action starts in Sydney. And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Bloomberg Brief. I'm Bonnie Quinn in New York. This week on Bloomberg Wall Street Week, we take a look at housing affordability in the United States. There's one major city where that appears to be making real progress, while others are still struggling.
The city itself was adding about $10,000 a month to the cost of a single-family home. And it was causing more than $500,000 a month to multifamily. Well, you can't, out of one side of your mouth, say you're for affordability, and out of the other side of your mouth, be getting in the way. And then, of course, the second big area is land use itself and how we make it so that people can use the land and build what they need to build. We came in and through what we called our home initiative, we changed that to allow by right 3 units on even a single family's owned lot. And then the second thing we did is change the minimum lot size. In Austin, our minimum lot size when I came into office was 5,750 square feet. That was the minimum lot you could build on. Well, what that means, if you got to have that big a lot, then you're going to need to build a big house. You're going to need to build a McMansion. But if you have the ability to have 3 by right and you reduce the minimum lot size, which we did, to 1,800 square feet, from 5,750 to 1,800. Now you can start building what I was talking about a minute ago, those starter homes. You can build smaller homes and it makes economic sense. The market can react to that in an appropriate way.
Wall Street Week's Simon Hampton joins us now at the desk. So it sounds like Austin did find some solutions, but what made the situation so urgent in Austin in the first place?
Well, it all started in the pandemic. You know, a lot of us were working from home, and a lot of people went to Austin. A lot of businesses moved to Austin. So there was a big influx of people around 2020, 2021. And rents, I think, increased around 25% in a single year. That was one of the biggest increases in the nation. So the advantage of that, I guess, is that the mayor there, you heard there, Kirk Watson, he really had support from both sides of the aisle to do something about housing. And so he got buy-in from everyone, and really he was able to turn things around and change a lot of zoning rules, change permitting, make things a lot easier for developers to bring supply online. And between 2023 and 2024, they built around 50,000 units. Wow. So they brought in a lot of supply, and then since then, they've now seen rents declining from that 2021 average by about 19%. So the supply comes online and affordability.
Yeah, the economic effect is literally follows right after. Can other cities replicate some of the things that the mayor was talking about?
I think they probably want to cherry pick some things. Maybe you take Manhattan, for example, which is certainly receives a lot of focus around affordability, and with Mayor Mamdani's rent freeze, an unpopular move with landlords at the moment. You compare Manhattan and Austin. Well, you heard there the mayor talking about the average lot size of 5,750 feet before they made the changes.
Yes.
It's a lot more than a Manhattan apartment.
Would we have that luxury in Manhattan? Bloomberg's Simon Hampton, thank you so much. Do tune in to tonight's edition of Wall Street Week. It's at 6 p.m. New York time. Coming up, we'll speak with Wei Li of BlackRock.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Futures slightly higher after the Mag 7 suffered its biggest one-day drop since the tariff-driven sell-off in April 2025. Fresh U.S. levies taking effect on goods from 60 economies as President Trump rebuilds his tariff wall. And Brent crude below $100 a barrel now, having topped it after President Trump says he's mulling a massive attack on Iran. Let's take a look at those markets then, and oil well down now. We have Brent crude, a positively calm 96.78 a barrel. Now, I'm being slightly sarcastic because obviously that's not a good figure to see. We heard that yesterday with Christine Lagarde being extra hawkish at the ECB pretty unexpectedly, or at least she wouldn't have expected that she would need to be. But that run-up in oil is still pretty massive. We saw a more than 30% run-up in Brent. this month alone, and obviously yesterday we did top 100 a barrel, so whatever is calming this market is certainly having an impact. WTI as well, below $90 a barrel once again, so down a good 3+%. No relief though for European gas futures, where we're really seeing some pain. 60 to 29 per megawatt hour now in terms of euros, and that is a really stunning incline for European gas futures. Obviously, there's a whole lot of pain about to be felt in Europe, and storage is really getting massively depleted as well. This is a time where normally Europe would be rebuilding inventories, and they haven't been able to as fast. They're only rebuilding them ever so slowly. Inventories usually around 70% full at this point. Now they're only just more than 50% full. Let's take a look at the US futures picture, because we did see that pretty massive drop yesterday, even with some positive earnings stories after the close, like Intel, for example, really cheering the market. Now, futures started off deciding which way to go, because we had a down session in Korea overnight and the chip sell-off continued there. However, it does appear that futures are going their own way here in the United States and rising once again. Let's look at yields, because that's also the massive story, particularly, well, the whole curve actually. We have the 2-year yield being extra volatile and well above 430, a massive rise in just a few sessions. And the 30-year yield continues to elevate. It's really just under 517 now. We had a tips auction yesterday that also saw poor appetite. So investors seem to be waiting for more basis points to get put on this trade before jumping in. All right, let's get to some individual market movers. Pre-market now. Back over to London and Chloe Melee.
Good morning, Bonnie. We are seeing Intel up about 4% in pre-market trading this morning after this much stronger than expected revenue forecast, which of course signals this very sustainable, strong AI demand, and also seems to indicate that the turnaround of the company is making progress and is starting to pay off. And so we're up quite strongly this morning for Intel in pre-market trading. Moving on to another tech company, we've got the semiconductor device company MaxLinear down quite significantly this morning, more than 10% after earnings came in only slightly ahead of expectations, and that was just not quite enough to sustain the massive rally, a more than 400% rally that we had seen in those shares since the beginning of the year. And finally, let's end with one last tech stock. We've got Amkor this morning signing a multi-year $1.5 billion partnership with NVIDIA to develop a semiconductor, advanced semiconductor packaging, and also testing some new technologies around those AI platforms. And so this is really driving the stock this morning, and we're up almost, well, actually more than 11% this morning for Amkor.
All right, Chloe, it is going to be a very interesting Friday trading session. Thank you so much. Futures edging higher after stocks notched their biggest drop this month. Whaley of BlackRock keeping the faith, though, sticking with stocks, writing, quote, "We prefer U.S. equities over long-term government bonds, so long as earnings growth remains exceptionally strong while offsetting higher interest rates." She's Global Chief Investment Strategist at BlackRock and joins us now. Whaley, characterize this earnings season for us. We've seen some massive disappointments, even if companies did surprise to the upside, and some massive outperformances, even when companies just did what they're supposed to do.
That's right. Good morning. What we have seen so far in the earnings season is that the sellers of scarcity are doing much better than buyers of scarcity. But the bigger picture remains that earnings expectations are very strong and elevated. So expectation for 26 this year, earnings growth for S&P 500 has grown to 25% from just 18% 3 months ago. So momentum is very strong, but increasingly it's not just about kind of the levels, but also durability of earnings, which is why kind of looking just beyond the next quarter is important, especially in the context of some of the cheaper models also becoming very good, potentially impacting the economics of AI and also how rent can be captured, especially in the intelligence layer. So specifically for this earnings season, I am looking for earnings durability. I'm looking for companies' commitment for CapEx, but also how they balance that with discipline, CapEx discipline, and also importantly, in the face of cheaper models, models becoming very good, how management is dealing with cost pressure and cheaper model deployment, and also in particular AI sovereignty, which is becoming a bigger consideration.
Yeah, absolutely. I think that's definitely going to be the next question. Wei, when will we know whether hyperscaler returns justify the capital outlay? Is there a company that will elucidate that for us, or a subsector of the AI trade?
I think we don't know yet, because it does take time for investment to then lead to new revenue creation, which is why in our media outlook, we try to focus on the scarcity, the bottlenecks, rather than betting on winners and losers. But for this earnings season, we are paying attention to revenue creation, earnings sustainability too. You know, we're looking at cloud revenue to get a sense, a hint of if some of the investment is paying off. But the bigger question about all this close to trillions of AI capex spend, when they are going to bear fruit, I think it's just slightly too early to say, which is why we are betting on the infrastructure layer, because even as models become cheaper, accelerating adoption can still create additional demand. But also, again, AI sovereignty, companies and countries wanting to have greater control over their own AI, wanting to rely less on foreign infrastructure. All of that leads to greater demand for infrastructure, which is how we want to play this.
Well, Wei, the thing about scarcity is that it's only scarcity if demand outstrips it, or close to outstrips it, right? And I feel like an investor has to really have the faith that these companies will see the pledges delivered upon, right? OpenAI and Anthropic pledges. I mean, will that happen? You know, could there be a problem down the road where those commitments aren't actually met in the end?
There is definitely a risk on the table. Right now, we're still in an environment where there are multiple scenarios, each very different from each other. They're all on the table. We call this environment a polyfaceted environment, which is different from before, where, yes, we have multiple scenarios on the table, but they follow a bit of a central case. Right now, there's no central case anymore with AI transformation and some of the other mega forces. So one thing that we are paying attention to, going beyond just this earnings season, is the revenue ramp of this leading model labs. You know, like we have seen incredible eye-watering revenue ramp, increasing ARR from likes of Anthropic and OpenAI. Earlier this year, momentum continues. If that continues, is going to be key, especially in the context of cheaper models, open source models becoming also very good. So the risk of commoditization is indeed important in terms of revenue capture for these model labs. But again, that impacts more on the rent capture of the intelligence layer, rather than questioning the whole AI thesis. The infrastructure build, that layer we do not think is impacted by more models coming online that are also becoming very good.
Wait, I have to ask you about yields, right? Because even you are so positive stocks, in spite of what you call a fragile world, right? There are so many challenges out there. Tariff risks are back. War risks are absolutely back just in the last week. The oil price shock, obviously, as a trickle down from that. And we've seen yields pretty much skyrocket, right? I mean, at their highs of the year, and maybe even 2 years for some parts of the curve. And it's not enough to entice investors back. Investors seem to be still looking at the AI trade, as are you. Explain to me why that makes sense.
Yeah, so this is really interesting and delicate. So I always get a bit nervous heading into summer, because investors want to square their book and liquidity is a bit thinner. So these are the technical factors that could drive market volatility. But in the rates space, it feels that it is more than just the technical factors that are driving yields spiking higher and volatility increasing. It feels a little bit more fundamental, and it's really the result of the two developments that you talked about. One is this prolonged supply disruption leading to higher inflation expectations and higher rates, and the other one is AI build out, increasing competition for capital, pushing up rates, not only nominal rates, but also real rates. So what we have seen in the rates yield space feels more fundamental. And this is something that we have been talking about for a while, the increasing competition for capital pushing up real yields. So that is happening now. And we actually think that there may be more to go. It's a great place for income. So durable income is going to be an even more durable theme in portfolio, but definitely this is why we have preferred equities over government bonds.
I didn't get to ask you about the Fed. We'll have to ask you after the Fed meeting. Wei, thank you so much. Wei Li of BlackRock joining us this morning. Now to all the top stories trending on the terminal. Bloomberg sources say SpaceX has started turning away satellite operators seeking rides on its Falcon 9 rocket beyond 2028. SpaceX has said it plans to transition Falcon 9 for Starship. Starship is central to Elon Musk's ambitions to put data centers in space. The company declined to comment. U.S. regulators will start developing new requirements to make sure drivers and passengers can safely exit their vehicles. The move comes after at least 15 deaths occurred in which car occupants couldn't open the doors of a Tesla that had crashed or had caught fire. The World Cup, staycations and scorching weather helped Britain's private sector bounce in July. S&P Global UK PMI data rose to a 3-month high. It came in at 52.1, a sharp increase from June. The hospitality sector was the biggest beneficiary, with pubs boosted by England's run to the World Cup semi-finals. Coming up, global tariffs are back. President Trump makes his biggest move yet to reconstruct his levies after being struck down by the Supreme Court. This is Bloomberg.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. President Trump putting his tariff wall back up. Fresh levies, two straighter, 10% and 12.5% on goods from about 60 economies, and they took effect overnight. Let's get more with Jonathan Tamari of Bloomberg Government in Washington. So the administration found a way, Jonathan. Is this a permanent, legally compliant fix?
It's certainly more long-lasting than the tariffs that just expired that had a specific time limit on them. As far as how much this stands up in court, I think it's going to be tested. It certainly is, again, it doesn't have the time restrictions as the other one, but I think that you'll certainly see people testing whether or not this actually complies with the law. The fact that these tariffs rolled on at the exact moment that the old ones rolled off, I think will be something that will be tested about whether this was a legitimate investigation and a legitimate use of the law.
Many, many products are not included, right? And there's also products that fall under NAFTA agreements that aren't included. And of course, Trump has also threatened tariffs on various subsectors and so on. So this isn't the end of the story. At the same time, countries will likely be trying to at least get around some of these tariffs, if not retaliate. Is the administration planning that there won't be any retaliation given what happened last time?
I mean, I think they need to expect that there will be retaliation, and they've experienced that already. And I think often we see, not always, but often we see that when the president's first moves are often just for leverage, for negotiating. We know that this week, for example, he also announced he was threatening the possibility of 50% tariffs on some things from Canada. And most people in both countries say that that's probably something that he's trying to use to bring Canada to the table for renegotiating the U.S.-Mexico-Canada trade agreement. And so I think that there's a chance that some of this is more leverage for the president, but some of it is that this is his signature economic policy. It's something he really believes in, and that he's doubling, I guess, tripling down on. This is his third attempt to put this in place after the Supreme Court knocked down the first one, and then his second effort had a legal time limit on it.
Moving to Iran, Jonathan, so obviously the president says he's weighing wider Iranian attacks. He said that before, but this time he seems to really be planning on escalating in a massive way. That was literally the word he used. You know, the cost of the war is increasing. There's an official count now of 17 bodies, right? As well as all of the munitions and the depletion of resources that are already, you know, going to 2 wars to help other parties. Will the president get a good response from anybody if he makes a massive strike on Iran?
There's not a large appetite that we're seeing in the American public, in Congress, for escalating this war. The war has been unpopular in public polling since it began. Members of Congress have not been consulted. They have very little say in it. There's a lot of frustration about that. The House, which, as you know, is controlled by Republicans, just for a second time passed a resolution to try to rein in this war. It was mostly, to be fair, Democrats supporting that, but there were 4 Republicans who crossed over. And remember, we are heading into the heat of election season. And when you talk about tariffs that have the potential to increase costs, a war that much of the public doesn't like and is also increasing gas costs, those things are not great for Republicans who are campaigning right now. So I don't think there's a lot of appetite for it, but we have not seen any serious moves from Congress to rein this in. And so there's a lot of complaints, but not a lot of action. I don't think there's a lot of support for this move, but the president seems to be out of maneuvers as he's failed or not been unable to reach an agreement with Iran.
Jonathan, thank you so much for all that context this morning. That is Jonathan Tamari of Bloomberg Government. Turning back to tech now, and shares of Intel jumping out of the chipmaker's guidance blew past analyst estimates. CEO Lip Bhutan telling Bloomberg, quote, demand is outpacing our increasing supply, and so those are good problems to have. Let's get more with Matt Bloxham of Bloomberg Intelligence. Matt, what is Intel suddenly doing so right?
Yeah, maybe it's not so much what they're doing right, but the way the market is moving, particularly in AI. So, you know, we went through a long phase where the investments were squarely focused on GPUs, the kind of chips that NVIDIA builds. And that was because the market was focused on training the big models. And because the market's now shifted towards actually deploying and using AI, particularly in a corporate environment, then you need a lot more of the kind of general compute, so CPUs, which is Intel's strength. And so I think the market's kind of shifted back towards where Intel really has strong capabilities. And yeah, as we heard there from the CEO, they've been expanding capacity alongside that, so they're more able to kind of match the demand that's out there.
But also, Matt, I mean, it's been a bit of a land grab, right? And Intel seems to have been able to ramp up really, really quickly and grab those clients, or as Lip Bhutan calls them, multiple engagements, whatever that means.
Yeah, so I think this kind of flips a little bit into the foundry market too. So, you know, in parallel to their kind of Intel-branded chip business, they're also building a foundry business, which is basically them contract manufacturing chips for other parties. It's still a kind of growing business, still at kind of very early stage, but they've got one public customer in Fortinet and a number of other companies that are evaluating the product quite closely, and perhaps the most interesting of those is SpaceX, together with Tesla and their TerraFab initiative, who may well use Intel as a significant contract chip manufacturer. So I think, you know, in both these areas, the business has got really good positive momentum. We heard today that they're planning to increase their capital spending. Historically, they've been cutting capital spending, and obviously now we saw a negative reaction to CapEx increases at Google earlier in the week. But I think Intel's coming from a very different place, and I think that's a strong signal of confidence in the forward book of demand that they have.
Yeah, important note to make there. And Matt, you know, it looks like Intel is going to add to its 171% gain year to date. That's just year to date today in today's session. Matt Bloxham of Bloomberg Intelligence, thank you so much. Coming up, we're going to get you set up for your trading day with more earnings and economic data on deck. This is Bloomberg.
The most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Guerrero.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. 6 contenders vying to be the next United Nations Secretary General made their cases at the UN headquarters here in Manhattan. Here's a part of the town hall.
Our responsibility is to make the UN relevant again, to deliver, to touch the hearts and souls of people on the ground.
Moral authority is always needed, and you always need to speak out on the issues where violations of human rights have been.
What we need to do is to restore this credibility of the UN as a valid interlocutor.
I would like to see a UN that is back at the table in the scenarios of conflict. I would like to see a UN that has rebuilt trust.
The UN must be more present, especially in the peace and security arena, that we would have moved from where we are today to a UN that is delivering better in peace and security.
Global security, peace and stability is something that is incumbent on the Security Council, and the lack of trust between the members today, particularly between the permanent members, is that means that crises go on without solutions being found.
And that was part of the UN Town Hall. Now, a look at what's ahead for this Friday's trading session. Well, we get earnings from SLB and American Express before the bell. And then we get data, US PMIs at 9:45 Eastern, followed by new home sales at 10. Plus, President Trump slated to participate in the rescheduled White House Correspondents' Dinner tonight. That takes place at 7 p.m. in Washington. Some micro movers before the bell now. Obviously, Intel extending post-earnings gains as its blowout outlook underlined AI demand. Max Linear down 10%. Results failed to sustain the strong rally so far this year. And Amcor Tech rising pretty substantially after the firm announced a $1.5 billion deal with NVIDIA. Let's take a look at your macro picture, though, on this final session after a really bumpy week and ahead of what could be an eventful weekend. We do have NASDAQ futures pointed higher, Brent crude coming down, and the 30-year yield at its highs close to them.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
I'm still very bullish on the overall AI infrastructure.
Second quarter earnings will probably mark the peak.
That bar, again, has become so much more challenging for rewards here.
There are legitimate questions about cash flow.
Aren't we all believing a little bit too much into that U.S. exceptional picture?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, ready for the weekend. The U.S. equity market heading for back-to-back weekly losses as the White House is threatening bigger and broader strikes on Iran. President Trump is rebuilding the tariff war with new levies on 60 economies.
Between 10 and 12.5%, that is the new levies under Section 301. This was widely expected as a way to get that income back that you hadn't gotten. I wonder if this is in response at all to the bond yields. I know this is kind of a crazy conspiracy theory, but there is this thought that people are getting increasingly concerned about deficits because you are not getting the income from what we had expected from tariffs. So if you recreate them in one way or another, maybe that could bring in revenues. Either way, it seems like people are wanting to fade the story hard as they have to focus at least on oil.
I'm sure the Treasury Secretary loves the idea of more money coming to the United States, but Trump is tariff man, and the tariffs were always going to persist. He just had to find new ways of enacting them. One administration official, though, did reject the idea that Trump was imposing these just to purely replace the earlier duties. But it clearly looks like a plug and play for what happened with IEEPA, which was struck down by the Supreme Court.
We got some better news this morning, at least. Crude is pulling back. Bring up the board. Brent, WTI down by 3 to 4% this morning. Brent pulling back from $100 a barrel to 96.88. Check out the bond board too. 2s, 10s, and 30s. Yields coming off the highs of the year. And in some parts of this market worldwide, the highs of the last several years, and for that matter, the last several decades. The 2-year at the moment is about 432, 10s at about 468. Yields are elevated here. So we've had the energy shock. We've had the rate shake-up. We haven't had the growth scare. And I think that third dimension is really, really important. So when you look at this bond board, why are we holding these levels for longer? It's precisely for that reason. We haven't had the growth scare off the back of all of this.
This is unusual. Typically, when you have bond yields up, that is a problem for equities, yes, but typically there ends up being some sort of self-fulfilling prophecy where people go back into bonds. That's not happening precisely because of what you are saying. Yesterday, we had the lowest initial jobless claims going back to 1969. One earnings after another highlight the strong consumer. I keep going back to Capital One, the fact that their charge-offs came in so much lower than they had expected, that they delivered much better than expected results. There isn't a sense of pain. In fact, it's resilience and even growth for the U.S. consumer.
We don't have a problem in the labour market, not an obvious significant one anyway. So if you're going into the meeting next week, you can't really lean on that as a dove right now. As a hawk, you can just point to inflation, and inflation being a problem. This came from Guneet Dhingra of BNP Paribas. BNP Paribas and Guneet has done a fantastic job of calling out this bond market ahead of time. When he talked about 5% not being a ceiling for this bond market, I wrote to him yesterday, this is what he said. Sticky inflation, healthy growth, hawkish Fed, ever-rising deficits, Bremo, and AI build-out raising the cost of long-term capital. It is harder to see how yields stop rising.
And that's what you're seeing right now, not only in the U.S., not only in Europe, but also in Japan. And guess what? We heard this morning that the Bank of Japan isn't going to be hiking rates in response to this. And guess what? The long end of the Japanese yield curve continues to sell off. And so at a certain point, you have to wonder whether this is a resetting in global markets in a new era where suddenly we went from a financialized market where people could make money by actually just going into financial assets to one where people need to build stuff. And when you need to build stuff, it is a very different proposition in terms of the value of money and how much people demand to have the privilege of borrowing somebody's money.
You're just itching for the weekend, right?
No,
Seriously?
I could do this for another.
I thought we're not allowed to talk about the weekend at 6 a.m.
No.
That's a 9 a.m. conversation
Honestly,
as long as I've been working with you.
I'm there right now. It's just been one of those weeks, right?
Friday.
Not that far. Friday is banned.
I know, that's why I'm going to keep saying
Without
it all
a doubt.
day.
We can talk about the weekend, but Friday is banned.
Okay.
Okay.
It's been a long week.
Yields this morning just about unchanged on 10s. Small rally at the front end of the curve. The 30-year is not bouncing. Yields are unchanged there. 30s around 517. Coming up this hour, we'll catch up with Keith Lerner of Truist with stocks on track for back-to-back weekly declines. Angela Zeno of CFRA as Intel shatters expectations. And Rebecca Babin of CIBC with crude hovering near triple digits. We begin this hour with stocks attempting to rally following following the biggest one-day drop in a month. Keith Lerner of Truist writing, the encouraging development is that this is still looking more like rotation than broad-based liquidation. Keith joins us now for more. Keith, I don't know when you wrote that, but does it apply to the price action of the last 24 hours too?
Oh, yeah, certainly. And hey, good Friday, Jonathan. Friday. Listen, even yesterday, we had that, some big cap tech names down a lot. And then you looked at the board yesterday, you had energy up, you had industrials up, you had financials up, you had healthcare up. So I think we're still seeing this big move up. But I also, if you zoom out a bit here, Jonathan, back when we had that rally off the lows in March, for the S&P, there was only one sector that outperformed, and that was tech. And tech was up 47%. The closest sector behind it lagged it by almost, by more than 20%. So, you had expectations reset higher. It was one sector that's very dominated, and now that money is rotating to other areas. And to the point that you just discussed, it's not leaving the market; it's just rotating to other areas. And you're also having some pretty good numbers yesterday. If I looked at the board yesterday, you had a lot of these industrials. Up 3, 4, 5%.
Keith, I think in some ways that speaks to what we're talking about in the bond market too. I mentioned these rolling shocks that we're experiencing right now through energy, through interest rates in the bond market. And I think it's important to point out, we've had the energy shock, we've had the bond market jitters, we haven't had the growth scare. And Keith, does that speak to maybe your enthusiasm for this rotation in equities, which is a risk asset that should be sensitive to the growth backdrop? You believe that can continue?
Yeah, I do. I will also say at the same time, Jonathan, we're still positive on tech longer term. I just think, as I mentioned, that it got too far, went too far too fast, and now you're resetting. And as we've been discussing this morning, the economy continues to prove resilient. In fact, I think, most on Wall Street, if you thought, maybe a month ago, if you said, hey, yields are at 470, where's the stock market? You probably would think it would be, hit a bit more. And you are seeing some of those tighter financial conditions hit in more of the growthy areas of the market. But all in all, I would trade a stronger economy than a weaker one with a little bit higher rates. And I think that's what the market's doing, because ultimately that should still feed into strong earnings, which continues to be the North Star of this bull market.
Which is the reason why, Keith, we're seeing a lot of people say the rotation is intact, but maybe the Magnificent Seven, or more specifically, the hyperscalers are no longer the same kind of bet that they were, say, 6 months ago. Yesterday, the biggest one-day decline going back to Liberation Day and some of the turmoil there in 2025, almost $800 billion in value erased from this particular index. Is it a buying opportunity or is it a warning shot?
Maybe somewhere in the middle. I mean, one of the dichotomies we wrote about, coming out of last month was that, the tech sector was up 18% at the time. At the same time, the Mag 7 was actually down for the year, and that's a lot of because of semiconductors. So, I would say more broadly, not just the Mag 7. I mean, the one thing that kind of stood out to me is, late last year, the technology sector was trading for about a 32 multiple. Now that's down to about 23. The premium for tech to the overall market early in this bull market was about 45%. That was the peak. And now we're down to about 10. So at least the good news to me is you're resetting expectations. And even though, not saying something specific about a recommendation for stocks, but Google and revenue and Intel's revenue numbers were 25%. It's hard pressed to find that. So overall, I still think ultimately that tech will be a buying opportunity. Is it right here, right now? I'm not sure about that yet, but ultimately I think money will rotate back into tech. And the last thing I'll also say is we continue to have this love-hate relationship with tech. This is the fifth pullback of at least 10% during this bull market. During the entire bull market, tech has doubled the S&P 500. So it's just like I said, the love-hate relationship that we're seeing.
It does feel a little bit different this time, and I know I'm going to get pilloried for saying that because those are the most hated words in financial markets. There is a new cost to borrow money for some of these hyperscalers in particular, and I wanted to bifurcate the tech universe into the hyperscalers, the spenders, and then the receivers, as John does a good job of talking about the wealth transfer. At this point, it does seem like the charge is getting bigger for a lot of these hyperscalers. Their desires are continuing to grow at paces that we cannot track, and there has been a sense of concern in markets at a time of already elevated bond yields around the world. Doesn't this change the calculus on some level, on a multiple level, or even just on a growth prospect level?
Yeah, certainly. And I would say, Lisa, one thing we've been really starting to track even more closely is breaking out all the technology, big cap tech stocks and look at credit spreads, and they're moving up. And even like Oracle being the poster child, you're seeing when CDX makes a new high, the stock is moving lower. So, I think it is very important. I think it is one of the key risks that we're looking at. But I guess as I think about things is we were trading at a 32 multiple. Now we're down to a 23. That premium that I mentioned has really evaporated. So at least in my mind, the market has re-rated down because of those very risks that you're talking about. So I guess the open question is it re-rated enough? And again, on a very short term, I think it's a difficult call. But I think at this point, at least we've really reset expectations. Again, not recommendations on individual stocks, because that's not my area of focus. But even like you look at, after what happened with Alphabet, you're trading at a sub PE relative to the overall market as far as a discount now. And at the same time, you're seeing these companies with really strong revenue growth. So I think all that's in the mix, Lisa. But I think, again, I would still think I'm giving tech longer term the benefit of the doubt.
Yesterday was different, and Bramo, I'm pleased you went there. Yesterday was different because this equity market punished the spending of Alphabet and Tesla and didn't reward the chip makers, which is where the money would go. Semis were down on the session yesterday, which I think would be surprising for a lot of people if they looked at the numbers of the spend coming out of the likes of Alphabet and the likes of Tesla. So you have to question the effectiveness of the spend, return on investment, and the durability, the sustainability of the spend as well. And the cost of capital is going to become increasingly important. I think you can see that in bonds and increasingly, just on the margin, just a little bit more, you can see it in credit too.
Yeah, right now you're starting to see spreads widen, as Keith was just talking about. And yesterday we saw some real pushback, but you're right. Normally the wealth transfer would be alive and well, and you'd see that inverse relationship. The idea that it's not indicates that maybe people don't believe that spend project can really continue at the pace that it is, or that there's going to be enough competitive pressure to lower prices, lower margins, and potentially get some new competitors into the field.
I'm not going to draw firm conclusions from 24 hours of price action. Lisa won't either, but Keith, it's notable that yesterday chips didn't rally. That had a nice little run going into earnings. Monday, Tuesday, decent few days of gains. 3 days, I believe, on the semis, Keith. Then things started to change just yesterday. What was your reaction to that?
Well, I mean, I think it is important. It's like, as you mentioned, right now, there's so much uncertainty about how all the AI spending turns into cash flow, and when. But I also remind folks, semiconductors just came off an 80% plus quarter. So in some ways, I think that was anticipating these good numbers, and it's priced in. So it does tell you at this point that this kind of cooling or this reset in tech and semiconductors likely has a bit further to go because it was so overheated. In fact, the move that we have seen in semiconductors over the last year is the strongest we have seen since the late 90s. But ultimately, I think one of the things that's different so far, and we can debate this, is valuations are half of what they were in the semiconductors back in the late 90s, and earning trends are much stronger. Obviously, we are still asking the question of what's normalized earnings as well. But I think the main point, going back to where I started, is you had a lot of good news priced into this quarter. So I'm not surprised you're not seeing the reaction, because you were up 80% for the overall index.
Keith, it's good to see you, buddy. As always, Keith Lerner there of Truist on this market. If you're just tuning in, welcome to this program. No doubt the first thing you looked at was maybe crude. This morning we're pulling back by a little more than 3%. Brent down to 97. We had a little look at triple digits in the last 24 hours, a pullback of 3% so far this morning. The words of the president in the last 24 hours, according to Axios. The president telling Axios on Thursday he's seriously considering restarting major combat operations in Iran. Yet to be seen what that looks like heading into the weekend.
Yet to be seen what that looks like, but at the same time, we have heard from CENTCOM, and last night there was another round of attacks, 13 straight days of attacks. The president also said in that interview that they haven't received enough pain yet, talking about the Iranians. He clearly wants the regime to capitulate, and at this moment they're not. And when it comes to the Red Sea, some vessels are still starting to turn around, while others are going for it and trying to get through the Bab el-Mandeb Strait.
We'll have more on that story a little bit later this hour. Let's get you an update on news worldwide this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, good morning. The U.S. will impose tariffs of between 10% and 12.5% on imports from most major trading partners, after finding about 60 economies harmed American workers by failing to prevent forced labor. It's the biggest move yet by the Trump administration to reconstruct the tariffs that were struck down by the Supreme Court. The Magnificent Seven, suffering their biggest one-day drop since the tariff sell-off last April. The group losing almost $800 billion in market value, fueling the sell-off disappointing earnings from Alphabet and from Tesla. Intel shares, though, rising in the pre-market. The chipmaker's revenue forecast shattering Wall Street estimates. Intel reporting its fastest revenue growth in 15 years and adding $2 billion to its capital spending plans as demand for chips used in AI data centers accelerates Intel's turnaround. That is your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Everyone's going to say Friday. on this program now.
100%. And I am so here for it. I can't
You
wait
like
to
that
see.
word?
I love it. I use it every day.
Can't stand it.
Oh, I know. I actually have no real strong feelings, but I think it'll be really fun.
What did Kobe Bryant say? It's not over. Right?
It's not over. And
Week's
actually,
not over.
And actually, today could be a really telling cap to
It's
a
not done.
tumultuous
We have
week.
2 hours
not
and
done.
45 minutes left.
We have a lot more than that.
You sound like you're there already. You really do. Up next on the program, threatening further escalation.
We're doing very well against the Islamic Republic of Iran. We're doing extremely well. They would like to do something, but I say they're not ready yet. We want to get it over with, and we want to do it right.
2 hours, 45 minutes sounds like torture for Anne-Marie. We're going to be okay.
Well, what are the stories we're talking about? Conflict, tariffs, that's my world right now. I know you guys are in some AI bubble, but...
We'll get to your world in a moment, okay? We'll make sure those 2 hours and 45 minutes fly by. Up next, Colonel Wayne Sanders of Bloomberg Intelligence, live from New York City this morning. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
The price of oil, setting the tone for the price of everything. We're pulling back by 3% on Brent this morning, around 98. As Anne-Marie pointed out yesterday, 2 choke points now, not 1. A much smaller cushion of inventories, a move of 15% plus last week, up around 10% so far this week, pulling back 3 so far this morning. Under surveillance this morning, threatening further escalation.
We're doing very well against the Islamic Republic of Iran. We're doing extremely well. They would like to do something, but I say they're not ready yet. We want to get it over with, and we want to do it right. We have to do what we came to do, and that's we can't let these people, very violent people, we can't let them have what they want.
So here's the latest this morning. The president threatening to escalate military strikes on Iran. Axios reporting the president is, quote, close to making a decision on attacks surpassing Operation Epic Fury. Bloomberg's Tyler Kendall has the latest this morning. Good morning, Tyler.
Hey, John, good morning. Well, as the White House weighs this wider escalation, the U.S. is dealing with this whole new front, and President Trump's threats are now extending beyond action taken by Iran in the Strait of Hormuz and to action taken by the Iranian-backed proxy group, the Houthis, in the Red Sea, as that maritime blockade creates another choke point. And we're starting to see data analyzed by Bloomberg News show that Western ship owners appear to be making alternate routes and travel plans to avoid that Red Sea path, while those countries with closer ties to Iran, like China, have seen their ships transit safely. In a new post last night on Truth Social, President Trump threatened, quote, major military punishment for targeting any commercial shipping and said damage done to cargo or vessels would be paid for via Iranian assets the U.S. controls. He didn't elaborate on how this would work, whether or not the U.S. would pay shipping companies directly, but we have to keep in mind the context here that this is the same exact money that had just been on the table as a potential economic incentive for Iran to agree to curbs on its nuclear program. But, John, at this point, we've gotten very little public indication that diplomacy is getting back on track. As you guys have discussed, yesterday, CENTCOM confirmed the 13th consecutive day of strikes, and we've seen Iran continue to target U.S. assets and energy infrastructure in the region.
Tyler Kendall with the latest. Tyler, thank you. Appreciate it. To build on that story, Colonel Wayne Sanders of Bloomberg Intelligence joins us now for more. Colonel, welcome to the program. We have a new front, a new choke point, and in many ways, it's an old choke point, an old front, an old problem. We have experience dealing with the Red Sea. Can you describe our experience in the last several years, how difficult it was to counter the disruption caused by the Houthis and how difficult it might be this time around?
We had to spend quite a bit of assets actually helping out Saudi Arabia in that region, specifically not only from an air defense threat from the Houthis themselves, but also then offensive capabilities supporting Saudi Arabia in that region. To be able to take them and bring them down to a level where, from a military capability perspective, we would call that a degraded capability. And so the U.S. was involved in that with the Saudis, and it got to a point where we think it was almost ready state operations, if you will. And then obviously then when the Iran conflict came up, this is something that I've been keeping a close eye on because I was actually worried that this was going to be a pressure point that was going to be pressed by Iran and by the Houthis. And now you're starting to see that as part of Iran's strategy going forward right now as an additional lever against the U.S.
When the president says I'm considering a massive attack bigger than ever before, what does that mean in DoD speak? Are these different targets that the United States is looking for?
Yeah, I would say it's going to be both not only different targets, because up until now, I think there's been certain ones that you would call almost like restricted targets because of how high the operational and strategic risk may be for hitting some of those targets. But due to the casualties, the U.S. service members who were killed in Jordan, I think this is one of those times where then you start to accept some additional operational risk. So you're going to see some, your standard IRGC Navy bases, missile production facilities, drone manufacturing, and all things air defense. But what you probably may see now is the IRGC command and control centers that may be closer to Tehran. You may see something against Natanz, Isfahan, and Fordo, and just creating a deeper crater in the ground during that area. Strategic energy production sites may be in there. And now as we're sitting here talking about the Red Sea, long-range missile sites in Yemen could be another one of those pieces. Coastal forces at any time, anything that's going to try and help the Houthis in this blockade is going to be something that would be a target in that area.
I'm glad you brought up the casualties because the Pentagon had announced that a total of 18 American service members were killed in the war in Iran on Wednesday. Then on Thursday, that number dropped to 14. Why?
I apologize. I'm not tracking that. I was still tracking the number as 18. I don't know whether or not they're looking at it as they're changing the number in terms of maybe direct casualties due to a strike that took place from Iran, as opposed to, northern Iraq when it was a controlled detonation that killed one of the service members. But I'm speculating at that point.
Colonel, is this a winnable war? Is there any kind of paradigm where you could see some sort of successful or at least satisfying end to what we're seeing?
Yeah, that's a difficult one because I don't think there's anybody who ever wins in a war. I think the best way that you can look at this is this was a war that needed to be fought in terms of Iran's dominance in the Gulf region based off of their military capabilities. That's been a big thing that President Trump has really tried to push, not only the nuclear side, but also just from the ballistic missiles in defense. So a lot of those capabilities have come down. It's allowed some of the Gulf states right now, even when they start looking at harden some of their military capability. So I wouldn't call it a win, but I think that those would be some of the only silver lining in this conflict that you could really point to at the end is that The Gulf states, the GCC has come up and said, hey, we're not going to take any more of this, and they have strengthened their positions. Iran still wants to be able to say that, hey, we have the ability to affect Strait of Hormuz, but we're willing to not. I think it's a political side that Iran would be looking for to win, and the U.S. needs to be able to say that they did decimate Iran's military capability.
Colonel, what would it take for Gulf nations, Gulf allies, to take more of an offensive posture in this war?
That's a great question, because when you look at it right now, UAE's already increased their air defense focus on commercial infrastructure, and you look at Bahrain, who's the most exposed because of Fifth Fleet headquarters. They've largely remained out of it as much as possible at this point in time. I think that when you start hitting more and more of the civilian infrastructure, UAE is a great example. Iran's gone after their economy, so they're trying to bring in. I think at this point in time, where they're really trying to get to is they have to have enough military capacity. Up until now, they focused on some defensive capability. If you start seeing indicators into long-range strike munitions being purchased by some of these Gulf states, that's when they're going to say that I now have a strategic deterrence option, and it's not just a defense against Iran.
Colonel, it's good to see you. I appreciate your input and your insight, experience. Thank you, sir. Colonel Wayne Sanders there of Bloomberg Intelligence. It became the story that you wanted to ignore, and could no longer ignore once crude popped into the 90s and breached triple digits on Brent just briefly. It was in all our faces. This morning, we're back down to about 98. AMH, WTI, 89.
Yeah, crude's going to be going higher, and potentially it depends. I mean, I know we're off the highs of yesterday, but we have to live with higher for longer, potentially throughout the rest of the summer, if the president is preparing major strikes that are going to expand what's going on in the conflict. And then, of course, you introduce the Houthis, and that's a whole other problem.
I'm watching diesel up 10% since July 5th. This is an input into every other component of inflation. Now $5.24. Watch this space, because that's going to reverse what we saw in the CPI and PPI.
Nothing Friday about crude product right now, right?
Well,
nothing good about this story.
There's nothing Friday about a lot of this, and that's the truth. Is you're trying to kill it right now?
It's dead. It's gone.
It's not.
It's banned.
It's going to keep coming up.
Up next, Intel. Intel running in the free market.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance, It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication
and the collaboration.
I spent a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Max 7, 5% slide in yesterday's session. Bramo gave you the number, $800 billion of market cap, shaved off that particular group of stocks. This morning, a pretty unconvincing bounce, to be honest. Alphabet up by 0.75%, Microsoft up by 1%. It's mixed. Meta's down by 0.2%. In the equity market more broadly, on the NASDAQ, on the S&P 500, heading towards 2 weeks of losses for both the S&P and the NASDAQ 100. The first back-to-back weekly loss for the NASDAQ, I believe, the NASDAQ 100 since March. Futures up by a few tenths of 1% on the S&P, a few tenths of 1% on the NASDAQ, and not a convincing rally in the bond market either, given the sell-off we witnessed over the last several weeks. Twos hanging on to 432, 10s hanging on to about 470, and 30s still well north of 5%, and yields not coming in.
You know, there had been a lot of different stories that were kind of offsetting one another. Even though you had concerns about the Middle East, oil prices had come in enough to allow the AI story to take hold. Right now, that is not the case. Oil is clearly in the driver's seat, and a lot of these problems that get more magnified when borrowing costs go up are accentuated in the artificial intelligence trade. So yesterday was a puke day, and today isn't exactly a buy the dip day, because we don't know exactly when this is going to resolve or if it could potentially get a whole lot worse. Halima Croft talking about how this really is an incredibly dangerous tipping point with a lack of inventories and, frankly, not a clear off-ramp.
So let's stay on the market and let's use that word danger zone. People used to think that was 450 on 10s. It's not. 460? It's not. Is it 470? I don't know. But I don't think this is a market, an equity market, going through a growth scare right now. And that's the important distinction to make this morning. And I keep going back to the framework. The rolling shocks that we've had so far in the last 5 months. You've had it through energy. You've had it through fixed income. You have not had a growth scare off the back of that. That's the missing component of this, is why the equity market is still within 2.5 to 3% away from all-time highs.
It would take a bigger shock, and people say, how much bigger? And Marie talks about, is it going to be $100 a barrel in terms of oil? And when you start talking about levels, what everybody on this show says, it's not just about the level, it's about the pace of increase. It's the pace of increase in oil, and it's the pace of increase in yields. Right now, the pace of increase is starting to get alarm bells to go off, even if this economy is less interest rate sensitive.
Brent crude, let's check out the price of oil this morning. Oil is down by 2.9%, but it's another big weekly rally, building on last week's big weekly rally. This morning, 98 on Brent. WTI, just short of 90.
Since the skirmish has started again and the attacks around July 10th, we're up some 25-30% on the oil price. We thought after 4th of July, potentially we were going to see this downtrend. We were moving forward, more ships were getting to the Strait of Hormuz. Now the attacks continue, and we've already bled through all those inventories. And now we introduce another issue with another choke point, which potentially could be a massive problem for Saudi Arabia and the global market.
Crude down this morning by close to 3%. On our radar this morning, the president rebuilding his tariff agenda, imposing sweeping new levies on 60 U.S. trading partners. The White House turning to the Trade Act of 1974 to invoke the tariffs after the Supreme Court struck down his initial duties. Elsewhere, the president considering a massive attack on Iran as he aims to force the country to the negotiating table. Trump telling Axios that Iran hasn't yet received enough pain and the strikes would be bigger than ever before. And finally, Meta facing higher borrowing costs for a $12 billion deal to fund a data center in Texas. The Financial Times reporting investors are demanding a higher risk premium than its last financing deal as unease builds over AI exposure.
We've seen this movie before, right? I mean, this is Alphabet and what they experienced when they tried to raise money in a very similar transaction and faced a higher borrowing cost. This is a borrowing cost not exactly going to stop the presses at 0.4% percentage point higher than what they did earlier this this year, but it highlights the exhaustion in debt markets right now of absorbing all of this debt. Just to put it into perspective, Amazon, Alphabet, Meta, NVIDIA, and SpaceX have sold a combined $219 billion so far this year. Given the competition from everywhere else, given the endless rosters of wish lists that we are seeing from all of these companies, people are just feeling a little bit like they need more to lend their money.
The pushback started with the SpaceX debt. I think it built when Amazon followed. And you're right to point out we need more money. It's important to make that distinction. The market's still open, but at a price. And the market's pushed back and said, if you want to keep coming to market, there's going to be a price, a high yield that we need to be compensated with.
They're still willing to borrow, and frankly, people are still willing to lend. But at a certain point, you start wondering how much is this going to impede valuations at the very least. And you start to say, actually, what's happening in markets and the route that we saw yesterday makes a lot of sense. Because suddenly the valuations are not as high as they used to be if you're actually burning cash and borrowing money at a higher rate at a time when the component costs are increasing as well. So all of these things leading to that little bit of skepticism. Some people are saying this is a healthy skepticism. Other people are saying, let's see how far it goes.
It's always a healthy shakeout.
It's a healthy
when you're bullish, right? It's always a healthy shakeout. It's a healthy rotation.
Yeah, but no one's saying it's a buying opportunity. Whenever we ask, is it a buying opportunity? Well, you know, it will be.
On the bond side of things.
On the bond side of things, you've seen all of these bonds sell off since they were sold, all of the AI-related debt. You start wondering, okay, well, what price exactly is going to be the clearing price?
Let's get to a single name. Let's talk about Intel. Shares rising as the chip maker's blowout forecast proves a longer-awaited comeback. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, welcome. What stuck out for you in that earnings report?
The fact that the turnaround seems to be working finally, and you know, they projected an outlook where they see things improving. I mean, they're not going to reclaim their leadership that they used to have, given the size of NVIDIA and how fast NVIDIA is growing. But with all this CapEx spend from the hyperscalers, Intel is now getting a small piece of it, and that's good news, given, you know, how long this turnaround took.
Mandeep, just to reflect on the hyperscalers yesterday and how the chips performed, the fact that we punished Alphabet and Tesla for higher spending, but chips didn't rally. Now, Intel's an exception, of course. Fantastic earnings. The stock is up by 5%. I'll spend some more time on that name in a moment. But Mandeep, I want your reaction to the fact that we punished the spenders and the recipients of that spending in yesterday's session.
I mean, look, there are reactions like this from time to time where you kind of see a ceiling. Trees don't go to the sky, you know, in terms of how much the estimates will keep going up. And at some point, you know, all these higher component costs will cause demand destruction. I think that's a big risk. We are already seeing that in terms of the consumer devices. Everyone has tempered their expectations. But I think at the end of the day, everyone wants to use this technology. The token demand continues to go up. So from that perspective, the trend is intact. And there will be some shakeout like you guys were discussing, but the overall trend is still, you know, upward revisions. We're talking about $1 trillion in CapEx for next year, and the consensus view seems to be getting there as well.
Mandeep, thank you, sir. Enjoyed your coverage this week. Busy week for you next week, too. Mandeep Singh there of Bloomberg Intelligence. What a slate of earnings we've got coming up next week. Meta, Apple, Amazon, Microsoft across 2 days with the Fed sandwiched in between.
So if you thought that, you know, we were not that it's not interesting today, maybe you can just wait till next week. Microsoft, though, particularly interesting because they've got to give a forward look for the year ahead. It's their full year fiscal report. Very curious to see what that looks like.
Let's talk about Intel a little bit more. Angelo Zeno of CFRA maintaining a buy rating on Intel, a 130 price target, writing, we believe the shift towards greater AI inferencing and AI agents creates a sustained growth opportunity for CPUs and expect strong results through 2027. Angelo, you and everybody else in this market, apparently, because that stock is already up 170%. And I don't want to force the narrative, and Angelo, welcome. I'm looking at this price move this morning of 5%. And I think about Intel so far this year, and I just think, oh, only 5%. I remember a time when that would have been 10, 15, maybe close to 20. Angelo, what does that tell you about price and positioning around this stock?
Yeah, John, and thanks for having me. So when I kind of think about just obviously maybe the lackluster gains that you're seeing here pre-market. I mean, clearly you pointed to the gains that we've seen this year thus far. I think we're at a point now within the semiconductor cycle where everybody is just kind of looking to maybe digest some of the gains that we've seen here in the first half of the year, especially from the more momentum-driven names, and clearly Intel being one of those momentum-driven names. I think at this point in time, the numbers matter less. Maybe they still matter actually a lot for Intel because Intel's more of an execution story relative to other chip makers out there. But as you kind of look ahead over the next couple of quarters, I think it's going to be more some of the derivative plays out there. It's finding another Anthropic. Does OpenAI, finally show a good growth story going into 2027 ahead of a potential late IPO next year? We need to start seeing more kind of these AI monetization stories really show up into the market for the street to really believe and maybe kind of throw that next leg up to the semiconductor trade here.
Angelo, let's just stick with Intel for a second. Is Intel's gain NVIDIA's loss in the respect that they're talking about CPUs that are less compute intensive and are a different type of chip than what NVIDIA really specializes in and can charge really significant prices for? Does that signify a shift in terms of demand by the base clients?
Yeah, I mean, Lisa, I think that's an interesting point. I think clearly the shift towards inferencing is, I think the demand, I think the way this works maybe is you just get a bigger piece of the pie or growth from the CPU side of things. AMD just had their AI event yesterday, and they basically came out and said, hey, listen, CPUs are going to grow from about a $26 billion market last year to a $220 billion market by the end of the decade. So there's massive growth there, less so on the GPU side of things. So, from that perspective, the pie continues to get bigger, but certain pieces of the pie get a lot bigger than other pieces. So maybe in terms of, does it hurt NVIDIA? Not necessarily, especially since they're kind of getting into standalone CPUs, and, they'll benefit from the CPU trajectory as well, but maybe less of a benefit for NVIDIA, maybe relative to an AMD or an Intel.
There's a fear hanging over right now a lot of the tech names, which is that we're overbuilding, and we're actually overbuilding in a really significant way with a lot of financial debt tied to it. Yeah. How do you determine when we've crossed that Rubicon?
I think I don't think anyone can really know when or not we're going to get to that point. I mean, clearly, what you want to see is you want to see healthy spending. You want these hyperscalers to be very responsible in nature. We did see Alphabet kind of hit the negative free cash flow here this quarter. That's not necessarily a surprise. I mean, especially when you kind of look at what Alphabet is seeing on their cloud side of things, and not to mention when you look at the balance sheet there, I think they're just kind of raising debt in order just to kind of have that flexibility that's out there. But yeah, I mean, you want these guys to be very responsible in nature. You want to see this accelerating growth, which you're seeing, and I think you're going to see pointed to from the likes of Amazon and as well as Microsoft here in the second half of this year. But in the same respect, you want that at least as a percentage of the increases from on the spending to start to moderate a little bit. I think you'll start to see that as we go into 2027 and 28. But in the same respect, I expect these companies, at least over the next 2 to 3 years, to fully blow out all their free cash flow. And I think that's something, whether or not the equity markets are okay with remains to be seen. I mean, clearly those multiples have come crashing in based on the fear that, hey, listen, we're not going to see any of that free cash flow here over the next couple of years.
Angelo, on Intel, given the fact that they had an amazing earnings report, strongest revenue growth, as you noted, in 15 plus years, when it comes to this company and this latest earnings report, could it be directly correlated back to the U.S. government taking an equity stake?
I think that was an important inflection. I think that was, an unbelievable investment that was made by the U.S. government. I think it helped really kind of save Intel in many respects. So to answer your question, I would say yes. I think the momentum that you can continue to see here over the next couple of years, and I think Intel is very different than a lot of the other chip makers because they aren't a fabless company like most of these U.S. chip makers are. They've got that manufacturing business. So the geopolitical uncertainties out there are another story to Intel, in addition to the AI thesis that's out there. So in our view, geopolitical uncertainties will continue to increase, especially with what's going with the uncertainties in Taiwan. And as a result, I think you'll continue to see that push and greater spend into Intel's foundry business, which is a big crux to our thesis and our kind of longer-term view that there's some sustainability here for Intel as we go into some of these out-year estimates.
A key national security objective. Angelo, good to see you. Thank you, sir. Angelo Zeno there of CFRA. Stock is higher now by 4%. That's one to watch into the opening bout. Let's see if that holds on to gains. I think that's going to be quite important. You've got some blowout earnings, a lot of enthusiasm around the name. It's had a big run up. Stock is pretty aggressive up and to the right. And it's up this morning by 4%. It's worth a little look into the opening bell.
If it doesn't hold, that's going to be a pretty bad sign, especially considering how big the beat was. Their profit beat by double. It was twice as much as expected, just to give you a sense of how much of a blowout this was.
This is what Max Kenner of HSBC was talking about. It's not just about the earnings. Earnings will be fantastic. It's about how this market responds to them. That's one to watch.
I caught up with him briefly yesterday.
What did he say?
Are you now bearish? And he said, not yet. You got to wait for all of them to come through.
Yeah.
Idiosyncratic things can come to the fore. So he's waiting until next week.
It's the price action of Thursday morning after Wednesday and Friday morning after Thursday that maybe he's waiting for into the weekend next weekend.
Yeah, so let's see how this all shakes out.
Yeah. Let's give you an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. Volkswagen cutting its sales and delivery forecast. Europe's largest car maker is saying revenue could fall as much as 3% as it faces a deepening slump in China. Volkswagen shares are off more than 30% this year as CEO Oliver Blume struggles to overhaul the company. AMD announcing new products for data centers it says will outperform those from rival NVIDIA. The chipmaker unveiling new generation microprocessors, an updated AI accelerator, and a new server design. Another setback for SpaceX, Elon Musk's company delaying a Starship rocket launch due to unfavorable weather. It'll try again this evening. The rocket will be carrying upgraded Starlink satellites that are intended to burn up in the atmosphere as part of the test mission. And that is your Bloomberg Brief. John.
In some ways, that's become a market event. Vonnie, appreciate it. Thank you. Up next on the program, hovering near triple digits.
We're looking at a low $100 range, 100 to 110 in the coming weeks. But the risk is way to the upside because there's enormous optimism in the price. And I think that optimism is unwarranted.
Rebecca Babin of CIBC joins us next, live from New York City. You're watching Bloomberg Surveillance.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time.
From finance to defense tech, AI to entertainment, from the road to the stars, Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
So this is the bounce from the biggest one-day loss of the month so far. It's small. We're only up by 0.2% on the S&P. The down week is small as well, and I think that's worth pointing out. Yes, we've had 2 days of losses, but on the week we're lower by 0.66% so far on the S&P. So just bear in mind, yes, a lot of violence in this market beneath the surface. Not a great choice of word. Beneath the index. At the index level, still pretty subdued. Still 2 to 3% away from record highs. On the Nasdaq, up a tenth this morning. In a bond market, 2s, 10s and 30s, still near the highs of the year at the front end of the curve, 433. Yields coming in 2 basis points. You thought we got away from 420 with softer CPI, softer PPI, and here we are again, going into the Fed's meeting just next week and setting the tone for the price action in the last 24, 48 hours. This move in crude holding on to gains just about. We're down by 2 to 3%. Brent crude, $98 a barrel. Under surveillance this morning, hovering mid triple digits.
We're looking at a low $100 range, 100 to 110 in the coming weeks. But the risk is way to the upside because even as we sit here today, there's enormous optimism in the price. And I think that optimism is unwarranted. And I think that bubble could burst. And if so, we're going to reprice much higher, I'm afraid.
So here's the latest this morning. Crude set for double-digit weekly gains as the war with Iran intensifies. Brent briefly hitting its highest levels since May. Rebecca Babin of CIBC writing, rather than asking whether the market can absorb today's disruption, traders are increasingly asking whether the current set of solutions has enough runway to absorb tomorrow's. Rebecca joins us now for more. Rebecca, welcome to the program. I think that's an important statement to make, so let's think about it a little bit more. The shock from late February into early March, we struggled to hold on to the gains in oil. We started working through massive levels of inventory. Do you think the setup, the backdrop is different this time?
Yeah, I do think the backdrop is different this time. Clearly, we're in a situation where inventories are meaningfully lower than they were when we started this conflict. We've seen the SPR go from 415 to now 313, so that's a significant drop. Commercial inventory is also lower. But I think it's important, Jonathan, to point out something that has also happened. We've seen China really reduce their imports of crude oil, and they've acted as this kind of invisible hand, allowing the market to recalibrate and not draw down as much inventory as we would have modeled when this conflict originally happened. So it's not that the inventories didn't draw, they did. They didn't draw as extremely as predicted, and there's been some offsetting factors which have buffered kind of the price move. So the setup clearly is different, but the market's resiliency also has proven to be stronger than I think was initially expected as well.
That's at the crude level, but what about the product level? China has been hoarding when it comes to actual products. Isn't that where the real problem is?
Anne-Marie, you bring up a great point. Products is really where the story is at, I think, in terms of tightness. China did actually ban exports. They've rolled that back over the last several weeks, but they haven't been extremely aggressive. Products just do not have the same level of buffers in the system. Refining capacity is constrained. We're running at 96% in the U.S. There is very limited sources of excess product. We had Russia products that were, really helping out the market. They put on an export ban, and we're seeing diesel prices, as you mentioned earlier in the show, really moving kind of more parabolically higher than linear as crude is moving. So yes, that is, I think, the bigger risk in the market, but that is also more priced in, right? So we didn't see the pullback in diesel and gasoline the way we did in crude oil when that sell-off has happened. So as the risks are higher, but the pricing is also higher as well.
When it comes to the United States, gasoline is now $4.10 across the United States. Do you think by the end of the summer we're hitting $5?
I don't think we're hitting 5. I think we're probably going closer to the 425, 430 level. And that really depends on what happens from here. If we continue to see Hormuz fully restricted with only a trickle going through and also Red Sea flows impacted, yes, I think we're going back to kind of that 450. If we also continue to see Ukraine target Russian refineries, I think, again, 450 is very realistic. 5, I think, is going to take more duration of this. We would need to see several months of this before we kind of hit that level. And keep in mind, in several months, we're kind of out of summer driving season. So the peak here is the next month. And I just think we have enough inventory, just enough. Keep in mind, Europe has not released as much of their SPR as they have announced. US has. Japan has. There's still a little bit of SPR, I think, that can come out of Europe. So I think over the next month, maybe 420 is where I'm looking.
How much do you think that this market isn't responding as quickly as some people would otherwise expect to the renewed tensions in the Middle East because of their being conditioned by experience, because of what happened over the past number of months?
I think there's a very significant component of that. And where I see that is in the option market. Yesterday, Brent options broke their all-time record. The most active option that was traded yesterday in Brent was a put. It wasn't a call. So yes, there is a condition in this market, mindset, sentiment, that rhetoric escalates and de-escalates. And when the rhetoric de-escalates, we go from worrying about scarcity to worrying about surplus. And that 2020 surplus of 2 to 4 million barrels, depending on who you talk to, is the overhang that drives a lot of that negative sentiment. I don't want to be caught long right now. If the rhetoric de-escalates, I'm looking at this huge surplus in 27 and prices are going to recalibrate in a heartbeat. So that's clearly part of the trader mentality, as well as the fact that, you know, we've gone up and down a lot here in volatility. People want to preserve P&L as we head into the weekend.
Rebecca, it's good to see you. Thank you. Rebecca Babin there of CIBC. Some risk heading into the weekend, obviously. My goodness, China has not helped out much with the Strait of Hormuz. But boy, have they helped out much with the price of crude. The price of crude would be a very, very different number without them making a move.
Yeah, and frankly, without a lot of people just quickly shifting to electric vehicles and other non-gas using ways of creating energy, how much does this last? How much is this a permanent shift? And how much is this something that potentially could be brought back online if it persists for long enough?
Quick note on Bank of America in the pre-market, slightly positive. Some news from them just moments ago, increasing their common stock dividend by 14% to 32 cents a share. This from Brian Moynihan. The increase in our dividend reflects the strength of our earnings, the power of our franchise, and our confidence in Bank of America's ability to drive long-term growth and create value for shareholders, following some pretty decent numbers from them in the last few weeks. That stock is up at a pre-market. Up next, Dan Greenhouse of Solos, Monica Guerra of Morgan Stanley, Michael Ventura of RBC, and Republican Senator Dave McCormick.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Some people have written that your bank, Revolut, is worth $75 billion. Have you ever thought of taking your organization public?
Well, the way I think about it, we kind of will be ready probably in 2 years' time. But then again, depends on how good the market is.
Since you don't have an IPO, how do people who work for you make some money? Do you make a market for people to sell their shares internally?
Yeah, so we do secondaries every 1 or 2 years when people can sell a certain portion of their stocks. to external investors.
So you've done secondary sales for your employees, so employees can then get some liquidity. Do you expect before you go public you'll do any more of those, or are you just going to wait till you go public before you liquefy any more stock?
Yeah, I think so. We might do secondaries as well before we do IPO, because we do it every 1 or 2 years, so we might do secondary as well.
All right, well, if anybody wants to sell their shares to me, let me know. And have any investment bankers told you why they're the best to do the IPO for you?
Yeah, obviously every single one is the best.
Everyone is the best. You're not in a rush to do it. You don't need the money.
So we're a bank, and then for the bank, it's super important to have trust, and then public companies are trusted more compared to private companies. So that's the reason.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
People are not acting like they expect higher inflation.
I just don't think that we're at the point where we're seeing widespread inflation.
I think the economy can well withstand $100 oil.
We need to start making a distinction between what might be called good hikes and bad hikes.
More likelihood of a hike than a cut, without a doubt, this year.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price section of scores look like this. It's a small bounce from the biggest one-day loss of the month so far. Equity futures up by 0.2% on the S&P. On the Nasdaq, not even up by a tenth. Notable, given the damage to that index yesterday. In the bond market, 2s, 10s, and 30s, yield holding onto these levels. 433. On 2s, 10s just about unchanged around 470. That's what's different about this moment. We're getting up there and then holding on to it. So you've got the energy shock to think about too. Brent and WTI holding on to those levels as well, around $100 a barrel on Brent crude. And Bramo, we've talked about this. Energy shock, rate shock, haven't had the growth scare. That's why you're holding on to these levels.
Even in Europe, which some people had left for dead, they came out with better than expected PMIs earlier this morning, that actually their growth had accelerated much more than people previously expected. When you see corporate earnings here in the United States, its resilience, its expansion, its profit margin, profit margins continuing to go up, and you look at all of this and you say, when does it get disrupted? So far, we haven't seen that sign. I mean, take a look at, for example, airlines, with the exception of American Airlines. They've all been able to pass along those price increases and see earnings that were better than expected. When do we reach the tipping point? And I think a lot of people are wondering that this morning.
And it's an important question going into this weekend, as the president is saying that potentially he's going to have to expand the strikes on Iran. They are trying to get the Iranians to capitulate. The fighting continues. Inventories keep shrinking. We're living really on the edge when it comes to inventories. We just heard from Rebecca, who talked about how we're at 97% refinery capacity here in the United States. On top of all that, a new risk in the Middle East has been reintroduced.
What is it about Bank of America? Not Bank of America, American Airlines.
Oh, yeah.
American Airlines. Bank of America on my mind because they increased their dividend, but you mentioned American Airlines. They're just like the odd one out for the big airlines right now. Why?
Well, yesterday they said that they actually downgraded their full-year forecast for the second time in the past couple of months, and they said it was because of fuel bills, and they said that what you had seen was a significant deterioration over the past month. We talked about how diesel prices are up dramatically, jet fuel prices are up dramatically. That said, is there something else with the hangover of debt, how they're issuing that with respect to the routes, with respect to how they compete with premium offerings that's put them on a back foot? Increasingly, a lot of people thinking about that.
The Farrow family moved away as well.
That was the
It's going to ding American Airlines.
You think that's sort of like that was the signal?
I have always been committed to one world. So I lived in London. You have to fly British Airways, right? And then also Qatar Airways when I go to the Middle East. So then come back home, I'm flying American. Now I fly Delta. And you know who emails me? Every morning I get an email from who?
Oh, do you?
Delta Airlines.
Do you?
Every single morning, there's an email popping up. They want your business.
Do you want to derail the program? Like for a couple of minutes?
Sure.
Just totally derail the show, kill the music, we're talking about
I know where
airlines.
we're going, let's do it.
I got the call. I got the call from American Airlines. So I talked about my experience on the program. They called me up and they said, what can we do? And I explained to them what had been happening with the family. I said, the mother-in-law, 5 million lifetime miles with you, flown with you for decades, had concierge key for years, stopped flying with you. You never called. She's disappeared, she now flies with Delta. The wife, Mrs. Farrow, concierge key for a couple of years, whatever, executive platinum forever, flown with you for decades since she was a small child, up and down to Latin America with business. She stopped flying with you, went on maternity leave, lost her status, she never called. She had to call you, and then you told her that if she wanted to stay with concierge key, she had to pay for it, right? So I said, so we've moved on. I said, the problem you've got now is if you start at 0 in New York City, and let's say you've got no status at all, and you fly business with work, lucky you would fly Delta in a heartbeat. You get status straight away because you get to go to the lounge. You get to use Delta One. You get expedited security through JFK, right? You can go straight through JFK. Terminal 8 with American Airlines, you can't do that. And to use the good lounge, you've got to wait a while to get status, then use the better lounge. So you're going to end up in a bit of a zoo, a bit of a cafeteria that you probably want to avoid. And that's the situation American Airlines are in. And when they called me, they called back a few days later, and they said, we can't do anything about it. We can't restore your status. And I turned around to them and said, not a problem. I don't want anything, but here's what you should do. I suggested to them they should introduce a program that when people go on maternity leave, they can lock their status. So when they come back and start working again and start traveling, they'll stay with you, brand loyalty. Maybe you should introduce that. I also suggested,
that's a good idea.
Right? I also suggested that for people that have flown with you forever and suddenly disappeared, maybe you should call them and find out why they're now flying with a different airline. And I've got to say, customer services were really receptive, but I just don't see the executive team making the kind of changes that are going to keep those high-value flyers.
There's a bigger point here, and this goes to how a lot of companies are using artificial intelligence. If you have a proper screening program to identify key people, key customers, and then cater to them with a way that's more efficient, you deliver better results. And that is why a lot of places are needing to invest in technology just to be competitive, to stay competitive. Because ultimately, how do you do all of this on scale? And you have to do things like this. You have to move the premium offering in real time. And so this is exactly what we're seeing under the surface about how it's getting deployed.
You want to phone in this morning, just dial 1-800, complain about an airline, Bloomberg surveillance.
Is that what Twitter's for?
We should move on. Let's talk about markets. Coming up, Dan Greenhouse of Solos with stocks struggling to find a firmer footing. Monica Guerra of Morgan Stanley on how rising prices will impact the midterm elections. We'll catch up with Republican Senator Dave McCormick on his favourite airline. We won't do that. We'll talk to him about the president weighing a massive attack against Iran and the serious situation in the energy market. We begin this hour with stocks searching for gains and crude hovering near triple digits. Dan Greenhouse of Solos Alternative Asset Management writing, with yields and oil moving higher, it probably means the market's consolidation phase is going to continue. Dan joins us now for more. Dan, good morning. Good to see you. Anything to add? Come on, please.
I have something very important to add. I'm concerned that extended segment will eat into my face.
No, you're good. I promise you're good. You're good.
Okay.
Are you on the edge of bearish?
I'm not on the edge of bearish, but listen, as traders... But we have to account for the fact that something is going on here. Oil prices are going up, yields are going up, and with the investor skepticism, for whatever phrase you want to use, regarding the Mag 7, the market's been trading sideways for a couple of weeks now, and that's probably going to continue as we work our way through this higher yield, higher oil environment. Now, that said, I'm going to keep going here because I feel like my time was stolen for your complaint department. American Express is on the tape this morning. Revenues up 10%, Card spending up 9%, XFX.
Guidance a bit firmer.
Guidance firmer, and from the press release I'm reading here, quote, 6 months into the year, we're seeing stronger momentum than we expected. Now, we all know American Express caters to a higher income cardholder, sure. But when we talk about, well, I'm seeing weakness over here and I'm seeing weakness over here, for many years now I've come on air and said, look at the card companies, because they see spending across categories. And obviously American Express is usually the first one out, but I imagine Visa and MasterCard will follow suit, reiterating and reinforcing the idea that the consumer is still doing pretty well.
I'm with you, and that's what's unique about this moment, that we've had the energy shock, we've had the bond shakeout, we haven't had the growth scare. And I just wonder, in your mind, when you look at these yields right now, what is sustainable? What kind of yield level can we sustain that this market's comfortable with, this economic backdrop is comfortable with?
Yeah, it's higher yields are worse, all else equal, than lower yields, depending on your environment. And certainly as you get up closer to 4.75 and 5, that gets a little more difficult for longer duration equities, et cetera, et cetera. But part of what's going on is the higher price in oil, obviously. Oil is one of the most, if you're going to think about inflation and forecasting inflation, oil is one of the most obviously important inputs. But eventually this conversation turns to the Federal Reserve. And some part of this is increasing odds of rate hikes, maybe not next week, but over the next couple of months. And I think if you're the Federal Reserve, you're in a really tough spot here. You have been for some time, but even more so now, because you have to disentangle why are inflation pressures higher? Why are they, obviously they have missed their target for multiple years now. And if you look at some of the drivers, dare I say most of the drivers of higher inflation, I'm not sure that a rate hike will do much about it. There's a war in the Middle East, oil prices are higher interest rates are not going to do anything about that. We keep getting tariff headlines. They are equivalent to a sales tax hike. There's nothing that a rate hike is going to do about that. Obviously, there's underlying demand issues and et cetera, and that is something you can do something about, although they have told me for years they are unwilling to do something about that. But for those two near-term main drivers of higher inflation, which is pushing yields up, I'm not sure a rate hike is the solution.
Do we need a growth scare at this point, given the fact that oil prices continue to go higher, that inflation has remained higher for more than 5 years?
I don't think you'd ever need a growth scare.
I ask this because that seems to be Europe's playbook, and that's honestly what a lot of people are thinking about. I mean, right now, the rates market is saying, give us a rate hike. And you're saying that the Fed doesn't need to deliver it. So there is a conflict here.
Well, I'm saying the Fed probably doesn't need to deliver it. I'm not saying they don't have to.
I'm laughing because I'm totally with Bramo that the Europeans just engineer growth scares. Yeah. Right?
How's that working?
I'm going to take so much stick for saying that, but that's what you're saying.
True. I mean, that's essentially what they are saying. So in the U.S., we're saying we don't need to, but the market is trying to engineer a rate hike. And so if they don't deliver one, does that become a problem, or is that going to be a boon to the equity market?
Well, I'm not sure the market's trying to engineer one. I think in the new era of less Fed guidance, everyone, I'm sure, has come on air. I watch quite often, but not all the time. And I'm sure everyone comes on air and says, in addition to the era of less guidance, you're going to have an era of higher volatility as the market prices in what it thinks the Fed should do as opposed to what the Fed will do. Because in the past, they have told us more or less what they would do in the post-GFC era. So yes, the market is struggling, for lack of a better word, to figure out what the correct policy course going forward is, and maybe next week we'll get greater clarity on that. All I'm saying is some of those drivers are not suited to rate hikes, and I think the Fed has to be very careful here not to exacerbate the situation. Now, in terms of a growth scare, the economy is doing fine. Jobless claims yesterday, since the doors were on the charts. You mentioned ISMs in Europe, et cetera, et cetera. There's no real big, obviously there's some issues at the lower end of the income spectrum, et cetera, but you listen to the United Rentals report, the Honeywell report, et cetera.
Well, then why aren't you getting bullish in terms of the sell-off being a viable dip?
We're like a percent and change off the high.
Not
I was watching TV yesterday.
7.
Well, yes, the NASDAQ is down 7 and change percent. That's fair. But for the broader market, and I think many investors, well, I shouldn't say that. I was going to say many investors are broader market investors, but they might own SpaceX and
What were you watching on TV?
Well, I watch all sorts of things.
Well, you were just about to say I was watching on TV.
I was watching some things on the TV.
Yeah, and what did you see?
I saw some person say something that I disagreed with.
And what did they say?
Which is not unusual.
What did they say?
I don't remember anymore.
Okay, all right.
But so...
He's not trying to start a fight here.
No, I'm not trying to start a fight. I enjoy all the TV and the people that I watch and the meetings that I have with investors. Everyone is wonderful. And so getting back to the main point here, I remember now. Someone was saying, are you using the sell-off opportunities as a chance to buy? And sure, that is applicable to many of the tech names that are down a bunch, right. Sure. But for many investors out there that invest in something besides technology, a lot of these names are barely off the highs. Look at the chart of Simon Property Group. Not that long ago, malls and retail was the short of the century. Pull up a chart of Bill in the control room. Pull up of SPG.
I thought it was Bobby in the control room.
He might be out today. It's Friday in the summer.
Bobby was fired.
Summer Friday.
Like a lot of these Ross stores, there are other things doing.
So I'm with you. And when you look at the index, if you've been away for vacation for a long time, it's done nothing since the end of June.
Yep.
We're 2 to 3% away from all-time highs. But earnings have been fantastic.
Yep.
What we're trying to gauge here, Dan, and I think it's an important conversation, is the index going to stop going up even when the earnings are so good? And is there a signal that you can take from that the market's no longer responding to that fantastic information in quite the same way it was?
Fair. There are something I think a lot of us who speak about markets struggle to articulate is the two seemingly divergent ways you need to look at the market. With respect to earnings, there's two analyses. Are earnings good, and are earnings good enough? If you're an investor, as we are and many are, all you care about is are earnings good enough. Good or bad doesn't matter. Good enough is what matters. If you're an economist, if you're looking for a signal from markets, good is all that matters. Yes, Netflix revenue growth was 11%. The market wanted 12%. Stock sells off, but 11% growth is still pretty good. I'm picking a random earnings report out of the air. Those earnings reports, I mentioned United Rentals and Honeywell and a whole host of other companies that have gone this season. I don't really see much weakness. I mean, Comcast talked about Epic Universe. Maybe there's some, I was just down at Epic Universe. It didn't seem like there was much of a problem to me. But Comcast said that maybe there's some trouble down there, and maybe that signals weakness for Disney. But across what I've seen so far, 100 plus S&P 500 companies, I hear pretty good things.
Who'd you fly with?
Who did I what?
Who'd you fly with for your vacation?
The CEO of Delta actually came with me. He wanted to make sure that I had a good experience.
See, he's very good at customer service.
And no, I went with my family down to Epic Universe. We went on the rides, and the Super Mario, my son is young. We went on the Super Mario World. It was fantastic.
Very cool. Are you satisfied with your time allocation?
I'm never satisfied.
A little bit more, or
if there's one thing you know about me, it's that I always
more TV. He's thirsty.
More. I love the sound of my own voice, sir.
No. Dan, thank you.
Thank you for having me.
Dan Greenhouse of Solos Alternative Asset Management, other networks. Dan is available for appearances. He wants to be invited still.
Weddings and more mitzvahs?
He saw things on TV that he disagrees with, but that's okay. He sees lots of things on TV he disagrees with.
But he can go talk about any of them, including his time at, Orlando.
Let's give you an update on news worldwide with your Bloomberg brief. Vonnie has more. Hey, Vonnie.
Hey, John. Thank you. The U.S. launching its 13th straight day of strikes on Iran. President Donald Trump threatening to escalate the attacks and saying it'll hold Tehran responsible for actions by the Houthis. Axios reporting Trump is considering a, quote, massive attack and is close to making a decision. The federal government dropping subpoenas compelling New York Times reporters to testify about anonymous sources. The probe related to the subpoenas came after the Times reported on security concerns over Trump's new Air Force One jet, which was donated by Qatar. SpaceX betting big on Starship. Sources telling us here at Bloomberg, Elon Musk's company is turning away satellite operators seeking rides on its Falcon 9 rocket beyond 2028 as it plans to transition to Starship. The company declining to comment. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the program, keeping an eye on the cost of living.
We have kept rates down, way down. Inflation is way down. The Democrats in Congress, if given the chance, they'd send you prices soaring and inflation skyrocketing.
Up next, Monica Guerra of Morgan Stanley, live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Equities bouncing this morning by just 0.2% on the S&P 500. Under surveillance this morning, keeping an eye on the cost of living.
We have kept rates down, way down. You know, we inherited the worst inflation in the history of America. Inflation is way down. The Democrats in Congress, if given the chance, they'd send you prices soaring and inflation skyrocketing.
So here's the latest this morning. The White House touting efforts to fight inflation. The president announcing an expansion of the ratepayer protection pledge. The president now scheduled to deliver an economic message in the key battleground state of Michigan on Monday. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, this weekend will actually mark 100 days until the midterm elections, which will hinge in large part on these voter concerns around the economy. And as you mentioned, those fears are now being compounded when it comes to the higher costs associated with AI development. President Trump yesterday touting this bipartisan ratepayer protection pledge, which essentially puts big tech companies like Amazon and Meta on the hook to pay higher electricity costs, essentially funding generation and power upgrades, though this is only one part of the economic picture that voters are contending with. The new poll this week from Fox News finds that Democrats now hold the advantage over Republicans when it comes to who voters trust for the handling of the economy and inflation. Of course, 2 issues where the party has typically been the stronger one on. And John, so far this week, the Trump administration is doubling down on its economic policies, being perhaps the busiest week in months when it comes to the tariff agenda, though a senior administration official tells me to expect more exemptions when it comes to the tariffs that were just announced overnight on goods that could contribute to supply disruptions as we get closer to November.
Tyler, thank you. This will be a major issue getting closer to November. Monica Guerra and the team over at Morgan Stanley writing in their midterm election preview the following. Even when growth is resilient, voters often discount healthy macro data when their lived experience is defined by higher costs for gas, groceries, rent, and utilities. Monica joins us now for more. Monica, good morning.
Good morning.
It's good to see you. This is going to be a major issue into the midterms. What can you do between now and then if you're a policymaker?
If you're a policymaker, you're looking for every avenue. I think that the Trump announcement around corporations contributing to power generation and trying to reduce those costs is one of those measures. But you have to balance that with what's happening geopolitically and globally when we see what's happening with the U.S. and Iran, pressures on gas prices, right, and that elevation, as well as concerns at the local level just around housing, and that's more of a local issue, not one that the federal government can just come in and cut.
It's the last week of Congress in terms of before their summer holiday that you have both the House and the Senate in session. Gas prices are going up. Americans are pushing back in polls about this war. Are they going to do something when it comes to at least some of the immediate effects at the pump?
So what's really interesting about this is that you see, like you said, it's a really unpopular war. About 59% of the population is not in favor. And Congress has actually moved, to rebuke the president. A Republican-held, House has rebuked the president with this GOP, war act saying that they are not in favor of continuation. However, Senate's not going to move on that, so it's mainly symbolic. And in the same hand, right? One hand you're saying, we're not in favor.
Now they're
but then
sending
they're
more money.
approving $95 billion, right, for more spending on the Iran war. So what are they going to do? There's limited tools that they can actually pull on. Maybe you look to releasing more from the Strategic Petroleum Reserve in the U.S., but even that is very limited. We already have dwindling levels of the SPR to historic lows, and any sort of shift there would maybe alter pricing for a week or two ahead of the midterm. So you would have to really time it strategically.
The other risk this morning, of course, is the reintroduction of new tariffs. The markets seem to be brushing this off, but some analysts I'm talking to are saying their clients, corporations really care. They're going through these lists. Is this going to be an issue for this White House with some of these C-suite executives?
Well, what we've seen is that the broader, in our view, we think that the broader cost pass-through to the individual related to tariffs has peaked and is starting to come down. We have seen a lower inflation print. However, all this macro, activity could turn that tide, right? It just was a small disinflationary, moment in June. So for us, we're still, very much watching that number and seeing, what Congress and the Trump is going to do to actually move on it. Now, what's important here for us when we're thinking about tariffs in the future is the full package for the consumer and how they're going to respond in the midterms. And so from the political science lens, we're looking at gas prices, which in years where there is an increase from the prior January, you get a loss of about 32 seats. So it really puts the GOP already on the back foot, not just because historically you get a turnover in midterms, but then you also have the gas price component also dragging on the likelihood of re-election.
So that's the election picture and sort of the lead up to it. From a market perspective, I understand that I've got a very skewed kind of view on a lot of things. But yesterday I saw the data on, or the news about the tariffs, and I thought, oh, they're looking for new revenue to plug some of the gaps because the deficit's going up so much. Maybe this could help bond yields. Is that even in their calculus? Because at this point, you're seeing bond yields really get carried away and affecting some of the areas that they've been talking about the most, like housing.
Well, you have to remember that the tariffs that have been recently announced are largely symbolic, right? You're saying, Trump came out and said 100% tariffs on pharma, but that starts in 2028, again, post-election, so it's not necessarily a midterm factor, nor do I think that it's really a revenue plug because it's giving a long runway in order to get, these generics back to the U.S. In addition, when you think about the USMCA renegotiations, we've said for a long time now, over and over again, that this was going to be a pressure point for the summer, and we're starting to see that come to head on the 50% on Canada. That we think could have the biggest impact, but again, that's still an opening bid. And when you're working with Trump, you have to remember this administration, we always land somewhere in the middle. So as far as the tariff component, I think it's a little less risky than, say, the gas and U.S.-Iran piece of the equation.
I share Lisa's bias. I was looking at the bond market too.
Thank
It was one of those days.
I know. I was just thinking to myself, yes, but you were looking at it because of oil and gas. But I'm thinking, what can they do to actually cap these yields? They could, try to fire someone on the Fed, or they could potentially, try to raise revenue.
I'm not sure firing someone at the Fed would help these yields.
I know, but they're trying to figure out how to engineer a different Fed board and what that would look like. But I mean, it's sort of they're running up against a lot of challenges, so maybe more revenue.
Monica, good to see you. Thanks for being here. Thank you. Favorite airline? No, don't do it. Monica Guerra.
No.
Monica Stanley Wealth Management. Monica Guerra. Monica, thank you. Fantastic guest coming up in just a moment, by the way, to talk about some of these issues. Senator Dave McCormick. He understands the backdrop for the geopolitics better than most, and he also pairs that with an understanding about financial markets better than most. That's about 20 minutes away.
Yeah, I want to hear what he has to say, given where bond yields are and what the financing costs are. I'm also interested in what the modern warfare is and skeet shooting with...
billion-dollar skeet shooting.
Billion-dollar skeet shooting, as you call it, yeah.
Very expensive.
How do we get away from that?
With great difficulty at the moment. Up next, we'll catch up with Mike Ventura of RBC on this equity market.
weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Usually when you get the kind of route we saw yesterday in both the equity market and the bond market, typically you might wake up and see a big bounce, and you don't see that this morning in stocks or bonds. Equity futures this morning bouncing back by just a few tenths of 1% on the S&P. On the Nasdaq 100 higher by just a tenth of 1%. And in the bond market, holding on to some of these levels. Pretty muted price action here. Yields down only a single basis point, coming off the highs of the year on a closing basis on 2s and 10s. 10s this morning, 468, 2s around 433.
The fundamental problem hasn't been resolved, which is the conflict in the Middle East, the flow of oil, and the inflationary pressures that could then ensue. You add to this some of the financing needs of the artificial intelligence-related companies. And you can see that people are demanding a higher premium, and that's not going away.
Just sit on that bond market and those scores just a little bit more. Let's look at those yields. Those yields, 2s and 10s in the last 24 hours, are higher than they were at the first stage of this energy shock, and they're higher than they were for the Liberation Day shock as well. Yields have taken out those levels.
That's what I've been thinking about, because the president reversed course on Liberation Day after he said the bond market got yippy. Well, now we've passed through that level, and he's still talking tough when it comes to rhetoric in terms of what he's going to do with the conflict as well, introducing new tariffs. I don't get a sense that he's prepared at this level to reverse course.
I think that's what's unique about this week, that we've got to these levels, and you pointed out earlier this week the buying's not come back in. There are a bunch of reasons for this, but that's a unique feature of this backdrop for this market at this point in time, that you can get to these levels across the yield curve, and we're holding on to them for a sustained period.
A lot of it goes back to what you were saying. Normally you see demand destruction. Normally you start to see cracks in the consumer and the underlying economy. You're not seeing that this time. So at a certain point, if you're seeing a faster than expected economy, inflationary pressures, and much more borrowing that needs to get done, that all adds to a higher premium.
You're not seeing the growth scare. You're just not seeing it, even with this move in crude. Check it out. WTI and Brent through triple digits in yesterday's session, backing away this morning by 3%, but holding on to 98. That was a feature of the conversation we had earlier on the program with Rebecca Babin. Can we hold on to these levels? We struggled to maintain the highs in March, April time. Is it different? Is this backdrop different? Is the cushion small enough to make a difference?
Well, we're living on the inventories. The fighting continues, and there's fresh risks that are now introduced. Torsten Slok just put out a note talking about how much more time it takes to avoid the Bab el-Mandeb Strait going around the Cape of Good Hope when it comes to Africa. He says 9 days to ocean routes, supply chains under pressure.
That's the price action this morning on our radar. President Donald Trump imposing duties between 10 and 12.5% on imports from most major trading partners, alleging around 60 economies failed to prevent forced labor in their supply chains. Elsewhere, the president weighing a, quote, massive attack on Iran. Trump telling Axios that Tehran isn't ready to make a deal, saying, quote, they haven't received enough pain yet. And finally, Intel shares gaining in the pre-market. The chip maker reporting its fastest revenue growth in nearly 15 years as the AI boom fuels demand for semis. Intel reversing plans to reduce capex and committing to increasing spending.
Their earnings were incredible. Just to put this into perspective, their profit in the second quarter was 42 cents a share based on the expectation of 21 cents, so double that expectation. Full year sales, 15.8 to 16.8 billion versus the expectation of 15.1 billion. Why? Because increasingly the CPUs that they produce, which are much more the nuts and bolts and less of the sophisticated chip that NVIDIA produces, are being required for the data center build out and a lot of what they're trying to do to build out computing capacity. Is this because of the investment from the United States? Is this because of some of the just the hype around what they've done? Or is this that the demand is so great and it's changing in nature and benefiting this company?
This week and the next couple of weeks for me and many others was never just a test for earnings. It was a test of price and positioning. And this story with Intel, I think, is a decent case study of that. It's had a monster run-up. What were we up year to date? 170%, something like that. Okay. Earnings are a blowout. You look at those earnings, they're absolutely fantastic. Look at that stock move. 3 to 4% for a name that, so you've blinked some days and Intel's up 10% sometimes, right? This tells me something about price and positioning. And the last few days have told me something about price and positioning too. There's not a problem with earnings, but it speaks to price.
People's bar is incredibly high just based on where valuations are. Samsung, though, didn't work. I mean, even when they did have blowout earnings, their shares fell. So the fact that Intel's shares are up probably gives some people confidence that there's something left and that there still is some modicum of surprise available, at least if you really do have an incredible earnings.
Yesterday was odd too.
It was.
You're punishing the spenders and the chip stocks don't rally.
It was a puke day. I mean, it was an everything, sell everything kind of day. It was sell the levered trades kind of day because ultimately nothing was going to work if oil prices get incredibly high.
Do you want to congratulate the president for his timing, his market timing with this particular stock? It's not bad, is it?
No,
how much money have they made on this?
They've nailed it on Intel. They have.
Totally.
Billions of dollars. And, well, what happens with it? Is this going to be some sort of sovereign wealth fund? But at the crux of it, it is about, with a company like Intel, which is why some Democrats were in favor of it, it is about national security.
Do you know what I'd worry about? And you're absolutely right. And I think we've sacrificed the free market and capitalism for national security. It's difficult to argue with. You need to develop the kind of production that we're developing with Intel domestically here in the United States for a bunch of reasons. Good news. Like anyone who gets involved in financial markets, when you get onto a winner early, sort of get emboldened, you're like, I'm good at this. I'll start buying a little bit more. That's what worries me about Washington, D.C.
Well, they might be doing that with AI companies.
That it sets the tone for a new era of very activist White Houses looking to make the same kind of investments. And I would warn Republicans that if you're comfortable with this, just wait, because it won't always be Republicans in the White House, and Democrats will have their own ideas on the right things to buy, and we'll have a different problem.
Yeah, let's see where this goes. Right now, Intel made a lot of sense. Let's see about getting a stake in it.
Brahma doesn't want to go there. Intel up by 3.5% this morning. Let's stick with the AI build-out. Investors weighing the soaring price tag of the big tech arms race. Alphabet boosting spending plans for the year, signaling hyperscalers may continue to tap markets to fund their ambitions. Michael Ventura of RBC writing, the equity market was already showing signs of fatigue. Anytime you have a market that is fatigued and overwhelmed with issuance, you're likely to see an outsized reaction. Michael, a fantastic guest, joins us now for more. Good to see you, buddy. Thanks for being here.
Thank you for having me. I have wanted to jump in for the last few minutes. You have highlighted a number of points that I think are germane to this discussion. The names that you have mentioned are some of the best business models in the history of capitalism. Many of them had blowout earnings this week. A lot of the news flow, from a macro perspective that you highlighted, is not new news. It's new cares. The market decided to care this week about a lot of things that they have been able to compartmentalize in a way that we perhaps have never seen before in history. Some of the news flow that you talked about would historically be macro events that would shut down the capital markets. We have looked past them, looked through them, and some of the issues that you highlighted are now problems that are sort of 6 inches in front of our face in terms of the AI spend, the build out. We've crossed the chasm, that we have been creeping towards with respect to will folks see free cash flow, see CapEx outstrip free cash flow. We're here. We're going to raise capital into it to support it. And so I think market now, despite the fact that we've lived in this world for the last couple of years, where there's this very highly concentrated group of systemically important publicly traded names, we're at the part of the programming where there's a quality curve being established even amongst those systemically important names. And that's going to be, I think, a fascinating, next wave of this thematic.
Can you describe the issuance window and what it looks like now, given the amount of supply we might see in the next 12 months?
Yeah, from an IPO perspective, we certainly saw some clients that decided to forego entering this July window. I suspect that they will look to access the next open window post Labor Day. I suspect that'll be a very, very active window. There will be great breadth to the folks that attempt to enter the market in that window. IPO market in particular, largely concentrated around industrial names, space tech, defense tech, some of those thematics. We're starting to see a diversification into some consumer names entering the market. But I do think that September window, which is the next most practical one, will be exceptionally busy because there were a high volume or high number of names that were already in the backlog. Add to it the folks that decided to forego the July window.
Do you think that some of the highest profile potential IPOs on the docket, and I'm talking about Anthropic and OpenAI, have been stymied somewhat by some of the recent news and frankly skepticism around open source models and just the changing dynamic of where value creation will come from?
Yeah, I think, obviously we're not in the business of mentioning single stock names, so forgive me for sort of talking around some of the specific names that you mentioned. I do think those will be the drivers of some continued seminal capital markets events this year, like we saw with SpaceX earlier this year. I do think institutional investors, by and large, believe that we are in a great industrialization, that the spend and the capital raise behind this thematic is warranted, should continue. Their dollars will be there to support it. Do they need to own 5 railroads? I think is a question that a lot of institutional investors are asking themselves right now. And so, again, I think we'll start to get into the part of the programming where we pick some real winners and losers amongst even this very concentrated cohort of again, very systemically important and highly valued names.
What signals from the market would you say, hold on a second, this might be a closing of the opportunity to raise money in the equity markets akin to what a lot of people have been planning for?
Great question. And I think one of the things that gives us a lot of confidence in this capital rotation that we're seeing happen right now, if you go under the hood with some of the volatility that we've seen intraday in the market, it's momentum down dramatically over the last 30 days, growth down dramatically over the last 30 days. It's a reallocation of capital into other parts of the equity market. It's not a withdrawal of capital from the equity market, flight to safety. You mentioned some of the bond market moves at the opening of this segment. If we had seen rates move more violently to signal that there was a real reversal of flows out of equities into bonds, a real flight to safety, that would have given me pause or indicated that maybe the window is closing. I think, again, there's a little bit of fatigue, a little bit of digestion. It's been a historically active issuance market. Institutional investors have also done incredibly well. And oh, by the way, it's August next week. And so this is sort of a time in the market when folks tend to try to take a break. And so I think we've all been rooting for that. I can say, having wall-crossed institutional investors on transactions over weekends in the first half of the year, folks are sort of looking for a little bit of a pause to the issuance pace.
For a Friday.
Right. Don't remind me that the summer's almost over. I'm starting to feel a little bit depressed now. When it comes to the investors and how they're feeling right now about the AI data center build out, do you think some of it is also concerned that they're going to spend all this money and then certain states are going to say, actually, we're not going to allow this?
Really interesting developments from a political front, particularly here in New York over the last couple of weeks. I think that is a question that we'll end up working through. It'll obviously be a topic of concern in the midterms. Again, not new news that there are midterm elections coming up, but folks have decided to focus on them in the last couple of weeks with great vigor and lots of debate around some of the micro topics that'll be brought to bear, which one of which you mentioned. I think overall the need for that capital expenditure is so large that yes, while there will be some domiciles that decide to sort of push back on the thematic, it's one that by and large will end up winning the day.
I know you don't want to touch single names, so I won't come to you on this, but market timing of Alphabet's just incredible. That C-suite, the way they timed that equity raise was just perfect. Tactically speaking, you might be wondering whether it was sort of opportunistic as well to maybe derail some other people thinking about doing the same thing. I wouldn't suggest such a thing, but I'm sure people might be asking that question.
It's not just the equity raise. Also the debt issuances, they've all been raised at some of the peaks in markets.
Perfect time.
But this ultimately goes to the anxiety right now in markets. Why would someone IPO? Is it because they need the capital, or is it because they see the window open? And how big is that divergence? I think that's an important thing. Is it that the market is just really open, or is it just that they actually need the cash?
I say, perfect timing, but they also shape outcomes because they're so large. So when they come to the market, they start moving things around.
First mover advantage is a very real thing. I mean, I will touch the single thematic, which is we have seen more equity raised from investment grade issuers in 2026, and it's the largest investment grade equity capital raising since the financial crisis, and obviously funding into growth as opposed to forced funding in many instances. And so I do suspect that we'll see similar thematics. Thank goodness they're doing it in the U.S. equity capital markets, which are capital formative, and they're pulling on every level available to them. Private capital via pipes, at the market offerings, low cost, sort of go anywhere and raise at any time capital. So thank goodness that they're doing it here in our market. Harder to do in other parts of the globe. The window is open, and we're in the latter part of the cycle. So we have seen a lot of the first round of very high quality issuers come to market. Our private equity clients, who are responsible for nearly half of all IPO issuance year to date, have owned these private companies longer, scaled them more significantly, and are looking out at an equity market that's re-rated probably 10 turns in value since they bought these assets. And so we're still operating from a place where there is a lot of investor enthusiasm, even about what's left in the backlog. And so we shouldn't lose sight of that and what that could mean for an open window for the back half of this year.
Michael, good to see you. Thanks for being here.
Thanks for having me.
Appreciate it. Thank you, buddy. You were fantastic. Michael Ventura there of RBC on this equity market. Anthropic, look, there's lots of demand for Anthropic, but the one I'm thinking of, OpenAI is kind of hanging out there, right? Talk of maybe delaying that IPO. Talk about first mover advantage. There isn't much of an advantage if you're the last of the big movers.
Especially because people do seem to be tiring somewhat. I do think both of them are challenged by what we heard with the moonshot over in Kimi 3, given the fact that ultimately there's a question about whether they will be the beneficiaries or whether it really will be the hyperscalers. And that, I think, is going to hang over whatever IPO gets to the market first.
Futures this morning, just about positive by a little more than 1/10%, close to 0.2% higher on the S&P. With an update on news worldwide with your Bloomberg brief, Vonnie has more. Hey, Vonnie.
Hey, John, thank you. Bloomberg hosting 6 candidates vying to be the next UN Secretary General.
Our responsibility is to make the UN relevant again. I believe moral authority is always needed.
What we need to do is to restore this credibility of the UN as a valid interlocutor.
I would like to see a UN that is back at the table in the scenarios of conflict.
The UN must be more present, especially in the peace and security arena.
The candidates are competing to succeed Antonio Guterres, whose term ends this year. In earnings, American Express raising its revenue forecast for the year after reporting second quarter earnings that topped Wall Street estimates. Customer spending growing 9%, the highest rate in 3 years on a currency-adjusted basis. And Verizon reporting second quarter mobility and broadband sales that beat analyst estimates. The company raising its full-year guidance for some metrics, including adjusted earnings and cash flow. And that is your Bloomberg Brief. John.
Bonnie, thank you. Thank you for the update. Up next on the program, finishing the job in Iran.
We're doing very well against the Islamic Republic of Iran. We're doing extremely well. We want to get it over with, and we want to do it right. We have to do what we came to do.
That conversation up next.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC. Africa CDC is the leader in terms of public health in Africa.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you the latest business news wherever and whenever it happens. I'm Scarlett Fu, reporting from America's biggest military shipyard. This is Bloomberg.
Crude this morning just off triple digits, pulling back to about 98 on Brent this morning. We're down by close to 3%. Under surveillance, finishing the job in Iran.
We're doing very well against the Islamic Republic of Iran. We're doing extremely well. We want to get it over with, and we want to do it right. We have to do what we came to do, and that's we can't let these people, very violent people, we can't let them have what they want.
So here's the latest this morning. The US striking Iran for a 13th consecutive night. The president telling Axios he is considering a, quote, massive attack to push a peace deal. Bloomberg's Tyler Kendall has the latest. Hey, Tyler.
Hey, John, good morning. Well, at this point, little public indication that diplomacy is getting back on track as President Trump now threatens wider escalation. He's previously previewed there's a few options on the table, including escalating strikes against Iranian infrastructure, including bridges and power plants, as well as going after what's known as Pickaxe Mountain, a site believed by the U.S. to hold nuclear materials. We'll have to see where it goes from here because we have to keep in mind that the U.S. is now dealing with another new front when it comes to the Houthis in Yemen and threatening shipping in the Red Sea.
Tyler Kendall with the latest down in Washington. Tyler, thank you. The Republican Senator Dave McCormick coming fresh off last week's Pennsylvania Defense and Innovation Summit, securing $10 billion in new investments for his state. The U.S. Senator Dave McCormick joins us now for more. Good morning, sir. It's good to see you.
Good morning.
Let's talk about the nature of this challenge. And the character of the challenge defensively has changed as well. And the Middle East is a fantastic example of that this morning. What do we need to change when we think about the kind of investments that need to be made in this country?
Well, there's three big changes that have happened. One, the world's getting more dangerous. Two, the nature of warfare is changing dramatically with drones, autonomy, AI. And third, we've had apathy within our defense ecosystem. So we need to introduce new players into our defense ecosystem, drone manufacturers and all sorts of other unique capabilities. And we need to change the way we procure defense systems. So it needs to be much faster, it needs to be much more competitive. We need to constantly be innovating. And so the focus of the summit was to bring together the traditional industrial base. We've gone from to 1% of global shipbuilding. So we need to go back to the core industrial base, but introduce all these new technologies into the mix. So the goal of that was to bring those players together, have the president, have his cabinet there, have all the major primes, all the emergent technologies, all the big investors, because you need the capital, and talk about ways to move forward in accelerating our ability to man the battlefield with this next generation of weapons.
Senator, it's an important conversation to have now because we are relying on inventories when it comes to the war in the Middle East, all that has been given in terms of Russia's invasion of Ukraine. Where are we on defense inventories?
Well, I think we're adequate in terms of being able to continue to conduct military operations, but there's no doubt that we need to ramp up our production capacity. Let me just give you an example. In Ukraine, they make 10,000 drones a day. A day. We have nowhere near that manufacturing capacity here at home. So we need to ramp up that manufacturing capacity. In shipbuilding is another example. In Philadelphia Shipyard, we build 1 ship a year. We need to go to 20, which we're doing over the next 5 years. So we've let ourselves become more dependent on others, and we've let ourselves locked into looking backwards at last year's or 30-year-old platforms, as opposed to embracing this next generation of technology.
When it comes to the next generation technology, when it comes to the Iran war, we even heard from Palantir executives, this is going to be the first war that really was conducted by AI. Are you concerned that China is building a model like Kimi K3 off of our technology?
Yeah, absolutely. I mean, China has a tradition of stealing our intellectual property and using that to their advantage. That's why we need to continue to do all the things necessary to lead in the AI race. I always like to say that I'd rather have our hand than China's hand, but it depends on what we do. So we need to embrace the compute capacity and the energy capacity needed to be in the lead. We need to make sure we don't overly constrain our innovators, because this is really the most important technology race of our lifetimes.
And we are throwing tons of capital at it.
We're throwing tons
And that's what's different about this moment, I think, for Treasury. And I want to make that pivot. I think it's important. The military costs a lot of money. We know that. And the deficit wasn't a problem because we didn't see the biggest companies on the planet raising the capital to the extent they are now. And you start to see these moves, and you're in a fantastic seat. And I mentioned this earlier on the program. You're in many ways the perfect seat because you bring to the Senate experience on both the geopolitics, the cost of war, and Wall Street, how you finance it. Are you starting to get concerned about what's happening with the bond market here at these levels? And if not, when?
Well, listen, we are in uncharted territory. I think last time I was here, we talked about this. We've got a couple things going. We're in the middle of this geopolitical shock with what's happening in the Middle East, and we're also in the biggest capital boom and productivity wave that we've ever seen. So I think we're digesting both things at the same time. And we talked about my friend Kevin Warsh now in this unique position because he has these inflationary pressures coming, but we also have this huge productivity boom coming. And I think he's wisely said, we're going to launch these committees. We're going to figure out how we're going to think about the models for the future. And he's also talked in, I think, very convincing ways about the need to guard against inflation. And so I think for the foreseeable future, we've got all these factors, and we need to just keep our powder dry.
Do you think he should hike next week?
I think we should keep our powder dry.
That means hold.
Well, listen, I'm unfortunately not in that position because
Senator Warren, your colleague from Massachusetts, has no problem calling out the Federal Reserve. You're in a position where you can say what you think.
Yeah, listen, I think given all those factors and uncertainty, I would like to see interest rates stay where they are.
Senator, it's good to see you.
Good to see you. Thanks for having me, guys.
Thank you. Senator Dave McCormick of Pennsylvania on military, defense, and the cost of war, and what it means for this bond market too.
Yeah, and at a certain point, how do you compete with all of the fundraising, and how do you deal with this a time that is a really interesting time? I mean, some people would say, you know, this is a very challenging time for the likes of Kevin Warsh, and he's chosen the wise thing of not saying anything that could really fit him down in any way, because it's a very difficult time to come up with conclusions.
That Fed meeting a week away. Up next, Megan Swiber of Bank of America, the Cisco president, G2 Patel, Neil Dutta of Renmag, Kara Murphy of Kestra Investment Management. The third hour of Bloomberg Surveillance just around the corner.
Being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid? I don't think I was reading magazines until I was in them.
You are on the cover of all of these. Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable.
Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it Paradise ahead or Gattaca?
Maybe somewhere in the middle.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech. Every weekday, only on Bloomberg Television.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is very cold. And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
The global economic playbook is being rewritten, and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting, rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Joanna Bersecci in El Ola, Saudi Arabia, and this is Bloomberg.
I'm still very bullish on the overall AI infrastructure.
Second quarter earnings will probably mark the peak.
That bar, again, has become so much more challenging for awards here.
There are legitimate questions about cash flow.
Aren't we all believing a little bit too much into that U.S. exceptional picture?
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend, live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equities up by 0.2. This is your bounce from the biggest one-day loss of the month so far. On the S&P, up a quarter. On the Nasdaq, only up a little more than 0.1%, heading towards a second week of losses. In the bond market, holding on to these levels. We'll talk about rate hikes a little bit later in the program with Bank of America. 2s at the moment at 4.32, baking in those hikes comfortably above the policy rate at the Federal Reserve going into next week's meeting. And we had some weight to the yield on 10 and 30s in the last 24 hours, coming down just a basis point this morning. 10s close to 470.
Yeah, and this really has been the notable feature, is just how long these levels have persisted. And happy Friday, John. It is going to be a weekend a lot of people need after the tumult that we've seen over the past number of weeks and months. And frankly, a real question here is, do we start to see cracks in the consumer? And you talked about how the resilience has been the feature of this market. The reason that you could see bond yields at such an elevated pace is that strength potentially a bug and not a feature when it comes to the Fed meeting next week.
I love a game of If I Told You. You know, if I told you that crude was at 100,
yeah,
that 2s would be 50 basis points plus above the policy rate of the Fed, we'd be talking about rate hikes. And we wouldn't be having a discussion about a growth scare, and that equities would be 2 to 3% away from all-time highs. If I told you that at the end of February, you think I was nuts, maybe mental. Perhaps you still do. I don't know. but this is where we are.
Yeah, I would also think that you were nuts if you talked about how much debt issuance there was, how much equity issuance there was, how much has just been thrown at this market, and the fact that it still is within all-time highs. That also would be surprising to me. This has been a bulletproof market because of the churn under the surface. Can that continue, or are you starting to see enough of the pillars start to just see a little bit of fractures?
I'm really trying to think back at where we were for Liberation Day when Trump said the bond market's yippee, he's going to reverse course on some of these policies. And I'm thinking, what is the Trump put now? Are they still moving? Are they still moving based off $100 oil, based off higher 10-year yields? I'm not sure.
I'm pleased you keep repeating this because I think it's so important. You bring up the yield curve again, 2s, 10s, and 30s, and we can just look at, say, 10s. The 10-year yield in the last 24 hours, above where it was off the initial energy shock, above where it was Liberation Day week, Liberation Month, wherever it was, April last year, when people were freaking out about the breakdown of the bond market and yields pushing higher. I think people were also worried at the time about the breakdown in the economy. That's why things are different a little bit now. So if you're in Treasury or at the White House and you're seeing yields spike higher and people are worried about growth, you've got a major problem. 12 months later, 12 months plus, that's not the backdrop right now. You've got yields going up to 470, let's call it. You've got crude at 100. And I don't see a lineup of people coming on the program worried about growth. In fact, they're so comfortable with the backdrop in the labor market right now. They've got conviction around the Fed that they believe the Fed will focus on inflation and hike interest rates. It makes 2026 so different at these same yield levels, slightly higher than where we were in 2025.
Earlier in 2025, when yields went up, people went into the hyperscalers and big tech because they were the haven when you potentially got that growth scare as a result of higher yields. Now, people are using it as a time to rotate into other names because it indicates the broadening out in the U.S. economy. To Anne-Marie's question, where's the Trump put? It doesn't seem like there is one right now. It seems like this is a market operating on the AI trade, on oil, and potentially on the borrowing needs of nations across this world.
I know everybody's excited about the weekend. You'll need some rest because next week looks like this. On Wednesday, a Federal Reserve decision and a ton of earnings from big tech start to come through as well, from the likes of Microsoft, from the likes of Meta, and then on Thursday, Apple and Amazon. That is a major week coming up next week for both earnings and monetary policy.
If we get to Friday and markets are responding to earnings the way that they did this past week, Max Kettner, please come back on and let's hear if you're bearish, because ultimately that was the tell for him. If you saw people sell off in the face of good news, that would be the tell that for positioning, things were changing on the margins.
We've got a big week coming up this hour, a big hour too. Megan Swiber at Bank of America with stocks on course for back-to-back weekly losses. Cisco President Jitu Patel on the race to build AI cyber defenses, and Neil Dutta of Renmag making the case for a rate hike maybe as soon as next week. Look out for that conversation in just a moment. We begin this hour with stocks looking to bounce and bond yields sitting near the highs for the year. Megan Swiber at Bank of America writing, we hold the yield curve flatter, but see risk to higher rates across the curve. If the Fed delivers a hike, we think the market can very quickly jump to 75 basis points. Megan joins us now for more. Megan, good morning. Good to see you. Let's just start with the setup then. What are you looking for from Kevin Walsh and the team next week?
So, John, what we've been hearing from a lot of the market for the past several weeks is we have a Fed chair that is going to be very reluctant to hike rates. A lot of that coming from this political debate that Walsh has really got this mandate to cut, that he needs to be considering this other side of the mandate on labor. But what are we seeing even in terms of the recent claims data? The labor market is so strong. We see this in a lot of our B of A card data too. Very strong U.S. consumer. And you mentioned this conundrum, right, with oil prices as high as they've been, yet we're not talking about a growth scare. We don't see evidence of that at all in terms of our consumer data. And it's not just upper income we're talking about, it's across the spectrum of a story of a very strong consumer and a Fed, when they think about this distribution of risk between unemployment and inflation. June meeting, every single FOMC participant saw more upside risk to inflation than the unemployment rate.
So the jobs market, language matters. The way you described the jobs market, you said it's strong. There's a difference between saying the labor market's not a problem and the labor market's strong. There are some people in the Fed, I believe, who are focused on inflation and saying, I don't have to focus on the labor market because it's not a problem, it's okay. But saying it's strong, I think, introduces a different risk. Do you think the labor market is sufficiently tight enough right now to be a problem for inflation, to be a source of inflation?
We're not seeing that in any of the official data yet. And really, the final tell for the Fed is going to be upward pressure in wages. We're seeing some of this in our B of A card data. in our B of A deposit data, but we're not necessarily seeing that translate fully through to what the Fed's looking at. But let's just talk about how we think about Fed Taylor rule. What are they looking at? Well, since this time last year, unemployment rate has declined, and the real Fed funds rate has eased over 100 basis points. So a Fed that maybe goes in July, maybe more like September, which is what our base case is, once they go, the market's very quickly going to extrapolate what this means for the cadence of these hikes. And that's how we still see the market underpricing what this could look like and see this quick jump to 75 basis points becoming more the norm in market pricing.
If the Fed did price in a greater number of rate hikes, would that be a good thing for the long end of the curve?
I think it actually would be, Lisa. And a big part of this, right, is the debate around Fed credibility, Fed independence, and inflation. The kryptonite for the long end of the U.S. rates curve is inflation. When we think about periods of time where multi-asset investors, folks who are buying treasuries to diversify risk versus equities, the period of time that those types of investors really begin to worry about back end of the yield curve is when a central bank cannot control inflation. Look at what we see in terms of the JGB curve right now, in terms of the risks that they've had to contend with because they don't have a central bank that's taking enough steps, at least in terms of what the market's expecting to combat inflation.
Earlier this morning, Nikkei was reporting that the Bank of Japan is probably going to remain on hold next week. Just the counterfactual here, what if the Fed does remain on hold in next week's Fed meeting? Do you expect that, or let's say that there's a dovish surprise where they indicate that maybe they're going to remain on hold and they get some sort of forward guidance? Not likely, but let's say. Does that mean that you expect the long end of the yield curve in the U.S. to sell off further? I mean, would that be a liability for U.S. Debt markets?
I would see that as moving longer-term inflation compensation higher. Since Warsh has come out as aggressively on 2% inflation, talking about this 5-year of inflation mess, not just talking about this as a couple months of the problem given the move that we've seen in oil prices, we've actually seen longer-term inflation expectations re-anchor and kind of trade at the lower end of recent ranges. And I would expect that a Warsh that sounds more dovish next week causes these 5-year inflation measures, causes longer-term break-evens to move higher, and we could get the market more concerned about what these longer-term risks could look like for a Fed that is not going to be viewed as credible on inflation.
What's a bigger risk factor for debt markets next week? Is it the Fed, or is it the tech earnings and the potential CapEx plans that they have potentially to announce?
It's such a great point too, Lisa. And when we think about over the next couple of weeks, I'll just add another one, which is quarterly refunding the week after Fed. And that's usually and historically has been a pretty sleepy event for the market. But so much of the focus now, especially given the very strong IG issuance that we're seeing, is what is Treasury going to do? And at the last refunding meeting, we were seeing some of this tension between TBAC, which is Treasury's Borrowing Advisory Committee, in terms of guiding to the fact that deficit risks are only going one way. They've really got to ramp up some of this issuance coming next year, versus a Treasury Department that's talking more about increasing that bill share, which is less duration supplied to the market, has less of this impact on longer-term yield levels. So totally agree, the IG story, the issuance that we're seeing in credit has actually more than offset the declines that we're seeing in terms of the amount of coupon supply that Treasury's been able to reduce this year.
I know we went through earnings and the Fed next week, but what if we have a weekend where the president is saying he's considering a massive attack on Iran and the conflict just gets even worse?
Yes, and geopolitical uncertainty continues to creep higher. And we're talking about a Fed, again, a couple months ago, them looking at these inflationary risks and saying everything is skewed to the upside there. I think it just puts more pressure on the Fed to go, especially if we're seeing that pass through to how the market views and perceives these inflation risks.
You've got the calendar up at Bank of America. What's circled right now? September? Where are you thinking?
September, John, is our base case. But the market's not ruling out July, and honestly, neither are we. We really don't have the market trading this level of uncertainty ahead of a meeting. When we look back over periods of time, I was just doing some of this analysis yesterday, actually. There's 2 periods that stand out as where we see the market pricing, even more uncertainty. And that was back in 2022 when the Fed delivered that surprise 75 basis point hike, and September of 2024 where they delivered the surprise 50 basis point cut. And we did see, some media reports coming out before those decisions to guide the market in a discrete direction, which maybe we don't get this time. He wants a family fight.
Always enjoy catching up with you. Appreciate it. Thank you.
Yes.
Megan Swiber there of Bank of America. Circling September. It's new territory. If you've been in the market for the last 20 years, particularly post-GFC, and that's your experience, that's your career, you don't really know a Federal Reserve that doesn't hold your hand. This Federal Reserve typically holds your hand going into a meeting and tells you what they will and won't do ahead of time. We don't know this time around. There is no guidance.
Right now, Fed funds rate is pricing in a 33% chance of a Fed rate hike next week. This is unheard of in terms of just random expectations ahead of it. And as Megan said, people don't want to trade this. What's your advantage getting ahead of this?
I love how the ECB does it. You know, we were talking yesterday about how the ECB is a three-part act. They'll drop the statement, they'll do the news conference, and then you get the sources later on in the day.
Yes.
It made me laugh because they always go into the news conference now. Their new shtick is we don't do guidance either.
Right.
And then, like, within the next hour after the news conference is finished, there are sources speaking to either Bloomberg or Reuters telling you what they may or may not do in September. I mean, like, it's like...
Exclusive Reuters, ECB considering several options to mitigate losses.
Bloomberg, we had the same thing out yesterday. It's fantastic reporting from the team, but it just makes me laugh. You can't sit in the news conference and say it's a new world, we don't provide guidance, and then provide sources on the side that provide guidance.
Well, you know, some people can't help themselves. And frankly, they want to get their voices out there, and they're on a stage to really deliver something, so they want to do so. It doesn't seem like Kevin Warsh really does that yet.
Some central bankers just can't get away from that world. Let's give an update on news worldwide this morning with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. The US will impose tariffs of between 10% and 12.5% on imports from most major trading partners after finding about 60 economies harmed American workers by failing to prevent forced labor. It's the biggest move yet by the Trump administration to reconstruct the tariffs that were struck down by the Supreme Court. SpaceX is betting big on Starship. Sources telling us here at Bloomberg, Elon Musk's company is turning away satellite operators seeking rides on its Falcon 9 rocket beyond 2028 as it plans to transition Falcon 9 for Starship. The company declined to comment. Facebook Marketplace is branching out. The New York Times is reporting Meta is launching Seller, a standalone app for Marketplace users. Marketplace is one of the most popular features on Facebook. And that is your Bloomberg brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes. Up next, the Morning Calls Plus. We'll catch this up with the Cisco president, Jeetu Patel. As an unprecedented hack, what a week it's been for AI. Sends new fears through the cybersecurity industry. That conversation with Jeetu is up next.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power. You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Overall, I still think ultimately that tech will be a buying opportunity. Is it right here, right now? I'm not sure about that yet, but ultimately I think money will rotate back into tech. This is the fifth pullback of at least 10% during this bull market. It's just a love-hate relationship that we're seeing. I would still think I'm giving tech longer term the benefit of the doubt.
That was Keith Lerner of Truist giving tech the benefit of the doubt. Not much of a bounce for tech this morning, up by just 0.2 on the NASDAQ, and that's a talking point for this market this morning. Where is the bounce? What happened yesterday with chips? Had a decent run of gains, bit of a bounce back for the chip players, and then kind of odd that we saw the names like Alphabet, Tesla punished for spending too much, and then the companies that receive all that money not rallying off the back of it much at all.
Yeah, you know, you could come up with a narrative if you wanted to, that maybe there are questions just in general, how much people are going to be willing to spend into the future, given the fact that there is some market pushback. I will say yesterday was just a big risk-off day, and we haven't had a correlated risk-off day like that in a long time, where suddenly all the pillars seem to be breaking down at the same time. If that continues, people might start getting nervous that the churn under the surface turns into something a little bit more directional.
You nailed it this morning. What'd you call it, a puke? It's one of those pukes, wasn't it?
It was a puke.
I just hate that word.
I know, but it's just...
Risk puke, bond
yeah,
puke.
It was...
And every time she said it, I was cringing.
I'm not a big fan of that word either. But it was, you know, the classic sort of bond puke. We're doing Friday still.
Well, I'm just going to keep doing it.
40 minutes, Grandma. Give it a break.
No, let's hope it's not another day.
That's the equity picture. Let's get to some morning calls. First up, Wells Fargo raising its price tag on Intel, seeing sustainable server CPU momentum. Your second call from Citi, trimming its price target, maintaining its buy rating. On IBM, saying the company's outlook is, quote, better than feared. And your third and final call from UBS, raising its price target on AMD, seeing a potential path forward towards sustainably higher EPS. That stock is up this morning by about 1.2%. They're three of your calls. Let's stick with tech. Cybersecurity concerns mounting after advanced models from OpenAI went rogue, hacking tech from Hugging Face in a first-of-its-kind incident. Cisco taking a head-on approach, unveiling a brand-new AI tool designed to find and address weak points in software. The Cisco President and Chief Product Officer, G2 Patel, a good friend of this program over the years, joins us now for more. G2, good to see you, sir. Great to catch up.
Jonathan, great to see you. How are you?
Let's get into this issue. I'm okay. I'm always nervous. You know I am. And then I see those stories like this week, and it makes me even more nervous. I've been asking you this for a while. Can you tell us, do you think these developments will expose vulnerabilities or over time just make these systems more resilient?
I think the reality is that, well, it'll be a little bit of both, because what you'll start to see happen is these agents are getting to be long-running agents that when they're given a task, sometimes they just keep going down that task. So for this thing that happened with OpenAI and Hugging Face, basically what happened is all that the agent was given was a goal, and it figured out a way to get out of the secure enclave and go out and make sure that it actually stole the model weight someplace else and stole the test. And so what you can start to see happening right now is we have to, one, be prepared that an agent might behave out of the bounds of what you think is normal. And two, when it starts behaving that way, you have to be able to intercept it and be prepared that that behavior could be, pretty bad for you. So it's something that we're just going to have to live in this new world where agents are going to, as agents mature, we will have to figure out a way to intercept them, and they're not behaving the way that we deem it to be appropriate.
G2, I remember when IBM came out last week and started talking about the change in focus and the wholesale shift towards cybersecurity earlier this year, as we learned about Mythos and Fable and how that affected their earnings. I'm just wondering, from your perspective more broadly, if you can sort of quantify or characterize just how much interest in cybersecurity has picked up and really concentrated the focus of CEOs around the world.
I think right now, if you think about what's happening in AI, there are two areas that are of material concern for organizations. Number one is cybersecurity. Number two is the cost of tokens. And these are both things that most organizations are concerned about, because if you have an agent start to misbehave, are you prepared as an organization to be able to intercept that and make sure that your organization is safe from the exploits that the agent might be able to go out and create for you? And so it's a very, very important area of the business. It's something that actually prevents some organizations from leaning in all the way with AI. So we have to make sure that cybersecurity and the safety of AI is pretty important, and dealt with it with appropriate level of emphasis. And then the second one is the cost of tokens. It's these cost of tokens can accelerate. These agents can, they're running 24/7. And if you don't monitor and observe the consumption of tokens, and when you start to see an agent go rogue, be able to put some boundary conditions around the agent, you could actually start having some very big bills that you hadn't forecasted for. So those are the two areas that most organizations are thinking about right now as they make their deployments within AI much more kind of broadly deployed.
It's a really interesting view on token maxing and why we're seeing a shift to token rationalization. I'm just wondering, G2, if you think that the renewed focus on cybersecurity has taken some budget away from exploring ways to become more efficient, other deployments of artificial intelligence?
I think it's most organizations have always had the balance that they've played where, for example, right now there's more emphasis and more budgets being spent on AI, and there's also a lot of budget being spent on cybersecurity. Of course, at some point in time, there's a finite amount of dollars that are there in IT that come from somewhere, but I think organizations, what they're doing at this point in time at least, is making sure that they've learned the hard way from the previous kind of episodes like COVID, where if you don't have enough amount of forward investment in tech, then you could actually be put in a world of hurt as a company. So you have to make sure that you're forward investing in some of these areas. So I'm not seeing the reason that people are investing in cybersecurity taking away from certain other areas, such as AI. But I think over time, you have to make sure that AI is starting to go out and produce enough positive return so that you can continue to have the investments being made in infrastructure for sure.
G2, there's another debate about what's going on in terms of China. Do you think Kimi K3 is potentially using U.S. technology? And what do you make of what is going on right now in terms of the race?
Look, I think firstly, China is a formidable competitor to the U.S., but they've actually made a tremendous amount of progress. And this notion of is China using distillation? The answer is yes, but that's not the only thing. They've actually done a fair amount of things that are very, very creative to go out and create a frontier class model and make it available, to the general public as an open rates model. So we should, as the U.S., we need to make sure that we continue to invest not just in closed source frontier class models, which we've been the leader in, but we also need to make sure that open source becomes a larger and larger part of our strategy as you move forward. Like it is in our national interest, and it is in the interest of every individual that U.S. models get used all over the world, whether it be closed source or open source. And by the way, companies like NVIDIA have done a good job with the Nemotron models. I think Mira Murati's company, Thinking Machines, that we're an investor in, has done a good job recently of coming out with almost a trillion parameter model with 40 million active parameters. So I think you will continue to start to see more and more kind of emphasis being placed on open source, but it's something that we have to you have to keep a close eye on.
Don't we need some G2 Patel interior design? Don't you want an office like that?
Oh yeah, he definitely has this sort of zen.
I got a job for him.
Maybe it's
seriously.
Is it real or is it AI?
Come over sometime, Jonathan. It'll be good to have you over here. We'll do it from here.
You're gonna have to set up some agents for me or something. I need that help. I need that help. I'm going to be in touch. You know that. G2, it's good to see you, sir.
Are you still skeptical on AI? Have you now got to the point where you actually believe in the potential?
Skeptical is not where I'm at. I'm constructive. I'm worried about the messaging at the moment and the amount of money being spent. So I'm less concerned about where the technology is taking us and more concerned about where the technology is taking capital markets, if that makes sense. I hope that makes sense.
Yes, good.
Okay.
That's for time for another conversation.
We'll have a longer conversation on the phone. G2, thank you. G2 Patel there, the Cisco president on the latest.
Yeah.
Turning the tables there.
I know.
I love that. I've got time for that.
But, I'm a little concerned about, nuclear war and things of that nature.
That doesn't shock me.
But
so.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
The up and about 60 minutes away. Equities bouncing back by, let's call it a third on the S&P, feeling kind. Up a third of 1% on the S&P 500, up a quarter on the Nasdaq 100. We'll round that up too. Following the biggest one-day loss of the month so far on the S&P 500. Feeling super kind.
Mr. Friday.
We're almost there.
What's going on?
I still won't buy into the Friday stuff. That's nonsense.
You said it more times than you've ever had before.
I know.
This morning.
Sure.
It's great.
Shut
We're
it
keeping
down.
a tally together.
Shut it
Shut
down.
what down, John? What are you talking about?
Shut it down. You know when Ramsey goes into a kitchen, you ever see that program?
Yeah.
I love. It's my favourite show on TV right now. You know,
Sandwich.
I think there's a new season coming up soon.
You moved on
Is it
from
on
Farmer
Fox?
Dates, Farmer
Farmer
Finds
Wants
a
a
Wife?
No. Nothing can top Ramsey when he walks into a kitchen, and it's always the walk-in fridge. It's always the bloody walk-in fridge. It's like, let's look in the walk-in fridge. Goes in the walk-in fridge, and it is disgraceful. And he'll turn around and say, shut it down. Then he'll walk into the kitchen and, like, you know, everyone put the knives down. You go into the restaurant, you tell everyone, put the plates down, shut it down.
That's what you're doing with Friday?
Shut it down.
Wait, but shut what down, John? Just say it.
I'm not going there. Bonds right now, yields down a couple of basis points on twos, 433, 10s around 470. We can't shut this down, and that's quite a story in financial markets. Yields are holding on to these levels. That's new. In years gone by, when you start to get to the kind of levels people get nervous about, these sell-offs become self-limiting. People get nervous about risk assets, the backdrop for growth, money goes back into bonds. This is different. People aren't worried about the backdrop for growth. Even with these yields, there is no growth scare. Maybe there is on the margin in the last 24 hours, but not much of one.
One thing that we've gotten accustomed to is thinking of this economy as being less interest rate sensitive than it has been in the past. So even if rates do stay at these levels, people are saying we probably can continue to grow through it, especially given the pillars of AI investment. Also, it's really nice to get this yield, and it looks like a great opportunity when you can't get it anywhere else. When you can get it everywhere else, when it comes to hyperscaler debt or other governments, then people are a little bit more choosy.
6-month-old chicken thighs, things like that. Really moldy.
That's disgusting.
You know,
I thought it meant it wasn't organized because I've seen your fridge before, and it's like almost color coordinated.
That is not equivalent to Friday. I find that offensive.
Shut it down.
Yeah, with 6-month-old chicken thighs.
Such a good show.
And Friday, that's horrible.
Such a good show. Brent crude around 98, we're down 3% this morning. WTI around 3% lower as well, around 90. Talking about holding these levels, we struggled to hold the highs in the first period of the shock, the first phase of things. Inventory's a big piece of that, China too. Can we hold the highs this time around?
I mean, we're at $97 on Brent, and the president's saying, I'm considering a massive attack. They haven't received enough pain yet, talking about the Iranians. And what we continuously are seeing in the global oil market is the fact that we already know the Strait of Hormuz grinding to the halt with ships trying to get through. Bab el-Mandeb Strait becoming incredibly harder with the Red Sea. At the same time, we are on the lows when it comes to inventories, and everyone's focused on product. Lisa nailed it, talking about diesel. This is where really the angst is. Diesel, jet fuel, gasoline, etc.
We should send Ramsey to the Fed next week.
2 slices of bread on the ears.
That's a good show too. What's that, an idiot sandwich or something like that?
What is this? An idiot sandwich.
Brutal stuff.
That's what you watch in your free time.
Brutal. You watch Ramsey when he first went on TV. There was a great program. He was first launching his restaurant, trying to achieve a Michelin star, something like that. or a second or a third, I can't remember now. But the attitude starts to come through, and he got that from a guy called Marco Pierre White. Marco Pierre White was a total legend, and Ramsey came through that world, and Marco was a pretty aggressive chef back in the day. We miss those kind of characters, don't we? Yeah, the kind of characters, the charisma that those guys had back in the day, the chefs of the 80s, like, you know?
I enjoy watching them on TV, not having, you know, too
No, I don't want to work with those kind of people, you know.
You know, totally, but they're good. They're good. They're dramatic.
Those characters in the world. Okay, let's talk about the Fed. The Fed facing growing inflation risks ahead of its rate decision next week, soaring energy prices, sweeping new tariffs on U.S. trading partners, fueling debates over hiking rates, maybe as soon as next week. Mike McKee has more. Good morning, Mike.
Good morning, John. It is kind of remarkable. A month ago, we had a very benign CPI report, and everybody was talking about the Fed on hold forever. And now, all of a sudden, this growing chance that Wall Street sees a rate increase from the Fed next week. What's going on? Well, you can find the votes for it if you're looking, because there are enough members of the Open Market Committee who have either said raise rates or will raise rates if inflation doesn't come down. And the case for inflation not coming down is growing at this point. In the minutes from their June 17th meeting, Fed officials said a rate increase might be appropriate if AI demand raises prices because there's not enough supply for AI materials, if the war raises oil or other commodity prices, or if tariffs raise prices. Well, check, check, and check. You got all those things telling you that inflation is going to rise again. What we don't know is what the other half of the voting members of the Fed are thinking at this point. John Williams says we're well positioned for the future right now, but there's still 4 members who haven't really spoken out about this. One would assume Mickey Bowman is not anxious to raise rates, but the other 3 could vote that way, which leaves us the wild cards. Kevin Warsh, we don't know what he's thinking. He doesn't like inflation, but does he think it's an immediate danger and something that needs to be done? People say also it might build his credibility to raise rates next week. And of course, Donald Trump, he controls the war at this point, and he basically has control over oil prices. Investors, though, see 2 rate increases by January, 1 in September, 1 in January, which is completely different than the Bloomberg Economist survey, which is out this morning. They see no hikes, and they see a cut in the second quarter of June 2027, actually the July meeting of 2027. So what's going to happen? Nobody really knows. I haven't got a good idea about what should happen, other than you got me thinking, John, if you sent Gordon Ramsay into the Situation Room where they're all talking about the Iran war and he says, shut it down.
Mike McKee would have a different backdrop for crude, without a doubt. If they listened to Ramsey and he had any authority down in Washington, D.C., Mike, appreciate it, buddy. Thank you. Into next week, we don't know. That's new for Mike. It's new for us. It's different.
Gordon Ramsay would be a family fight that we'd all watch.
Without a doubt. That's a different kind of family fight.
That'd be a different kind of family fight.
I'm not sure that's the language that will be used next week at the Fed, given the kind of characters on the Federal Reserve. But, you know, maybe I'm wrong.
Maybe they'll just...
Can you imagine Beth Hammock dropping F-bombs in that meeting next week? I can't.
Who knows? I mean, maybe that's what happens behind the scenes, you know?
I'm not sure that's how the Cleveland Fed president runs business. But
it's being thrown.
Maybe we'll see. There might be sources afterwards that you know, reveal what happened in that room.
You can call in.
Neil Dutta of Renmac, not seeing a reason to wait to hike rates. He writes the following: if you have 1 good month of inflation data, but you know the next 2 months will be bad, you might as well just do it now. Neil joins us now for more. Neil, provocative piece this week. Appreciate your time and thanks for coming on. Walk us through the setup for next week and why you think tactically this might be the right window to hike rates.
Well, I think following with what Mike said, the sort of checking of the boxes, I mean, I almost feel like, guys, it's sort of hiding there in plain sight in the minutes, right? So you kind of have the AI demand piece. You know, we see that hyperscaler CapEx continues to moonshot. You have the oil piece, and while it's encouraging that oil is down today, I mean, it does feel like the conflict is ongoing, and so I think it's possible that that's fleeting. But we do know that no matter what, gas prices probably go up into August. You know, lastly, tariffs. The president is doing what the president does with tariffs. So it's kind of, you just go down the list. Now, if you're Kevin Warsh, I think it's important to go hike when you can and maintain some modicum of control over the committee than to hike when you must. I mean, can you imagine a situation where if he wanted to, he could probably get the committee to get on board for a hold in July. By September, he may not be so fortunate. So if you're him, do you really want to have to deal with that? That would make him look, I think, like a much weaker Fed chair. So I think tactically, just give it to the hawks now. And if the data kind of improve, the war ends, oil falls, you kind of see a renewed disinflation from the housing market maybe, then you can go tell them to pound sand. But, I think you kind of have to fight one thing at a time. And I think the risk reward is, go now as opposed to having to go a lot more later.
Neil, we've known each other a long time. You know how much I enjoy your research. And one thing I think that you're fantastic at, even though you have very strong feelings about a moment, is separating what you think a Fed should do from what you think the Fed will do. I'd love to ask, though, how wide is the spread right now between what you think they will do and what you think they should do? How much daylight is there between the two?
I think the Fed should, to me, I'm more on the dovish side of the consensus, and I think that's because I see a relatively uneven economy that's being sort of held up by one area. People talk about the broadening out in the capital markets, right, John? But do you really see a broadening out in the economy? You don't, actually. If you look at non-AI related structures investment, it continues to remain weak. If you look at residential investment, it's still sluggish. The high frequency data that we have, your own Bloomberg second measure for consumer spending, that's actually quite weak to kick off Q3. So you don't really see that broadening out in economic activity. You see a very uneven economy. And so I think the risk, of course, with aiming policy at one specific area could be problematic because monetary policy is a blunt tool. So if all you're really trying to do, and by their own admission, they'd be raising rates to cool off AI demand, that can exacerbate the stresses in other areas of the economy, like credit sensitive spending, housing as an example. So that to me is why I'm somewhat cautious on them hiking. So it would put me more in a defensive mood if I'm an investor. But as you mentioned, my use case as a analyst is really what's the Fed? What do I think the Fed's reaction function is? And I think they're all kind of tiptoeing towards a hike. There's not really anyone in there that's making the case that I just made. And when you think about just tallying up the votes, that to me is important, but it's also important to kind of think about it in terms of conviction. Right? Like folks like Beth Hammack and Lori Logan, they have a very high level of conviction. Folks like Philip Jefferson, Lisa Cook, maybe less so. But they I think are like sort of they're price takers, not so much Logan and Hammack are price makers. And so if they can kind of corral the, sort of pull along the rest of the committee, I think it's possible for them to do so. And that's kind of why I said, strategically, if you see this kind of debate unfolding in the committee, if you're Kevin Warsh, you can kind of see the tea leaves. Even someone like Williams, who Mike McKee said was sort of, signaling a hold, he's not signaling a hold for long, right? He's basically going to get on board for September. A bet on no cuts for this year at this point is really a bet that you get continued weakness in inflation like you saw in June. Possible. I wouldn't bet my life on it. And there's a lot of reasons to expect that some of the improvement we saw last month unwinds.
Neil, I am wondering, a lot of people are saying, what will actually a rate hike accomplish? And you're talking about that, given the fact that there still is a very bifurcated economy. That said, some people like Megan Swiber of Bank of America just earlier this hour was talking about how it could cap the long end of the yield curve. It could potentially dampen longer-term inflation expectations enough to create a bit more of a ceiling on some of those longer-term yields. Do you agree?
That's part of what, this is sort of the same argument that was made after Kevin Warsh sort of pledged allegiance to the flag of price stability back in June. It's just another version of that argument. Yeah, it would also mean that the Fed is trying to cool off growth, and that's why the long end would be coming down also. Inflation expectations, in my mind, look stable as it is. But that's, again, part of that is a function of reals continuing to go up because they're committed to price stability.
I guess I'd flip this on its head and say if the Fed does not hike rates next week, does that make you more bullish on going into an equity market that's re-rated on the margins over the past couple of weeks?
I think based on where clients are right now, where the markets are, I could see a scenario where if the Fed doesn't hike and people read that to mean that they're not hiking for the rest of the year, you could see the back end sort of keep pushing higher. Yeah, I mean, I think that there's something to that.
Neil, I know that we always talk about what's interesting on Fed decision days, how the market reacts to things. How do you think the president would react if we get a hike?
I think, again, that goes to Henry, the reason why War should do it. He's got I mean, it's like, it would be like leaving your honeymoon early, right?
So not good.
Yeah, so I don't think if you're, I mean, what I've found very interesting is how deferential the president has been, right? I mean, I could see a scenario where Warsh hikes, and because Trump has a much bigger fish to fry at the moment, he kind of gives them a pass. By September, October, when you're much closer to the midterms, maybe he won't feel as forgiving. So again, that's another reason for him to get it out of the way now.
Not advisable. Yeah, is that something you considered at the time? Is there something you want to share? I'm not sure where that came from. Leaving the honeymoon early?
That'd be terrible.
Oh, no, it's a metaphor. It's a metaphor.
Where you are.
Good to know. Yeah. Thanks, Neil. Appreciate it. Neil Dutter of Renmac on the latest. Left the hotel early on the honeymoon.
You did?
I did, yeah.
With or without the missus?
Of course, she's still with me, Bram. I'm not sure that would be the case if that had happened.
You're like, I'm out.
Rejected the hotel, yeah.
Really?
Yeah.
Where'd you go? Camp out on the beach?
To a different hotel.
Romantic evening?
To a different hotel.
Yeah.
I know where you went. You went from Capri to Ischia.
Let's not talk about where we went or what we did, but we did ditch the hotel. All right, let's give you an update on news elsewhere this morning. Might be close to the truth with your Bloomberg brief, or maybe not. Let's get Vonnie Quinn for more. Hey, Vonnie.
Hey, John, thank you. Meta is facing higher borrowing costs for its latest data center in Texas. The Financial Times reporting investors are demanding a roughly 40 basis point premium over Meta's previous Hyperion data center. U.S. regulators are developing new requirements to make sure people can safely exit their vehicles. The move coming after at least 15 deaths were related to passengers who couldn't open the door of a Tesla that had crashed or caught fire. The Los Angeles Dodgers are visiting the White House to celebrate back-to-back World Series wins. Many of the team's fans are angry over President Donald Trump's immigration raids in their home city. Stars Mookie Betts and Enrique Hernandez notably skipped the Rose Garden ceremony. And that is your Bloomberg brief, John.
Bonnie, thank you. There was construction on the roof.
Okay, here we go.
I just got to clear it up for people. There was construction on the roof.
I thought it was the towels.
It was a joint decision.
Oh, well, that's good.
Of course.
Okay, good.
Mrs. Farrow leads everything. I'm not sure I even led that decision. I just followed.
Oh, you're going to throw her under the bus this morning.
Just letting you know who's in charge at home, all right? It's not me. Up next on the programme, we'll set you up for the day and the week ahead. Plus, we'll catch up with Cara Murphy of Kestra Investment Management, live from New York City. You're watching Bloomberg TV.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. You know, it's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication
and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the most important news and financial information whenever and wherever it happens. I'm Michael McKee on the Mexican border, and this is Bloomberg.
There's this very highly concentrated group of systemically important publicly traded names. We're at the part of the programming where there's a quality curve being established even amongst those systemically important names. It's a reallocation of capital into other parts of the equity market. It's not a withdrawal of capital. There's a little bit of fatigue, a little bit of digestion.
That was Michael Ventura of RBC on financial markets, the equity market, the indigestion we've seen, some of the jitters, the fragile moves we've seen in both bonds and energy and then equities for a brief moment in the last 24 hours. Equity futures okay this morning, bouncing back just by 1/10%. Check out next week, though. Next week's a monster of a week. It's a big 24, 48 hours, and it starts on Wednesday. So take a long weekend. Fed rate decision on Wednesday. You're going to take a long weekend?
Maybe now.
If you want. Then later on in the day, you'll hear from Microsoft and Meta. Then on to Thursday, you'll hear from Apple and Amazon. That is trillions upon trillions of market cap. And Lisa, you asked a really interesting question earlier on. What's more important to the bond market, the Fed, or the earnings from the big tech players that are issuing a lot of debt?
On one hand, you've got the Fed that has to give some sort of prognostication about inflation and where their policy fits in. And then you have the expectation for more than $1 trillion of capex from those companies, brought up from a $750 billion expected earlier this year. That is supply that is going to dilute a market that already is showing a bit of queasiness.
1 week to go for those big tech earnings and a big Fed meeting. July is live, apparently, maybe on the margin. Here's the take from Cara Murphy of Castro Investment Management. She writes the following: AI retains the upper hand, but not as strongly as it did just a few weeks ago. What's less watched are mid and small cap names. Cara joins us now for more. Cara, good morning. Good to see you.
Good morning.
No big bounce in tech this morning. What was your reaction to the sell-off in the last 24 hours?
I think these are hints that the market is giving us that they're not going to give a free pass to these names forever. You know, we can all agree that AI is going to be a revolution. It's going to change so many things in the world, but that doesn't mean that these companies can continue to spend with impunity, you know, damaging free cash flow without the true earnings piece. Now, that doesn't mean that it's all over for them, but it does mean that the market is going to be discerning, and we have to be mindful of that.
Do you think it raises the bar just a little bit more for a few of those names that I mentioned next week?
For sure. I mean, I think the CEOs at these companies should be more cautious. They need to listen to what the market is telling them. The market is saying, you can't just keep spending money like this.
Well, is it part of the issue, not just the money spent, but also the lack of visibility as to when there isn't going to be an acceleration in terms of the increases that we're seeing every quarter?
For sure. Like last year, it was a little bit different, right? We were a bit earlier in the cycle. The numbers weren't quite as big. This year, we move forward. We know a little bit more about how people are using AI. We also know it's going to be a little bit before we start seeing returns on it. So the market is saying maybe we need to slow this pace a little bit.
Right now, what do you find as an attractive sort of hedge to what we're seeing, which is just the everything risk being thrown at markets depending on the day?
Well, I think the answer to that is actually a lot simpler than many people think. You know, you mentioned the quote about small and mid-cap earnings. The market has been so concentrated in a handful of mega cap names. That means that a wide swath of the market has been largely overlooked by investors. Mid and small cap, I think, are just obvious areas. Now, we haven't seen up until recently the resurgence in earnings. So that's really going to be key in the second half of the year. Can these smaller companies actually deliver the goods and grow earnings? We think that they can, and I think that gives the market an ability to pivot to somewhere else.
RBC's Michael Ventura was on earlier, and he said the market just has new cares. They've always been there. They're just caring differently about different things. Do you feel that now, what's going on with the conflict in Iran and potentially higher bond yields?
Yes, I think there is something to that. I was thinking about this morning. If we had the earnings that we had this week, but 3 quarters ago, I think the market reaction would have been very different. Now, Iran, it's a little hard to get around triple-digit oil, right? So that is very real. That is going to really start to hit consumers' pocketbooks, company P&Ls, and so those are very real concerns. I don't know. It's going to be hard for the market to look through that unless we actually have a peace deal and oil prices recede. But I think on the AI side, for sure.
We're learning something about price and positioning every time we get these earnings.
Absolutely.
Intel's a good example of that, speaking to exactly what you just described. Intel out with blowout numbers, and if this was 3-6 months ago, we wouldn't see a move of 4% in the pre-market. You'd see something like a multiple of that, Bramo.
Yeah, but 6 months ago, it was also lower by
100%
about half.
lower.
So, I mean, this is, we're talking about a very different
lower.
valuation. Yeah. I just wonder how much you can get that broadening out if you do have yields continuing to get higher. I mean, do you still see opportunities? I mean, that's ultimately one question that people keep asking.
We've had a 170% rally.
Exactly.
Year to date, which is
that's just
monster.
yes.
Keep tracking that name, though. It's now only up by 2%.
What's your call? By the end of the day?
I don't make calls on markets, Bramo, you know that. But I take some signal that if you have a blowout earnings report and you're only up 2%, tells you something about price and positioning.
Yeah, it's the idea that the bar is so high that we can't even see it. And ultimately, even if you blow things out, people still are going to say, nah, I don't know how much upside there's.
$1 trillion question, Cara. What does that mean for where you want to be long? Where can you get more bang for your buck right now?
And this is where we're actually bullish on the market overall. I'm cautious on kind of like the future of the mega cap tech names in the near term, but I think there's so much opportunity elsewhere in the market. Overall, the U.S. economy is in really good shape. We're talking a lot about the Fed, and maybe they hike a little bit, but we don't have a massive inflation scare yet. Labor market's fairly strong. Consumers are still spending. So I think we still have a really good economic backdrop, and going long U.S. equities just outside of the mega cap tech, I think, is a great place to be.
We are still 2 to 3% away from all-time highs on the S&P 500. Cara, thanks for wrapping up the week with us. We appreciate it.
Thank you.
We're looking ahead to a big week next week. That was Cara Murphy of Kestra Investment Management. What a week we've got coming up next week.
To me, the idea that we get both the Fed discussion and tech earnings is going to be a massive kind of determinator for this market. This week, we saw clearly the reaction in markets. We're setting the signal. Any bar that we set is not high enough for you to clear because we have already priced in so much. Next week, if you have that move continue, what does that mean for the rest of this year? And ultimately, Max Kettner, come on and let us know. Have you turned full bull, full bear?
Before next week, though, also, how do we get through this weekend with the president saying that he's all set? He just has to decide if he wants to make this massive move, like he's considering a massive attack.
Some nervousness going into the weekend. We've had the energy shock. We've had the bond market jitters. We have not seen a growth scare yet. Coming up on Monday, we'll catch up with Seema Shah of Principal Asset Management, Frank Lee of HSBC, Elisa Shallard of Morgan Stanley, and a whole lot more. From New York City this morning, good morning. Have a wonderful weekend. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency. Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Happy Friday. It's 30 minutes until the start of your cash equity trade. I'm Danny Berger.
And I'm Isabel Lee. Bloomberg Open Interest starts right now. And President Trump rebuilt his tariff wall while threatening a massive attack on Iran.
All of that keeping investors on edge ahead of a Fed meeting next week.
Happy Friday indeed, Danny. And the whole week we looked at 3 stocks, but today we're just looking at, as you said, the bright spot, Intel. Intel delivered a revenue forecast that shattered Wall Street estimates as data center spending fueled a long-awaited turnaround. You see the stock here higher by 2.5%.
Meanwhile, some other stocks I'm looking at this morning, specifically American Express, also had earnings, Isabel. They beat expectations. Affluent customers, they keep spending, promoting the company to raise its full-year revenue growth forecast. But I do want to mention shares are down 4 and about 1/3 of 1%. It's something consistent we've seen throughout earnings. Even with 85% of stocks thus far beating earnings expectations, the majority of them have fallen after they've reported.
And as we just mentioned, Intel really is gaining momentum. The company CEO Lip Bhutan telling Bloomberg, quote, demand is outpacing our increasing supply, and so those are good problems to have. Joining us now is Bloomberg tech reporter Ryan Vlastelica. Ryan, Intel did beat on the upside. Is this going to be the turnaround for the company right now, especially under the leadership of their new executive officer?
Well, this is certainly the latest indication that the turnaround really is progressing well. The stock has done extremely well over the past year, and there are a lot of signs that they're seeing incredible demand related to AI, that its foundry business is getting momentum. So I think a lot of the things that people were wanting to see in order to really have confidence that this turnaround, which was years in the making and involved a lot of money destruction prior to the turnaround, that it's really playing out. I think people are really seeing everything they wanted to be seeing.
They also increased capital expenditures, nothing like we've seen from the likes of the hyperscalers, but still they need to spend more. What can be done, Ryan? The bottleneck from them, they've said it is not demand, it is their ability to continue to build. What can they do to try to get through some of these bottlenecks?
Well, that's sort of the tricky thing is building these fabs really takes a lot of money and a lot of time. So even though they are allocating a lot to this, it's likely to be a while before we start to get more supply come onto market. Now, in the meantime, that's going to be good for them in terms of their pricing power and so forth. But this has really become a major issue in the markets overall because we've seen prices for some of these AI components really rising right now. It's just because there's not enough supply on the market.
And you had a great piece, Ryan, that Thursday saw the Magnificent Seven suffer their worst one-day decline since Liberation Day, wiping out nearly $800 billion. And Wall Street for years have been applauding when it comes to big AI spend. But then now it seems like the sentiment is turning around. Where do we go from here?
Yeah, so this is really the flip side of the Intel story, which is that these companies are spending so much, and a large part of that is because prices have risen so much for things like memory chips and so forth. There has been a real shift in sentiment. I think there is some growing appreciation that these companies are seeing a return on this AI spending. Alphabet's cloud growth, for example, was more than 80%. That's extremely strong, much stronger than expected. But at the same time, they're spending so much that their cash flow turned negative. That was the first time in their history as a public company that that happened. That forces people to reconsider how they are viewing these companies. They were real cash cows just for years and years, and that was one of the most attractive things about them. If that part of the story has really changed, even if you have faith in the long-term ROI of all of this AI spending, I think a lot of people say they need to have a lower multiple if they're not cash flow positive. They need to have a lower multiple as we kind of consider what is the timeline for this AI spending paying off, what is the magnitude of the payoff. So until we get a little bit more clarity on that, a lot of people I talk to, even though they still like the strategy, say that there could be some more pain and volatility ahead.
And also, in the meantime, worst day for Mag 7 yesterday since Liberation Day. Ryan, thank you so much for joining us. Bloomberg's Ryan Vlastelica. Elsewhere in earnings, American Express raising its full-year revenue forecast, but shares are falling after second quarter revenue and net card fees came just shy of expectations, and at the same time, huge surging expenses over marketing. Bloomberg Intelligence analyst Ben Elliott joins us with details. Ben, how much of the sell-off we're seeing in stock in the shares right now, 4.4%, is a true disappointment or just reflects an American Express where the expectations were very high?
Yes, I think this is mostly a story about expectations here. The bar was pretty high going into the quarter. Amex trades, 70% premium to many of its peers. I think that people were looking for an acceleration and they got a deceleration, especially in those card fees, and that's kind of the secret sauce of the revenue model. So to see that start to slow down, investors start to ask kind of some questions about the sustainability of the revenue going forward.
Ben, with expenses rising faster than revenue, how should investors think about trade-offs between near-term cost and long-term growth investments?
Well, so I think expenses came in a little bit below revenue, so there's still a little bit of mild positive operating leverage there. But sort of the story behind Amex, right, is they have to spend to create the value proposition that attracts Gen Z and millennial customers to these cards. So investors expect and want to see them spending more. I think there's some sort of some oddities in the numbers there as they kind of lap the refresh in the Platinum card, which was launched September 18th. So you could see some of that kind of smooth out. But by and large, it's the fee and the interest income that really sort of generates the revenue above what they spend to sort of attract customers to those cards. And so I think that's why people are a little bit more concerned about the slowing in the fee revenue rather than like a temporary increase in the expenses.
Ben, appreciate your time this morning. That's Bloomberg Intelligence analyst Ben Elliott. Isabel?
Now to Washington, President Trump is rebuilding his tariff wall, imposing duties of 10% to 12.5% on imports from dozens of trading partners. Let's get the latest from Bloomberg Washington correspondent Tyler Kendall. So, Tyler, supporters argue that this is about rebuilding American manufacturing, but can you talk to us about evidence, whether they actually have that?
Right, Isabel, that's a really good point at this point in time, as we know that it takes companies time to onshore their production, and in certain instances when it comes to some of those sector-specific tariffs, like what we saw rolled out earlier this week in terms of generic pharmaceuticals, these companies are weighing the pros and cons and how much cost it's going to take in order to onshore their manufacturing. This latest wave of tariffs that we're seeing stem from what's known as a Section 301 investigation into whether trading partners have failed to take effective action to block goods when it comes to forced labor. And that's why you actually see sort of the tier here. That 10% rate is going to go towards those countries that have banned forced labor but are not effectively enforcing it, while that higher rate will be for those that have absolutely no laws on the books. At the same time, though, we are expecting exemptions to come down. We've already gotten a few of them from the USTR, including oil and gas, fertilizer, food products, those items that are very highly exposed to supply disruptions. And in fact, a senior administration official tells me that we should expect more exemptions to come down the pipeline, that the administration has already gotten, at this point, hundreds of requests amid this new flurry of action that they are taking. And Danny and Isabel, at this point, we should be expecting more. I mentioned those generic pharmaceuticals earlier this week. We also got those tariffs against Canada earlier this week, too. But keep in mind, there's another Section 301 investigation pending out there that has to do with excess capacity, and that, too, could lobby on additional stackable tariffs for many of these trading partners.
Just with these tariffs around forced labor, Tyler, you described it. It's not necessarily that they're using forced labor. It's whether they have rules on their books in order to prevent goods that use forced labor from coming in. But even in the case of Canada, for example, they do have a rule on their book, but this White House decided that they didn't have data showing anything, which to them suggested that they aren't enforcing their own rule. Canada, India, various countries have pushed back. Tyler, are we likely to see pushback also result in more lawsuits around these tariffs?
That is also a really good point. Though Section 301 is considered to be that more legally durable action that the administration does have when it comes to their tool and their toolkit. We had Section 301 tariffs from the first Trump administration that are still on the books. So they're a little bit more difficult to challenge, but we do expect there to be challenges or at least negotiations going further from here. You mentioned India. We saw the USTR outline that India at first was supposed to get that higher 12.5% tariff rate, and then that was dropped down to the 10% rate. But in the case of Canada, for example, we know that Canada wants to come back to the table with active negotiations, and perhaps this could be used as one of those pressure points, as we saw the USTR in Mexico this week negotiating with the other trading partner in the USMCA. So there are just so many different parts of the puzzle that we have to keep in mind here, as the Trump administration has made it absolutely clear they want to double down on this economic policy, rebuild that tariff trading wall, even as we head into the midterm elections amid voter concerns about the inflationary impacts.
Tyler, appreciate it. As always, thank you. Bloomberg's Tyler Kendall in Washington, D.C. Only 2 bells to go until you can start your weekend. 20 minutes away from your trading day. The S&P is pushing slightly higher after yesterday's sell-off that took tech down with it. I mentioned this, worst day for Mag 7 since Liberation Day. NASDAQ still underperforming. Yields come in after your 10-year yield breached 4.7% across the curve, trading at something like 18-month highs. Part of that was due to crude. Crude trades lower this morning, down nearly 3%. Some of the individual movers that we are looking at this morning. Earnings-wise, Verizon raising its guidance as wireless carriers win over customers with perks, also announcing a partnership with Google and data centers.
And Oracle climbing after winning a 10-year U.S. defense contract worth nearly $7 billion. The stock there popping nearly 2% in pre-market.
And Deckers, the shoemaker, reporting full-year guidance coming in below estimates, down 1.8%. Do they make Vans? I'm pretty sure Deckers makes Vans. That might be wrong.
I think that, you know, when I first...
No, they don't make Vans, I'm being told.
I thought that they made outdoor stuff.
Well, they are called Deckers out. You wear shoes outdoors, so you're not completely right. Oh, yeah, Hoka.
No, it's Hoka.
Producer Will says it's Hoka, so running things. Usually that had been doing well, but clearly that's turned around. Coming up on the show, SpaceX is no longer taking future reservations for its Falcon 9 program as the company looks ahead to Starship. We're going to have the details for you next. This is Bloomberg Open Interest.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Anything we do in Africa is going to be more risky than the U.S. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe. I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie. This is your opening trade.
Only on Bloomberg.
Now to high interest, a look at what's making headlines around the world. 6 contenders are vying to be the next United Nations Secretary General. They argued their case at a town hall event moderated by Bloomberg TV in the UN's General Assembly chamber.
Our responsibility is to make the UN relevant again, to deliver, to touch the hearts and souls of people on the ground.
Well, I believe moral authority is always needed. And you always need to speak out on the issues where violations of human rights have been.
What we need to do is to restore this credibility of the UN as a valid interlocutor, and then use the tools at hand.
I would like to see a UN that is back at the table in the scenarios of conflict. I would like to see a UN that has rebuilt trust.
The UN must be more present, especially in the peace and security arena, that we would have moved from where we are today to a UN that is delivering better in peace and security.
Because in reality, global security, peace and stability is something that is incumbent on the Security Council.
The candidates are competing to succeed current UN Secretary General Antonio Guterres, whose term ends this year. And Samsung and SK Hynix are set to unveil major agreements with U.S. tech companies during the South Korean president's visit to Silicon Valley, kicking off today. A senior presidential official saying these announcements involve, quote, very large sums and will likely include new long-term memory chip supply deals. And SpaceX has started turning away satellite operators looking for dedicated rides to orbit aboard its staple Falcon 9 rocket beyond 2028. Sources telling Bloomberg the company has stopped building some non-reusable components for the Falcon family. The move underscores CEO Elon Musk's massive bet on its Starship. Danny?
Bloomberg Sana Pashankar helped break that news, and she joins us now. Sana, first of all, fantastic reporting. Thank you for bringing us this story. And it seems like this bet is essentially one to say, we are betting on Starship away from Falcon. Why is SpaceX making this bet?
Yeah, totally. So Starship is key to basically all of Elon Musk's ambitions for SpaceX. That's sending data centers into space, that's expanding the Starlink communications network, and it's also sending humans to the moon and Mars. So essentially what this signals is kind of a movement of the priority from Falcon 9 and, the launch business that helped it make its name to focusing completely on Starship, building that rocket out and making it operational.
So this obviously underscores the huge bet and the huge belief that Elon Musk has when it comes to SpaceX being able to really propel this to success. Do you think this is risky?
Yeah, so with Musk, you really never know. While today he is saying, we're not going to take any more Falcon 9 reservations past 2028, he could wake up tomorrow and say, Starship isn't ready. We're going to keep extending how many Falcon rides we're doing. But right now, this is the course they're taking. They still have a little bit of wiggle room. It sounds like they are fully booked out until 2028. So things could always change. But, I think it is definitely signaling their priorities for Starship. And that is like the route that they want to take for the future.
Sana, could you go through in more detail the struggles that Starship has had? I know you and the team have been covering these test launches that they've continued to scrap. I believe yesterday they scrapped one for the second week in a row.
Yes, totally. So Starship has had, a really rocky development testing cycle. It is advertised as the most powerful rocket ever built. It is very massive. It is supposed to be fully reusable. So that means the booster, the part that boosts the rocket to space, and the top part are supposed to come back to the Earth intact so that the rocket can fly again, which has never done before. Like, they don't even do that with their current Falcon 9 rocket. But they have had, as I mentioned, a rocky development cycle. They've had some explosions. They've had some setbacks. Just this week, they had postponed the launch because some of the engines didn't ignite. And then yesterday, they again postponed the launch to today because of bad weather, which that is pretty common in rocketry. But, today all eyes are on Starship. It is the first test flight since their IPO. So investors will be watching, I'm sure.
But Sana, talk to us if Starship is not ready to launch missions by the end of 2028. What will happen if the company doesn't revert to the Falcon family?
Yeah, so if Starship isn't ready and the company is deciding to turn off access to orbit with their Falcon family, that could be really catastrophic for so many US-based companies that rely on SpaceX to get to orbit. SpaceX basically commands a near monopoly on launch. It's enabled the growth of all these large-scale satellite networks because it launches more frequently than any other rocket in the world. So, these Amazon's networks, telecoms networks, satellite imagery networks, many of them rely on SpaceX to get to orbit.
Sana, fantastic reporting. I believe that was one of the most read stories on the Bloomberg terminal at READ Go. I think it's top 10, which is very impressive. Bloomberg Sana Prashankar, thank you for that. Coming up, Empower's Martha Norton shares where she sees value in the AI trade. This is Bloomberg Open Interest.
Weekday, Bloomberg puts a spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia. We'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream.
Mag 7 stocks have wiped out nearly $1 trillion in value just this week alone, and that could signal a buying opportunity. Empower Chief Investment Strategist Marta Norton argues that within the AI trade, software and hyperscalers look like the value trade. Let's bring in Martin, who joins us now. Great to have you in New York, Marta. Thanks for stopping by.
Yes, of course.
The idea that Mag 7 would be a value trade, if we said that a couple years ago, we'd probably been like, there's no way.
Yeah.
So is this a dip buying opportunity, what we've seen?
I mean, I think it is a dip buying opportunity, but I don't think it's instant gratification. I think this is a long-term play. I mean, it's remarkable that when you see Alphabet report and you see the kind of cloud revenue that we saw, that there still is a massive sell-off. So the monetization is there, but it's not nearly enough to account for this wild spending, and the markets are all about the wild spending now, and that doesn't look like it's stopping anytime soon. So in my mind, if you're looking for a piece of the AI trade, this is a great place to go, but you have to be patient.
So I think that's a phrase we've heard throughout the show with Danny and me. Everyone's telling us patience is key, but then the timeline is still different. And you see a market where they reward investors, but they also punish when it comes to all of this AI trade, like the dichotomy between Tesla, IBM, or even other companies. So then what is your timeline? Until when would you be when would we be waiting?
Yeah, so I think what we have to see is we have to see more monetization relative to the CapEx. And I don't think that's happening 2026. That may not even happen 2027. This could be kind of a 2028, 2029 time period. And for those who are much more concerned about the here and now and capitalizing on gains now, I think that's why they're looking to those who are benefiting from all the spending, the chip players, and really a lot of companies throughout the market cap, even in small cap, industrial areas.
It's interesting because a lot of the capital expenditures are no longer just being funded by free cash flow. We saw that with Alphabet turning negative for the first time since 2016. The market has started to push back against some of the funding. I think Google's 100-year sterling denominated debt is, I mean, that would have its own problems to begin with, to be fair, but it's something like 90% to par. Most of the hyperscaler debt is trading below par. Do you think that these companies might run into any issues just raising the amount of money that they are committed to spending?
I think it all depends on what kind of money are we asking for here. And I think that is one of the biggest concerns in the market. I mean, certainly there is a range, when you think about the range of outcomes, there's an outcome out there where this is wasted money and good money after bad. And I think we have to account for that. And that's why I think you want that discount, that margin of safety if you're going to move into these names. You know, last fall, that was not the time to be buying these names. There was so much enthusiasm around them. So it's really that combination of the possible optimistic outcomes and where the prices are today that makes them a buying opportunity.
Okay, Marta, you're going to stick around with us through the opening bell. That's Marta Norton. And a check on your markets ahead of that opening bell. 5 minutes to go until we get there. And it is an unchanged market, but maybe that's better compared to what we saw yesterday with a broad sell-off. Worst day for Mag 7 since Liberation Day. The dip buying opportunity. Calm also in this bond market. At one point, the front end of the curve was up 6 basis points yesterday. All of them trading near 18-month highs. We're at 468.52 for your 10-year yield, while Brent crude also takes a breather, down 2.5% after reaching over $100 a barrel. On the other side of this break, we'll have your opening bell.
anytime you have an industry that grows like that, there will be pockets where things are more difficult. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market, you can get that from a bank, you can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Let's get you started in this trading day. One bell now to go until you have your weekend. I'm Danny Berger. It's a market that is tepid after yesterday's sell-off fueled by inflation woes over higher oil and yields and some of the earnings we got from Alphabet with CapEx spooking investors. Today, it's the S&P little change and the NASDAQ starts to fall yet again. Ringing about the New York Stock Exchange, we have Oliver Scholars that helps give education to underserved communities here in New York City, a great and worthy cause. Meanwhile, down at the NASDAQ, we have a new listing. It's Scribe Therapeutics. It's a biotech company backed by Eli Lilly. So you got some of the... And so, like, up here, they have the scientists from the labs, like, beaming in. And I'm just like, is that sanitary? Like, aren't these, like, very sanitized labs? Are you allowed to have cameras and that kind of equipment in it? Probably, but...
Maybe they chose a corner where they will... I never noticed that. Do they always have that?
Sometimes when it's a big company and you can tell here they really want to one-up it. And I love it when they bring their kids. Everyone should bring their kids to... Yeah. It's a once-in-a-lifetime event.
I would have loved to have been there, but maybe we'll have
just needed a parent that started a public company.
That's not too hard.
No.
Let's get you to some stocks to watch now. We're looking at Intel, which just flipped to red right in front of my eyes. In pre-market trade, it was edging higher, but now it's in the red, down by 0.8%, wavering after it delivered a revenue forecast that shattered Wall Street estimates. And this comes as data center spending really fuels that long-awaited turnaround, Danny.
I'm looking at American Express this morning that continues to see its shares fall. It raised its full-year revenue outlook as affluent customers kept spending, but shares are lower. Second quarter revenue, card fees, and expenses disappointed. All of the marketing that they had to do in order to attract customers with their higher fees. We're back in the studio with Empower Chief Investment Strategist Marta Norton. And Marta, we've been talking about the sell-off in tech. It hasn't just been that's been troubling for these markets. I mentioned it. It's also higher yields at the front end and in the middle of the curve, trading near the highest since 2025. At the same time, higher oil prices. What is a bigger risk for this market? Some of the concerns about CapEx and tech, or what's happening with the concerns over inflation?
I mean, it's no question that investors are worried about both. I think if I have to pick a bigger enemy right now, I do think it's the CapEx concerns, because it kind of takes some of the momentum out of earnings, which of course is what's been driving markets higher. I think that is a source of volatility that we're probably going to have to contend with for quite some time. But there's no question that there are concerns about higher yields. And I think the uncertainty is something that markets have a really hard time handicapping, because we don't really know how this geopolitical situation is going to work itself out.
So Danny and I have been talking about the headline ping pong that we're seeing.
Yeah.
Have you made any tactical allocation changes recently, like maybe added your hedges or downgraded some asset allocations?
Well, I think the thing that we're thinking about the most these days is how do you get defensive in this kind of market environment? Now, I am not one of the people who's lost the faith in fixed income. I still think that there's a value there to diversified investors, especially at these yield levels. I mean, to your point, they're pricing in a lot of different risk, whether it's real rate risk or whether it's inflation risk. But I also think within your equity portfolio, it does make sense to try to find that balance between the anti-AI trade, which is not the easiest thing to find in the US, and also something that would be defensive if you do see some sort of massive concern around oil prices, and that leads me to healthcare.
Don't you have to do the same thing in your corporate bond portfolio now too? BlackRock, for example, just started kicking off a more than $12 billion sale for a Meta data center. Every day there's a new bond offering worth billions coming for the various AI projects. Are bonds in danger territory of also getting highly concentrated in AI and tech too?
Well, I think it's certainly a trend that's on the move. I think we have a ways to go. I mean, when you think about the size of these companies and how much they've issued historically, these are not companies that have been heavy borrowers, so they have some room to go. But I do think, and this is a refrain we've been hearing for years, but spreads are tight, right? And so it's not necessarily a timing indicator, as we know, but it is an indication that you shouldn't be careless with the risk that you're taking on the bond side.
Part of the reason that spreads have been tight that people have pointed to is just the amount of cash that needs to be put to work.
Yeah.
Is there a scenario as we keep seeing more issuance, not just on the debt side, but equity too, with more IPOs, cross listings, Google coming to market with another equity offering, that balance flips, that there is more supply that starts to challenge markets?
I mean, I think that is one of the concerns that we have to keep front of mind for us. I think when the IPO market doesn't bother me quite as much because it's not like we're seeing one wild idea after another. It's really these big mega deals that are coming out. But absolutely, there's just a lot more options to tack into these markets. And when you have that much supply, I think it can just weigh on markets. So the idea that the second half of the year could match the first, I think that's a little too optimistic.
And then we have, of course, rising oil prices, which can add to the inflationary pressures, which may make it more likelihood for the Fed to really talk about hiking rates, and they meet next week. But you said you're in the no-hike camp for this year.
I am, yeah, and I think that's largely because I don't understand what a hike would do for us. Now, maybe politically it's a good signal, right? Maybe it's a signal of independence and that kind of thing. And maybe it gives those who are really concerned about inflation a win and helps them relax about concerns around inflation. But when we think about what has been the major source of inflation, it hasn't been wild consumption. It's been more supply shock after supply shock. And if you raise rates by 25 basis points, is that really going to slow this AI train, which is really what's been, pushing the market forward? I'm not sure it will, but it will add to affordability concerns, and particularly around housing. So I think those are the types of questions that the Fed is going to have to grapple with.
No, it is interesting because AI for now, the way that inflation has showed up is maybe through chip prices. Do you expect that to change?
Not in the near term, right? I mean, especially when we look at these CapEx numbers that continue to move higher, and we'll see more of that next week. We'll see what that looks like, but it looks like a big proportion of that does relate to that chip buying, and that doesn't seem to be slowing anytime soon. So at least as we think about the intermediate term, the next few years, I think we can still see some of that inflation force coming from the AI trade.
And you also in your notes said that investors are already assuming strong earnings growth. Danny and I talked about this, that it's not even the beat that matters, it's what investors react to when it comes to those beats. Talk to us about how much of that optimism or overconfidence maybe is already priced in.
Well, it's interesting because when we roll the clock back to the last earnings season, the focus was all on geopolitics, and we weren't really thinking about what earnings could do. And then we see these remarkable numbers that aren't just, above average, they're almost historic in terms of what we're seeing from an earnings perspective. But now we know that to be the case, and we're already seeing that type of growth showing up early in earnings season. And I think it's one of the reasons why investors kind of yawn when they see some of these results and they say, I want to see the details, like with Alphabet, instead of getting overly excited about what the headline numbers look like.
Again, the stats that our Bloomberg Intelligence team pulled up was 85% of companies thus far have beat, but the majority of stocks are falling after they announce their earnings. So again, it gets to that point that it is a high bar and so much is already priced in. So if this earnings season isn't going to be the catalyst that continues to take this market higher, what is then?
Well, I don't think it's necessarily going to be valuation. I mean, if we decompose returns and we look at what drove returns over the past year, the bulk of it was earnings, and we actually saw valuation compression. And so when we're at valuations of these levels, broadly speaking, they're not outside of certain areas of the market, they're not overly stretched, but they're not low either. It's not like they have a lot of room to expand. So you really do need earnings to come through. And I think they are coming through. But if investors keep re-rating that, then we might not see exciting returns in this back half of the year. It might be quieter. So I'm not betting on necessarily a major market sell-off, but I don't think we're going to get what we saw in the first half.
All right, Marta, so great to have you here. Thank you for joining us, Empower Chief Investment Strategist Marta Norton. Let's get a check on your equity markets about 8 minutes into your trading day. And it is a market that's cautiously higher, up 0.1%. The breadth is pretty good, though. Nearly 400 stocks are trading to the upside with 130 trading down. A lot of it is just the Mag 7 recovering after that sell-off yesterday. Apple, Microsoft, Alphabet, Amazon, all of them are higher. Eli Lilly having a good day, too. Some of the software stocks also doing well. Verizon reporting earnings and announcing a new partnership and investment with Google, so that's helping them out. To the downside, because if you have a day where Mag 7 is up, it means that chip makers and other tech stocks are going to be down. That's just the nature of the game these days. Intel, interesting to look at. It was higher pre-market after they reported earnings that showed robust demand, but now they flipped negative, down nearly 2%. And again, all the others are chip makers. Luke Kawa of Entry Point puts it well. This is the Seinfeld market, as Jerry says. I'll paraphrase him: when Elaine is happy, George is sad, and vice versa. And that's apparently the case with chips and Mag 7 stocks these days. Looking at some of the individual sectors this morning in a market that's fighting its way higher, only 3 sectors are lower. Infotech is lower, even though the Mag 7 is higher, because chips aren't doing well. Real estate, energy, communication services, so some of the bond proxies doing better this morning. Again, Isabel leading us to a market that's up 0.1%.
Danny, I'm going to watch Seinfeld and look at that Elaine and George analogy.
To be clear, you have seen Seinfeld before?
No.
Oh, Isabel. All right, we're going to have a talk in the commercial break.
I know, I have a lot of homework from this show. But coming up, more on Intel's blockbuster quarter and the week ahead for big tech earnings. This is Bloomberg Open Interest.
We should not deny that change is coming. And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data. Yes. We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the Dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on Salar de Uyuni in Bolivia, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Time now for a top call. Some of the analyst action in focus this morning. First up, Telsey Advisory downgrading Albertson to market perform, pointing to the company's soft earnings report and clouded outlook. You see the stock there down by nearly 4.5%. Next up, we're looking at Citi raising its price target on HPE to $74 and opening an upside 90-day catalyst watch on the stock. They expected continuing strength in IT infrastructure spending. You're looking at the shares there higher by 0.6%. And finally, JP Morgan boosting the price target on Intel to $85. This is, I guess, the stock of the day. Danny and I have talked a lot about it. The stock is now down by nearly 3%. Earlier in pre-market, it was actually in the green. Citi saying that the company's results and outlook cleared expectations by a wide margin. Danny.
A big turnaround from Intel. For more on it, we're joined by Bloomberg Intelligence Head of Global Tech Coverage, Mandeep Singh. Mandeep, originally these earnings were interpreted as something that was positive for Intel, showed that their continued turnaround was taking pace. Now shares are lower. What did you make of the results from the company?
I mean, the server demand is pretty strong, and that's where Intel did really well. The data center segment growing 59%. During the earnings call, they talked about raising their capex, and there are some fears that if they need more money, could they do some equity issuance? And anybody who is spending capex right now is being viewed in terms of, what kind of ROI you are going to show. And we saw that with Google, even 82% cloud growth wasn't enough. Even 82% cloud growth wasn't enough to convince the investors that the ROI is commensurate to the capex increases. So from that perspective, I think Intel is a beneficiary of that capex. But then they also have to do their own capex, and I think that's where any increase would be viewed as somewhat of a negative in this market.
And how does Intel plan to compete with NVIDIA and AMD when it comes to AI infrastructure and as that spending accelerates, Mandeep?
Yeah, I mean, look at what consensus has for NVIDIA right now for the upcoming quarter. Even at the base that NVIDIA is at, they will probably end up growing faster than what Intel just printed. So look, I mean, Intel is a turnaround story. Things seem to be heading in the right direction after a number of years of struggle, whereas NVIDIA is just executing to perfection, and probably that's why they're not getting the credit that there is more upside left in terms of positive sentiment, but very different in terms of where they are at with respect to their exposures to this capex.
Well, when it comes to inference chips and others, Mandeep, Intel's mission, be it their partnership with SambaNova and elsewhere to try to keep those costs down, how is that progressing? And do we know sort of the uptake from companies, the demand for them versus something like a GPU?
Yeah, I mean, look, Intel is trying different things, and you're right. I think they're trying to boost their exposure on the accelerator side, because on the CPU server side, you will have a lot more competition. Even NVIDIA makes own CPUs. We saw that from AMD yesterday. And all these companies are trying to sell you systems now. So it's not just about CPU or accelerator, but complete systems where Intel actually trails. And so they're trying to ramp up foundry as well as inference exposure, but it's the foundry side where there are more expectations in terms of positive surprises, because if they end up landing up Apple or somebody new on the foundry side, that could be huge, and that could justify all the capex investments that they're planning to make.
And Mandeep, next week we hear from Microsoft, Meta, and Amazon. It's going to be another busy week for you and for everyone here. Anything you're going to be on the lookout for? Do you think investors will be grading the market on AI results more than their AI ambitions?
Yeah, I mean, you could compare the cloud growth. So if Google is growing 82% and Microsoft Azure comes out at 40%, that's half of what Google grew, or even Amazon AWS, if it's 35%, that's not good enough. So they have to show acceleration in the cloud growth because Google has put the bar really high now.
Mandeep, thank you so much for joining us. Looking forward to your coverage next week. Mandeep Singh of Bloomberg Intelligence.
Coming up, an ETF startup named Corgi is launching hundreds of funds in hopes that just one will be a blockbuster. That's next. This is Bloomberg Open Interest.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Anne-Marie Hodern in Beijing, China, and this is Bloomberg.
Welcome back to Bloomberg Open Interest. A check on your equity market this morning. The S&P is up, but the NASDAQ is down, led by a sell-off in chip stocks this morning, though Mag 7 rebounds. The Russell 2000 up 0.2%. Brent crude down 3%. Yields, if we had those on the board, it would be showing you that those are also moving lower today after charting higher by about 5 basis points across the entirety of the curve. NVIDIA, Intel. Before market, pre-market was up. Now it is down 2.5% as they increase their capital expenditure plans. I mentioned that a lot of the chip makers are selling off. Amex also beating on their earnings, but falling more than 5% with higher fees. Verizon, they reported earnings and announced a partnership with Google, so those shares up 2.5%. Isabel.
Danny, thank you for that update. We're now looking at Corgi Strategies, which is an ETF issuer looking to disrupt the $15 trillion landscape after launching a record 34 funds in one day. Now it's planning to launch hundreds more as it takes aim at giants like BlackRock and Goldman Sachs. Bloomberg Intelligence analyst James Seyfried joins us to discuss. James, Corgi is a little-known startup in the humongous ETF world, but then they're already in the top 10 issuers by count. How unprecedented is this, and are they even profitable? Because it seems like they're throwing spaghetti at a wall and seeing what sticks.
I mean, that's exactly what's happening. This is spaghetti cannon in action. We don't know. We can't see the internal financials of exactly what's going on, but it's almost certainly the truth that they're not profitable right now. But they have VC backing. They're a larger fintech type play. And they're using the VC playbook. So they've filed for well over 500 ETFs. They launched their first ETFs in the late fall last year. So they're on track now. They're just shy of 200 ETFs they've launched this year. One of them is pretty significant in assets. It's nearing 500 million, but it's very unlikely that all of these ETFs, the cost that it takes to run these things on an annual basis, that they're profitable right now, but that's not what they're betting on. They're betting on that one of these will take off, or at least a few of them will take off and support everything else.
How do you even come up with 500 a year? Are they just like, hey, Claude, give me 500 random ETFs? Like, is there any rhyme or reason or consistency among what they're actually offering?
So it seems like it really is the VC playbook. They're trying a lot of different things. They're trying to undercut the market. They're trying to do new things. So there's like no one set way of doing things. There's filings for what we expect to be super cheap beta products. They have over 100 products that are single stock or theme leverage ETFs. They're thematic ETFs. Their biggest ETF is Ethereum, lithography related to AI. They filed for leverage versions of that. So they're launching and filing tons of things, and then also filing leverage versions and defined outcome versions. So they're basically trying anything and seeing where the market is going to, put their assets with them.
Well, James, we know that launching an ETF is becoming easier and becoming cheaper. I mean, there's this famous number that maybe it takes around $300,000 to launch an ETF. But then keeping it up and running is now the hard part. And of course, distribution. Can you talk to us about how you think they can surmount those challenges?
Well, obviously, one of the ways they're trying to surmount the challenges of distribution is being like, we're offering cheaper products than everybody else, and a lot of the products are extremely similar. It remains to be seen how that's going to work out. Like I said, they have one fund that's proven to be very successful, but they're basically trying to create this giant whole ecosystem. I mean, this is the same company that has 24/7 cafes all over San Francisco and different parts of California. So they're like trying to create this big ecosystem. But one thing we have seen in ETFs more broadly is like we're seeing a lot more launches in general. Obviously, Corgi is completely an enigma. It's a thing in all itself. Nothing else is even close. If they launch all the things they filed, they will have more ETFs in the market than anybody else, including BlackRock, which is the current leader at just shy of 500. So essentially, I don't know how they're going to play it out, but they're obviously trying lots of things. And like I said, they have VC backing. There's a lot of money here, and this is just a piece of what they're doing. So they might expect this to be a cost center for them, but it remains to be seen how it's going to play out long term.
So clearly they're issuing so many ETFs, James, and the world is already awash in different exchange-traded funds. Are we seeing, though, at the same time, more closed? Because of this kind of thing, you do a spaghetti cannon, but not all of them are successful, so you have to shut them down.
Yeah, so perfect question. That's 100% what we're seeing. So you go back like a decade plus ago, it was like kind of a bad sign to close an ETF. You launch an ETF and it like didn't look good if you had to liquidate or close that thing. That is not what issuers are doing now. We're seeing a lot more launches. We had by far record launches in 2025. We're on pace to beat that by 30. We're going to see over 1,400 launches this year, most likely. We're also seeing record closures. So people are launching a lot more, and they're pulling the trigger on liquidating them a lot sooner. Like we talked about before, and Isabel mentioned, it costs a lot of money to launch these things. It also costs hundreds of thousands of dollars just to keep them operating throughout the year. So if you don't get enough assets and your fees don't compensate for those costs, you're going to end up closing. And it's not a bad look anymore if you close. People just don't care.
Are a lot of the new ETFs we're seeing, James, does it also coincide just with more IPOs and more hotly anticipated IPOs that maybe you want to build, a 3 times inverse levered SpaceX ETF or whatever?
Yeah, I mean, part of it is that there's a lot of things going on, particularly with AI and space, other thematics, semiconductors, tech. That's a lot of what's happening. But also we have single stock ETFs that's buoying this, right? So you can launch if multiple issuers launch a single stock ETF in every single stock out there, we're going to see a lot of things. So part of it is that. Part of it is like a lot of people, for the most part, most of the assets are still in like those S&P 500, NASDAQ 100, broadly based diversified equity ETFs. So as more money goes in there, a lot of people want to, get wild with another portion of their portfolio. We call it core and explorer or core satellite. So in those satellite portions of the portfolio, as people get more disciplined with low cost beta type exposures, they're looking to go out and play with things that we refer to as hot sauce, get a little spicier, these types of leverage ETFs we're talking about. And so it's creating an opening.
All of a sudden now I'm hungry between spaghetti and hot sauce. James, thank you so much for joining us, James Sefford. And of course, tune in to ETF IQ Mondays, 12 p.m. New York time. Coming up in the next hour, Maria Waitman from State Street Global joins us, and economist Douglas Irwin reacts to the latest tariff plan, plus the CEO of Singapore Exchange. All that in hour 2.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
ABC News. I'm Sherry Preston. A 16-year-old has just pleaded guilty to all 55 counts in a deadly school shooting nearly 2 years ago at Appalachia High in Georgia. Colt Gray entered the plea without any deal with prosecutors. 2 students and 2 teachers were killed in that shooting, numerous other people wounded. Tensions remain high in Madison, Wisconsin, following the police-involved fatal shooting of a black man earlier this week. ABC's Pierre Thomas has more.
Police were responding to reports of a man checking the doors of parked cars Wednesday afternoon. Officers spotting him, but police say he took off on a bike. They catch up with him roughly a half hour later. Police say he pulled out a fixed-blade knife. Officers trying to tase him, but police say they were unsuccessful. Part of the controversy, the police in Madison typically do not wear body cameras.
With the old ones now expired, the Trump administration has announced a new round of tariffs on 60 countries taking effect today.
The White House, the Trump administration has done these investigations. This is a more traditional way of imposing tariffs into all of these partners. They're accusing them of using forced labor practices as a justification for putting these new tariffs in place.
ABC's Elizabeth Schulze, the nations involved, deny any forced labor accusations. New questions about the deal announced this week that would allow Saudi Arabia to develop a nuclear power program. Here's ABC's Mary Bruce.
The president is now dramatically changing the terms with a new condition that could put the entire deal out of reach. Trump saying it is totally subject to Saudi Arabia joining the very respected and successful Abraham Accords. But that remains highly unlikely. It would require Saudi Arabia to normalize diplomatic relations with Israel, something they have refused to do unless Israel commits to a Palestinian state.
Following a 13th night of fighting in Iran, Iran is warning civilians to stay away from buildings where U.S. troops are being housed. You're listening to ABC News. A new investigation into one of those on the security detail for the vice president.
The Secret Service says an agent on Vice President J.D. Vance's detail is facing an internal investigation and even a potential criminal probe over accusations this unnamed agent leaked information about the vice president's travel, compromising his security. A Secret Service spokesperson telling ABC News that, quote, any conduct that potentially threatens the safety of a protectee will not be tolerated.
ABC's Jay O'Brien on Capitol Hill. The district attorney in Jackson County, Mississippi, Angel Myers McElrath, is speaking out for the first time since the death of 18-year-old Nolan Wells.
She met last week with Wells's parents, who pledged to allow investigators to examine his phone, which he left behind in a boat during a July 4th trip with friends to Horn Island. Few details have been released, but the district attorney says that's by design.
The pressure for answers does not change what the work requires. Our responsibility to Nolan and our community is to complete this investigation thoroughly, carefully, without compromise.
ABC Chief Investigative Correspondent Aaron Katursky reporting. A slow-moving storm system is bringing forecasts of multi-day flooding to the Carolinas. An inch per hour of rain is possible from Charleston to Wilmington, including Myrtle Beach. Midwest Poultry Services recalling nearly 1.6 million cartons of eggs due to potential salmonella contamination. I'm Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Friday morning. This is Bloomberg Intelligence, broadcasting live from the Bloomberg Interactive Broker Studio in Midtown Manhattan. We are streaming live on YouTube as well. Paul Sweeney is off for the day. Scarlett Fu, Alexis Christoforous, and John Tucker here with you for the next 2 hours. We've got a lot to cover because tariffs are back. The president is aggressively rebuilding a tariff structure, so we're going to get into all of that with our Nathan Dean, Senior Policy Analyst for Bloomberg Intelligence. Oil prices have eased a little bit, but they are still hovering near that $100 barrel level, especially if you look at Brent crude. So all that comes up in terms of what it means for markets and this global bond sell-off. Barbara Ann Bernard, Windcrest Capital founder, will be joining us from the Bahamas to talk about that. And hyperscaler earnings in full swing next week. Alphabet reported this week it's going to spend a ton of money, $1 kajillion, on building out its AI infrastructure. So next week, Alexis, we get who? Microsoft, Amazon, Meta, Apple. So a lot of billions of dollars, tens of billions, hundreds of billions of dollars will be coming up. And Boon Chai Lo is the CEO of SGX. We're going to talk with him about the Singapore Exchange, how it's striking new deals with MSCI. All that coming up in the next hour of Bloomberg Intelligence. But let's get a setup first here of the markets on this final trading day of the week with our John Tucker.
Oh, happy Friday. This Bloomberg Business Flash brought to you by IBKR. Trade, election, climate, and economic outcomes with IBKR prediction markets. Right alongside your stocks and options. Earn interest in your position and receive $1 per contract if you're right. Learn more at ibkr.com/predictions. So after yesterday's sell-off, right now the major averages mixed to little change, and you really have to look under the hood for the real story because you know, you have 10 of the 11 major industry groups in the S&P 500. They're actually higher. There are 369 stocks up, 129 lower. So consider the weighting of some of the individual stocks like, Intel, most active, and it's down. Why? I don't know, because Tatiana is going to be along to explain that.
Passing the buck.
Yeah, I don't know. She's a lot smarter, by the way. Among the worst performing stocks of the S&P 500, American Express down close to 6%. So their expenses surge. They're trying to spend more on marketing. And meantime, Karen Manna at Federated Investments says, you know what, these new Trump tariffs that took effect after midnight, they're adding to a list of worry for investors.
We came into this week thinking it was quiet, it was summer, we'd be paying attention to earnings and seeking clues, but yet treasuries are pointing, north in terms of yield, and it's definitely a more inflation on environment. The concern is there.
And S&P 500 down 1 point right now, 74.06. The Dow up 102 points. That's up 0.2%. The Nasdaq Composite Index 135 points lower. That's down just about 0.5%. Let me do oil for you. A little lower. Brent, the active contract, the international benchmark, down about 3%, 97.38 a barrel. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alexis and Scarlett, you made it to the end of the week.
Yes, we made it. I mean, it's been a brutal week.
It really has, and a busy one on the earnings front. And yeah, oil, Brent breaking through $100 a barrel. It is easing though today, but more tariffs being imposed on more countries. So yeah, it's hard to keep up with the news cycle for sure.
And I get the sense that people are a little bit worried about what else could come this weekend too, because we know this president likes dropping a lot of news over the weekend as well. So let's get a check on some individual movers in this mixed stock market right now and bring in Tatiana Darie. She is our strategist for Markets Live, MLive Go on the terminal for those who have a terminal. Hi, Tatiana.
Good morning. What a turnaround here in Intel shares are now down about 4%. Your ticker is INTC. Really, after blowout results, the company reported earnings that were double the forecast. It also said that sales in its data center segment soared 59% last quarter, more than double the pace of its overall revenue. So the results really show that the CEO's Lee Bhutan's turnaround efforts are really paying off. He said demand for CPUs in data centers is really taking off. So a lot of good news. Still, we're seeing yet again, good news is not enough to really improve sentiment around these stocks, and tech is selling off heavily here again, as it looks like investors are really taking a break and really pausing on the whole AI specter, not just the hyperscalers versus chip makers.
Right. I want to stay with tech because you brought along a software maker, Oracle, got a nice big contract, right, from the Defense Department.
Exactly, but here again, the stock is down after being up about 2% in the pre-market, being dragged in this broader sell-off in the tech space. But the company won a 10-year contract with the Department of Defense, valued at about $3 billion for the first 5 years, up to $7 billion if options are exercised. This is very important because this is a company where free cash flow is really closely watched, as its balance sheet is on the weaker side if you look among hyperscalers, and those debt concern and debt cost or the cost of AI investment has really weighed on the stock, down 5% through yesterday, just this week, and down 38% year to date. It's also weighing on its debt, with the cost of protecting its debt against default reaching an 18-year high just this week. This company reports earnings a little bit later, so we won't get to hear more details about the new contract, but still it can definitely use some good news.
Yeah, and also something that folks in the credit market are watching very closely as well. Tatiana, I'm looking at Canada Goose's website, and it's kind of cold in this studio. A lightweight down jacket costs $1,000 and $1,000, yeah. I mean, even the more low-end ones are like $600.
Yeah, well, get ready for even more expensive jackets from this brand because the new tariffs, the 50% tariffs that Donald Trump has put on Canada will make prices more expensive if they stick around. Of course, shares of this stock are down 3%. Ticker is GOOS. After Williams Trading downgraded the company to sell, anticipating a greater risk that it will pull guidance due to this potential tariff headwind. They know that just over a quarter of its revenue came from the U.S. in fiscal year 2026, so that there is a risk that that portion of the revenue will be impacted when tariffs kick in August. I only say if, because we know that the president really likes to pivot on these things and uses it as a negotiating tactic, so we don't really know what the end level there will be. Nonetheless, Canada Goose gave guidance in May, calling for total revenue growth in the low single digits, so it will be important to watch when they report next week.
All right, good stuff. Thank you so much, Tatiana Darie, strategist for Markets Live. And for more conversations like what you just heard, subscribe to our Stock Movers Reports, where we offer 5-minute audio reports on the biggest winners and losers in the stock market. Stock Movers is available on Apple Podcasts, Spotify, or anywhere you listen. We were talking about these tariffs that President Trump has reimposed, or has new tariffs that he's imposed. It's kind of hard to keep track, which is why it's great to have Nathan Dean with us.
Absolutely.
He's our senior policy analyst for Bloomberg Intelligence, joining us from Washington. Nathan, the president has been on a tear this week, announcing new tariffs left and right. There was something on Canada, there was something on generic drug makers, and now he's talking about new duties of between 10 and 12.5% on imports for most major trading partners. Just give us kind of the broad overview of this latest announcement.
Yeah, so President Trump is showing that, even though tariffs are highly unpopular with the American populace, they are going to be here, and they're most likely going to be here through the rest of President Trump's administration. Now, what President Trump did here is he converted what is known as a Section 122 tariff, where he was somewhat limited in what they could do, and he converted it into what's known as a Section 301 tariff. Now, what the investors should note is under a Section 301 tariff, in this case for forced labor, President Trump now has a tool that's on firmer legal ground, so you're not going to see a repeat of the Supreme Court trying to curtail his powers here. And as we go forward, he's going to be able to use Section 301 tariffs as a way to say, we wake up on Monday morning and there's a Truth Social post saying this country has done X. As a result, based off this investigation, now you're going to face a 100% tariff. So the headline risk that's going to come from President Trump's social media is going to only increase. The only thing that's really stopping him at this point is the midterm elections, because tariffs is really unpopular. But after the midterm elections, I think 2027 is going to be a story of tariffs.
Nathan, even some of Trump's backers and his allies are questioning this new round of tariffs, especially with midterm elections around the corner. Is this going to, again, amount to a tax on the U.S. consumer?
I think it will be. I mean, let's look at the retail industry in particular. So, right now, Lululemon, Nike, and Adidas, they are somewhat constrained or somewhat exposed to Southeast Asia, mainly Vietnam. Now, right now, there's a Section 301 investigation in addition on excess capacity on those countries. So if you're exposed to Lululemon, Adidas, or Nike, not only you're going to deal with the 12.5% that you're getting from the Section 301 tariff that they just put in place, there's another tariff that they're investigating. Now, why would they do this if it's highly unpopular? Well, President Trump loves to use it as a negotiation tool. And like Tatiana was just saying in the prior segment, when you look at this 50% tariff or the 100% tariff on generic drugs that starts in 2 years, those are negotiation tools to force countries to come back. But in the interim, those countries and those investors that are exposed to those retailers, you're going to see higher prices as a result.
What about the countries that had signed bilateral trade deals with the U.S., at the start of the second Trump administration? Do all those just kind of go by the wayside? Do the tariffs kind of get layered on top of that?
So right now, it depends on the country, but most of the countries, they're still at the 10% level. So a lot of those trade deals in the United Kingdom in particular, was just a little bit higher than 10%, but they're at 10% right now. Most of those trade deals are going to be remaining the same, because that's ultimately where the United States and where President Trump and U.S. Trade Representative Jamieson Greer wants to go, is they want to have these individual trade deals, because then you're going to be able to have exemptions. You're going to be able to focus on specific industries. In the UK perspective, cars. And so ultimately, those deals are going to be there as a base layer, but President Trump always has the authority to add more if he wishes.
Nathan, before we let you go, we got to talk about the possibility of another government shutdown that could happen September 30th, of course, with those midterm elections right around the corner. First off, how likely is it that we're going to get a shutdown? And if we remember correctly, during the last or the most recent one, the S&P 500 returned more than its historical average, so the market seemed to shrug it off.
Yeah, exactly. And I think that's what's going to happen here. I mean, it's kind of funny. The S&P actually did better coming out of the shutdown than it did going into it. But in this case, we're ascertaining a 40% chance. Look, shutdowns right before the elections, they're politically risky. Neither party really wants to do it. But the Democrats really didn't pay a political price for embracing a shutdown last year. And there are Democrats out there that say, look, I'm not going to support President Trump's immigration agenda or vote to fund anything related to that anytime soon.
Right.
And that's where the challenge is. Now, the House has passed a bill that would fund the government through December 4th, puts it into the lame duck, kicks the can beyond September 30th.
Yeah.
Right now, I think the Democrats will agree, but we'll see.
All right, Nathan, quite a lot to sum up there from Washington. Nathan Dean, very busy with the latest policy initiatives out of Washington. He's our senior policy analyst here at Bloomberg Intelligence. We're looking at stocks limping to the finish line here on this Friday. The S&P now unchanged. The NASDAQ Composite Index down 0.6%. This is Bloomberg Intelligence on Bloomberg Radio.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. And the major averages mixed. 10 of the 11 major industry groups in the S&P 500, they are higher right now, and it's being led by real estate. That's where some of the data center REITs live, like Digital Realty Trust, the ticker symbol there, DLR. That is actually the best performing stock in the S&P 500 right now. It's up over 13%. Currently, it's been up 5 of the past 6 days. TD Cowen raised the recommendation on the real estate technology company, citing record demand strength for, yeah, you guessed it, data centers. S&P 500 right now, 10 points higher. That's up 0.1%, 74.18 on the index. And the NASDAQ Composite Index That's down 120 points, even though Intel had some pretty bang-up results. Shares of Intel right now 3% lower, and the Dow Jones Industrial Average up 138 points, also reflecting some of that rotation from tech. That's up 0.3%, up 144 points, 51,853. 10-year yield 2 basis points lower, 466. Twos down 2 basis points. That's at 4.32%. I just wanted to bring you this headline of Israeli Prime Minister Benjamin Netanyahu will meet with Donald Trump, President Trump, in Washington. That is scheduled for Tuesday. That's according to Israel. And we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Alexis, you think they have anything to talk about?
I think they have a lot to talk about. Do you think Mamdani will show up in D.C.? I don't think so.
Yeah, I don't think so. Well, he sort of nixed that it was just a threat. He wasn't going to actually arrest the prime minister. So.
Lots of swaggering talk from lots of politicos. All right, John Tucker with our Bloomberg Business Flash. Thank you so much. We got some data at the top of the hour on housing, and it's so fascinating because everyone's waiting for interest rates to come down, Alexis.
Right.
And with the 10-year yield spiking this week, doesn't feel like that's going to come anytime soon.
No, and actually rates are still below where they were a year ago, but they're continuing to inch higher.
Yeah, so if you're waiting for that 30-year fixed rate mortgage to go below 6%, keep waiting for a while. Let's bring in our next guest, Barbara Ann Bernard. She is CEO and CIO of Windcrest Capital. She joins us right now from the Bahamas. And Barbara Ann, I want to start with the new home sales numbers, which show the first increase in about 3 months. So that sounds like it's good news when it comes to new home sales, yet the actual increase was smaller than expected, 1.6% versus the expected 4.8%. But I guess to some extent, consumers, home buyers, they're making peace with the idea that borrowing costs for homes will stay kind of elevated.
That's right. And I think one number doesn't make a trend, Scarlett. So if you look at May, it was 580K versus an expected 640. So it was, is this a bounce off of a soft base, or is this, an uptick in trend? But nonetheless, I think what it confirms is that the consumer is feeling pretty good. And you've seen this in new car sales and, credit card data. So the consumer is feeling strong. There's no question about that in the face of higher inflation and higher rates. And I think, if you look at the employment numbers, the jobless claims yesterday, they came in better than expected too. So as long as people have jobs, they're willing to spend and they can cover their mortgages.
I want to do a hard turn for a moment, Barbara, and just talk about gold. I quote gold nearly every day when we do our business flashes, and it is down from its high about 25%. Where do gold investors go at a moment like this? Or is this a nice opportunity to step into the precious metal?
So in the face of, or in the threat of higher rates going forward, gold is going to underperform, right? But I think today the case for gold is more about de-dollarization, more about deficits, more about distrust in the U.S. dollar, given the amount of debt and the deficit that the U.S. is taking on and its ability to service that. So gold is still a fear trade, and there's certainly a lot of uncertainty and fear in the world. We have a huge war going on that needs to be paid for. We have, tariffs that people are going to demand refunds for. And so, how we fund some of our deficits and our growth, I think, is a real theme for both governments and companies today.
I want to stay on the idea of commodities, but move to energy. And within energy, you've highlighted fusion energy as an area that becomes, very attractive for retail investors to consider. You call it an investable sector for retail in 2026. Why is that?
Yeah. Well, it's an exciting space because I feel like this year we're democratizing the dream because it's the first time fusion companies have gone public. So General Fusion just went public via SPAC on the 17th of this month, and it is a pure play fusion company. Later on this year in Q4, you have Shine, which is a medical isotopes fusion company with a near monopoly in the U.S. I think that's a really interesting one. It also wants to go public. And then, of course, in Q4 of last year, you had the Donald J. Trump Media Company merged with TAE, and they hope to complete that merger in Q4 of this year too. So within those companies, you have a range of sort of valuations, if you will. General Fusion went public at a small cap valuation, I'd say, just under $1 billion, and the DJTTA merger is more of a $6 billion market cap. And Shine wants to be in that neighborhood too. So these are very capital intensive businesses. And what's getting hurt right now is growth that is capital intensive. And you're seeing that in the AI sector, right? And the question is it worth it, and will that growth be forthcometh? The difference between Fusion today and this time last year is when Donald Trump announced that merger, he sort of put his money where his mouth is, right? The world was worried that Fusion looked like windmills to him, and it doesn't. And so in addition to that, not only did he merge his company with TAE, but he also followed on with an $80 billion government partnership with Westinghouse, Cameco, and Brookfield to build a new AP1000 reactor fleet. So that's the U.S. government underwriting nuclear the way it once underwrote highways, right? That's infrastructure scale conviction. So I think that's what makes fusion and nuclear different this time.
Got it. Barbara Ann, thank you so much. Barbara Ann Bernard is CEO, CIO, and founder of Windcrest Capital.
All right, we want to talk earnings next week because they're going to be dominated by the mega cap hyperscalers. We're talking Meta, Microsoft, Apple, Amazon, and the like. And who better to do that with than Mr. Dan Ives, live in our studios here in the Interactive Broker Studio, partner and senior managing director, Yorkville Ives & Co. Dan, good to see you.
Great to see you.
And you have an animal motif for those not watching on YouTube. Animal motif today. Is this a tiger?
Tiger. Got a koala hat. So yeah, little animal motif. No, I should have brought a bull maybe.
I like that. Little animal spirits to the conversation.
Animal spirits.
We'll talk about next week in a moment because I want to talk about Intel right now. After the bell yesterday, I've on every metric I thought blew it out of the water. Yet Intel is down 3%. Why do you think?
Look, I think the reality is some of these knee-jerk reactions I think could be misleading relative to the fundamentals. Because what investors are looking at here is what does demand look like for the AI revolution? And look, Intel has become a huge barometer. And you combine what we saw from Intel with the hyperscalers, that just gives you more confidence to what we're going to see over the next week relative to CapEx, enterprise demand. I think that's why it's very easy for investors to get caught up sometimes in what the stocks do, a day after. But for Intel, I mean, they've almost become the comeback kid.
They have.
They definitely have. With a big helping hand from the U.S. government, of course.
And NVIDIA, yeah.
And NVIDIA. Okay, so let's talk about the hyperscaler earnings that are coming up next week. Alphabet, the knee-jerk reaction there was to sell it off yesterday, down almost 7%. Today, it's making a little bit of a comeback, stabilizing up 2/3%. We've got Meta, Microsoft, Amazon, all reporting next week. Are we going to see a similar kind of outcome where they're going to increase their CapEx and the return on investment, through cloud sales, for instance, is going to show that they're getting some payoff, but investors' bar is so high right now that they're not going to be rewarded for it.
Look, and I think the Alphabet reaction, I think that someone would say maybe head scratching because if you saw the cloud growth, you look what they're doing across the business, and then of course increasing CapEx. But as we've talked about, this is an arms race. It's third inning in the AI revolution. Microsoft, Amazon, Meta, no one's going to slow CapEx. Could you slow it down? You get ultimately, you're out of the line in terms of when it comes to capacity. I think the most important thing relative to tech earnings, to the market, to these stocks is demand accelerating? Our enterprises toward what ultimately is going to be monetization of use cases. And in terms of the reactions, look, I think we've seen, I think investors are definitely fickle and worrying about, we'll say maybe patience wearing thin. But guess what? Let's say Alphabet said, we're cutting CapEx.
Exactly. The market would freak out.
So that's why it's one where these companies are doing but they're not just spending like 1980s rock stars for no reason. Mm-hmm. They're spending because their customers are moving on the hyperscalers, on the cloud with AI. That's why they're doing it.
Sort of like you're damned if you do and you're damned if you don't, right? Because if you're not spending and keeping pace with the other big hyperscalers, well then what are you doing? But if you're spending a lot, they're still going, what are you doing?
But it's you're building out the Vegas Strip in 1955.
Great analogy.
So the point is, you get one spot on the Strip. If you pull back, guess what? You're 2 miles away, you're in Reno.
Right.
And bottom line is that's how these companies are thinking.
Okay, so they want to make sure they have a prime spot on the Strip, and that means they need to spend a lot of money. They also need to raise a lot of money. They've been doing that in the bond market. Are more companies going to do what Alphabet did and tap the equity market as well?
I think it's going to be a tidal wave. Now, in terms of I think it's also going to happen over the next 6, 12, 18 months, because the reality is if they don't do it, despite whatever the stocks do, they know they're out of the game. Now, investors, how are they going to react to that? I would argue, see, if you look at Meta's last quarter was basically increased CapEx, dog ate the homework, they didn't show it. Alphabet, they are showing it. Microsoft, penalty box, prove me moving for Nadella. Each one's almost become idiosyncratic relative to how they're treated. But the reality is investors are going from CapEx to monetization. That's the phase we're in, but it's still early in terms of as it's all playing out. And for the first time in 30 years, the U.S. is ahead of China when it comes tech.
Apple's a different animal from the other companies we were just talking about. And every day I feel like they're saying we're going to revamp another product in our lineup, again, geared towards AI. So what can they possibly say that's new when they come out with earnings next week?
Look, for Apple, they finally now have an AI strategy. It's not just talk, and we talk about, we saw at WWDC. It's not Anthropic, it's not OpenAI. They don't need to be that because they have the install base of 2.5 billion iOS devices, 1.5 billion iPhones. For them, okay, it's really about giving investors an update on the deployment of the AI strategy and then giving some sort of sense in terms of what this iPhone 17, it has been a surprise upgrade cycle. And I think that's something you saw it even on the AT&T numbers. And it's very important for this broader market. The stock, what's happening to the stock, investors are realizing Apple is basically, they're going to be the toll collector on the consumer AI highway. No matter which way.
But do we need a foldable Apple phone? That's my question, Dan.
And again, Keen's talked about that, and I think, I know he's waiting for it, but I think it's going to come probably next year.
It'll fit in your pocket better. It's not going to fall out of your pocket that way. Okay. It'll be bulkier, but it won't fall out. Dan Ives, always a pleasure. Dan Ives is now partner and senior managing director at Yorkville Ives.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
With this Bloomberg Business Flash, well, the S&P 500 on track for a second straight week of declines. So this would be the longest streak of losing streak since March. Only 2 of the 11 major industry groups in the S&P 500 are actually lower. Information technology is the biggest drag, and of course that's home to the semiconductors. And the Philadelphia Stock Exchange Semiconductor Index, right now, that is down over 4%. Talk about getting whipsawed. And the stock of the day, Intel, turnaround story kind of there. After the close, they delivered revenue forecasts that shattered Wall Street estimates. Chalk that up to booming data center spending. But right now, of course, the shares are down, Intel down 3.9% on the day. This is kind of another turnaround story. Verizon Communications, mobility and broadband sales exceeded Wall Street expectations. Now, Verizon is actually up 2.9%. Of course, the Federal Reserve meets next week on interest rates. Veronica Clark at Citigroup Global Markets thinks they're not going to make any move.
I mean, it's interesting. I don't really think that they need to raise rates, right? I think raising rates at this point, you do have to think of the trade-offs, right? Raising rates to cool inflation has to do that through cooling demand, and you don't really see strong demand.
S&P 500, 4 points lower, 74.03 on the index. The Dow Jones Industrial Average up just 47 points right now, up 0.1%. And the NASDAQ Composite Index down 194 points. That's a decline of 0.8%. Number of big changes coming away at Facebook. Meta launching a new app called Seller. It's going to provide better tools for people who sell the most on Marketplace. Sort of like the nation's garage sale.
I like the way you put that. Have you ever used Facebook?
No, you know, I have so many tools that duplicates that people have given me over the. I got to go on and start selling this stuff.
Yeah, you can make you could do that.
Yeah, but the thing is, I don't want these people showing up in my yard. So, yeah, whatever.
Then you got to make a lot of trips to the post office.
I guess, but Meta can do all this AI stuff. Mark Zuckerberg, and the fact of the matter is, blah blah blah. It's stuff like this that really powers the company.
True.
So anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Alexis and Scarlett.
All right, I'm going to buy some power tools from you.
I'll just give them to you. Bring them in.
Even better. I like that.
Or John, can you come to my house and do the work is really my question.
No, that's definitely out of the question.
I pay well.
Sorry. Right. I do like you, but I'm not doing that.
Okay. It was worth asking.
Fair.
All right, John Tucker, thank you so much for that Bloomberg Business Flash. We have a special guest in studio with us right now to talk about what's happening in Singapore. The Singapore Exchange has struck a new agreement with MSCI, the index compiler, to build on an existing partnership and also add some new products and services. We want to welcome Boon Chai Loh. He is the CEO of SGX, and he joins us now in studio. Hi, Boon Chai.
Hi. Thank you for having me here.
Thank you for joining us today. So tell us a little bit about the existing partnership you have with MSCI and what this new expanded partnership allows Singapore Exchange to offer.
It's a long-standing partnership, close to 30 years. We have grown our MSCI Singapore Index, equity index derivatives over the years. We've added new products on climate action via ETFs. And this new expanded partnership will allow us to provide derivatives, in particular equity index derivatives, across more regions, more countries, more sectors, because that's what our investors, participants are telling us. Risk management is more complex these days. You don't look across just a single region. It's now cross-border, across region, across markets. So we hope through this partnership, we can have an expanded suite of risk management tools for our participants.
What will these contracts involve? What will they look like? Because I understand it's going to be broad-based.
Well, today we offer contracts across Asian markets for the equity index derivatives. This will now include broader emerging markets, some developed markets. It will also include some other single countries outside of Asia, and also sectors that we've never done before, such as industrials, and also global financials.
Energy part of that?
Energy would be part of that.
Okay.
Yeah.
I'm curious about what you see in volatility in the region. We've seen the Korean stock market really go up and down quite a bit, aided in large part by those single stock leveraged ETFs. This elevated volatility that's happening in Asia, what does that mean for the Singapore exchange? And at what point does it become worrisome, perhaps?
Well, as you mentioned, volatility has increased, but I don't think it's just in Asia. It's been across the globe. At the exchange, we're focused on the long term, in particular, a resilient, transparent, and efficient platform. And as you mentioned, volatility then requires clearly a more focused risk management by participants. And that's why even an MSCI expanded suite of products will just give more risk management tools to our participants.
What about your offerings when it comes to cryptocurrencies and the crypto perpetual futures?
Yes, that has been growing, albeit from a low base. We are now onboarding more customers and also onboarding new customers that have not traded our core SGX products before. So we're excited about it. Perpetual futures is one other form of instruments that we hope we can offer to other asset classes.
How about prediction markets? Prediction markets have really taken off around the world, in the U.S., especially following the World Cup this summer in North America. And it's really become a fast-growing area of financial markets, even though most of the wagers are on sports. They haven't really migrated to anything else.
But more and more they're becoming wagers on politics and other things. I'd have to imagine in your position, it's very challenging.
Well, there is information value, in particular, on the events around macro, around economic indicators. And I think for institutions, that information could be useful, could be relevant. That said, the volumes are not at a level where institutions find it meaningful to execute or risk manage. And I think it's just an evolving, developing market.
So as a result, is prediction markets something that you're not interested in entering into until it becomes economically viable?
Not for economic viability, but I think what's important is what do our participants look for? And if there are economic indicators that could be expressed as an event, we would want to think about that to enhance risk management for our participants.
At the Singapore Exchange, what is the fastest growing segment of the business at the moment?
All segments has grown broadly. I'm in a blackout period, but just looking at the historical last 2-3 years, FX has grown rapidly. Today, our FX volumes are evenly split between the Asian and after Asian hours. Commodities has been a big growth driver. Our equity index derivatives has grown on the back of GDP growth in Asia, and also not forgetting our stock market, which obviously has seen great volumes in the last 12-18 months.
In terms of strategic partnerships, you have one with MSCI, you're expanding on that. Could we see more of these strategic partnerships with other indexes, with other index providers, with other exchanges?
We have a very collaborative mindset. MSCI is one important strategic partner. We also have an existing deepening and growing partnership with FTSE Russell. We also have a global listing board partnership with NASDAQ, also a technology partnership with them for over 20 years. And increasingly, we have now been able to do partnerships with other exchanges.
I'm curious to get your thoughts on the London Stock Exchange recently announcing it plans to launch an overnight trading platform called LSE24. What does that mean for the Singapore Exchange?
Well, for asset classes that has 24-hour feature, has got participants' demand, just like FX, we trade, as I said earlier, almost evenly split between Asian and non-Asian hours. For our broader derivatives, it's close to 24 hours. But I think for the stock market in general, in Asia, that's not heading towards longer hour at this point in time, because there's an FX component for you to set the trade if you are a dollar-based investor.
Right.
All right, Boon Chye, thank you so much for joining us today. Boon Chye Loh, he is the CEO of SGX, joining us in our New York studios on the Singapore Exchange, striking some new deals with MSCI, the index provider for derivatives, among other products and services.
Such a treat to have you here.
Yeah, we really appreciate it. I'm looking at the markets, Alexis, and there's not a whole lot going on here. It feels like people are kind of sitting on hold, waiting for developments over the weekend, maybe. The S&P unched.
waiting for the Fed next week, waiting for big tech earnings next week. There's a lot of reasons maybe to stay on the sidelines.
From New York, this is Bloomberg Intelligence on Bloomberg Radio.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
This is Bloomberg Intelligence with Alexis Christophers and Scarlett Fu and John Tucker. Paul Sweeney is off for the day. He's at the beach enjoying a long weekend. And Alexis and I were just talking about how we're both Amex card holders.
Yes.
And we're trying to figure out the most economical way of transferring rewards points to your airline account and not have to pay fees.
If you find a way to do that without paying fees, please do let me know. Because it varies on how much you're going to pay to do the transfer. But I feel like, there's a fee for almost everything you do.
You know what? You need to go on Reddit because the folks on Reddit have broken this down to a science.
I'm doing
have
it
all
after
the
the show.
details. Let's bring in Ben Elliott. He's our consumer finance analyst, and he's going to talk to us about American Express earnings. And Ben, a big part of what we're seeing from American Express is how much it spends on marketing these cards to Alexis, these cards to me. And, the Platinum card in particular is their big moneymaker because the fees are almost $800.
That's right. Yeah. So it's sort of a you got to spend money to make money scenario for Amex, right? And one of the challenges they're facing right now, which you can see in the response to earnings today, is that the expenses happen right away and the benefits take a year or two to flow through P&L. So one of the things that I saw that was very optimistic in the earnings was management guided towards higher card fee growth in the third quarter and then higher run rate exiting 2024. And that's just because mechanically, they raise people's card fees when they renew their card, right? So that's kind of on a rolling basis, and they're still raising card fees from the previous refresh of the Amex Plat. So that's going to keep rolling into P&L through next year, and that will make some of the elevated expenses look more palatable to investors, I think.
Ben, how is artificial intelligence part of the American Express story right now? And did they talk about it at all on the call?
They talked about it on the call. They talk about it quite a bit of regularity. Right now, I think the biggest impact they're seeing is they're just really a lot more efficient on the sort of the tech stack modernization effort that's been ongoing for a long time. But they would like to do things like agentic purchasing, AI travel agents, things like that. And they think that could add meaningfully to revenue and also be a big positive on the expense side.
Your colleague Nathan Dean is our senior policy analyst in Washington, and he's been writing about how there's this credit card competition act that hasn't made its way through Congress yet, but would supposedly require banks to offer 2 rival credit card networks to their merchants, and that could potentially be a threat to American Express, Visa, MasterCard. Is this something that the company is worried about, is kind of working around at this point, positioning itself in any way?
I don't think that they're particularly worried about it yet. I think that Nathan has some sort of tempered odds on that, but I don't know his latest odds. Amex, I think, is such a sort of like lifestyle brand, value proposition driven company that, if they had to, for instance, offer like a Visa or MasterCard branded card, it would impact the discount revenue sort of side of things, but I imagine that they would still try to drive users towards their Amex branded cards where they have the full economics, and they could do something like provide a more basic card on the Visa MasterCard network and provide kind of like the higher end, the real meat and potatoes of the business on their own proprietary network, and that might be an offset. And there's also all kinds of other different ways to add fees and find other revenue sources that aren't
one of those
contemplated.
fees be? I was talking to Scarlett off mic earlier about, let's say, for instance, you have a bunch of rewards points and you want to transfer them over to an airline that you fly often. Amex does charge you, at least in my experience, to make that transfer. I have to tell you, when you're paying, $800 a year for a card, that doesn't feel too good, Ben.
Yeah, I'm not sure exactly which program you're talking about, but the redemption rates.
I was trying to get miles over to Delta and was charged $99 to do it.
And she's outraged.
And I'm quietly outraged.
Interesting. I mean, that's like the flagship program. So I'm not exactly sure the scenario you're talking about, but I don't think that they would want to do something that sort of negatively impacted partners. So that's probably not the first fee that would be on the menu. But there are plenty of ways to bifurcate your audience and still provide what Amex does provide now, and then just have like some sort of add-on that meets any kind of new regulatory requirement.
I like the way he put that, bifurcate the audience, meaning if you upgrade to a better level Amex Delta card, maybe you won't be subject to the fees that you just experienced. And that kind of gets to the heart of it, right, Ben? I mean, they can slice and dice this in a very, very thin slices.
Yeah, everything's about the platinum. So anything they can do to drive more traffic to the platinum, I think will, in the end, actually be a net positive, even if, there's some sort of change in the business model and they have to serve, maybe a lower FICO borrower, maybe a broader audience. I don't think it will affect the core audience who likes what they have right now, and they're happy to keep paying more for it.
And just very quickly, for the American Express card holders, like maybe those who come in on the introductory card, like the, blue card, do they tend to stick with Amex? So they kind of go along with the brand and make it all the way to platinum?
Yes, I think 75% of new customers are coming onto a fee-paying card already from the get-go. 65% of those are Gen Z and millennial, and the company sees a gigantic lifetime value in those consumers.
Gotcha.
And an explicit goal is to get those people to spend more over their lifetime, and retention rates are crazy high.
Yeah.
On the Amex Plat, it's like almost 100%. So people basically never give up their card once they get it.
Ben Elliott, Bloomberg Intelligence consumer finance analyst. We could do 2 hours on this.
We could. Just on
there's
airline miles
outrage,
alone.
there's excitement. Yeah. Get him on a Reddit forum. Thank you so much, Ben Elliott. All right, for our listeners in the U.S., a reminder, listen to us via satellite radio on Sirius XM channel 121. It is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research because the next hour of Bloomberg Intelligence with Alexis Christoforous, Scarlett Fu, and John Tucker begins right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Friday morning. This is Bloomberg Intelligence, broadcasting live from the Bloomberg Interactive Broker Studio in Midtown Manhattan. We are Alexis Christoforous, Scarlett Fu, and John Tucker with you for the second hour of BI. Paul Sweeney is off for the day. There's not a whole lot going on in equities in that we've kind of hugged the unchanged line for a while now. The S&P modestly higher, the NASDAQ modestly lower. So we've got a lot of other things to talk about, starting with the universities. Women's scholarships are facing pullback at universities as well as companies. Simone Foxman will be joining us to talk about that. She's a member of our equality team. Tom Keene will make a comeback to the radio studio.
I spend every weekday morning with the man, so I'm glad.
And so you know that he's out of the office by some time.
I survived, but of course he's here on Fridays because of the show with you, Scarlett.
That's right. Yeah. And Bloomberg Money airs every Friday at 12 p.m. noon time on Bloomberg Television, and Tom will join us to talk about what's on tap for Bloomberg Money this week. Michelle Kasky will join us because it is Munis in Focus this Friday as well. New Jersey Transit managed to avoid a World Cup meltdown. John Tucker, did you know that?
I'm surprised by it, but, you know, as somebody who commutes on a regular basis, you'd have to go to Paul Sweeney for that.
You survived the World Cup
No, I got to drive because I get here so early. There's no
mass transit. Once in a while, you feel the impact of the New Jersey Transit.
Oh, absolutely.
There's no one I go to more than John Tucker for all things New Jersey. He knows everything.
And gas prices. This we know.
$4.26 at the Wawa. $4.26 a gallon.
Oh, John Tucker is just a font of information. Kunjan Sobhani will join us as well to recap Intel's earnings. But first, let's go back to John for a check of these markets. I wrote them off as not much going on, but there is a lot of news under the surface.
I should point out, like, the volumes are kind of, you know, anemic for this time of day. Let's start with the earnings report card so far this earnings season. 85% of the S&P 500 constituents that are reported so far exceeding profit estimates. This is actually the highest proportion in 5 years. But so what? They may be getting overshadowed by worries about all the AI spending and some of the economic growth. The next big test, of course, you talked about it earlier when some of the biggest tech firms report next week. Digital Reality Trust. Let's start there. The best performing stock at the S&P 500. This is a data center REIT. Those shares, they are up right now over 12%. And then you got to do Intel, most active, down 3.8%, despite really good results. The company's data center segment, those sales soared 59% last quarter, driven by the build-out of data centers. Meantime, Keith Lerner at Truist Advisors says the tech-led sell-off we've seen marks a pretty healthy rotation.
Listen, even yesterday, you know, we had that, you know, some big cap tech names down a lot. And then you looked at the board yesterday, you had energy up, you had industrials up, you had financials up, you had healthcare up. So I think we're still seeing this big move up.
Right now, the S&P 500, 28 points higher. That's up 0.3%, 74.28 on the index. The Dow up 147 points, and the Nasdaq Composite Index down to 80 points. That's a decline of 0.3%. Consider this one, this story that's on the Bloomberg right now. The Centers for Disease Control and Prevention reporting a total of 2,318 confirmed measles infections today. This passes last year's total 2,200 cases.
Not good.
The highest level since 1991. 43 states and Washington, D.C. have reported at least one infection this year. Of course, the vaccine policy has been upended since Robert F. Kennedy Jr. became a Secretary of Health and Human Services. So, I mean, just consider that. It doesn't need any commentary. Just, there are the facts and figures as reported by the CDC. We check the markets and other stuff for you right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Alexis.
Just to follow on that, I'm reading this in the Bloomberg News story, which again, it cites the CDC. Measles is highly contagious. 9 out of 10 unvaccinated people who come into contact with the disease will be infected. 90%.
Yeah, and not to mention the deaths that we saw also,
Right.
especially vulnerable are kids.
Yeah, vulnerable population. Thanks for
Okay.
that, John.
On that note, let's take a look at what's moving in the equity market. The S&P up by 0.25%, the Nasdaq down by 1/3 of 1%. Avalon Purnell is our Bloomberg News equities reporter, and she joins us in studio. What's on your radar?
Well, we have to start off with Booz Allen. That's ticker BAH. It's currently climbing about 14% for most intraday since 2012. And that's after the defense contractor reported first quarter profit that was much better than estimates. Jefferies analysts saying that Booz Allen's beat on the bottom line was really driven by better labor performance. She also highlighted that the firm really got to push back on the market perception that AI is a potential headwind for the company by noting instead how their recent investments in AI are actually driving award wins with the government.
All right, we had a really nice spirited conversation with Ben Elliott just a little while ago, our consumer finance analyst, about American Express, because, I mean, for all intents and purposes, this was a nice, solid earnings report, but the stock is under pressure.
And Alexis is outraged.
And I'm, well, they have to stop charging me to transfer my points over to an airline. I feel like I'm paying fees left and right.
That is a very good point. That's a ticker AXP, and it's currently dropping about 5.6% most since February. And that's partially because the credit card issuer did report that their net card fees and also revenue fell a little bit short of those expectations. Amex also reported that the total expenses this quarter were a little bit higher than forecast as well. I'm curious if that has anything to do with some of the offerings on their cards.
You got to pay more to get more, right? You got to pay to market to those customers and then get them to sign up.
That's how you know it's exclusive, Alexis.
Oh, is that what I'm paying for? The exclusivity. Thank you, Scarlett.
Okay, all right. Go on, Avalon. What's your last one?
Last one is Tenet Healthcare. That's ticker THC. It's currently soaring about 22% for its biggest intraday leap since 2020. And that's after the hospital operator really shook off investor fears by posting a beat and raise quarter that exceeded expectations nearly across the board. Going into the print, a lot of investors were concerned about potential headwinds, especially from the drops in enrollment from the Affordable Care Act, subsidies expiring at the start of the year. Instead, a lot of them pointing out about how good the cost management was, Leering saying that the cost controls were very impressive this quarter, and also noted that the stock continues to remain too inexpensive relative to the growth and risk for this company. Worth noting its peer is only up a little bit since they did point out that the ACA is one headwind for them.
Sure.
All right, good stuff. Avalon, thank you so much. Avalon Purnell is our Bloomberg News equities reporter. And for more conversations like what you just heard, be sure to subscribe to our Stock Movers reports, 5-minute audio reports on the biggest winners and losers in the stock market. Stock Movers is available on Apple Podcasts, Spotify, or anywhere you listen. All right, Alexis, this story got my attention.
Me too.
Women's scholarships are facing pullbacks at universities and companies as well. And the reason why is because no one wants to get on the Trump administration's radar.
They don't want to get on his bad side, in essence.
Exactly.
And we're seeing universities sort of going through it. A lot of research has been pulled, so a lot of medical research not happening at universities at the moment. And now women's scholarships seem to be the next target.
Simone Foxman is our reporter for our equality team, and she's been writing about this. Simone, just give us some examples of what you've collected in your reporting.
Well, it's interesting and it's hard to find some of these. So it was as much a challenge searching for them because many companies especially will just sort of do away with scholarship programs. They won't renew them for a year, and so you'll have to kind of go find records. So we found, examples, especially in science and technology, the likes of Google, Palantir, and on campus, you do get a little bit more attention to these sorts of things. So Rensselaer Polytechnic Institute getting rid of its Women's Leadership Scholarship, Middlebury saying that it ended a scholarship program that provided as much as $25,000 to students in its Bold Scholars program. But really, the list goes on, and it kind of depends how large these things are. In some cases, you have Fordham getting rid of language on a club's website saying that it was for women, really emphasizing that it was open to anyone who wants to come in a women in business club. MIT doing the same thing, where some people getting rid of actual endowed sort of scholarships that are meant for women, saying they have to go to everyone now.
Simone, is part of it that the people and the organizations who were giving to these scholarships are the ones pulling back? Is it the university saying, hey, we don't want to offer these scholarships in the same way, or is it a combination?
It's a combination of all of them. Certainly there's fear. For example, at RPI, we understood that the administration was very worried both about the Supreme Court's decision on affirmative action, as well as the Trump's executive orders. They kind of gave a smattering of different concerns to students who were upset that the Women's Leadership Scholarship was going away for new students starting this fall. But it seemed like a bunch of different things, right? And in other cases, perhaps you do have companies who say, well, we see a lot of legal riskiness around scholarships for any specific identity group, or maybe this is not the best way to foster women. But certainly, I think at least part of this is legal risk. I think you look at Google as a great example. They phased out their women's scholarships in the United States and in Canada a couple years ago, but left them for other countries. So they're still available for women in Ireland, for example, but not necessarily in the US and North America. So you really have to wonder, okay, well, if you're a company doing away with the scholarship, and again, most of these aren't like widely announced, are you doing it because you're worried about the legal risk, or because you truly think that you need to do a different program or means of recruiting different kinds of candidates?
All right, Simone Foxman, thank you so much. Reporter for our Bloomberg News Equality team, on how companies as well as universities are pulling back on women's scholarships, eager to avoid scrutiny from the Trump administration, which has basically come down pretty hard on the higher education sector as a whole.
Yeah, but to be fair, single-sex scholarships administered by colleges, they've sort of been under fire over the years, right? Because of under Title IX,
Yes.
So it's not a Trump administration specific thing,
but it's accelerated.
But it's definitely heightened now, for sure.
All right. On that note, Tom Keene is back in the radio studio. He is, of course, of Bloomberg Surveillance and now of Bloomberg Money. We co-host the Bloomberg Money Show every Friday at 12 noon Eastern Time on Bloomberg Television. And Tom, I know you pay a lot of attention to the news in higher education, and we're going to be speaking with someone about education savings plans.
Someone with immense energy about the train wreck, which is American education. Tricia Scarlett is in the absolute trenches of this. It's JP Morgan Asset Management, and it's, the usual drill, saving 529s and all that, but it's way more the shock and awe of what the cost has become.
I mean, what is the average now? Is it, I hope the average isn't 70,000. I don't know if I read that somewhere.
Well, we know that some schools, NYU, USC, are now like $100,000 a year all in when you include tuition and room and board.
The private schools, for sure, yeah.
Absolutely. I don't know what on average it is, and they always say that the sticker price is different from what a lot of people pay, but there are plenty of people in our audience
who pay for the full
thing.
It's a full,
Somebody says, why are we doing this in the summer? And I said, the people always that ask that don't have kids. And
there you go.
I mean, it's 12 months a year, and you're already planning, and they start August 20th, and should I have a TV in my dorm room? Important stuff. I never had a TV.
What about an air conditioner? Weren't you sweating your buns off?
I had no air condition. I was in Boulder, Colorado, and it was no air conditioning. And it was not like the heat now, but it was bad.
You didn't have anyone doing your laundry.
Nobody
because now
had
you
your
can do
laundry.
that now too.
But you only went to college with 2 pair of blue jeans, and you only wore one of them. So there was no laundry. Ed Giardini, I was just up in the food court, and he's chowing down. I mean, Ed Giardini.
He came early for the food.
He's here came early for the pretzels and the Cheez-Its. But to have Ed Giardini with us, given the market turmoil, Scarlett's going to be great.
He's the guy who coined the term bond vigilantes, isn't he?
We're not going to open with that, but we'll talk about it. We have to, because this week felt very bond vigilante-ish.
Yes, there's a sell-off in global bonds. It's not just the U.S., it's the U.K. as well. And this comes ahead of a big, big week for central banks. So, a lot could change quickly.
Yeah, oil coming down probably helped the situation as well.
Just for today, though.
Yeah, we have a special treat, too, which I must mention. If you're lucky and you go to college, you're in a classroom with the most famous person in the field. Young Scarlett Fu was in class with Barry Strauss.
History professor.
And we will talk about the Odyssey.
Oh, you saw it, you said, Scarlett.
I did see it.
Tom and I have not seen this yet. I have to
Totally worth
carve
the 3 hours. I was a little bit skeptical going in. I was thinking, 3 hours.
But
can I
here's
do
my
this?
question. Did you see it in 70 millimeter IMAX?
No,
Okay,
because
see,
it's
hard
really
to get
difficult.
a ticket.
Yes,
I know,
yeah,
I know,
exactly.
here in New York City. So I might just have to suck it up and go see it.
Who's the guy that was in The Bear, the actor?
John Bernthal.
Yeah, how did John Bernthal do?
Well, he was very bald and very ripped.
Okay.
In the Odyssey, in contrast to him having a lot of hair and
That's
being
like
kind of
when John
manic
Tucker
in the
comes
Bear.
in the studio.
Very
Yeah,
bald and very
exactly.
ripped.
Yeah, that's it.
So you guys are talking the Odyssey on today's show?
We
Yes,
are.
we
We
are.
are. Because a
I'm
lot of
tuning in.
people have been, you could have bought the IMAX tickets to the Odyssey a year in advance.
Yes.
Because people were so looking forward to seeing Chris Nolan's treatment of the Odyssey. And people were doing that, and they're like booking their flights to
Yeah,
come to
but
New York to do that.
To Alexa's
It was an
good
investment.
question, part of what we're doing on Bloomberg Money is aspiration. Like, what's an IMAX ticket cost?
$40?
$40, $50.
About double what a
But
normal
I
one
mean,
would.
someone would buy it and then sell
People
it on the secondary
aspire to
market.
do IMAX. It's summer. They're certainly bringing in a lot of money. Plus, Scarlett Fu's a celebrity lodestone.
So I think you can get. I think you can get one, Scarlett. But they had a really great box office weekend last weekend. They debuted and already.
Yeah,
I
they
think
made their money back.
globally they made the money back that they
Yeah.
spent on the movie. It was a $250 million
Yes.
budget, and they made more than that at the global box office.
I do have some issues with, just the way that the movie progressed. Everyone has an American accent, which is fine. Robert
We
Pattinson
talked
with
about
an
that on
American accent is a
Surveillance.
little bit weird.
But what we did say, when you think about it, they wouldn't have been speaking British back in AD
True.
whatever. This took place BC whatever. What is BC?
A long
I
time
forgot
ago,
my
a long
centuries
freaking
wrong. But
time ago.
listen, they would have been talking ancient Greek. Nobody's doing that.
Right,
So.
but also the son would call Matt Damon, who played his dad, Odysseus, Dad, which I thought was really weird. Like,
Very colloquial.
why not say father? Why say dad?
I don't know what Chris Nolan's doing
John,
with that
we don't
decision.
have these deep discussions early in the morning.
This is like too deep for me.
Really, I've spent hours talking about this.
All
with
right, wait.
people.
Who was your favorite actor in the movie? I'm taking like a little poll.
I do like Matt Damon. I thought he did a great
did?
job.
Okay,
yes.
okay.
And I think he came into this kind of like the right guy because he's an every guy, but he's also can be kind of a jerk sometimes and kind of full of himself sometimes. And he threaded that needle really well.
You hear that?
Do you know that right now there's someone on the Pennsylvania Turnpike making the big turn at Altoona? Listen to this going, this is a business station.
I
Why
know.
are we talking
Well,
about
there's
Matt
a lot of money
Damon?
attached to this.
Business of movies.
Yes.
It's big.
Matt Damon's IMDb, by the way, there's like 100 movies on there. He's been very productive.
And when is he not making a movie is my question.
Exactly.
And Anne Hathaway, she had the Prada, Devils Wears Prada 2. Now she's in the Odyssey. They're everywhere, Tom. I don't know. I can't keep up.
All right, well, Bloomberg Money with Tom Keene and Scarlett Fu airing every Friday at 12 noon Eastern Time. Be sure to tune in.
Be sure to tune in,
We're
guys.
going to talk
You
about
always
the
learn
Odyssey
something
and
new
other
on
real
the show.
things.
I have to say, and it's news you can use.
Thank you. I mean, inflation is like a consistent topic because every day, every week, there's like a new point of evidence about prices not coming down. And that continues today.
Filtering through the economy. for sure.
Absolutely. All right, we have the S&P 500 in the green, up 0.5%. This is Bloomberg Intelligence on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver information guide and learn how to add metals to your IRA or 401k tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. S&P 500 on track for its first back-to-back weekly loss since the early stages of the Iran war. Now, Intel delivering a revenue forecast. It shattered Wall Street estimates. So booming data center spending fueling its long-awaited turnaround. The data center segment, those sales soared 59% last quarter, and it was driven by the worldwide build-out of data centers that power AI. But the shares, part of a broader chip sell-off, Intel is down right now 3.2%. All 11 major industry groups in the S&P 500 right now, 10 of the 11 are higher, led by real estate. That is home to data center REIT Digital Realty Trust. In fact, it's the best performing stock in the S&P 500 right now, up close to 15%. And then you have information technology, the only group that's down right now. The semiconductor stocks live there. And the Philadelphia Stock Exchange Semiconductor Index down today 2.8%. Overall, the S&P 500 up 39 points, 74.47 on the index. The Dow up 328 points. That's a rise of about 0.6%. And the Nasdaq Composite Index right now 5 points lower. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That is your Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM insured municipal bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength, build a stronger tomorrow with BAM Mutual. For today's Munis in Focus, we're going to talk about New Jersey Transit. Paul Sweeney is not here, so I'm taking up the mantle for New Jersey right now. And John Tucker, did I just see a fist pump from you?
Oh, yeah.
Okay.
Well, anything New Jersey is.
Right. We should just take a shot every time someone says New Jersey on this show. It comes up quite often. And that's just on air, off air, too.
Okay.
But New Jersey Transit is the rail system that links New Jersey, the state, with New York City. Commuters like Paul are very familiar with it. And it played a starring role in the World Cup this summer, Alexis, because if you wanted to go see the game at New York, New Jersey Stadium, which is what they call it.
We call it Giant Stadium.
Well, exactly.
Well, yeah, he's really going back. John's really going back by referring to it as Giant Stadium. But
yeah, the Jets play there, but who cares?
MetLife Now, or New York, New Jersey Stadium, according to FIFA, you had to use New Jersey Transit if you wanted to use public transit.
Right. And then I think get a shuttle when you got off because you couldn't. Right?
Well, that was you could take buses or New Jersey. That was the only way to get to the stadium.
Okay, because you couldn't drive there and then go and park there. That was the whole thing. And it seemed like a mess looking from the outside in.
And it cost a lot of money, too, because they really charged people quite a bit for that round trip. Michelle Kasky is our Bloomberg News reporter. And Michelle, before the World Cup, there were weeks and months of hand-wringing over whether New Jersey Transit could handle the volume of people going to these games. It would have to add new trains during the weekends and during midday to accommodate all these folks going to the games. And people were just getting ready to predict it would be kind of a mess. Did it end up being a mess at all?
Yeah, that's right. It was before the World Cup kicked off. A lot of people were very skeptical that this could really get pulled off, that they could do this and get so many spectators to MetLife for 8 separate matches. And they did it. There weren't any major delays or any major system-wide meltdowns. They were able to do it. So kudos to New Jersey Transit for that. But regular commuters did have to deal with some serious alterations.
Michelle, let's talk about the bottom line, though, right? Because both states actually spent a lot of money prior to the World Cup to get the infrastructure right. And I'm wondering if the ticket sales for these, because they did definitely get bumped up. I think FIFA did that. Did that outpace how much was actually spent on trying to get things up to speed.
Yeah, these are the numbers that New Jersey Transit is still crunching and trying to get the final tally on. But before the World Cup and during the World Cup, they were estimating that the cost of providing this extra World Cup service would be roughly about 32 million. It was actually higher, it was 48, but then they were able to get that down to 32 million with some corporate sponsorships and some federal funds. But it looks like, given the ridership numbers during the World Cup, that they only collected about 18 million from World Cup transit riders. So you've got a shortfall there. Now, those are very rough numbers. Like I said, they're still trying to figure out, the official tally. We'll find that out in the next couple of weeks or so, but probably they're going to come up a little short. But again, New Jersey Transit they just approved a $3 billion budget. So I think they'll be able to figure out this shortfall.
Does that preclude having the regular commuters make up the difference?
Good question.
They during the World Cup, it was World Cup riders that paid $98 round trip to get to MetLife. So they did increase the cost dramatically for World Cup fans. But we'll see. We'll see how they work this out. We'll see exactly how much of that of a deficit there is there, and if it's going to. I mean, every year now, New Jersey Transit riders will experience a fare increase. It's going to be. It's a regular annual increase now after a number of years of no increases. So the fare did increase on July 1st, roughly about 3%. And every year they're going to continue to do that, increase the fares by no more than 3%.
But the good thing is that the World Cup people were happy. The daily commuters,
Oh, is that where the priority lies? Okay.
Yeah.
Oh, am I being, do I sound cynical?
Just a wee bit.
Okay, John Tucker on his soapbox.
Yeah.
Michelle,
yeah, definitely the regular commuters had to deal with the fact that one of the biggest challenges was that there was no service from Penn Station, New York Penn Station, to New Jersey for roughly about 4 hours before each match. So on 8 separate days, you had this 4-hour window where you could not catch a train from Penn Station to get you to New Jersey.
And I think Paul Sweeney had to take a ferry.
Yeah, he had to come up with alternate routes.
Right.
And
I had to drive, and they closed down a bunch of roads, so you're stuck in traffic. But there, the bus to the in New Jersey Transit, they're running fine.
That's your view
for
from on the ground with
people
John
who
Tucker.
visit the city.
John Tucker's not bitter. He's fine with everything.
Every 10 years.
Michelle Kasky, thank you so much.
Am I
Michelle
bitter?
Kasky, our Bloomberg News reporter on Munis. No, you're not bitter at all.
I'm just saying.
Yeah, of course. You're just pointing out facts. Thank you. Thank you for pointing out these facts. That's our Munis in Focus for this Friday. Let's get back to corporate news and earnings. We got Intel's results yesterday. I need to save us from John's wrath towards New Jersey.
Well, first you had to listen to Alexis about our credit card. So
No. It's okay. We can air our grievances. It's Grievance Friday.
This is
It's the airing of the grievances right now. Let's talk a little bit about Intel, because Intel shares are down about 4%. And Alexis, you were pointing out earlier that the outlook was good and the results looked decent, and yet the stock, however, is not responding.
It was higher in the pre-market when I was doing the flashes on surveillance, talking about how Intel was rallying. And then once regular trading started, stock is down.
All right, so let's check in with Kunjan Shabani. He is our senior semiconductor analyst joining us from San Francisco. Kunjan, explain to us what happened between the pre-market and the start of regular trading when things looked fairly good for Intel, and now clearly the market does not like everything it sees with the latest set of results.
From our perspective, we liked everything we saw. After quarters and quarters of facing hurdles and missteps, this was finally the most cleanest positive quarter from a fundamental perspective. They beat on all metrics, but more important than that, they showcased a lot of confidence in the foundry progress that they're making. If I had to guess what just a reaction of few hours since the market has opened could be just because some folks are not liking the higher spending, which is going to be a headwind to the free cash flow, right? So if you add on everything positive that's happening, they were finally now getting to a free cash flow, which people were liking, but this additional spending is again going to put a pause, and a lot of investors have been waiting to get this positive free cash flow. But other than that, fundamentally, everything looks really good.
You know, earlier we were talking with Dan Ives about this and about the hyperscalers that are going to be reporting next week. And I'm curious, is there anything they can say with regards to CapEx spending on AI that would please this market? Because you would think if they're spending too little, the market might not like it. If they're spending too much, the market doesn't seem to like it.
Well, you got it spot on, right? The investors and shareholders of those hyperscalers don't like it when they spend a lot of money. But the investors for the semi guys that I cover should like that higher number. In fact, I mean, if we don't get a much higher number, those investors might not like for the names of NVIDIA, AMD, Intel, and so forth. Because remember, the higher the capex for the hyperscalers, that means the better the probability of upside for the semiconductor guys that I cover.
So, Kunjan, would you say that the U.S. government owning a stake in Intel has been unequivocally good for the company and the stock?
I mean, I don't see any direct correlation there. Like, they haven't done anything except for, investment, just bringing in the liquidity and the cash flow. There's definitely that credibility that, government likely won't let Intel fall. But I think I would not give them a lot more credit for what we are seeing in the stock. It has all been execution since the new CEO coming in. And we are now seeing the fruits of that discipline and the execution finally showing up.
I was looking a little more into the report and also just taking a look at what some analysts had to say. So Intel, this is their strongest revenue growth in more than 15 years. This is according to a Citi analyst. And is it all AI that's driving that right now? Is it diversified in any way?
Well, it's mostly AI because, again, they're in the compute business, right? And anyone who is in that proportion of business, it's mostly AI. I think they reported a number that now 70% of their total revenue in this quarter was AI exposed or AI related in some shape or form. But more importantly, what's driving it, the tide is lifting all boats. Everyone's enjoying that. But really what the goodness came out in this quarter was, again, their execution on the foundry end, their yields are getting better, costs are coming down. It's a supply constrained environment everywhere else, and Intel has its own supply. So when they're able to bring up more volume, they're able to sell more parts and drive higher revenue and charge a lot more because, again, supply constraints. So any new volume that they bring up, they're able to right now charge a lot more higher prices.
Got it. All right, Kunjan, thank you so much. Kunjan Sobhani is our senior semiconductor analyst on Intel. Breaking news, Alexis. LeBron James has chosen to sign with the Philadelphia 76ers over the Cleveland Cavaliers as a free agent. He is signing a 2-year, $8 million deal with the Sixers. They've been considered the winners of the offseason because they swapped Paul George for Jaylen Brown.
Wow, the wait is over because it took them over 3 weeks to make that decision. Miami Heat was also one of the teams that was in contention, but looks like it's going to be LeBron and the 76ers.
And he says on X, I believe I can make this Philadelphia 76ers a championship team. I'm so excited.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Right now, the major averages, they are mixed. Let me start with the most active. Intel's years-long effort to revive its chips business actually paying off. The tech giant delivering a revenue forecast well ahead of expectations. Of course, they reported after close last night. But shares today, they're down, and that reflects a broader sell-off in the chip stocks. The Philadelphia Stock Exchange Semiconductor Index, the SOX, down 2.6% right now. Traders also getting ready for next week's reports from the mega caps, including Microsoft, Meta, Apple, and Amazon, right?
Amazon, you got it.
Yeah, Wall Street's been looking for more convincing evidence that all that AI spend, the CapEx, to generate new growth rather than just, weighing on the profits. And ahead of next week's Fed meeting, we've got to take that into consideration, too. Joe Lavorgna at SMBC Nikko Securities says the inflation fight is far from over.
It's not going to fall unless something happens. And in the past, it's always been the Fed needs to increase interest rates and raise the price of credit and money. As you could say as much as you want, it's going to go back to 2, but the words alone aren't going to do it.
Right now, the S&P 500, 41 points higher. That is up 0.6%. And real estate is actually the best performing industry group in the S&P 500, 7450 on the index. The Dow Jones Industrial Average up 372 points. That's a rise of 72.7%. And you also have the NASDAQ Composite Index. That has turned higher, right now 21 points higher, up just about 0.1%. What, you read that statement from LeBron before. What did he say?
Yes, he says, another championship. I believe I can help make the Philadelphia 76ers a championship team, and I'm so excited to.
Okay, and how many I's are in the word team, Scarlett?
There are no I's.
You got
in
my
team.
blood boiling now.
Yeah.
It's just like, what kind of statement is that? It's the team, not I, me, I.
There are 4 or 5 I's in that tweet or X post that he.
I'll argue one of the things about the Knicks, the championship team. It's just like a great bunch of guys.
And they worked well
this
together.
year,
They gelled as a team. And look, I know the 76ers are going to be playing the New York Knicks now with LeBron James on there. But all I have to say is no one can guard Brunson. Thank you.
There you go.
Oh, wow.
Okay.
All right.
I said it here, right now. I said it already for the next
Said it
season.
with conviction. Thank you, Alexis.
We check the markets and occasionally sports. Don't you love it when I do sports? Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett to Alexis. Happy Friday, by the way.
Happy
We
Friday.
made it. Yeah, all
I'm
of
outta
us, to
here.
everybody.
John
Happy
Tucker
Friday.
does not hold back, and that's what we love about him.
I'm in so much trouble.
Very
I'm
endearing.
going to get beat up by LeBron.
He's
could
coming
be.
after you.
Yeah.
41 years old and all. He's coming after you.
You know, he's going to be close to you because you're in Jersey. He's in Philadelphia.
Not that close.
All right. You know what's happened today is we've got a turnaround in the markets because yesterday was all about surging bond yields, was all about equities in the red. And today we're seeing a reversal. And the 30-year yield, it's worth noting, though, is still above 5%, well above 5% at 5.13%. The 10-year yield at 4.65%. RJ Gallo is CIO of Global Fixed Income Group, Federated Hermes, joining us from Pittsburgh, Pennsylvania. RJ, thanks for joining us. And let's just get your take, first of all, on what we've seen. What John thought I was going to ask
You
about.
were going to get his take on LeBron.
I thought
well,
about
Pittsburgh, though.
I thought about it. So, RJ, any thoughts on LeBron joining the 76ers?
Well, Pittsburgh does not have an NBA team, so I guess the closest proximate team might actually be the 76ers. So I say it's a good news. We'll take it for the state of Pennsylvania.
They'll take it for the state of Pennsylvania, John. There you go.
RJ is part of a team, by the way.
There he certainly is.
And the Pittsburgh Steelers, they're a little closer to the hearts of Pittsburghers like myself. But that's a season that has not yet
All
begun.
right. We'll talk
we gotta
football
wait
with him
on
next time.
All right.
That's right.
Let's get back to the bond market because I want to get your sense about what we have seen, these rising bond yields around the world, which happens every so often. It happened back in May. It happened this week as well. Was this a temporary freakout, or do you think that the increasing frequency of these surging bond yields is the start of a broader regime change?
Oh, it's a great question. I think in the most immediate sense, the war that everybody thought should have been over by now, including President Trump, has a lot to do with the backup in global bond yields just in the last week or so. The re-intensification of the fighting was not what was priced into the market, and as a result, higher oil prices, higher bond yields is what you have as the fighting has heated back up. I think bigger picture, however, you touch on I think a general concern in the global bond markets. The amount of outstanding debt is much greater now in the wake of the pandemic and all the pandemic-related responses that led to large fiscal deficits both here and abroad. That should lead to higher term premia, should help drive nominal yields to higher levels, or likely to stay at higher levels in the post-pandemic environment, certainly relative to what happened before the pandemic. Going forward, we think that from a bond investor standpoint, that's actually a healthy thing. I mean, if you can get the 10-year Treasury yield close to 470, is currently at 465, the 30-year is well north of 5%. This should be attracting capital into fixed income that should be rewarded in the sense of greater income accruals from these higher yields, not necessarily just looking for bond price changes to drive your total return. So it's probably a good thing for bond investors to have higher nominal and real yields going forward. It'll help boost returns after what has been a relatively weak return environment over the last few years.
RJ, I'd love to get your thoughts on these bond sales that are being fueled by companies needing to raise money for their AI ambitions. Today, we found out BlackRock kicked off U.S. high-grade bond sale that's tied to Meta. We've seen Google's Alphabet do this, many others. I guess the question is the demand there to meet these bond sales, because they're happening more often now?
Well, so far, the answer to your question is yes. The demand has been strong. Generally speaking, credit spreads in investment grade and high yield are tighter year to date, despite the fact that issuance has been heavy in many forms, including debt and equity capital from the hyperscalers. And we've also seen issuance in asset-backed securities and in high yield markets that are related to the CapEx build-out. And the marketplace has taken these deals down without much of a hiccup at all. I do think the more recent series of events are worth highlighting. You know, up till now, the story has been about strong issuance, debt, and equity to finance the AI CapEx build-out. I do think it's interesting to see the response to Alphabet's earnings, some news from Tesla. You know, as you now see the hyperscalers shift from free cash flow positive, very strong credits, to free cash flow negative, in the sense that they actually need to come to the capital markets to finance these capital expenditures. Their free cash is not sufficient to finance the build out. You know, that is a change in tone. And I think that the marketplace is keenly focused on whether or not we will see realized investment return from all this CapEx, and when will we get signals as to that. So any signs in the earnings releases that you know, we're going to be focusing more on the CapEx and not enough on the returns, you know, that could be the incentive for spreads to widen a little bit. And we've seen that over the last week or so in relation to the AI story.
So very quickly, RJ, before we let you go, what will you be listening for from the hyperscalers that report next week, the Microsofts, the Metas, the Amazons, when it comes to CapEx and even more importantly, the returns that their ROI on the investments they have made?
Yeah, the ROI story, you know, in a timing sense, probably will not become clear enough in calendar 2026. It's really more of a calendar 2027 event. So I think the focus in the near term will be CapEx plans that will be shared in the earnings releases. And if there's any comment on their front about adoption and, you know, take up, if you will, from underlying paying customers, where revenue, in fact, is being generated from some of the early CapEx that has already been put in place. So I think for now, the market is very focused on the borrowing, yet is going to be searching for any signal whatsoever about the payout, about the ROI from all this CapEx. Sadly, I don't think we're going to get much of it. That leaves us vulnerable. It leaves us vulnerable to another DeepSeek kind of moment. You know, recently we had some news coming out from another Chinese AI provider. Are other models going to come out that will actually be cheaper and more competitive? And that could really pressure spreads wider if that's the case.
RJ Gallo, CIO of Global Fixed Income Group at Federated Hermes, joining us from Pittsburgh, Pennsylvania. The Bloomberg Intelligence program. We'll come back right after this. We have the S&P 500 up 0.5%.
You're listening to Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Alexis Christoforous in for Paul Sweeney, who has the day off, along with Scarlett Fu here. It is 11:53 on Wall Street, and we want to talk about Charter Communications, because this stock taking it on the chin today, down about 6.5% after its quarterly earnings report. We want to dig in a little more with Geetha Ranganathan, U.S. media analyst for Bloomberg Intelligence, and she joins us from our Princeton, New Jersey office. Geetha, always good to see you. I guess the top line here is they did it again. Revenue declining once again at Charter as subscriber growth continues to slide. What else in this report did Wall Street not like?
Thanks so much, Alexis, for having me. So really, this story is, we've seen this movie before, and just the story just keeps getting worse and worse every quarter. So, Charter, as you may know, is going to very soon be the largest broadband provider in the United States after it closes on its Cox deal, which will happen in the next couple of weeks' time. And really, the story for this company has been this persistent loss in broadband subscriptions. And what Wall Street did not like this quarter was that not only did we see a deterioration in those subscriber trends, which was losses much worse than what we had initially projected, but also along with that, we are seeing this tremendous pressure on broadband ARPU, which is causing declines in EBITDA. And so just, as you kind of think about the growth outlook for this company over the next few years, there is just no turnaround in sight, and that is making investors extremely nervous.
Now, there were bright spots here. No, I mean, they did add, I guess, subscribers on the mobility end of things. How's that going?
Yeah, so, this is a story that we're seeing across a lot of the cable providers. So both Charter and Comcast introducing their mobile product, which is Spectrum Mobile and Xfinity Mobile. And we've seen a lot of success with this. And really what these cable providers have done very creatively is that they're bundling their mobile solutions with broadband. Really, the big picture here is they're trying to retain those broadband subscribers as well as attract new ones by bundling in mobile. And people kind of like that, so that you do have quite a few new subscribers kind of signing on, because if you actually look at the market out there, the wireless market, Spectrum Mobile is priced very, very competitively, much more competitively than the big three, and that is what is helping them kind of gain subscribers. But remember, they have about 10 to 12 million subscribers versus, we're comparing it with Verizon and AT&T and T-Mobile, which have hundreds of millions of subscribers. So, again, it's small potatoes, but yes, there are some bright spots.
What about some of its competitors? I mean, I guess we heard from Comcast this week, quite a different story, but then I guess you could also argue Comcast is a lot more diversified than a Charter Communications.
Yeah, so actually for Comcast, they're, it's kind of ironic, Alexis, because they've always been punished because they were not a pure play cable company. They had this media operation with NBC, which they never really got credit for. And actually, in order to kind of simplify the story, and get more value for their media business, they announced that they will be separating out those media operations, which will happen sometime in 2027. But you have the cable business that has really come under tremendous pressure, and we're seeing that both, with Comcast as well as Charter. Comcast is slightly better because, again, they have that diversification, as you pointed out, with media. But cable valuations, if you just track them over the past 4 years, Alexis, I mean, they've basically gone down by 50%. So right now we're under 5%, historical lows. And the problem is that the story is not getting any better. So with the emergence of Starlink and the possibility of having much greater competition in the broadband landscape, the story just gets so much more complicated and muddied for both Comcast and Charter.
I'm just looking at its service area. Charter Communications provides a service across 41 states, including much of New York, California, Texas, Florida. And I'm taking a look at the stock right now, Geetha, down about 69% year to date. I mean, is it a possibility here that Charter Communications either tries to sell off some parts of the business or just gets bought out in the next couple of years?
Excellent question. And this is what all of us have kind of been, scratching our heads with. So one of the things that came out of the Comcast's decision to separate out its NBC media business is the fact that now the remaining business will be a pure play cable company, a clean cable company. And that kind of sets the stage for a potential, M&A deal with Charter. So remember, there is really no regional overlap. With this, both Comcast and Charter will have that national footprint. And really what investors are banking on is that a combined company with roughly about $80 billion in costs can really extricate some synergies, maybe up to about $5 to $6 billion. And they would be then able to compete better against fiber and fixed wireless, which has really caused this extreme deterioration in their subscriber trends. So that's what everybody's hoping for. We'll see how everything plays out.
All right. Thanks for taking a deep dive into Charter Communications with us. Geetha Ranganathan, U.S. media analyst for us over at Bloomberg Intelligence in beautiful Princeton, New Jersey. Taking a look at the markets here, things have turned on the plus side now. Lots of green arrows here. Dow Jones Industrial Average up 363 points. We're seeing some more modest gains in the broader market. S&P up 45. Got the NASDAQ up 37. Helping out today is this drop in oil prices. Brent at 96.11 a barrel now. West Texas Intermediate at 88.46 a barrel, each down more than 4.5%. And for our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the very latest news and industry research. We've got your top stories, your global business headlines, all coming up in just a few minutes here on Bloomberg. We're going to have a balance of power on Bloomberg coming up next with Joe Matthew.
From ABC News, I'm Stephanie Officer. Colt Gray, the teen accused of killing 2 teachers and 2 students in the 2024 Appalachia High School shooting in Georgia, has pleaded guilty to all 55 charges in court this morning.
Mr. Gray, you understand all 55 charges? Yes, Your Honor. And you understand that you would be pleading guilty to the entire indictment? Is that right? Yes, Your Honor.
Gray now faces a minimum life sentence. A jury in March convicted Gray's father, Colin, on charges of second-degree murder and involuntary manslaughter after reportedly giving his son the rifle he later used in the massacre. Wisconsin residents want clear answers from authorities after a police-involved shooting earlier this week. ABC's Pierre Thomas.
A community mourning the death of Corey Ruiz, a black man fatally shot during a violent encounter with police. The vigil coming only hours after a bizarre moment when city leaders tried to provide an update to the community about Ruiz's death.
Because we don't want to hear anything you've been saying.
A man spewing anti-Semitic and anti-capitalism views suddenly emerges from the audience and literally takes the microphone from the Madison police chief.
The Wisconsin Department of Justice is leading the investigation. New questions today regarding the status of a deal that would see the U.S. working with Saudi Arabia to develop a civilian nuclear power program for the Saudis. ABC's Mary Bruce.
The president is now dramatically changing the terms with a new condition that could put the entire deal out of reach. Trump saying it is totally subject to Saudi Arabia joining the very respected and successful Abraham Accords. But that remains highly unlikely. It would require Saudi Arabia to normalize diplomatic relations with Israel, something they have refused to do unless Israel commits to a Palestinian state.
Sean Diddy Combs got into a fight and was sent to solitary confinement at FCI Fort Dix, where he's serving 50 months for transporting prostitutes. You're listening to ABC News. New Jersey is the latest state to ban so-called surveillance pricing, where different prices are set for shoppers based on their personal information and purchase history. ABC's Elizabeth Schulze.
Maryland and Connecticut have approved similar bans on surveillance pricing for groceries. New York also passed legislation on this. New Jersey's law also implements a one-year ban on the use of new digital price tags on shelves at stores. So you might have seen, for example, electronic prices at Walmart, which the company says stay the same no matter who's shopping.
Let's consider the wave of the future. Artificial intelligence data centers have suddenly fallen out of favor with some of their former supporters.
It was November of last year that Governor Greg Abbott sat beside Google Chair Sundar Pichai and declared,
Texas will be the centerpiece for AI data centers.
New polling suggests a majority of Abbott's constituents oppose data centers. 8 months after his meeting with Pichai,
We must prohibit them from building AI data centers in rural Texas neighborhoods.
A coalition of AI firms says data centers pump $4.5 billion into the state's economy every year. Jim Ryan, ABC News in Dallas, Fort Worth.
Texas is home to more than 300 large data centers. The European Commission today accused the video sharing app TikTok of allowing adults to view the accounts of minors. The commission says TikTok exposed children to cyberbullying and predatory behavior. TikTok's parent company ByteDance says it will review the findings. I'm Stephanie Officer, ABC News.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
Here come the tariffs. Welcome to the Friday edition as the Trump administration implements new duties on imports from our major trading partners. This will sound familiar. To once again replace those struck down by the Supreme Court, with more to follow, they say. We'll have the latest coming up from the White House with analysis from Chris Kennedy at Bloomberg Economics. The U.S. striking Iran for a 13th straight night as the latest ceasefire proposal is reportedly rejected by Tehran. We'll have the latest on the war from Bloomberg's Jeff Mason. And as Democrats meet to rewrite their primary calendar today in D.C., we'll get analysis from our political panel. Jeannie Shanzano and Katie Frost are with us this hour. And we start, as always, on Wall Street. It's the Friday trade, and it's looking a lot better than it was when the opening bell rang. Charlie Pellet has the details in New York. Hey, Charlie.
Indeed, Joe Matthew. Happy Friday, by the way. Quite the bounce back now with the Dow, the S&P, NASDAQ, not just higher, but on the S&P 500 index, best level of the day right now. We're up 48, 74.56. That is a gain right now of just about 0.6%. You run the numbers on the Bloomberg, and right now we are on track for another losing week. However, on the week, the S&P is down less than 0.1%. Keep it locked into Bloomberg throughout the day, and of course, for the closing bell to see how things shake out. S&P up 48 now, up by about 0.7%. The S&P now at 74.56. Dow Industrials back above 52,000, 52,058 now, up 345, up 0.7%. NASDAQ up 61, up by about 0.2%. With the SOX, the Philadelphia Semiconductor Stock Index, declining now by 2.1%. A 10-year at 4.65%, a 2-year 4.31%, and the 30-year 5.13%. Gold is up $26 the ounce to $4,075. That is a gain of 0.6%. We are looking at a retreat for crude. That is certainly helping sentiment. Right now, we've got WTI down 4.1%, back below 89 now at 88.39 a barrel. Brent well below 100, 96.01 for a barrel of Brent, down now by 4.6%. However, average gasoline now at $4.10 a gallon across the country, raising the question, and is it a fair question, could we see $5 gasoline by the end of the summer? Rebecca Babin is senior equity trader at CIBC. She was interviewed this morning on surveillance.
I don't think we're hitting 5. I think we're probably going closer to the 425, 430 level, and that really depends on what happens from here. If we continue to see Hormuz fully restricted with only a trickle going through and also Red Sea flows impacted, yes, I think we're going back to kind of that 450. If we also continue to see Ukraine target Russian refineries, I think, again, 450 is very realistic.
CIBC's Rebecca Babin. Chip makers declining today despite Intel's solid outlook. Intel trading lower now by 2.8%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down by 2%. NVIDIA up 1.2%. Micron down 4%. And Broadcom down by 1.5%. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, thanks for walking us through the roses once again. Charlie will have more on the markets in about 15 minutes' time. We do it like this every day. This being the Friday edition. You made it to the threshold of the weekend. And we thank you for meeting us here on Bloomberg Radio. Streaming live on YouTube. If you want to join us in the studio, it's pretty simple. Search Bloomberg Business News Live. We got the stream going all day. Whether our shows are coming from here in the Capitol or in New York City, you can pause it. You can back it up. It's like having a free terminal on YouTube, and we present it to you every day here, live on Bloomberg, thanks to the mighty Bloomberg Radio Network. I'm Joe Matthew. It's great to see you. Kaylee is off today. We've got a lot to talk about, as always. As we mentioned, the tariffs took effect 12:01 a.m. on this Friday, a whole new round to replace those that are expiring, which replaced those shot down by the Supreme Court. Just a heads up, by the way, we're going to talk Jeff Mason in a minute at the White House about this and the latest in Iran. Next hour, we're going to have a really interesting conversation with someone who's got some skin in the game here, and that would be Ireland's ambassador to the United States, Geraldine Byrne-Nason, will join us right here in our Washington bureau, waking up to a new round of tariffs today. We're waking up as well to news from Iran with a 13th straight night of bombing and no apparent off-ramp. There was a proposal for a ceasefire that you probably heard about. That has been rejected. It was delivered by the Iraqi prime minister. Remember, he met with President Trump in the Oval Office just a week or two ago here, brought this idea forward. It was shot down. And I'll remind you of the Axios report, which is pretty heavy duty. President considering restarting major combat operations that would be bigger than the ones carried out in the outset of what we all call Operation Epic Fury. Happening across town, Democrats are trying to rewrite their primary calendar. We're going to have more on that later in the hour. Are we really doing this again? We have this argument every 4 years, and then New Hampshire says, no, you can't. It's a state law. We have to go first. Maybe there'll be a write-in campaign for John Ossoff coming up in 2028. But let's start with what we know here. We're going to get into the latest with Iran and the tariffs on this day, 90 days later. The president finally gets to deliver his speech to a room full of journalists at the White House Correspondents' Dinner. Remember, we all gathered up there at the Hinckley Hilton, and we all had to leave because somebody tried to shoot the thing. And that got a whole nother conversation going about presidential security, whether the ballroom will make him safer and all that stuff. And remember that night, he said, we're going to do it again. At that point, he said 30 days. Didn't work out that way. 90 days later, he's going to finally get to read the speech. And they've got the mentalist guy in there too, right, James? The problem is they can't fit even half the number of people who were in the massive ballroom at the Hilton. So this is a very intimate affair ahead this evening for the President of the United States. And you better believe Jeff Mason's going to be there. I don't even know that, but I'm assuming it because he's the preeminent White House correspondent. He joins us right now from a gorgeous North Lawn. It's actually really nice this week. We got really nice out in Washington. Wow, I feel like I'm outdoors right now. Jeff, how are you? Looking forward to tonight. We'll get into that,
Joe. I was just going to say thanks for arranging this nice weather. It's made it much more pleasant to join you from the lawn.
Well, you look fantastic, and I wish I was out there with you. The president is actually talking about things today. He just mentioned President Xi on Truth Social, told me he would not under any circumstances give or sell weapons to Iran. That statement, he said, included Chinese companies. I take him at his word, doing very big favors. He says President Putin, despite the horrible war going on in Ukraine, told me he would not sell weapons to Iran. What is he talking about here, Jeff, that he felt a need to come to Truth Social to send this message?
So, Joe, I always believe in saying I don't know when I don't know, and in this case, I don't know.
Yeah.
Because both of those things are things that he has said before. Not really clear why he decided to post that today. I don't think it's new. We don't think it's any kind of new development. It's possible that there's something going on behind the scenes that caused him to send that out today. We may have a chance to ask him about that in the Oval Office this afternoon.
Is he going to open things up, or are we waiting to find out? Because I just wondered if maybe he heard that China was sending weapons.
Yeah, I wondered too, and certainly there was a question mark over that. That was one of the bigger issues that overshadowed, or at least underpinned, to use a couple different analogies there, the China summit that President Trump held with President Xi in Beijing a few months ago. And one of the outcomes was what he just announced again today, which is that he said that President Xi had pledged that China would not be supporting Iran. So I'm not sure why he needed to or felt the need to mention that today. I guess if we're drawing a couple different stories together, you could also potentially conclude that he wanted to remind President Xi of that promise on the same day that these tariffs are coming out. That may be a way of saying, hey, we may be doing something today, we being the U.S. in this case, that's upsetting to Beijing, but don't forget your pledge.
Mm-hmm. All right, I'm with you. As you mentioned, we don't know if we're going to hear from the president today. That's frequently the case, unless he's already holding forth in the Oval Office at noontime. I referenced the Axios report, Jeff. Do we believe that he's on the precipice of some major decision, or are we just back into this rolling night after night of strikes?
What I can tell you, Joe, is that certainly his rhetoric this week has not indicated that he's ready to come back to the negotiating table or to send his team back to the negotiating table, and that is a shift. A few weeks ago, the president was talking about how much Iran wanted a deal. He continues to say that Iran wants a deal, and yet the U.S. and Iran have not let up on their strikes over the last 2 weeks, and that seems to be the direction that this war is going.
Interesting. I should ask you about the tariffs. We saw them coming. The White House promised this, right? There'd be a series of investigations that would bring new justification. And in this case, it's forced labor, Jeff Mason. The U.S. will collect duties of between, depending on the nation, 10 and 12.5%. The filing in the Federal Register says this impacts 60 economies to prevent forced labor in their supply chains. These are, in some cases, some pretty important trading partners. What do we mean by forced labor?
Yeah, good question. And I would add to that list that includes the 27-nation European Union, a bloc that I used to cover when I was based in Brussels. And I think it's fair to say that they also take forced labor very seriously. So I'd be curious to read a little bit more about the details here in terms of where the U.S. is accusing forced labor of being used in these supply chains. But broadly, as just a stand back comment, Joe, this was this administration's attempt to neutralize what was a damaging Supreme Court decision for them. The president loves to use tariffs. It's one of his, if not the signature foreign policy and sort of economic move that he has used since coming into office the second time. He used it a lot during the first term as well. And the Supreme Court really hampered that with its decision, and he was upset about it, and they found a workaround, and this is it.
Yeah, they sure did. 301 replaces 122. And as I mentioned, we'll talk to Chris Kennedy about that. They've got really interesting analysis at Bloomberg Economics about actually how close the administration is coming to rebuilding the initial tariff wall that brings us back to Liberation Day. Hey, Jeff, is he dusting off the same script for tonight? I mean, we're kind of in a different world than we were back in May, or whenever the heck that was, the first Correspondents' Dinner, right?
Yeah, end of April. We are in a different world.
That's
and
right.
Yet,
wow.
My suspicion is that the script is getting dusted off. We got the impression that he was going to be pretty sharp against the press at that dinner. Then, of course, the shooting happened. He ended up giving a press conference that night behind me in the press room where he used a pretty conciliatory tone. But it's been 90 days, as you said in your intro, and in that period, his administration has issued subpoenas to New York Times reporters over their reporting on the new Air Force One. Those subpoenas, of course, yesterday were dropped. But he has not backed down, shall we say, in his rhetoric against the press. So probably we're going to hear that tonight as well.
No, this ought to be a riot. Jeff, thank you. Let me know what's on the menu later on. Bloomberg White House correspondent Jeff Mason on the North Lawn. He'll be back in our second hour. There were like 3,000 people in the dinner in April. They're going to have, what, 1,000 tonight? That's why not everybody's going. And listen, you'll hear people pretend that they're happy about it. That's the game right now in Washington. Me, I love getting the invitation. I live for the invitation. I just don't always want to go to the event. Chris Kennedy's next on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. Oil lower, stocks higher. S&P 500 index just about the best level of the day right now at 74.55. That is a gain of 47 points, and that's an advance of just about 0.6%. Dow Industrials up 388 points on the Dow, up by about 0.7%. Nasdaq right now up 0.2%. The Nasdaq 100 index does remain lower. Right now it is down by 0.1%. Intel weighing on the index. Intel shares lower after last night's earnings report. Right now, Intel down 4.7%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down now by 2.3%. The 10-year, 4.65%. The 2-year, 4.31%. And the 30-year currently yielding 5.14%. Gold up another $25 the ounce, up by about 0.6%. 4,074 on the precious metal, while West Texas Intermediate crude 88.49 a barrel. It is down 4%. Brent 96.03, down by 4.6%. This time yesterday we were telling you about Brent trading above $100 a barrel. Again, the Dow, the S&P, Nasdaq all in the green. Oil is lower on hopes that mediated talks between the U.S. and Iran will resume. As for the oil majors today, mixed bag. We got ExxonMobil down 0.1%. Chevron higher by 0.1%. ConocoPhillips down 0.2%. Key takeaway on those oil majors, for the most part, trading little change. But oil bears repeating. West Texas Intermediate crude 88.54 a barrel, down now by 4%. LeBron James ending his Lakers run. The NBA's all-time leading scorer says he is signing with the 76ers for his 24th NBA season. That, Joe Matthew, is a Bloomberg Business Flash.
That's Charlie Pellet, ladies and gentlemen. He's got the news, the markets, the headlines, and he'll be back in about 20 minutes' time here. Big part of our program every day. He's the voice of Wall Street and the New York subway. Listen, next time you're in the tube. Headlines, NVIDIA. We've got a bid under NVIDIA today. What a strange market. This thing is really turning higher as Charlie walks us through the whole Friday trade here. Up 1%, but Intel, after blowing the doors off with the earnings report, is down 5%. Kind of weird. Qualcomm is actually showing some losses as well, down 1% on planned price increases. That's about memory, right? Why is Micron down in that case? These are the questions I ask James every morning without expecting answers. He just looks at me and shakes his head. That's why we have Charlie here. Hey, at least Nike's got a bid, James. At least something's going okay. And oil prices are lower despite what's happening in Iran. I was curious to see how the markets would react today with the idea of new tariffs landing. And of course, it's all about predictability, right? People saw this coming. We are seeing interest rates drop, though, and it's probably got more to do with oil than tariffs, because this looks like kind of a wash. I woke up this morning, I saw Chris Kennedy's post on LinkedIn. That's actually, honestly, this is how sometimes you put the show together. And I sent it to James. I said, we got to get Kennedy on. This is the smartest analysis that we've seen, because you hear the headline, and I've repeated it myself. Trump's rebuilding the tariff wall. But the Supreme Court knocked down the tariffs. And then, of course, remember, they were replaced by, what was it, 301. And those were temporary. Those are expiring today. And the new ones are taking effect, presumably, and this is what, 122? Tyler knows all the sections. So does Chris. I just hang out with smarter people. These are under the guise now following a months-long investigation of forced labor at the EU. These are like close trading partners and allies of some sort of, I don't know if it's their labor or if they're importing products from China that made with forced labor, but that's going to be the rationale here. And I'll, by the way, let you know this right now. On the late edition of Balance of Power, we're going to spend some time with Peter Navarro. Yeah, the grandfather of the tariff regime. Take the phone off the hook at 5. Navarro's coming in. I should be like, Navarro's coming in. The president, though, says it's his favorite word. This might be Navarro's bailiwick, but Donald Trump loves the tariffs, and we're going back to the future. Listen.
I am a tariff man.
To me, the most beautiful word in the dictionary is tariff.
I really think we're helped a lot by the tariff situation that's going on.
I use these tariffs, took in hundreds of billions of dollars to make great deals for our country.
I hate to pay people back tariffs. We have other ways of tariffing. As you know, we're already doing it.
Yes, we do have other ways. Enter Section 301 of the Trade Act of 1974. So where are we in sports here? Is the tariff wall rebuilt? I've mentioned his name repeatedly. He's Bloomberg Economics economic statecraft analyst, Chris Kennedy. Great to see you. Welcome back. This is some statecraft. Our early estimates, as you write, suggest this will nudge up the average effective U.S. tariff rate from the current level by just 0.1%. Is the wall rebuilt?
The wall is not rebuilt, Joe. So the numbers, we crunched them last night, late into the night. We were expecting, when the USTR, Jameson Greer, announced proposed remedies back in June, we were expecting the rate to increase by something closer to 0.5 percentage point. But because of new exemptions and some shifting rates on countries and positive treatment of countries that have inked reciprocal deals with the president, the actual effect is only to increase the rate very marginally. Now, to be clear, this isn't the end of the story. As you mentioned, these tariffs are under Section 301. It's a tested authority. Right around the same time the forced labor investigation was announced, a separate investigation into allegations of excess capacity in 16 large economies that account for 75% of U.S. imports. So that we still don't know the results of that investigation. We do expect those proposed remedies from that investigation to nudge the tariff rate higher, probably closer to the 13.5% that we saw before the Supreme Court threw out those tariffs back in February.
Got you. So as we currently stand at what you found to be 10.7%, right? What do we make of this justification? Is it durable?
Well, the courts have been unwilling to really dive into these determinations that executive branch agencies make when it comes to these trade actions that Trump has undertaken. USTR was very careful to follow all the procedures that are required under Section 301. And we expect, and I think Bloomberg's legal team also expects, that while there'll be litigation, we don't think that these tariffs will be thrown out.
Okay, sure.
Yeah.
I mean, you are hearing countries push back, not retaliate, to be clear, with more tariffs, and we've seen how well that works. But when we talk about forced labor, is this happening in the European Union?
So the allegation is that these economies have failed to prevent products produced using forced labor from entering their supply chains. Is this all China we're talking about? It's not just China, but this has been a bit of a thorn, I think, in some U.S. trade policy folks' side for a long time. We in the U.S. have this law. It's called the Uyghur Forced Labor Prevention Act, a very strong prohibition on the importation of products that are produced by forced labor. And most other economies don't have as stringent of a rule. And so, I think that this will be a great question for you to ask Peter when he's in here later. Yeah. But that seems to be the reasoning, because these economies don't have as strong of a prohibition as the U.S. Okay. We should be taking action. It represents some sort of undue burden on U.S. commerce.
So is there a corrective measure here? Could they pass a law? Could the EU pass a measure that would result in the tariff being lifted, or blowing a hole in the justification?
One would think that is how Section 301 was intended to work. It's intended as initially it's part of the Trade Enforcement Authority of USTR, holding our FTA partners to account for the commitments that they make. But it's been used more in recent years, initially under Trump's first term to go after China in 2018. And then, recently Brazil, et cetera. It's now being used proactively against economies with which the U.S. does not have free trade agreements. Ideally, you'd think that they could do something, but as I think many people suspect, 301 is being used largely to just rebuild some of the tariffs that were tossed out by the courts.
They're going to have quite a story to tell. I mean, I'll be deeply curious to hear how Peter Navarro frames forced labor. Help us frame excess capacity. As you write, this could help, once this investigation is done, bring tariffs that further close the gap between the new rate and what we had pre-Supreme Court ruling in February. Are we talking essentially about dumping here? How does this work?
So the second 301 investigation is into policies and practices that are contributing to this supposed excess capacity in manufacturing specifically. Excess capacity itself is not an actionable thing under Section 301. So it's things like subsidies, et cetera, that the U.S. feels are burdening American producers, and that's the sort of justification. I think, as with the forced labor, we saw a number of economies push back pretty hard when these investigations were announced. Norway, for instance, noted that their fish production is helped in part by the fact that they have fjords. This isn't necessarily a story of massive subsidies, right? These are comparative advantages that exist in the global trading system.
Okay, you mentioned exemptions here. And there are a lot of different carve-outs, including products that we cannot produce here. Does that mean my coffee is going to be safe? Avocados, bananas? Where's the administration on that?
Yeah, so a number of foodstuffs were exempted in this latest round, and also on the unrelated Section 301 tariffs on Brazil. So coffee was excluded there. Sure. And we did see a number of exemptions be expanded from the Section 122 tariffs that these are meant to replace.
I see.
That's part of the reason why the overall hit to the effective tariff rate wasn't as large as we thought.
Fascinating. Okay. The president doesn't want USMCA, he says, or at least we're not renewing it in the way that many expected. Even though he negotiated it, he birthed the USMCA, but he says that was only to get us out of NAFTA. If we didn't have USMCA, this would be a really different scenario for Mexico and Canada, correct? They were exempting massive numbers of goods here.
That's right. And those exemptions are persisting with the Section 301. Now, earlier this week, it's been a very busy week for trade policy. The president invoked another authority that's never been used before, Section 338. It's from 1930 against Canada, 50% tariffs.
That was for the wildfires? No, that was a whole different deal. We haven't done the wildfires.
Dairy, for alcohol.
Because they were mistreating American alcohol, he said.
Yes, that's right. Now, those tariffs, as proposed, will not exempt USMCA compliant goods, which is notable because that is different than all the other tariffs that have been applied to Canada so far.
Yes, right.
We'll see what happens with those.
Wow, we've come a long way from Liberation Day. We've had a Supreme Court ruling. This administration is hell-bent on getting us back to that initial point, which was in place for such a brief period of time. Can we even quantify its economic impact?
Well, the change, so today, the tariffs are not changing very much. So our estimate is there's not going to be too much of an impact on the global economy compared to the baseline that existed yesterday. We'll have to see. It's very challenging. As you just note, these tariff rates have been jumping all around over the past year and a half. I think the bigger point is that this uncertainty is bad for investment. It's really difficult for businesses to make decisions when they don't know what the tariff rate is going to be in a few months.
Right. So. Markets feel that. Politicians feel that. And Chris Kennedy helps us understand it. Great work on all of this. He was up late so you could know more about it at Bloomberg Economics. He is our economic statecraft expert and a friend of the program, and we appreciate it as always, Chris. I'm Joe Matthew in Washington. We'll assemble our political panel coming up next. We've got a good one for you. As they rethink the primary calendar for the Democrats, we're doing this again. This is Bloomberg.
It's 12:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ, they're all advancing. Stocks are climbing as oil sells off big time. We're looking at a loss right now for crude. West Texas Intermediate down 4%, 88.46 a barrel. Brent crude well below $100 now, 95.94 on Brent. Barrel of Brent this time yesterday was above 100. Right now, Brent is down by 4.7%. Bottom line here, traders driving stocks and bonds higher. The S&P 500 index is at 74.44, up 36 points, gain there of 0.5%. Dow Industrials back above 52,000. The Dow up 320 points, up 0.6%. NASDAQ higher, flat on the day, though little changed, up 9 points on NASDAQ. The NASDAQ 100 index, however, is lower, down 0.4%. Intel weighing on the index after earnings. Intel right now is down 4.4%. The Bloomberg Mag 7 index ahead of a lot of key earnings next week. The index up by 0.5%. The VIX below 18, and the 10-year 4.66%. The 2-year 4.31%. The 30-year 5.14%. Gold is up $17 the ounce to $4,067, up by about 0.4%. And again, WTI crude down 4.1%. We are roughly 6 hours away from the scheduled attempted launch of SpaceX's Starship rocket. It was supposed to go up last night, but it did hit a weather delay, so they're trying again tonight. Sanapa Shankar is covering it for Bloomberg News.
They have had a rocky development cycle. They've had some explosions. They've had some setbacks. Just this week, they had postponed the launch because some of the engines didn't ignite. And then yesterday, they again postponed the launch to today because of bad weather, which that is pretty common in rocketry. But, today all eyes are on Starship. It is the first test flight since their IPO, so investors will be watching, I'm sure.
Sanapa Shankar, who will be covering it for Bloomberg News. She mentioned the IPO. SpaceX shares, they are down now by 4.8%, out the gate at 135. SpaceX now trading at 112.50. Recapping, West Texas Intermediate crude selling off, down 4.1%. Stocks higher, S&P up 0.5%. That, Joe Matthew, is a Bloomberg Business Flash.
All right, Charlie, I appreciate you. He'll be back coming up top of the hour, 1 p.m. Eastern, with more on Wall Street as we follow the Friday trade and try to get out of here alive for the weekend. That is, of course, the job of the investor every Friday, sometimes a little worried about going long into the weekend, specifically with the war in Iran that is giving us a little bit of relief today with oil prices pulling back, but nothing has changed. We had a 13th night of strikes. We'll get the latest from Jeff Mason coming up from the White House at the top of the hour. The president is posting about the bridge, the Gordie Howe Bridge. You know, the one Detroit connects America to the United States. This is sticky. They were supposed to have a big ribbon cutting thing there, and you heard Canada disinvited the U.S. We haven't been getting along. The tariffs. President takes to Truth Social. Canada disinvited the United States of America to the opening of the Gordie Howe Bridge, which is fine, considering they're paying substantial tariffs to the United States. But the original deal, he says, on the bridge, which was terribly negotiated by a previous administration, no longer stands. We changed terms of the deal so the U.S. now gets 50% of the profit. Thank you for your attention to this matter. I guess they're going to have separate ceremonies on each side of the bridge. We are hereby calling it the Jack Hughes Bridge on our side. I stole that from producer James. Hey, message to the president. A lot of people are getting disinvited around here today. Hundreds are being disinvited to the White House Correspondents' Dinner. That happens tonight. No one's really talking about it because 2,000 people got lopped off the invite list. I happen to be one of them. They put 3,000 people, or something close to that, in that massive ballroom in the Hinckley Hilton, the one that broke down when the shooter ran through the... So now 90 days later, they're going to do the dinner again tonight. We talked to Jeff about it. It's be down the street at the old, what used to be the Trump Hotel. It's a Waldorf Astoria now. They can only fit 1,000 people in that ballroom. So this was one heck of an exercise to whittle down the list of people important enough to get in that room. And the president will have the speech that he intended to deliver originally. The press secretary Caroline Levitt, promising the speech will be, quote, unifying yet vicious, and serious yet hilarious. I don't know how that's possible. Said the speech changed little from the version that the president planned to give in April. It's going to be fun getting in there. I'll tell you what. I mentioned earlier, look, we all have an ego. Everybody wants to get an invite. This one might not have been really fun to go to, though, right? Weijia Jiang says she's trying to ensure the event does not feel like a candlelight vigil. The scholarships will be awarded. They're going to do all of that. The mentalist will be there, too. And everyone has to have a QR code, and they're going to be in line for, like, airport-style security after what happened last time. Entry requires the code and a photo ID. It's like the Save America Act at the Waldorf. Now, in a separate hotel at the Salamander over by the tidal basin, this is where everyone goes to use the spa and try to get out of the way, have a quiet weekend, a staycation. The 49-person strong DNC Rules and Bylaws Committee, they're not getting massages. Well, they might be, but that's not why they went. They're there to bang their heads against the wall to figure out what states ought to come first in the next nominating primary series. And we've gone through this a lot of times. Ask anyone in New Hampshire. Nevada and South Carolina think they're going to be first in line here. They're duking this out to see who comes first. Nevada says, come on to Vegas on February 1, because we're going to start picking presidents around here. New Hampshire, aforementioned, and Michigan, according to reports in Politico, appear next in line, and Virginia wants to be fifth. I'll remind everybody that New Hampshire has a state law that says they have to come first, so no matter when anyone, they'll do it tomorrow if they have to, as long as it's first. That is non-negotiable for the state of New Hampshire. And Democrats punished the state last time for doing it. And they sidelined all the delegates. So there was a write-in campaign for Joe Biden. I mean, it was really weird. We showed up in Manchester. James and Kaylee were there. We went to the snowshoe. We were looking for people. We couldn't find anyone other than Vermin Supreme. There was nobody walking the streets. Nobody cared because the delegates were swept away. Republicans had a real convention. And, well, that didn't hold much mystery at the time. But I'm curious our panel's thought on this because, the party's looking for a more representative population, more diversity. This is what we always hear, right? Then these weird places in the north like New Hampshire and Iowa that have done a pretty good job, by the way, over the years picking presidents. There's no easy answer on this. Everyone's going to get angry, and I have no idea how it's going to finish, so we'll let our panel figure it out. Bloomberg Politics contributor Jeannie Shanzano is here, by God. Happy Friday, Jeannie. Democracy visiting fellow at Harvard Kennedy School's Ash Center, and it's always great to see Katie Frost. Welcome back, Katie, Republican strategist and political director at the American Principles Project. I don't mean to get too worked up here, Jeannie, but are we going to be walking down Elm Street again talking about a write-in campaign for John Ossoff in New Hampshire? What's the point of this?
Yeah, we might. And Joe, you just gave me so many things to chew on between the correspondence dinner and the fridge and now this. I just have to ask you one thing. Am I led to believe that Americans are going to be taxed higher because Donald Trump is upset he wasn't invited to a bridge opening? Is that what's happening? I can't wrap my head around any of this.
I think it's just a case of timing here, but I don't know.
New Hampshire will try to go first. They will have their, if they do, I mean, they have no choice. They're not going to change that law. The Democrats will do the same thing they did in 24, same thing they did to Florida and Michigan, by the way, in 2008. And they will, in the meantime, try to work out who is actually going to go first in this lineup of the sort of top 4 or 5 before the March big primary day. And you said it was going to be tough. Somebody who's been in those meetings was quoted as saying it's going to be a bloodbath and people will fight to the death for this. So if anybody thinks this isn't serious, these are big odds, Katie and Joe.
Man, this is going to be a hell of a panel, Katie. I don't want anybody to get in trouble or get hurt. You know the old saying in New Hampshire, Iowa picks corn, New Hampshire picks presidents? I don't know why we do this every 4 years, and I guess I do. I appreciate the spirit of the argument, but it leads to great chaos when every state wants to jump in front of the other, Katie. How come the Republicans don't have this whole deliberation?
You know, we're traditionalists. We like order. We like structure. And I got to say, the Democratic Party process doesn't seem very democratic at the moment. A lot of people wonder, why is Iowa the first to go? And that's always been a question. I actually worked for a candidate in 2016, Ted Cruz, and when he was running, he committed to doing the full Grassley, which is where you have to go to all 99 counties in Iowa. So I've seen every corner of Iowa. I actually have a T-shirt that says, Iowa, for some reason, you have to come here to be president. But the reason Iowa went first is that after the chaotic 1968 convention that the Democrats had with all the protesting, they said, all right, we're going to pivot and spread this out amongst the states. And Iowa had a very complex process at the time, so they wanted to get a head start on that. So they ended up being the first state to go in 1972, and then the Republicans followed in 1976, and Iowa just was the first in the nation. That's how it goes. But we're seeing a lot of pushback now at the DNC. But so who's it going to be? If South Carolina isn't a state, though, they're saying they want more diversity. But why would you go to a state that has Republican control? The population may be diverse. There's not a lot of ideological diversity there. Well, Congressman James Clyburn, of course, is a huge figure in the Democratic Party, but will South Carolina be able to hold on to that position once he's no longer on the scene? It would maybe make sense to go somewhere like Georgia, because, I mean, I'm not saying this because I am from Georgia, but Georgia is a state that has elected some Democrats recently and also is a very diverse state. But I don't know why we need to do this all. Come on, guys. It's Iowa, New Hampshire, South Carolina. We know that's the drill. Let's just do that, and let's not strip people's voices away at a convention. The convention is an incredibly important moment for both parties, and I will just say on a personal note, party conventions are very important in my life. My parents had their first date at the 1988 RNC convention, so I wouldn't be here on this panel if it wasn't for the conventions. We need to let everyone be represented.
Hey, wild things happen at conventions. Jeannie, what do you think about this? If this changes the order and New Hampshire freaks out, should the party strip the state's delegates?
Yeah, I mean, they probably will, whether they should cosmically or not. They probably will, although there's talk that the Democratic Party in New Hampshire could hold a follow-up convention or primary and get the delegates that way. But again, this has been done before. As I mentioned, it was done in 2008. It was done in 2024. It'll probably be done again. But let me just explain why. Katie makes an excellent point about Georgia, but there's a very practical reason. And this is one of the things that people don't consider a lot, are the practicalities of this. As much as Democrats would love to hold their first in the nation primary in Georgia, Georgia has a Republican-controlled state. And so getting their legislature and their governor to sign off on moving that date is all but impossible. So amongst the many things that this almost 50-person committee today is trying to figure out is what they would like to see, and of course, what is practically possible. And of course, Georgia is not practically possible. They've got to go to a state controlled by Democrats. That's why, Joe, your state of Virginia is on the short list. I don't know that it's going to get there, but it's there because it could sort of stand in for a southern state that has Democratic control. But what they're trying to do is they're trying to make sure that they have representation in all ways, demographically, ideologically. They're also trying to ensure that these are states that matter, not just in the primaries, but in the general as well, so they don't waste organizational resources. There's a lot of practical concerns there. And Joe, you and I were in Iowa last time around. It was god-awful cold. They couldn't pick a winner. And we knew at that time it was probably, I'm sorry, Katie, the end of Iowa. They couldn't get it together.
It was so cold. I've never felt cold like that before or since. I'm still cold. Katie, Ryan asks a really good question on the terminal. I want to throw this by you. Ryan says, why don't all states report at the same time? Why do we need some weird decorum where Iowa and New Hampshire go first, as they might be the least relevant states? Isn't it, we've talked about a national primary, and I've got a minute left, Katie. Isn't it because candidates would only go to New York and California?
That would be complete chaos from a campaign scheduling perspective. That would be a nightmare, and also wouldn't give us anything to talk about. We wouldn't have the drama and the buildup. Come on, Joe. We need a drawn-out process so we can talk about a different state voting every week. And it would just make it another chaotic national election, and wouldn't have the same thing where you can see over the period of time. Remember, this is also a way of vetting candidates, and different things come out over the course of several months as different states are voting, different debates are happening, different voters and issues are coming forward. So I'm in favor of the drawn-out primary process.
This is a great conversation, and I'll tell you what, I can't wait to get back on the primary trail with all of our great analysts. I'm looking at you, Jeannie Shanzano, and Katie, thank you for being part of our panel. They're both back in our second hour, coming up here on Balance of Power. I'm Joe Matthew in Washington. This is Bloomberg.
Live from Washington, D.C., this is Balance of Power with Joe Matthew.
President Trump rebuilds the tariff wall. Welcome to the Friday edition as the Trump administration adds new duties to imports from major trading partners, including the EU, just as tariffs implemented after the Supreme Court ruling expire. We're going to get the latest when we bring you to the White House and talk to Bloomberg's Jeff Mason with commentary this hour from Chrystia Freeland and analysis from our political panel. The U.S. striking Iran for a 13th straight night as the latest ceasefire proposal is rejected by Tehran. We'll talk strategy with Tom Caracco, who runs the Missile Defense Project at CSIS. And later, our conversation with Ireland's ambassador to the U.S., Geraldine Byrne-Nason, is with us in studio, all after a look at Wall Street. Let's get to the Friday trade now with Charlie Pellet in New York. That NASDAQ looking a little wobbly here, Charlie.
Exactly. Last update, Joe, we told you NASDAQ was higher, but right now it is moving lower, down by about 0.1%. Bottom line, here we have some familiar themes. Oil certainly moving markets today. Price of oil is declining. Chip stocks also declining today. And Intel, after that blowout report last night, Intel shares now trading lower by 4%. But right to the equity numbers, with the S&P 500 index holding on to a gain now of 30 points. We're off session highs, up by about 0.4%. Dow Industrials up 277 on the Dow. That is a gain of 0.5%. Right now, 51,989 on the Dow Jones Industrial Average. NASDAQ, though, down under 0.1%. The NASDAQ 100 index down 0.4%. And again, Intel after earnings down now by 4.1%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, trading lower by 2.8%. The VIX just below 18, and the 10-year at 4.66%. The 2-year 4.31%. The 30-year 5.15%. Spot gold at $4,067 the ounce, up 0.5%. West Texas Intermediate crude 88.24 a barrel, down 4.3%. Brent crude 95.82 now, down 4.8%. This time yesterday we were talking about Brent trading above $100. Again, chip makers trading lower. I mentioned the SOX down now by about 2.9% among some of those other tech names. Chip names, we've got NVIDIA, little changed, up 0.6%. Micron, though, hard hit, down 5.3% now. Shares of Broadcom lower by 2%. Recapping, stocks are trading mixed. S&P up 27, up by 0.4%. West Texas Intermediate crude down by 4.3%. At Joe Matthew is a Bloomberg Business Flash.
Charlie, thank you so much. Lower oil prices going a long way to give stock traders some relief, even after Iran and the U.S. Continued for a 13th straight night. American airstrikes shortly after Iran reportedly rejected a ceasefire proposal that had been delivered to Washington by Iraq's prime minister. This could be a very interesting and informative weekend in the future of this conflict, and it's where we start with Bloomberg White House correspondent Jeff Mason, who is on the North Lawn right now. Jeff, will there be a 14th straight night?
You know, if past is prologue, there probably will be, Joe. I don't have any specific intel on that, but the president has shown, certainly over the last 2 weeks, that he wants to increase attacks and to continue these attacks that started a little over 2 weeks ago when, or roughly 2 weeks ago, I should say, when the ceasefire collapsed and the memo of understanding was essentially thrown in the trash. Not a great spot right now between those two countries, but there are seemingly some efforts by outside mediators to try to get them back to the table. Our friends at Reuters reporting earlier that Pakistan was pursuing another option or way to get the two sides back at the table, and that has helped the markets a little bit. I think markets generally are just looking for any signs of hope that this conflict is not going to continue to escalate and continue to escalate. Obviously, you then also have sort of the opposite type of reporting from Axios suggesting that the president is looking at even a bigger attack or a bigger use of military force against Iran. So we're going to ask him about that this afternoon. He's holding an event in the Oval Office, and I'm expecting to be there, and we'll try to get a couple questions in.
I'll be deeply curious to hear what he said, Jeff. Indeed, bigger than ever before was the quote to Axios. I'm close to making a decision. We're all set for it. Listen to the way the president framed the war with Iran when he was speaking yesterday.
We're doing very well against the Islamic Republic of Iran. We're doing extremely well. They would like to do something, but I say they're not ready yet. We want to get it over with, and we want to do it right. We have to do what we came to do, and that's we can't let these people, very violent people, we can't let them have what they want.
At every turn, we're doing extremely well. Jeff, you've heard him say it. He has even said it directly to you. He's also claimed victory more than 24 times over the course of 5 months. Do we actually know what the president thinks about the state of this war?
You know, I appreciate that you use that 24 figure, Joe, because it's emblematic of the mixed messages that he has given about this war, really from the very beginning. and throughout. And it also, I think, you asked me what he's thinking. I think that it is that's also sort of a window into what he's thinking, because this is a president who wants victory on all sides. He wants to be able to say that he was a historic president who took on a challenge with Iran that other presidents had not, and he says that repeatedly. But he also has voiced fears of becoming a president who presides over an economic downfall like the Great Depression. He doesn't want that, and that was one of the things that he cited when he ended, or said he was ending the war a few weeks ago. So it's a lot, and it's a lot to decipher, and it's a lot of back and forth and contradiction. There are also lots of different opinions about it within his own party. There are people on the right who would like to see President Trump and this administration really continue this war against Iran and do even more to ensure that Tehran is unable to get a nuclear weapon. Whereas there are others who I think are also concerned about the Republican prospects in the midterm election if gasoline prices continue to go up and if this conflict continues.
Let's talk tariffs, Jeff Mason. We've got a new round here, replacing those that are expiring, those temporary tariffs following the Supreme Court ruling. Everyone's becoming an expert on this stuff. This is Section 301, a 431-page filing in the Federal Register, and it's aimed at, well, tariffs between 10 and 12.5%, aimed in many cases at our trading partners, our allies, including the EU. Jeff, this is on the grounds of forced labor. What do we know about it?
Yeah, including the EU is right. That and you're throwing out 301 in the same way that lots of people are throwing out 301, which used to mean nothing, I think, to many people, but it means a lot in the trade world. Spot on with that figure there. It is the workaround that the administration is using to continue tariffs against basically a good chunk of the rest of the world, including very close U.S. allies. As far as that particular reasoning that you mentioned in terms of forced labor, that's the crux that they have hinged this on or attached this to. I am curious to see more of the details about where they are seeing forced labor in these supply chains. Certainly from a bloc like the European Union, which is also pretty sensitive to those things. I would think that they'd have to have something to show for it.
Jeff, right while you were speaking, the president just posted, I think he's watching us again. We're running headlines across the terminal right now. I want you to hear this. They're starting a 301 probe into the practice of the European Union, he says, robbing U.S. firms. The European Union, he says, is at it again, taking direct aim at great American companies after having fined Apple for no reason at all, $15 billion, Meta, $3 billion, Amazon, $2.5 billion, and many others. We have just been informed that Google has been fined another $1 billion without explanation. I read down here, it's a very long post. He says the U.S. is on a piggy bank for Europe, and a 301 investigation will be immediately initiated into the practice of robbing American companies and, in turn, the American taxpayer. Jeff, he says the EU will pay a very big price for this illegal and highly unethical conduct. This sounds like a lot more than forced labor.
Yes, it does. And let's unpack a little bit of that without even having seen the post, and thanks for reading it out loud, Joe. One thing I can tell you as a former EU correspondent is that the European Union, and particularly the European Commission, which is the EU's executive based in Brussels, has broad authority over antitrust. And their antitrust department, or the part of the commission that does antitrust, is the one, or is the part of the commission that is taking on some of these big U.S. technology companies. That is not the same as trading practice. It's an antitrust practice, if I'm understanding correctly what the president is complaining about. So that would raise questions for me as a reporter about what kind of legal maneuvers or legal challenges that the EU might now take, not even with regard to retaliation, but with regard to fighting this measure in an international court of some kind. I don't know the answer to that, but just throwing that out there. But broadly, back to our discussion about what the president is thinking, the president doesn't see that differentiation. He sees it as Europe taking or attacking U.S. companies and taking money away. And so he's using the only thing that he often uses as a tool to prevent that, and that is these tariffs.
I guess we'll have to see what the level will be, Jeff. He says the penalties will be entirely reversed, and we anticipate a substantial tariff to be placed on them at the earliest possible moment. I'm really glad we were with Jeff Mason when this story broke. Jeff, thank you so much. With your institutional knowledge here on the EU, a fascinating story. He's our White House correspondent, live, of course, on the North Lawn. And we want to assemble our panel for their take on this breaking story. We'll get to what's happening with Iran, but the tariffs are leading the day here. It was already a major story with the implementation of these 301 tariffs for some 60 economies that the White House says has forced labor in their supply chains. Bloomberg Politics contributor Jeannie Shanzano is with us, our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. And we're joined as well by Katie Frost, a Republican strategist, political director at the American Principles Project. Katie, this is an interesting moment. After the White House struck down the tariffs, the president has managed to rebuild a good chunk of what people call his tariff wall. And it looks like there's more coming based on what he's writing about the European Union. Does this make you nervous in a world where we're already seeing an economy, where we're already seeing rising prices because of the war in Iran?
You know, I've long held that tariffs are something that should be a tool and used in negotiations. And President Trump, of course, we know he loves to negotiate. But for far too long, we had countries that would have a tariff in place, and we did not at least have a mirror tariff of that. So that's something I've long been an advocate for. But we'll have to see how these different countries want to negotiate and finalize these deals. And as we saw previously, there were several times when the president would talk about a tariff, and all of a sudden, people wanted to get to the table and have a conversation. So I will wait to judge until we see the final product. But if we're talking about something like forced labor, I think that's something we should all be able to agree on. There's a reason we haven't allowed certain imports from regions like where the Uyghur concentration camps are in China. If there is forced labor and slave labor being used in the production of those products have no place being in the United States.
Well, and apparently they have no place in the EU, according to the administration, Jeannie, and the EU is taking some issue with the forced labor allegations. Weigh in on that as you see fit. The EU is going to be getting more, it sounds like, based on these penalties to, as he mentioned, Google, Apple, Meta, and more.
Yeah, I mean, to impose these tariffs, which are not anything but taxes on the American public, the president using 301 has to show that these 59 countries plus the 27 EU nations are engaged in forced labor, at least they are in their supply chain. And that is something that, as far as we can tell, we have not seen the evidence of. So whether or not the administration can produce that is critical. On the heels of that, just hours after imposing these, the president takes to Truth Social with those posts you were reading to Jeff Mason. And he says, oh, by the way, this might not be anything to do with forced labor, apparently. This has to do with antitrust. I don't like how you are treating our big tech companies, Google and the rest. Well, this is a big question for the administration. Which is it? And you've got people in Congress, you've got senators, you've got people like Linda Sanchez, you've got people like Ron Wyden who are saying we need to pull this power back from the president because he is misusing it. I will tell you one consistent theme in every report we've heard today, even before the president posted about the antitrust, is this has nothing to do with forced labor. This is a workaround for the president because his ability to impose his favorite tool, tariffs, was stripped by the Supreme Court. And the minute, literally last night, when those last set were pulled back, he then imposed these using forced labor as an excuse. So the big question here is, can he and the administration show evidence of forced labor? And what is he talking about the antitrust? If that is coming into play here, 301 isn't going to give him the tool he needs to be able to do this legally.
Well, and you know that there are going to be court challenges coming here. What do you make of this post, Katie, that the president just made, upping the ante when it comes to the fines that he says are for no reason at all against some of our biggest tech companies, Meta, Amazon, Google, and others, isolated in this note. He says the United States of America is not a piggyback for Europe. Do you think we are?
Well, it certainly seems like they expect us to bail them out whenever something is happening over there. And, you know, there was the old joke that everybody talks about in America, we are the back-to-back World War champions. But look, at the end of the day, you know that anyone who represents those companies is going to make sure that they're advocating for their best interests, which we should. But we also need to have someone who's advocating for the best interests of the American people. And that's supposed to be the President of the United States. And if Europe is doing anything that impacts negatively our economy, there needs to be something done about that. And I agree with Jane. We don't know what the final version of this is going to be, and there will be a lot of court cases about this. If there's one thing we have more of in the DC than lobbyists, it's lawyers. So you know they're going to be suing over these regulations. But we have to see what the final product will be. No one really has an answer right now.
Let's turn to Iran, if we can. Jeannie, we haven't heard from you yet today on this, with the president taking to Truth Social as well to talk about China's promise and Russia's promise to not provide weapons to Iran. We had a 13th straight night of bombing last evening, and we're going to be talking more with the missile expert at CSIS coming up here about strategy. But are you concerned that we are on the verge of all-out war once again?
Well, I am, based, in part on the president's comments. And the fact is, it's becoming increasingly tough to take what he says to take him at his word on any of this. At the same time, he is telling the American public in Georgia that apparently Iran wants desperately to negotiate, but he's not ready. Then we get reporting out of the New York Times, which says that he sent, and I think he should be doing this, an attempt to negotiate a deal with them that they rejected. So which is it? We've got to be able to trust the president and the administration, not to mention, Joe, reports that they pulled down the number of casualties that were posted from 18 to 14, saying the 4 men and women who returned to Dover Air Force Base the other day did not die during the war because this came after the MOU. That is an astonishing thing to do, and hopefully, I haven't checked in the last few minutes, has been rectified. But this is an administration that is saying things that don't match with the reality of what we're hearing, and we need to be able to trust them on things as basic as, are you attempting to negotiate? How much has this war cost? How many casualties and wounded have we had? How much more money do you need? And increasingly, that's becoming difficult.
All right. We've had a great panel, and I want to thank both of you, Jeannie Shanzano and Katie Frost, for sharing your insights on another breaking news day here in Washington. We're going to have much more on the war with Iran when we talk to an expert coming up. Tom Carrico runs the Missile Defense Project at the Center for Strategic and International Studies. An insider's view next, only on Bloomberg.
It's 1:21 on Wall Street. We do check markets all day long here at Bloomberg. Price hikes at Qualcomm, the biggest maker of smartphone processors, is planning to increase prices by a percentage in the double digits. It's a move that is likely to ripple through much of the tech industry. Now, this is according to a document that has been seen by Bloomberg News. Qualcomm says these price hikes will take effect for products shipped after September 1st. Qualcomm, by the way, will be reporting earnings next Wednesday. Right now, shares of Qualcomm, they are trading lower. Qualcomm shares down now by 1.7%. The Dow and the S&P are higher. Techs are tumbling. We've got NASDAQ down 0.1%. The NASDAQ 100 index down 0.5%. This as Intel slumps after earnings by 4.1%. The S&P at 7436, up 28. That is a gain of 0.4%. Dow Industrials up 277, up 0.5. NASDAQ down 27. For NASDAQ, a drop now of 0.1%. The Bloomberg Mag 7 index is pushing higher ahead of key earnings next week. Right now, that index up by 0.3%. But the SOX slumping, semiconductors selling off. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down now by 2.2%. The 10-year 4.67%, with the 2-year 4.32%. The 30-year 5.15%. Spot gold 4,066 the ounce, up 0.4%. A retreat for crude, major story today, certainly giving a boost to many stocks. WTI 88.79 a barrel, down 3.7%. Brent crude 96.23, down by 4.4%. Peter Lake, the senior director of power at the White House's National Energy Dominance Council, will be leaving the administration at the end of July. Recapping, S&P up 25, up by 0.4%. WTI crude 88.82 a barrel, down by 3.7%. That, Joe Matthew, is a Bloomberg Business Flash.
Okay, Charlie, many thanks, sir. Charlie Pellet will be back in about 20 minutes with more on the Friday trade here as we follow through this trading week. We're live in Washington on Balance of Power. I'm Joe Matthew. Kaylee Lyons is off today, and we do have breaking news on a story that we touched earlier in the program. The competition among states to become first in line for the Democratic primary process when we get together to choose another president. As we mentioned to you, Nevada and South Carolina were considered contenders to be first in line, and the Associated Press now reports that South Carolina was in fact selected to lead off the Democratic Party's 2028 presidential nominating schedule. This is the DNC Rules and Bylaws Committee holding up at the Salamander Hotel here in Washington, D.C., and they've been at it making arguments for a couple of days, and according to some, it's been a knockdown, drag-out fight. The decision will need to be approved by the full DNC, to be clear, which is scheduled to meet in August. And now you can brace for the reaction that will come from many states, beginning with Iowa and New Hampshire, who will be very much looking to maintain their first-in-line order. Of course, Iowa kicks things off, or has historically, with the presidential caucuses. New Hampshire, the first in the nation primary state, which has a state law on the books that says it must go first. And so it will likely jump the line if history is any guide here, and could in fact be penalized again. The state was stripped of its delegates in the last cycle, which is why there was a write-in campaign for Joe Biden. We're back to the situation in Iran, as promised, with a 13th straight night of attacks after Iran reportedly rejected a ceasefire offer that was delivered on behalf of Washington by the Iraqi prime minister. And based on what we have been seeing, with Iran continuing to attack vessels in the Strait of Hormuz and even employing the Houthis to do the same in the Red Sea, Wall Street Journal reports that Iran has proven it retains a significant missile and drone arsenal that it continues to use and threaten American forces, even as the president has claimed to have totally destroyed Iran's military. It's where we start our conversation with Tom Carrico, a real expert, as we try to understand what exactly the capabilities are that Iran still retains. He's the director of the Missile Defense Project and senior fellow in the Defense and Security Department at the Center for Strategic and International Studies, CSIS, right here in Washington. Tom, welcome back to Bloomberg TV and radio. Is it possible to answer that question? Do we know how many missiles Iran has left?
Well, the president about a month ago said that Iran had about 21% of its missile force still intact, and he added that's still quite a lot, unfortunately. I mean, I think just the fact that, yes, we've been bombing them the last 13 days, but they keep managing to get missiles off. And it's the fact that the missiles are getting off the ground in the first place just speaks to the fact that we've not sufficiently degraded either the missiles themselves or their launch infrastructure. It's a reminder that the whole desire to do things left of launch before the missiles are launched, while highly desirable, is also very hard. Scud hunting is hard, and Iran has built an infrastructure, learning from the North Koreans and other folks, and watching the way in which the United States conducts strikes over the last several decades, that have been able to ride out these attacks, unfortunately, more than we would have liked.
Remarkably well, Tom, as I read in the story here, and I should note that you were quoted in it, the strike on the airbase Friday that killed 3 Americans was carried out by, they say, likely Tehran's most effective missiles, including the Kibar-Shikan medium-range system. That and others housed in vast underground facilities that the U.S. and Israel spent weeks pounding in March and April. Since then, Iran has dug them out and resumed firing from those same bases. Are we not able to destroy them?
Look, it's likely a circuitous maze of missile launch points. Iran has actually put video of some of these underground missile cities or these underground tunnels online over the years, and it's a pretty clever concept. You basically got a road that you drive around, and then you have little holes that in the surface that pop up, and so it's designed to be resilient. It's designed to be able to move things around and have the aspect of deception in terms of making it harder to figure out where an individual missile is at a given time. So it's when you bury things underground, you have the benefit of a passive defense to make it harder to be struck.
Interesting. These are, I presume, the sites that we're going back to hit now for a second or third time. When you hear the president talk about additional targets, how many of them have already been hit?
I don't know the number offhand, but I think what you're pointing to in part is the challenge of doing everything from the air. This is a lesson that unfortunately we have to remind ourselves of or relearn. It seems like every decade or so that the desire, American air power is exquisite, to be sure, but it is very hard to be able to do everything from the air, from a standoff capability. The land domain, we talk about multi-domain operations, but land domain is the domain on which most human beings spend most of their time. And that's where politics happens. That's where stuff exists. And so it's difficult from a military perspective to be able to, no kidding, accomplish all of your objectives without being there, without sending in forces. And so that's not something we want to do, but that's just the challenge.
Well, I guess I'm winding up to a question about whether Iran is simply digging out these missiles because they were very carefully stored underground, or if they're maybe getting new ones. And the president posted on Truth Social today, I'd love your thoughts on this. Referring to President Xi, he said, told me he would not under any circumstances give or sell weapons to Iran. That statement included Chinese companies, he says. He says, likewise, President Putin told me he would not sell weapons to Iran, and he understands that I do not sell weapons to Ukraine, but to NATO countries. What's the point of this? Does the president believe that China or Russia may be providing weapons?
Well, the quote would seem to suggest that he'd like to believe they weren't. I think the good money, the good bet is that, of course, they are. And why would they be doing that? Because it's too great a temptation not to, frankly. Yes, admittedly, through NATO, the United States has, of course, been providing weapons, but also targeting information to the Ukrainians to resist the Russian invaders. So in addition to the likely prospect of stuff going into Iran, there's been a number of news reports on that front. There's also the reports that maybe the Chinese or the Russians are assisting with targeting information. So the United States bases in Qatar and Bahrain, and yes, in Jordan, where the service members were just killed. It's hard not to think that targeting information could be helping the Iranians out a lot. And there again, it's probably just too great a temptation for the Russians and the Chinese not to be assisting.
Wow, that's really important, Tom. I'm looking at the defense contractors today. They're reaching higher again after a big rally yesterday in RTX. Lockheed, they had earnings reports, and it brings us to the question right now. There you see it on your screen. RTX is up another 2%. Lockheed is up even more than that. The question about our own stockpiles, Tom, these are the two companies, among others, that stand to benefit from a massive purchase of missiles, interceptors, and other munitions that we have spent in the war in Iran and, of course, in providing weapons support to Ukraine. How badly does the Pentagon need the money it's asking for right now? There's a supplemental budget request that's on the table in Congress. It just passed the House. Pentagon officials, Pete Hegseth testifying earlier in the week, say they're already moving training schedules around, moving money around because they need the cash. What do we need to buy? What's our state of munitions in our stockpiles?
Yeah, so the bad news is that it is not a very good situation at all. We have, I would say, figured out a good plan that was begun last May of 2025 to begin what was called a munitions ramp, to build up about a dozen change prioritized munitions. The two companies that you cited there are the primary providers of those offensive and defensive missiles. That was a good plan. There were announcements, heads of agreement, agreements to agree that were announced in December and then in January and February of this year. But the bad news, that's all good. The bad news is they haven't been contracted, or almost nothing has been contracted to do that. In January, when Congress passed the 2026 appropriations, they said that they were $28.8 billion short of the Pentagon's request just for munitions. That was before Epic Fury. Things have gotten a lot worse. Now, the supplemental bill that you referenced there, assuming it can get through Congress, would basically finish up that earlier shortfall, but it doesn't even get after the munitions shortfall from Epic Fury. And yes, the numbers of offensive and defensive missiles that have been expended in this conflict is frankly shocking. And it is something that, as I've written, is frankly degrading our deterrence and defense abilities in the Pacific, for instance.
We've only got a minute left, Tom. You said Pacific. Could we wage war against China right now while we're doing this with Iran?
The United States could, but it would be much harder. And the other thing is, what I really worry about is that we are essentially tempting China to do something because we are, from a military posture, moving stuff out of the Pacific. It just makes it that much more tempting for them to pick a fight with the Philippines or with Taiwan or whomever. And so that's what I really worry about, is that the folks in Beijing are sitting there clicking away on a hand clicker for every Patriot missile that we fire and every Tomahawk missile that we fire. And they're doing a lot of clicking, and it's not a good situation.
They're counting the bullets as we fire them. Tom, you're great, and I appreciate your analysis very much. With great work at the Missile Defense Project at CSIS. Tom Carrico, Ireland's ambassador to the U.S., is on the way in next here on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. Oil is declining, and the Dow and the S&P are higher. NASDAQ bouncing around. Right now we've got NASDAQ down 18. Just a minute ago we had NASDAQ higher, but down 18 now, drop of under 0.1%. S&P up 29, gain there of 0.4% with the Dow up 281 points now. Dow Industrials up by about 0.5%. Weakness in tech names today. The NASDAQ 100 index is down 0.5%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down 2.8%. Intel after earnings moving lower by 4.4%. The VIX right at 18. The 10-year 4.67%. The 2-year 4.32%, and the 30-year 5.16%. Gold at $4,068 the ounce. Spot gold up $19 the ounce, up by about 0.5%. West Texas Intermediate crude now at $89.07 a barrel, down 3.4%. Brent $96.46 barrel of Brent, down 4.2%. Brent is retreating from $100 a barrel as traders assess signs that oil is still managing to get through Middle East trade routes despite the recent escalation in hostilities. Among oil majors, ExxonMobil down 0.2%. Chevron up 0.1%. ConocoPhillips down 0.1%. Bottom line there, the oil stocks are trading little changed. Recapping, S&P 500 index up 27, higher by about 0.4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet. Joe Matthew, that is a Bloomberg Business Flash.
Charlie, thank you so much. He'll be back at the top of the hour with more on Wall Street, 2 p.m. Eastern Time as we kick off Bloomberg Business Week daily, just like we do each day here. That would fulfill the name on Bloomberg TV and radio. I'm Joe Matthew in Washington. Thanks for spending some time with us as we talk tariffs today. There's actually a lot of tariff news, which can make things a bit confusing. The White House today implementing, as expected, a new round of tariffs on our trading partners to replace those that were put in place temporarily following the Supreme Court ruling. It's 10 to 12.5% applied to 60 different economies with the justification of forced labor. This is Section 301, replacing Section 122. Now, that's separate from what the president is threatening to drop on Canada, the most recent round, a fresh 50% tariff on some Canadian goods, milk, hockey equipment, beer and plywood, as opposed to those, in some cases, including energy, that are covered by the USMCA, over what the United States or the Trump administration says was unfair treatment of American alcohol, cars, and dairy. Now, to that end, there was supposed to be a dedication ceremony today for a new bridge, the Gordie Howe Bridge, connecting the U.S. and Canada right there in Detroit. President, writing on Truth Social, Canada disinvited the United States of America to the opening of the Gordie Howe Bridge, which is fine, he says, considering they are paying substantial tariffs to the United States. But the original deal on the bridge, terribly negotiated by a previous administration, he says, no longer stands. We changed the terms of the deal so that the U.S. now gets 50% of the profit. Thank you for your attention to this matter. Indeed, the United States will hold its own dedication ceremony, it seems, on this side of the bridge. This was the foundation of David Weston's conversation with Chrystia Freeland that you will see and hear on this week's edition of Bloomberg Wall Street Week. Of course, the former Canadian finance minister, now Bloomberg contributor, weighing in on Canada tariffs. Listen.
The official rationale is in reaction to Canadian treatment of U.S. alcohol, U.S. dairy, and U.S. cars and car parts. But we have to be careful about believing the official rationale, because just before the proclamation came out, the complaint was that Canada needed to be punished for the Canadian wildfires, which is a hard thing to figure out how Canada should stop them. And I think we really have to recognize that this is happening against a backdrop of what is turning out to be a very contentious renegotiation of the USMCA, formerly known as NAFTA, trade agreement governing the U.S., Canadian, and Mexican trade relationship.
How big a deal is that in terms of the amount of trade between the United States and Canada?
People have calculated that it's about $20 billion worth of goods. That's not, a killing blow for the Canadian economy, but it is significant in and of itself. And I think the other thing, what is really important about this is it shows that this is going to be a truly contentious negotiation. It shows that Donald Trump wants to punish Canada, and Canada now has to decide how to respond.
Do we think it's punish Canada or use some leverage on Canada? As I understand it by reports, the United States is farther along with Mexico in negotiating on the USMCA than it is with Canada. I'm not sure Canada's engaged that much. Is it possible this is just a way to get Canada to the table?
I actually, David, agree with you about most things, but I don't think that's a fair interpretation at all. Canada has been ready, willing, and able to negotiate any place, any time. The U.S. did not have to impose tariffs to get Canada to negotiate. Canada wants to talk. Canada wants a deal. In fact, Canada has made a number of concessions, sort of bargaining against itself in advance, I guess, to show willingness to negotiate. Canada last year dropped the digital services tax. Canada has dropped most of its retaliation against the illegal and unjustified U.S. 232 tariffs.
So there you have it. We're all becoming experts on this. And of course, Chrystia Freeland already was. And you can catch the full conversation with David Weston. Bloomberg Wall Street Week starts 6 p.m. Wall Street time, as we say here on Bloomberg TV and radio. Extending our conversation now on tariffs, geopolitics, and diplomacy with a very special guest here in our Washington bureau today. And it's Ireland's ambassador to the United States, Geraldine Byrne-Nason, with us in studio. What a treat. It's great to see you, Madam Ambassador. Welcome to Bloomberg.
Thank you, Joe. Great to be with you.
Can I say right on the air, you throw the best parties in Washington, D.C., not that I would be at any of them, but your residence and your embassy are very important venues for diplomacy and the application of soft power. Before I get to tariffs here, does Irish diplomacy work with the Trump administration?
I'd like to say Irish diplomacy works with any administration anywhere. We have been very lucky here in the United States over a very long time, 100 years of independence, to have good relationships across the aisle. And we work in good faith and sincerity with every occupant of the White House.
Well, I tell you, I want our audience to know a little bit about you, because we talk to ambassadors, but then there are career diplomats who are experts in statecraft, and you're one of them. You served as Ireland's ambassador to France and Monaco. Had to be the best job you ever had, but you can tell me about that later. You were appointed to Ireland's permanent representative to the UN, which we're going to ask you about. You secured a seat for Ireland on the UN Security Council, which was a huge deal for your country and for the UN. You spoke at the DNC in 2024, a speech that we all remember. And for one that's close to my heart, I just saw this on your wiki. You marched with Richie Neal at Holyoke Mass in the St. Patrick's Day Parade? No one knows where Holyoke is, Ambassador.
It's the center of the world on St. Patrick's Day, that's for sure. I've never seen the St. Patrick's Day Parade quite like it. Six deep on the deck chairs cheering on the Irish in Holyoke, Massachusetts.
Pretty remarkable. I'm sure the chairman, now ranking member, loved that. With everything that I just said here, you have been around the horn when it comes to diplomacy. How do you manage a cycle of tariffs that the president is announcing today? Does this strain the relationship?
Look, this is a challenging period for us internationally, but particularly economically. And no secret, Ireland, the European Union, doesn't think tariffs in general are a good idea. I just saw the latest news on tariffs as I arrived here to speak with you, Joe. Overnight, the administration had made an announcement around a 10% global tariff. And frankly, we in Europe welcomed that as good news.
Really?
That was positive. Last year, President Trump and President von der Leyen of the European Commission agreed an EU-US trade framework. And that set tariffs at a ceiling of 15%. So last night, when I saw the 10% announcement, I thought, that was good news. The EU would be below the ceiling of 15% tariffs.
Okay.
We know it may not be the end of the story, but it was positively received. Just now, there has been an announcement that links tariffs with a fine or a series of fines that have been applied in terms of the European digital markets. And that changes the conversation. It's disappointing.
Well, I'm going to ask you about that in a moment, because that broke since we came to air and since you've been in our bureau. So I want to be fair as we read through this. This Section 301 tariff that was implemented this morning is based on forced labor. Forced labor in the supply chain. Does the EU have something to worry about there, or how do you respond to that?
No, look, I mean, frankly, the rubric under which the decision was made, we would take issue with.
Yeah.
However, as I've said several times in any contacts I've had with US business, and I reflect Irish and European interest here, we want a stable, secure, predictable trade relationship with the United States. Yeah. The EU and the US trade over $4 billion a day. There are 4 million jobs that go with this relationship. 30% of global trade is between the EU and the US. This is in all our interest to stabilize it. So having that trade agreement and that framework makes good sense to us. The 301 was an instrument that I think this administration had to choose. The court threw out the last instrument. We're not recognizing that it has any implications for EU policy, but the actual framework in terms of the tariff level, as I said, was broadly positively received last night.
He writes on Truth Social, the European Union is at it again. And it's important, we should note, by the way, that this is an important time for Ireland as you currently hold the rotating presidency of the Council of the European Union. He's essentially accusing the EU of theft, robbing American companies. And to your point, it refers to the fines on Apple, Meta, Google, and Amazon, and others. He's announcing a 301 investigation into what he says the practice of robbing American companies and in turn the American taxpayer. How would you respond to him, and what do you expect this investigation to uncover?
Well, look, as you said, it's just breaking news, so I won't have a definitive response. It's disappointing given the overnight news. What I will say is what I think the president is referring to there is the announcement this week about a fine on Google for market practice under what's called the Digital Services Act. That's an act that is essentially about avoiding market abuse, protecting small and medium-sized companies or startups in a market where you have huge actors who may take advantage of scale. The other companies mentioned have previously been found by independent investigations, European courts, to have abrogated the rules in the digital European market. This isn't extraterritorial. This applies only to companies who come in and operate in Europe. They do that because it's profitable for them and because it's good for US business and for US taxpayers. You know, we do not discriminate. I think you will have seen last week there was a fine against AliExpress, a Chinese operator. European companies have been fined. It happens to be US companies that the president is referring to. It's non-discriminatory. The European Commission, Ireland, of course, has its faith and trust in the work it does in terms of managing the market. So we have no qualms, and we will hopefully get to a dialogue and to discuss exactly what the president means by this. The European Commissioner for Trade, Mariusz Šefčovič, works very closely with USTR Jemison Greer, and I'm sure there will be conversations very quickly today about that.
Yeah, wow, really interesting. I can't imagine you ever thought you'd have to be an expert on the tariff regime, but here we are. Could you work out a trade deal in our remaining moment with the United States at the Irish Open? This is going to happen at his I'd
have a good run at it, I have to say. Yes, the president's Doonbeg, beautiful golf course.
Will you invite
will
him for
host
that?
The president has been invited to Ireland every year by the Taoiseach, and so we think he may well want to be on his own golf course. We have no confirmation yet. I look forward to being in Ireland around the same time as it happens.
Great, okay.
Great players like Rory McIlroy, Shane Lowry are going to be on the course.
You don't think he can resist being there for that? He's going to have
probably irresistible, but we have to see. We have to see.
Madam Ambassador, it means a lot for us to have you. I know you spent some time in our newsroom beforehand, and it's great to have you here in studio with us on Bloomberg TV and radio. I thank you so much. Geraldine Byrne-Nason, if you're in Washington politics, this is one of the folks you turn to at times like these for insights and analysis and soft power, as I mentioned. Ambassador, thank you for being a part of our conversation. I'm Joe Matthew in Washington. I'll meet you on the late edition of Balance of Power at 5 p.m. right here on Bloomberg TV and radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio. television, and Bloomberg Originals.
And a very good afternoon, everybody. Yes, indeed, you are watching across Bloomberg platforms, and this is Bloomberg Business Week Daily for this Friday. Carol Master, Tim Stanovic, live here at Bloomberg headquarters in New York City on a day where markets a little bit of a mixed trade, kind of assessing some of the earnings we got overnight, assessing the war, and assessing another round of tariffs.
We're going to have more from Charlie Pellet in just a minute. The S&P 500 up 0.4% right now. The NASDAQ Composite down 0.1%. The Dow down about half a percentage point. Oil, we did see Brent actually fall below $100 a barrel, about $96 a barrel right now. WTI at $89 a barrel. Still, Brent's up about 30% just this month, Carol.
Yeah, so a little bit of context, right, in terms of pressures. We're going to get into all of that. Hey, ahead this hour, kind of what is old is new again, kind of that kind of theme, if you will. So welcome back tariffs.
I mean, very old if we want to go way back.
We just want to like kind of deal
right?
in the world of President Trump. Also, welcome back Intel, welcome back software despite AI. Of course, on tariffs, President Trump rebuilding levies with kind of targeting 60 economies. So we're going to get into that, what it means. There was also just about an hour ago targeting the EU when it comes to some big tech companies, again, under Section 301. So what you need to know, Mike McKee is here.
We also are talking tech, too. You mentioned we're talking Intel. We're talking AI, too. The CFO of Ford is joining us on why artificial intelligence can't do everything yet.
Exactly. Hey, the World Cup may be over. Yes, indeed. Yet the battle of the brands all over the players on and off the field, that continues. We're going to talk Adidas, if you were Matt Miller, versus Nike. So all of that to come over the next 60 minutes.
First up, a check of the day's trade and top business stories. Here he is. Hey, Charlie Pellet.
Thank you very much. We made it to Friday, and we got some familiar themes for this equity market right now. Chip makers, they are declining today despite Intel's solid outlook. We've got oil retreating, and that is sending stocks higher. Let's begin with the Dow because the industrials are up 271 points right now, up by about 0.5%. S&P higher by 25 for the S&P 500 index. That is a gain of 0.4%. NASDAQ and the NASDAQ 100 index, however, they are both declining. NASDAQ down now by 0.1%. The NASDAQ 100 index down 0.5%. This after earnings from Intel. That stock down now by 4.4%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, it is down now by 3.1%. All of this with the VIX, Wall Street's fear gauge, just above 18, a 10-year at 4.67%, the 2-year 4.32%, and the 30-year 5.16%. Gold at $4,063 the ounce, up by about 0.3%. Crude, major story, down 3.3% right now, but holding right around $89 a barrel on WTI. Barrel of Brent just above 96.34 on Brent, down now by 4.3%. This time yesterday, we were talking about Brent trading above $100 a barrel. Chip makers, though, moving lower again. I mentioned the SOX, the Philadelphia Stock Exchange Semiconductor Index, down by 3%. Intel bears repeating, down 4.1%. Among other chip names, NVIDIA up 0.5%. We've got Micron down 6.1%, and Broadcom lower now by 2.2%. Recapping, S&P holding onto a gain, higher by 24 points, up 0.3%. Carol and Tim, that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, let's get to it, folks. Deja vu all over again. The U.S. extended a 10% tariff baseline, hitting most major trading partners, prompting pushback from countries around the world while shoring up a protectionist wall that's been a top priority for President Trump despite its unpopularity at home. Man, like I said, deja vu. Weren't we here a year or so ago?
Yeah, we were. But this time it's different, we're at least told.
It is. All right.
There's a different legal challenge, too.
Yeah, and we should just kind of layer on top of this. President Trump, just about an hour ago, taking aim at EU funds against Apple and Google, threatening tariffs against the region. The president says the U.S. is starting a 301 probe into EU actions on U.S. tech. So there we have it.
Yeah, we got Mike McKee with us, Bloomberg News International Economics and Policy Correspondent. He joins us here in the Bloomberg Business Week studio. Mike, I have trouble keeping track of all of these. Fortunately, you're here to set us straight. People are familiar with the Liberation Day tariffs from last year, struck down by the Supreme Court. I'm still waiting on my refund check. I don't know if you've gotten yours.
No.
Okay. You haven't gotten yours
You're not likely to get one. Don't wait too long.
Okay, we'll get to that. The new tariffs that were laid out yesterday, 4:57 p.m. Wall Street time. How are these different than what the president did last year?
Well, the president did the Section 122 tariffs after the Supreme Court struck down his IEEPA tariffs, which gave him the ability to do 150 days of tariffs at 10% around the world, and that expired at midnight last night. So today they announced these new Section 301 tariffs, which is basically an effort to recreate the tariff levels that they already have. In this case, they're arguing Section 301 allows tariffs on national security grounds, or if the U.S. is party to treaties and people are not keeping up with the treaties. And it's kind of that part that it falls under, because the U.S. is accusing these countries of either using forced labor to produce things or not policing the companies that they're importing from. And so then they've levied 10% to 12.5% tariffs on these people, which is the same as what we had before with the 122s. So it doesn't change the tariff level, maybe a little bit for some companies, but in general keeps tariffs at about where they are.
It's just a different justification.
It's just a different justification that they hope will be legal before the Supreme Court. But while you were talking, we just saw a headline that some companies have already filed suit against the president on those tariffs, arguing that they're just an excuse for the tariffs that were already struck down as illegal by the Supreme Court. So we're back where we were, as Carol was saying, the deja vu all over again. And now we have these other threats today on from the president on the 301 tariffs, arguing that it's not fair to American companies that the EU can fine them for breaking EU law.
Yet, some would say if the U.S. felt foreign companies were breaking the law, right, we would do that.
Well, of course.
We would impose fines.
Of course.
Okay.
But you're trying to be logical.
Okay.
What are the I mean, is there a does it stem from forced labor in China? Is that where all of this stems from?
Yeah, what is that
No,
about?
not necessarily. I mean, there is, and Bloomberg's done some award-winning reporting on this. Forced labor, basically slavery around the world in many, many, many countries, particularly in Southeast Asia and some in Latin America, where and Africa, people are just forced into producing for workers, and it can be actual slavery where you're imprisoned and you're made to do it, or it can be economic imprisonment, basically.
But are there? I mean, is it legitimate? Does the U.S. have a legitimate way of actually proving that these countries are doing business with companies that are using forced labor?
With a 301, you have to do an investigation, and so the administration has a written justification for these countries. Now, I would put some of it certainly under stretching the law as far as it will go. The United Kingdom, for example, or Canada, but there are some legitimate uses, and so we'll have to see how legally this all plays out. But what's happening is the president is using these, and he's going to put the tariffs in place, and they will be in place while whatever legal battles go on.
So essentially a mechanism for imposing these tariffs while everybody figures out really what he can or can't do.
Right.
Essentially. Right. So the Supreme Court ruling, like you brought this up because you've been talking with some of your buds or last night, who were like, how can the president do this, right? With coming after the Supreme Court ruling. This is just a reminder that he has different levers he can pull.
There are different levers, and there's a lot of disagreement about which ones are legal. And the court basically ruled in the IEEPA case, the very first Liberation Day tariffs, that Congress didn't give him the right to impose broad-based tariffs like that. That what Congress did was say the president could impose tariffs on case-by-case basis when there are obvious violations of U.S. law. So there's some grounds maybe to look at this broad 301 effort today as also problematic for the president, but it's going to be up to the Supreme Court to decide.
And what would the timeline on that potentially be?
Well, you're going to be talking probably sometime late next year, if then.
Okay, so let's push forward to the Fed next week and sort of the inflation.
Well, let me just mention one thing. There's another 301 in process for overproducing goods, which is similar to the idea of the dumping that countries are doing. And that one the president may add on to the tariff levels So we may see tariffs go up from the
bit.
10 to 12% range, even higher.
So are tariffs inflationary?
They are, but not to the extent that we thought they would be, in part because the world has changed, but in part because a lot of the people who were tariffed, the businesses doing the importing, absorbed some of the tariffs, and then they were working off of inventories that they'd stocked up on because the tariffs were coming. So the price changes didn't hit people all at the same time. Now, you saw today that Qualcomm said they're raising their prices by double digits. So maybe we're going to get a bit more of a reaction now, but in the grand scheme of things, they weren't, to take it back to where you want to go, they weren't the kind of level of inflation that the Fed would worry about at this point.
But with Qualcomm, that would be like what Apple did as a result of prices, right? Not
that falls under the category of
as a result of
supply and demand. There's more demand than there is supply for AI goods,
Right.
And that's something the Fed mentioned at their last meeting that they were concerned about in terms of inflation.
30 seconds, something really important before you leave. Most read or among the most read stories on the Bloomberg, LeBron James, a Laker no more.
A Laker no more. His contract is not going to be inflationary because he took a very low payday in order to join the 76ers, and hopefully he leads them, hopefully he says he leads them to another championship. I'm sure anybody who doesn't live in Philadelphia doesn't have the same hope.
Yeah, I know we have some folks on our team from Philadelphia, and they were pretty happy, I think, about this. Mike, thank you so much. Really appreciate it. Bloomberg TV and Radio International Economics and Policy correspondent Michael McKee. All right, now let's get to the comeback kid, and by that we mean Intel.
Yeah, Bloomberg's Ian King writing, Intel's long-awaited turnaround is in progress now that the AI data center boom is fueling demand for its chips. And yet, Intel shares, they actually reversed an initial advance that came after the company's third quarter forecast was much stronger than analyst expectations. Those results, Carol, highlighted both the durability of AI demand as well as the success of Intel's turnaround.
All right, we want to talk about that also. We just talked about with Mike about President Trump out on social about EU fines against Apple and Google. Let's start, though, with Intel. Stock certainly has pulled back from highs that we have seen earlier, certainly overnight and earlier in the session. Bloomberg Intelligence Global Head of Technology Research, Mandeep Singh, is with us, joining us remotely in New York. Mandeep, Intel shares, you were with us. They rallied more than 12% following results. You were here with us. Shares coming back down to earth here, and they are lower as we speak. Post the Intel earnings call, what did we learn? Anything here change your thinking about the results?
Yes, I think the server side obviously was quite refreshing, that fact that they are under shipping demand. But on the client side, that's where the memory prices probably will have a bigger impact in the second half. And that's where I think Intel tempered expectations for how much that client side is going to grow in the second half. And the other thing I would call out is just the CapEx expectations. I mean, they talked about ramping up foundry and yields getting better, but when it comes to financing some of that foundry expansion, it wasn't clear that they have the balance sheet to do it, and if it will involve some sort of equity financing. I think the financing aspect just wasn't clear if they were to raise their CapEx, and that's where I think there was some nervousness around what this means to Intel's balance sheet.
Mandeep, we're going to talk about the week that was when it comes to tech, but before that, and kind of related to that, we did hear from Alphabet, and certainly concerns about Alphabet's CapEx, and people thinking, okay, well, how do we add that into the picture of how all these companies are spending on CapEx for AI demand, and then also the backlog there, and looking at AI demand. Did we get anything from Intel that makes that picture any clearer?
I mean, right now, it feels like every company has to raise their CapEx simply because all the components are getting more expensive. In fact, if you're not raising CapEx, in my mind, that is a sign that you are cutting back somewhere else. And so the fact that Alphabet raised their CapEx by 4% for the full year 2026 is a sign that they are actually taking in the memory prices into account and not curtailing anywhere else. And same thing with, I would say, even Intel, things are getting expensive for them in terms of making those investments. So it's a good sign that these companies are staying on track when it comes to taking the component price increases into effect, and they're not holding back in terms of cutting somewhere else. So I view it positively, personally, in terms of this overall AI infrastructure expansion.
Right. If you're looking for signs of optimism, it's not just about growing backlogs and other things, but it's if you are willing to raise prices and still keep on spending. You wouldn't do that unless you felt like the momentum is going to continue for longer, correct?
Exactly. And look, Alphabet did give us a proof point in terms of their cloud growth of 82% and margins expanding to 36%. Yes, near term they may come down, but that's for a different reason because they're renting from third parties. And so everything, every data point that we gathered this week at least was positive. Obviously, we'll find out next week if the same holds true for Microsoft, Amazon, and others. But the narrative so far supports the AI infrastructure expansion as well as the ROI you are seeing on that investment.
So, okay, let's talk a little more about the big picture and kind of the week that was. We'll if we have time, we'll get to the president's view on tech and tech with regard to Europe. But given that we have 4 more of the Mag 7 next week, Mandeep, we'll hear from Apple. I'm trying to understand the big picture of what we learned this week and what we need to be prepared for next week.
I mean, 2 big things. One is obviously the cloud revenue comparison. And now that, Alphabet has set the bar so high with their 82% cloud growth at a $100 billion run rate, and the backlog that they have shown 500 plus billion. Now, Microsoft will be measured to that bar in terms of whether Azure growth is 40% or 45 or 50. Same thing for Amazon AWS. Is it going to be 30 or accelerating sequentially? Because I think everyone is expecting to see ROI on this big spend in the cloud numbers for sure. Meta, it will be different because they don't have a cloud business, and it'll be interesting to see how they talk about that on the call in terms of what they plan to do going forward. And Apple, to my mind, they are another case of a company that is facing component price increases that, I mean, if I were to contrast them to Intel, which said second half, consumer PCs may actually slow down because of the demand destruction tied to higher memory prices. The same thing should be applicable to Apple. So it'll be interesting to see what they end up guiding to for the second half.
Hey, 30 seconds. Anything we need to know about the president here out on social about EU fines against Apple and Google and looking to kind of go back after the EU? I mean, these nations have a right to oversee these big companies that operate there. Just got a few seconds, 25 seconds.
I mean, very supportive of big tech, both on the EU side as well as the open source models and how they are looking to scrutinize them. So overall, positive for big tech companies in terms of the support they're getting from the administration.
You're amazing. We owe you like an Apple basket or a box of chocolate or something. Mandeep, thank you for always being there for us. Mandeep Singh, Bloomberg Intelligence Global Head of Technology Research. Coming up, we get a view from the CFO suite. We do, right?
We do.
Maybe both.
We get a view, and we also always love when Mandeep joins us. That's next.
We do.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. We've got stocks lower. Stocks trading mixed right now. Oil is trading lower. West Texas Intermediate crude 89.24 a barrel, down now by 3.2%. Barrel of Brent 96.73, down by 3.9%. S&P up 13, up 0.2%. We've got the Dow up 222 points now, up 0.4. Nasdaq lower by 90. Nasdaq Composite now down 0.4%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down 3.6%. Intel weighing on the index. We've got Intel shares after earnings now lower by 5.7%. 10-year at 4.67%. The 2-year 4.32%. Spot gold up 0.2%. $4,059 the ounce. And again, West Texas Intermediate crude down 3.2%. 89.23 a barrel. Price hikes at Qualcomm, the biggest maker of smartphone processors, plans to increase prices by a percentage in the double digits. It's a move that is likely to ripple through much of the tech industry. Qualcomm shares, they are trading lower. Qualcomm down now by 2.1%. Recapping, S&P 500 index higher by 14. The NASDAQ 100 index down 0.8%. And right now, we've got West Texas Intermediate crude 89.20 a barrel, down 3.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcast. I'm Charlie Pellet, Carol, and Tim. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Massar along with Tim Stanovic live here at Bloomberg headquarters in New York City. So we love to check into the C-suite, and we're going to do that in just a moment. And this next company, what's really intriguing is that we've talked a lot about AI and the impact on software companies in particular and the SaaS environment. Bloomberg reporting this week that OpenAI is set to announce that it now has 10 million people using 2 of its agent products, Codex for coding and ChatGPT work, for a wider mix of tasks, nearly doubling usage from earlier this month.
In addition to that, just today we learned that Anthropic is rolling out a new AI model. It's meant to handle workplace tasks adeptly and affordably. It's a key selling point as some customers grow more cost-conscious, and competition is going up from China. A number of AI developers, including OpenAI, Meta, SpaceX AI, are now competing to offer more cost-efficient AI models as businesses increasingly scrutinize their AI spending. Some customers, Carol, have recently imposed tighter limits on employee AI usage after being hit by sticker shock. This is the, should I say, token minning versus token maxing?
We've all been reading all of that. We're having some technical problems, so we're hoping we can work them out because we want to get into this discussion in just a moment. In the meantime, let's just do another check on the market so that we can then get to our guest and our own Nina Trentman, who is in studio with us. We're looking at a market, a bit of a mixed trade right now, just up about 14 points on the S&P. Dow definitely higher, up about 0.5%, but we are seeing some pressure on the NASDAQ 100. It is down about 236 points, down 0.8 percentage point.
Yeah, taking a look at the NASDAQ 100 right now, the stocks that are in the NASDAQ 100 that are making the big moves today and that are weighing to the downside. Some of those neo-clouds, like Nebius Group, down 11%. SanDisk, there's a little bit of a decline in the memory stocks that we're seeing today. SanDisk down a little more than 10%. CoreWeave down 9.2%. We do see some software stocks, though, higher, including Adobe up 6%, Workday up 5.5%, and Intuit up 4%.
All right, so what's interesting, too, is we're coming off a week where we're getting ready for another week where there is going to be some big earnings. We're talking about 4 of the Mag 7 next week. So you've got Meta Platforms, you've got Microsoft, you've got Amazon, you've got Apple. Not all the same kind of company, each of them kind of with a different AI story or AI-related story, but nonetheless, it'll be really important because so much of the market momentum over the last few years has because of these big tech companies.
Yeah, and interestingly, if you look at the Mag 7 and the companies that have done the best so far this year, Apple's actually the one in the lead. Shares of Tesla are in last place, having performed the most. And a couple companies in there are pretty much flat on the year. Alphabet, as of yesterday, was one of those.
All right, so we do want to get to our next guest, and we are delighted once again to get a check-in on the C-suite. As we mentioned, one of the things we find fascinating is that generative AI market, an agentic market in particular. Bloomberg Intelligence has really been focusing on that and how much that will grow, projecting it to grow to $2.3 trillion by 2013. That's the global generative AI market, and a lot of that is because of the rapid proliferation of autonomous agentic systems in enterprise workflows.
Our next guest company has its own agentic offering, supply chain agent, merchandiser agent. With another edition of the CFO briefing, we welcome Gordon Pothier, the CFO of Board. It's a privately owned AI continuous and enterprise planning platform. Gordon joins us from Boston. Also with us, the leader of our CFO coverage, Nina Trentman, Bloomberg News senior editor. She's editor of the CFO Briefing newsletter. You can subscribe to it at bloomberg.com/CFO-briefing.
We have a lot of questions, but I got to say, before we get going, Gordon, would you just kind of lay out what you folks do? Because mentioned that you guys are an AI continuous and enterprise planning platform, which for those in the industry will know what that is. But if you could just lay it out just briefly, and who are some of your big customers or your typical customers?
Yeah, absolutely. And thanks for the opportunity here. So at the highest level, Board is an enterprise planning platform. Realize that sounds pretty generic, right? So I like to think about us as an operating system for enterprise planning. So instead of companies using separate tools for budgeting, forecasting, reporting, operational planning, we bring that together in one platform. We're a system of record, which is very valuable for many of these companies. But we use AI. We just released AI agents recently, and this is really to help support the planning process. It's not really to replace what we do. It's really to help accelerate and support it.
Maybe to follow up here, Gordon, thanks for joining us again. You and I talked about AI and the meaning for your business. You talked about it as a challenge and opportunity at the same time. I'm curious, talk to us about how you're talking to customers about AI and how that fits with your existing business. Like, do you still have a business?
Absolutely. And we certainly believe that we do. I think the conversations we're having right now, I would say, even if a CFO doesn't necessarily believe that AI will replace their planning platform, they're obligated, I'm obligated to ask those questions. My CEO is asking, my board is asking, what can we do here? So the conversations we're trying to have with our customers are really around what are they trying to accomplish? Most of our customers are running sophisticated businesses. They're often global, often public companies in retail, manufacturing, consumer goods. Again, they need a system of record that they can rely on. They need governance around that. They can't have one answer today and a different answer tomorrow because of the way the LLM is responding. So for us, it's very much trying to make sure we're aligning with their expectations, providing that system of record, but with AI agents as a helpful tool, as an accelerator, but not as a replacement.
You know, I don't mean to pick on a company like Salesforce as this example, but it's down more than 50% from all-time highs back at the end of 2024. And a lot of people are using this company as a poster child for the so-called SaaSpocalypse and the idea that, you know, we're going to be able to code something or vibe code something that replaces seats that someone would buy from one of Salesforce's many software as a service products. Is the public market, are stock investors getting this story wrong in your view?
I don't know if they're getting it wrong. I think there is an element of hype, and I think there's an element of just acceleration of where we are today, and maybe where we may be in 5 years. But you know, again, and I think it does depend on the company profile too. If you're a small mom and pop shop, maybe that's possible. But if you're an enterprise class business, if you're a public company, if you're running a sophisticated organization, I don't think a vibe coded solution is really going to provide what you need that's supportable, sustainable over time as your business changes, as you pull in an acquisition or not. It just, there's a lot of complexity that goes into what a company like Salesforce has built.
And just to follow up, is like in terms of conversations with your clients, is this something that you have to argue as board, saying, well, actually, you can't just replace us with AI or an LLM, but this is why? Or is it not really coming up with customers at this point?
I would say it's coming up, not at the argument stage yet, but more at the exploratory. Why should I renew for 3 more years? Isn't this going to be replaced? You know, some of those exploratory conversations. And again, we're happy to engage with those. I think for the most part, the companies that we're dealing with, they get it, but they want to understand. They want to test that theory. They really want to make sure that they're thinking about it the right way. And we feel like we have a really good conversation to have around that, around the sustainability of a platform like Board.
Not argument, but exploratory. Do you anticipate it's going to get to the point where it is more argumentative?
It's a good question. I think it depends. You know, I think even 6 months ago, I think the expectation around what was possible has even changed. In the last couple of quarters. I think one of the things we talk a lot about, we talk a lot internally about, is the concept of just because AI can do something, should it do it? Should you put the reliance on it? In your last segment, you were talking about the cost of tokens. Do I want to put something that I can do some other way? Do I want to put that dependency on AI with the potential for my cost to go out of control later on? You know, those are questions that we need to be thinking about as well. So it's not just the pure capability, it's the should we go down this path?
I mean, you're a CFO, right? You understand that you look at the spend on CapEx, whatever it may be, and you want to see that ROI. You get it, right?
Of course, yes. And this is internally, we're very much in this stage. We went from this, let's roll it out, let's get adoption, let's make sure that we're using these products now, to let's justify the business case. Let's really understand the ROI. Can we measure it? And again, just because we can measure it, do I want to be thinking about this in a year or two now? Will I think about this in a year or two the same way, based on how the costs are trending?
Gordon, the company is still privately owned. You're owned by a European private equity fund. With the IPO markets being pretty strong right now, I'm wondering how the company thinks about its journey forward. Do you expect to remain private? How much are you thinking about IPO readiness at this point?
Yeah, Nina, like we talked about in our earlier conversation, right now our path really is to continue as a private company. But, the way we operate internally is very much from that public company mindset, so we really hold ourselves to strong quarterly milestones, our ability to run a predictable business. We're just in a fortunate position right now where we're very aligned with our PE owner, Nordic Capital, around the direction of the company. And it's really to build a good, strong, sustainable company, continue our expansion path. We're profitable. We don't have a forcing function. We don't need to go raise capital right now. So it's a fortunate position for us to be in. So we can focus really on driving the business. If things change down the road for us, we may consider that opportunity to go public.
But is there a chance that you may never go public? You may stay owned by private equity. You're generating cash.
It's very possible. It's very possible. And I mean, the liquidity markets are, the private liquidity markets are very strong, can be very strong, maybe not right now, but I think there's many options. I think we'll consider all of them, but again, really with the focus of how do you build a good, long, sustainable business?
Gordon, you talked about the expansion of the business as one of the things that you're currently working on. Talk to us a little bit about that. You originated in Italy, but the US is now a very important market for you. What does that entail in terms of next steps?
Yeah, so the history of Board is interesting. It's very much a European history. Our strongest and largest markets are still in Europe, in Italy, France, Germany, UK. And we're actually seeing our best growth continue out of those markets. The US market, the North American market, is obviously the biggest addressable market for us. We're in the market. We've been in for the last couple of years. It's a very competitive space, but we continue to push the growth in those areas. We're trying to do it on our own as well as through partners, which have tremendous influence just in the office of the CFO.
Yeah, I was just wondering, because you did a deal in 2024 and acquired a company, wondering, do you see that growth through partnerships and organic growth, or could you also do more deals?
Both. We're certainly, I would put us in the opportunistic category right now as it relates to acquisitions. I think if something comes along that fits with us, that expands our core platform or allows us into, to better get ourselves into the U.S. market, we would definitely look at it. We're not necessarily running processes, but we're definitely looking as opportunities come up for for those acquisitions.
So, you come to a company, you came to this company as CFO about a year ago, I think a year in this coming August, amid everything that was going on in AI. When you came in, did you anticipate kind of some of the challenges of AI, at least, or the speed or pace that these challenges are kind of coming at companies like Board and others? And how much has kind of it changed since you came on board almost a year ago? Is it all kind of happening so much faster?
It It's a great question. It feels like a very dramatic change, even from a year ago. So, I feel like today we're living in just a very volatile time as businesses and as CFOs trying to deal with this volatility. You talked about tariffs earlier, right? I mean, all of the things that are coming at us, including AI. And I think somehow we as CFOs need to balance the short-term pressure to adopt AI, show ROI and cost savings, but also with our long-term fundamental beliefs on how to scale the business. And sometimes they may marry up and sometimes they may not. But it's a volatile time for sure, and I don't see it ending anytime in the near future.
I'm curious, Gordon, how Board's clients are doing right now. You've got a great view into what these companies around the world are doing at any given moment. We mentioned some of the companies. Others include H&M, Burberry, Toyota, Coca-Cola, HSBC, and others. What can you tell us about what you learn about the macro just by understanding what your customers are doing on your platform?
Yeah, it's a great question. It's interesting because, at Board as a software company, we're not necessarily affected directly by some of these larger economic factors, but our customers certainly are. It was tariffs last year. It's potentially tariffs again. So what we're seeing through them is more scenario planning, more capability to understand how to deal with that volatility. Also looking for ways to trim costs, right? So, and that's where AI, I think, can be a benefit or maybe not. But they're looking to us for help. One of the unique differentiators we have through that acquisition we did was we actually can pull in macroeconomic indicators and allow companies to use that for their forecasting. So that's a nice benefit we can offer our customers, so they can maybe look just outside of their own walls around what else is happening, and ultimately how can they best react to those changes.
Gordon, I know many companies these days are very careful about spending. They're scrutinizing not just AI tokens, but also other licenses, software packages that they spend on. Are you impacted at all? Are you seeing companies clamping down on spending for Board services or not so much?
We're fortunate that we have very high retention rates and we're a very sticky product, but it doesn't mean we're immune to the questions and the pressure. Companies, we're doing it internally at Board. We're trying to renegotiate some of those contracts. How can we bring down the cost here so that I can go fund my AI investment? So we're definitely seeing it. We've been managing it well so far, but we don't take it for granted. We work very closely with our customers to make sure that they're seeing success and they will continue to be long-term customers.
We have questions. One more question here for you before we have to wrap up, Gordon. Yeah. Just wondering from a CFO perspective, one thing that I'm asking a lot about in recent interviews is how do you keep an eye on AI costs as a CFO yourself? Like how do you manage the fact that tokens are expensive and people tend to go through them faster than we all thought? Is that happening at Board?
It definitely is. We've got some pretty detailed tracking around not only the token usage, but also the other tools that we're bringing in to help with our AI story. So we're managing it at a functional level, trying to balance, adoption, like I said before, with ultimately just good cost control. And it goes back. Some of it goes back to, again, just because we can do it in AI, should we? So we're asking those questions and trying to make sure we have a good answer on the other side.
Anybody get cut off?
Not yet, but we're definitely starting to, the ceiling's coming down for sure.
Cheryl, your AI stopped working, right?
No, it's funny. It's a conversation I'm increasingly having with lots of folks about that this is just not going to be open-ended because there is a cost to it. Gordon, really appreciate it. Take care, be well, and have a great weekend. Gordon Pothier, he is the CFO of Board, joining us here from Boston. And of course, our own Nina Trepman. Nina, thank you so much. She's Bloomberg News senior editor of the CFO Briefing newsletter. You can subscribe to it at bloomberg.com/CFO-briefing. New one comes out every weekend.
Hey, in just a minute, we're going to speak to the battle of the brands. Adidas and Nike, the World Cup, and life on and off the battlefield. in the field. That's next. First, though,
Adidas.
Yeah. First up, though, a check of the day's traded business stories. Charlie Pellet is standing by. Hey, Charlie.
Hi, thank you very much. And here's what's going on. Interesting day for the equity market. You look, you got the Dow higher right now. S&P has just turned negative. Yes, down 6 points right now, down by about 0.1%. But you dig beneath the surface, you check the S&P 500 index, and we can see the 364 members are higher right now, 139 lower. Bottom line, though, the S&P down 4, lower, little change, down under 0.1%. NASDAQ 100 index, they are both in the red. They've been lower all day. NASDAQ down 174 right now, down by about 0.7%. NASDAQ 100 index trading lower by 1.1%. The SOX, the Philadelphia Stock Exchange Semiconductor Index, down by 4.4%. This as Intel tumbles 6.3% now after earnings. The Bloomberg Mag 7 index ahead of a couple of key members reporting next week, Amazon and Apple among them. Right now the index is down by 0.1%. The SOX down 4.3%, the 10-year 4.68%, and the 2-year currently yielding 4.32%. Spot gold, meanwhile, up $4 the ounce, little changed, up 0.1%, $4,053 on gold. Crude, big story today. WTI 89.16 a barrel. It is down 3.3%. Brent crude, 96.52. Barrel of Brent down 4.1%. This time yesterday, we were looking at Brent crude trading above $100 a barrel. Bitcoin down 1.6%, 64,083 a token on a Bitcoin. Earnings news. Verizon reported mobility and broadband sales that exceeded Wall Street's expectations in the second quarter. Shares of Verizon today, they are higher by 4.9%. T-Mobile reported yesterday. That's stock up by 6.3%. Earlier in the week, we heard from AT&T. AT&T shares up now by 4.6%. Also out with earnings, American Express, it reported this morning, shares are down 5.3%. Now, Amex said second quarter expenses surged 12% as the company spent more money on marketing to attract and retain those premium cardholders. Again, right now, American Express trading lower by 5.3%. Some of the other stories that we're following today, as I mentioned, the price of crude oil, West Texas Intermediate crude down 3.2% right now, 89.23 a barrel. We've got the oil majors trading mixed. ExxonMobil down 0.1%, Chevron up 0.3, ConocoPhillips up by 0.1%. Tim and Carol, that is a Bloomberg Business Flash.
All right, Charlie, so appreciate Charlie Pellet, of course, with an update on the market. So not what he dreamed of, and you can kind of understand why. And I mean,
it's not because he was a Messi fan.
No, it wasn't about that. I mean, for a sportswear and sneaker company, if you're Nike, having its teams fall short of the World Cup, it's kind of a bit of a bummer, especially falling short of the final. All of it, both teams, not there. None of your teams, none of your jerseys, none of your iconic logo out there around the world where billions were watching.
What about the cleats?
Not there.
Okay. Yeah.
No. Nil.
That's yeah. All right. In the FIFA world, I'm like, you've got the lingo down, Carol. Just wait 4 more years, and then you'll be able to say nil again. Well, the story is really about Nike versus Adidas.
Yes.
We've got Bloomberg News retail reporter Lily Meyer on set with us. Tell us about the Nike soccer boss and his disappointment about what happened over the weekend.
Yeah, so the Nike head of soccer messaged employees and basically said to them, you know, like, thank you so much. This was great, but it's not the result we dreamed of. And as you said, they weren't in the finals. So, yeah, another 4 years and another year until the Women's World Cup.
How big of a deal is the World Cup for Nike?
It's a huge deal. I mean, I think right now every sporting event is an opportunity for Nike to prove to the market and to shoppers that they're dominant. And so I think it's, you know, another opportunity where they didn't shine.
Who would you say, I mean, you think back to like the teams that were in it. Adidas was a huge winner, of course. Also Adidas with the soccer ball, the World Cup ball.
Mm-hmm.
Where else did Adidas win and Nike lose?
I think another big moment this year was the London Marathon. So Adidas had 2 runners who beat the 2-hour goal, a goal Nike had been chasing for quite a while.
I mean, Lily, is it just a case of you win some, you lose some? I mean, I'm sure there's moments we know where Nike's just been plastered, you know, somewhere in a tournament of some sort along the sports universe. Is that just what it's about, or is just Nike having trouble lining up with the right teams, if you will, and kind of staying very relevant to a population that they hope will buy their stuff for years and years.
Yeah, I mean, I think it's a mix of both. You know, Nike obviously can't control what the players do on the field.
Right.
That's out of their scope. But I do think it's a moment where, as a sportswear brand, you want to shine, and it's a missed opportunity.
You've been doing a lot of writing about Nike, and to be fair, we've been talking a lot about Nike with our Poonam Goyal of Bloomberg Intelligence, and just following this. I mean, we got earnings earlier this month. Executives gave a cautious outlook. They warned about elevated consumer anxiety. So once again, we know Nike's been working on a turnaround. They've got a new CEO. Why is this turnaround so tough? Is it just a big ship to turn and kind of move the needle?
Yeah, I think the ship is a great analogy. I think Nike's a huge company. There are lots of areas that need to turn around. I think some areas like running in North America have shown progress, but I think others have been more persistent challenge areas for Elliott Hill, their CEO.
Well, speaking of executives, I'm actually getting some IBs from Tom Thornton over at Hedge Fund Telemetry right now. He says he's long Nike. He reminds us that a new CFO starts next month and comps are going to get easier. This is what he certainly thinks. What's the street saying about what Nike can do? I mean, we went through some of these numbers a few days ago. It has been such a challenge for this company. I mean, I have a couple friends who worked years. They live in Portland, worked for years at Nike. Both of them did, the husband and the wife. One of them left. The other one took a buyout. Neither of them are there anymore. These were like Nike people for life. I mean, it has completely changed.
Yeah, I mean, a lot of executives departed during the John Donahoe era under the former CEO. There have been a lot of layoffs and changes and reorg. So I think, but on the positive, employees really respect and admire the new CEO. I think there's still some hope that he has what it takes to bring it back. So
yeah, I mean, I don't know. You also had another story I just want to throw on top of this.
Shares down about 50% since he's been there since October 2024.
I mean, it's a rough chart. People on radio can't see it, but it's kind of not quite a ski slope to the downside completely. But overall, it's also falling off a cliff at one point and then coming back and then going back down.
Let's keep going with that metaphor and talk about ACG, all conditions gear, because that is a big bet that they're making when it comes to mountaineering, when it comes to climbing, when it comes to trail running and just being outside. Has that panned out?
Yeah, I mean, they used the Olympics to relaunch ACG.
Which is funny because that's not really an Olympic thing.
Yeah, I think it was kind of like the Milan, Italy, Alps
and I guess,
moment,
skiing
outdoor.
And being outside.
Yeah, exactly. Okay. So, but it was super present during the Olympics. I think, it's more present in stores than it was. They did a huge relaunch. I'm not sure we've gotten enough information to tell whether it's really had an impact yet, but I'm curious to see more about the impact of ACG. Clearly, it's something they're investing in.
So what about, we've got about 45, 50 seconds. You also put a story out earlier this week, Nike ending online sales agreements with potentially hundreds of distributors in China as part of a sweeping effort to revive flagging sales in the region. Just real quickly, how does that move the net?
Yeah, I think that's something really interesting that came this week. China has been one of the areas that continues to decline, has really not turned around. And so Nike is saying, we're going to invest more in our own stores and our own channels, and is pivoting away from some of those online retailers in China.
I mean, iconic brand. You think about brands that are out there, right, and logos, but it is interesting to see some of these brands that have been around for a while still have some issues and some troubles.
Listen, in the 7-year-old demographic, I'll tell you that they know about Nike and Adidas quite a bit. If it's got a Nike swoosh on it or the Adidas logo,
that's why I say
the kids want it.
A younger generation, like they go for it. Lily, thank you. Appreciate it. Lily Myers, she's Bloomberg News retail reporter. Be sure to check out her reporting. It is